Welcome back. It's time now to talk about stocks. You're watching Bazaar Morning Call, and our entire research team is ready with us with CNBC TV 18's list of top stocks for the day. But let's begin with the Ekta and the Trump tariff threat on generic pharmas. Ekta.
Well, yes, this morning we woke up with the shock tweet from President Trump that all generic drugs being bought into the US will continue to have a tariff of around 0% for 2 years. This is starting from August 1st, and after 2 years, the rate will be raised to 100% for 1 year and then 200% thereafter. Now, just to put it into perspective, this is how important Indian generics are to the US. 90% of the US market by volumes is generic. And India supplies 40% of generic drugs to the US. Indian pharma exports to the US is valued at around $10 billion at this point in time. And India has the largest number of US FDA plants outside of the US, which is around 670 odd. Now, if you manufacture a drug in India, it costs 30 to 50% less than what it does in the US. And hence, the feedback is that one needs to see how this progresses after President Trump's term ends and the developments thereafter, whether or not this is going to be challenged and what the feedback from the people in the US would be, considering that a generic drug which possibly costs $5 at this point in time will then see an exponential rise going forward, and healthcare costs would then rise. So that would be the key. That is the key feedback that I'm getting at this point in time, that one needs to wait and watch. For now, sentiment negative for the pharma stocks.
Ekta, what you're saying is this is being read as negative because of that deadline, that after 2 years this is going to happen and all the big numbers essentially may kick in, right?
Well, yes, because it's uncertainty, it's negative. Feasibility, unlikely to be as much as what President Trump is saying.
Yeah. So in a way, is there any way to look at it in a positive way? I mean, the point is that it could be a pressure tactic, right? Make more of this stuff on shore, right? That's essentially what this is.
So the other thing is that the details of this particular tweet haven't come out. So while this tweet could just be to possibly test the waters and the feedback that they're getting, and then maybe it could just be that, you want to increase manufacturing into the US, and hence this is what you need to do in the next 2 odd years. This is what they did with branded generic, right? So now we have big companies, the big pharma, which is setting up base in the US much more than what they were doing earlier. So they probably want generic companies to do that as well. It's also a security issue for them. Remember what happened during COVID? There were drug shortages, there were API fears. So they don't want that situation to take place again. And hence, this is also a way to sort of secure themselves when it comes to any possibility of drug shortages going forward. So it's low on details at this point in time, and that's what the pharma industry is hoping on.
Okay, well, it's the carrot and the stick. Carrot for 2 years, and we don't know, right? I mean, remember, in everything that President Trump does, he starts big, and then, he slowly comes down, so 100, 200%, but basically trying to onshore more of that manufacturing, as Ekta is pointing out. Well, JSW Infra, Ekta, thanks very much for that. JSW Infra reported numbers. Vivek has got details here. Vivek, take it away.
Well, good morning. JSW Infra, largely inline set of numbers, maybe a mild negative bias, especially in terms of the volumes to what the street was anticipating. Another important thing that we need to watch out for, of course, is the fact that the stock has rallied quite significantly post the successful completion of the QIP. In terms of the numbers themselves, revenue is higher by almost 18% on a year-on-year basis, EBITDA up over 15% on a year-on-year basis, margins 90 basis points lower, mild negative over there, and profitability down 8% on a year-on-year basis. In terms of the cargo volumes that the company handled in Q1, it was up 6% on a year-on-year basis, partially negatively impacted by tensions in the Middle East, where the company does have some presence. In terms of Navkar Corporation, good performance there. Domestic cargo volumes over there were up 40%. Group cargo volumes, to the JSW Group itself, was up over 13.5%. And the company, the good part is, reiterated their FY27 guidance of revenues of 6,850 crore, operating EBITDA of 3,000 crore rupees.
Thank you very much for that. Back to Ekta, and this time earnings on Anthem Bio.
Well, yes, definitely a disappointing set for coming in for Anthem Bio this time. So year on year, the revenue is down around 22.6%. Q on Q, the revenue has declined around 31.5%. Margins have come in at around 36% versus 43.7% on a sequential basis, and around 35.4% year on year. The profit too has seen a decline this time. Their key bread and butter business, which is basically their CRDMO business, is down 25% year on year. It's down 33% Q on Q. Their specialty specialty ingredients business is down 11% year-on-year and down 21% on a sequential basis. The company has said that the decline in revenue reflects the timing shifts which are taking place in terms of deliveries to key customers. The underlying demand, however, remains strong, and there is higher concentration of scheduled deliveries in the latter half of the year. So they're expecting second half to pick up. They're firmly committed to sustaining revenue growth, which is aligned with their long-term historical performance. So what they're saying is that this quarter was weak, but they're hopeful on the second half of the year.
Got it. All right. Thanks a lot for that, Ekta. Let's hop across to Vinny. She's here to tell us about Sagility. Morning, Vinny.
Hi, good morning. So Sagility, in terms of their numbers, a steady quarter, a decent performance in Q1 FY27 as well. They're seeing a 27.5% growth in terms of revenues. Margins, a bit of an impact coming in. So 22.3% versus 22.5% last year. Profits of the company have seen an increase, and this is despite the exceptional expense that they have coming in this time due to the impact of those minimum wage revisions. So because of that, we're seeing an exceptional item of around 15 crores. So despite that, they're seeing a growth in terms of revenues. Now, what's interesting is that the management has reiterated the FY27 guidance in the con call. Low double-digit organic revenue growth in CC terms is what they're talking about. They're expecting better visibility coming in from Q2 FY27, end of Q2 FY27. The management maintained its FY27 EBITDA margin guidance in the range of 24 to 25% as well for the full year. And they've just said one point, which is a bit of a worry. Management has reiterated that revenue deflation could rise from historical 150 basis point impact to 200 basis point impact and could be higher because of certain factors, but that is an important one. But otherwise, the stock has seen an underperformance in the last 6 months, so maybe some bit of a green is what we could expect.
Okay, thank you very much for that. Manglam is now joining in to tell us how the numbers look from Indian hotels. Manglam.
Well, it's a good set that has come in from Indian hotels. In fact, the company's revenue, EBITDA, as well as net profit are marginally ahead of expectations. So they've reported a revenue growth of 14.5%, around 2339 crores. The street was working with a number of 2300 crores to 2320 crores. The EBITDA at 672 crores, also above street expectations of 655 to 660 crore range. And as a result of which, the net profit at 391 crores, much above street expectations of about 360 crores as well. The good part is it is led by their hotels business, which is up 16% on a revenue basis. And even the EBIT out there is up by 26%. What's actually softened this time around, and understandably, is their air catering business that starred SATs because of lower number of flights that operated in the first quarter because of geopolitical uncertainty. All the internals for the hotels, the signings, the RevPAR growth, as well as the kind of cash that they have on their books point northwards, and which is why we have a lot of brokerage upgrades coming in on the stock this morning as well. Expect green.
Thank you very much for that. I was reading the Nomura note post the earnings call, and they're saying the management expects robust domestic demand to continue into Q2. Domestic demand, particularly leisure demand, is offsetting weak international demand, and according to Nomura, the company is likely to deliver more than their guided revenue growth range of 12 to 14%. So strong Q1, as Manglam pointed it. But let's talk about Bandhan Bank, because that could be the stock of the day on the way down. Disappointing guidance. Ananya joins in with the details, and she'll also tell us about Abbas Financiers.
Well, let me start with Bandhan Bank first. They reported a mixed but steady quarter. PAT jumped 35% year-on-year on lower provisions here. NII grew 6%, was in line with expectation, nothing new here. But the main positive was the asset quality. It improved further. Credit cost easing to 1.8%, while loan growth remained healthy at 18%. However, deposit growth was muted at 6.6%. Margins are expected to stay under pressure here. And the biggest negative was the sharp cut to exit ROA guidance to 1.2% from 1.4%, from 1.6% to 1.8%. The guidance is cut by 40 bips, so that will weigh on the sentiment today. Now moving to Abbas Financiers, the quarter was largely in line. NII grew 16%, PAT rose 23%, while disbursements surged 41% here. Now, however, AUM growth of 15% was impacted by elevated repayments. Now, asset quality also remained healthy despite a slight sequential increase in stage 3 assets, with management reiterating that it is not seeing any stress in the portfolio, but it will be a key monitorable for the investors going forward. Now, the company retained its 17 to 18% AUM guidance and 22 to 23% disbursement growth guidance of FY27. Now, the main catch is the ongoing leadership transition also remains a key monitorable here for the investor.
Got it. Thanks very much for that. Ananya. So keep an eye out on those two names this morning. Cyan DLM is what we're going to focus on next. Upasana has got details here. Upasana, take it away.
Well, overall, the company has reported a strong set of numbers, the strongest ever Q1 performance reported by the company. Now, if I talk about the numbers, revenue stood above the street estimates, while margins and PAT largely in line with the street estimates. Now, the revenue growth was led by company's industrial segment, which saw growth of 87% on year-on-year basis. Aerospace registered a growth of 41% and defense 34% on year-on-year basis, while defense and medtech remain largely flat on year-on-year basis. Now, if I talk about the order book, it stands around 2,600 with an uptick of 22% on year-on-year basis and 8% sequentially. And mind you that this order book is highest ever since company's IPO. Now, if I talk about the TTM sales, that stands at 1.9 times. So certainly a healthy order book here as well. Now, revenue stood at 374 crore with an uptick of 35%. Gross margin took a hit because of the higher input cost, down about 230 basis points. EBITDA margins up 150 basis points at 10.5%, and PAT saw an uptick, which is more than double because of the strong revenue growth and healthy product mix. So overall, strong set of numbers, but the stock saw a huge run up, was up nearly 4% yesterday. So let's see what happens today. But overall, going with green for now.
Thanks a lot for that, Upasana. Hopping across to Sudarshan. Sudarshan, tell us about Gabriel India.
So two things have happened for Gabriel India. One, company has announced the earnings. Earnings look steady in Q1 FY27. Also, company has announced the acquisition. It's going to announce acquire promoter stake in HL Mando Anand India, and that acquisition will be done from Asia Investments Private Limited. And total value is more than rupees 2,231 crore, and funding will be done via cash and preferential allotment. Now, after this acquisition, AIPL stake, or say Asia Investments Private Limited stake, will rise to 46.98% from the current holding of 42.67%. Talking about the earnings, revenue, like all the other auto manufacturers, has seen a double-digit growth of 16%. EBITDA too has seen a jump of 5%. Margin, because of increased input cost, has come down to 8.7% from 9.6%, and gross margin too has slipped to 25.7% from 27.1% in the same quarter last year. Just talking some details about the acquisition, it's going to acquire 29% of HL Mando Anand India from Asia Investments, and price is 463.70 rupees per share, and will also allot equity shares to promoter Asia Investments Private Limited on a preferential basis, and the allotment would be worth almost 1,900 crore at rupees 1,306 per share, and remaining funding of 350 crore will be done via cash. I'm going with green just because stock has run up in 2026, up almost 50%. This month, up almost 20%. So, in the anticipation of this, stock had seen a huge run up, but fundamentally, this deal is positive. EPS accretive up to 13%.
Okay, all right. So thanks very much for that. This is Gabriel in focus. Anantraj has announced a split of business, and the data center business is being put into another company. Shares will be issued to existing shareholders of Anantraj. Ria has got details here. Ria, take it away.
Well, yes, that's right. Anantraj has announced that it will be demerging its data center business in order to attract investors as well as new strategic partners. Now, this will be creating two independent focused listed entities. The first one will be Anantraj Limited, which will be focused on the real estate business as well as the infra development segment of the company. And the second entity will be Ashok Cloud Private Limited, which will be dedicated to next-gen data centers as well as cloud services, including their AI workload segment as well. Now, in terms of the revenue scale of both of these companies, the FY26 revenue for the real estate and infra business was nearly 1,492 crores. And for the data center business, the FY26 revenue was around 136 crores. So on a revenue scale basis, this segment is much smaller compared to the real estate business. But apart from this, the company has also highlighted that all of their data center and cloud operations will be consolidated under one entity before the demerger. And they've also announced a share issuance ratio of 1:1, and the stock expected to open in the green on the back of this news.
Well, indeed, thank you very much for that. The data center business is hot, and Anantraj is looking to capitalize on it by splitting its business. But can't take your eye away from what's happening in the commodities market, particularly crude prices back above $92 per barrel. Manisha, give us the details.
Thank you for that. Well, absolutely. Above $92 a barrel. It's a 6-week high is coming in for the crude oil prices. And this is as the supply risks intensify across major export routes. Earlier, we were just talking about Strait of Hormuz. But now there are concerns at Red Sea. There's a Kuwaiti tanker carrying oil products stuck at Hormuz. And then there have been attacks on Caspian Pipeline Consortium Terminal, which is along Russia's Black Sea coast. So there are various waterways which are getting impacted right now for different reasons. And that is what is bringing premium back in case of crude oil prices. But overnight has been a space where you have seen gains across commodities. So while crude gained, gold was up 2%, silver 4% on the higher side, platinum gained 2.5%. Copper is trading at a 5-week highs with nearly 3% of gains. Nickel is trading at a 1-month highs. Aluminum prices gained 1% overnight. So while there have been individual fundamentals, but the markets are anticipating that you could be looking at stronger demand going forward. The dollar index is off its highs, and that seems to be supporting commodities across board.
Okay, absolutely. And I think one of the graphics which Manisha put out in a segment yesterday, pretty instructive, how much oil passes through some of these important waterways across the board. And as she said, now 2 important routes are hit, the Red Sea route and the Strait of Hormuz as well. We'll take a break. The Granules management on their on the first quarter numbers and the outlook going forward, coming up in just a bit.
Welcome back. You're watching Bazaar Morning Call. Let's invite the first management on the show. That's Granules India. Well, we'll talk to her about the Q1 numbers, but we'll also talk to her about the tweet that's coming from Donald Trump about generic pharma, which will have tariffs of more than 100% first after 1 year and then 200% after 2 years. To discuss this, we have Priyanka Chigurupati, Executive Director, Granules India, now joining in. Priyanka, thank you very much for joining in. Well, let's begin with generic pharma. Does Granules get impacted, and how do you see this play out? Now, from an industry point of view, we know that manufacturing in India is a lot cheaper, 30, 40, 50%. How would the math look? Manufacturing in India versus you manufacture in India and take that hit of a 100, 200% tariff. Take us through the economics, or will companies be compelled to start investing and set up manufacturing plants in the US?
To go straight to your question, I just want to say that I think it's evident that cost of production in the US is significantly higher than the cost of producing products in India, primarily for large volume generic products. Granules is well positioned to tech transfer a lot of products to the US as needed, if needed. And Granules from a US position is also has two facilities right now, and we're also embarking on our journey for the third facility there. But to answer your question straight up, I think it's going to be a huge task if that is actually implemented. But I see that to be close to being impossible at this point, purely because of the cost differential. You're talking at least a 20 to 25% increase in costs, and passing that on to customers will be extremely difficult.
So you don't expect this to go through, even 100% tariff on account of the cost impact it will have on U.S. consumers, and you expect it to get diluted eventually. There will be lobbying from the Indian pharmaceutical industry.
See, I think he's talking primarily about companies that have not onshored any facilities in the US. From that perspective, I'll speak for granules. We are pretty much okay. So I don't know if there'll be the percentage that he's talking about. But there might be a part of it, like he has with other countries. He has reconciled with other countries. So depending on the kind of products and the country that he's in discussion with, I think the percentage will certainly go down.
All right, so the cost could go up as well, and we'll have to keep an eye on the percentage of tariffs. So Priyanka, what about the time factor? He's talking about 2 years. The kind of feedback that I've got since morning is that's way too short a duration because you require approvals, you need to set up. It's going to take many more years. What is your broad estimate?
Well, you answered the question yourself. I think 2 years is extremely short, especially for the kind of products that are going there. But the medium and low volume products, there's different sets of products if you talk about generic pharma, right? So the large volume products, which are extremely dependent, which the US is extremely dependent on, will take a long time. And I don't think it's a practical possibility unless there's a significant change in the economics that the US also provides.
Priyanka, hi, morning. If they follow the template of what was done for branded drugs, the date is. I remember the date was groundbreaking. It was not about manufacturing, but it was about if you break ground and you show that evidence and that's it, and you get that exemption. That is what they did with branded. So I'm not sure, but we don't have details. And in any case, 2 years from now, he's going to be 4 months away from finishing his term, right? Second term and final term. So, how much influence and whether he'll be able to push this through at that point. And so lots of ifs and buts. But you have manufacturing in the US, Priyanka?
Yes, we have one manufacturing site, one packaging site, and now we're also starting our logistics division over there, our warehouse situation. And if needed, we always have the capacity and the flexibility to increase the manufacturing space in our existing facility.
And you said the cost is the difference is 20-30%. I remember speaking with when President Trump took over, we had, I think, the manager on Lupin with us. And I remember the numbers were, I think you're being charitable. The difference is much larger. I mean,
70%? Do you remember?
I remember very
large numbers.
Order of magnitude difference between, what you spend here and what you spend there.
Again, I'm talking about for us, depending on the kind of products that we make, it could go up to 70% also. But it really depends on the type of products that we're talking about.
Got it.
Broadly, what would be the break even? At what point of time does it make more sense to manufacture in the US?
Well, you'll have to look at least, like you said, 50 to 70% increase in costs for the business to be sustainable.
I think, there has to
prices,
be...
my bad, increase in prices.
When I think there has to be robots on the factory floor, then it'll make sense, right? Because I think then
You're right. You're absolutely right. The biggest contributor to that is the cost of manpower and the cost of execution in the US.
Talk to us a little bit about what's happening in the company, Priyanka. Different segments, and just give us a sense of how FY27 is shaping out to be like.
So the first quarter was the highest first quarter that we've ever had in the history of the company. We've had a 22% increase in revenues and a 60% increase in our PAT. So Q1 shaped out really well for us, and we're excited about that. Q2, Q3 also look good, but of course, with the cost input pressure that we have right now because of the geopolitical situations, if you look at it monthly, quarterly, we could see some peaks and troughs. But if you look at it on an annualized basis, I think things will start to normalize again, and the margins will remain.
What's the extent of raw material inflation, particularly on account of crude prices, the Middle East, on your margins in Q1? Will you look to take a price increase, and what's the outlook on margins?
Well, I don't want to give us any specific margin level details, but yes, we are looking to take price increases. We've already received price increases from a majority of our customers. But look, Granules as a customer, Granules primarily focuses on regulated markets, which are tied into long-term contracts where we do have flexibility to take price increases. So we have passed them on to a certain extent. But we have to split costs, the cost differential with our customers for the sustainability of the long-term businesses. So we're not the ones to look for just short-term gains. We'll take a part of the cost differential, but our partners have already taken a lot of it.
All right, Priyanka, so what does it mean in terms of margins? Do you expect margins to pull back a little bit in the near term because some costs have gone up? If you could give us some clarity on that. And also complex generics, that's moved up as a percentage of your mix. Where do you see this number stabilizing at? And in turn, what does it mean for margins?
So again, if you look at the breakdown, 50% of our business today comes from the complex generics, which has increased from roughly about 39% year on year. The rate of increase of contribution of those complex generics will certainly go up in the months to come and the quarters to come. But there will be a little bit of a hit in the legacy business, which we expect to start normalizing by the later half of this year.
Any update on the Gagillapur US FDA warning letter? Any reinspection date?
We're waiting any day now. So we wrote to the FDA last month, and they acknowledged it. And so we expect them to come in any day now. And the good thing is that we have submitted every single update to the FDA on time, and we haven't received any commentary about any sort of insufficiencies. So like I said last time, very positive about how this would shape up.
Okay, all right. Priyanka, we'll leave it there. Thank you very much. All the best, and appreciate you joining us early this morning on CNBC TV 18. Thank you. Okay, well, we'll come back and we'll stay with, pharma. The management of MedPlus is going to be joining us on the other side quickly on the first quarter numbers and, of course, their FY27 growth and CAPEX outlook as well. So stay tuned, coming up. Welcome back. I think we have the management of MedPlus now joining us. So right away on the earnings treadmill, one after the other. MedPlus has reported numbers, but I think they are talking about some changes to their expansion plans, etc. We are joined by Gangadhiri Madhukar Reddy, is MD and CEO at MedPlus. As always, Mr. Reddy, good morning. Great to have you with us here. Thanks for joining us. So I just want to start by asking you flat out that I think you're increasing your CAPEX for the year in terms of how much you want to spend. You're making some changes essentially. So why don't you list that out for us?
Sure. See, as we had earlier said, the store growth continues at the same pace. It'll be around 800 stores. It'll take whatever money it takes, between the franchisee and our own stores. It'll probably be around 25 to 30 lakhs a store. So that's what we have already mentioned in the past. But the new thing which has come in is 100 crore, slightly over 100 crore, investment into a new service. As an entrepreneur, you constantly look to figure out newer streams of revenue for the company in adjacent areas and all. And as long as they are, I would say, giving the same return on investment or slightly better return on investment, we are always looking at it. So this is a new venture for us. We are actually venturing into a little bit of concierge medicine, as I would call it. And that's the investment we're looking at right now.
You're going to be investing 100 crores into this new venture?
Yeah. So this is an all-in thing, takes into account all the losses and all which will accrue as we go forward in the first 6 months and all that. The capex actually is going to be slightly less. There's a sum total of the investment we plan to actually invest in that whole new venture.
Right. And this is this is what exactly are you doing? This is a subsidiary of the company, or you do this? It's a business unit.
This is a separate business unit of the company. It is part of the same company.
Okay. And what exactly are you aiming to do here? You said concierge medicine.
Yeah, that's right. So what we'll end up doing is this. I don't know. I'm not sure if I can really fully explain it, given the paucity of time here. But you can take it as this. We will basically be doing everything outside of a hospital, in the sense that it's going to be a diagnostic center / clinic / let's say the overall. As I said, everything outside of the hospital. It's going to be a center which it's like a health club, where on a membership basis you are given a complete set of care, starting from your baseline healthcare tests in the beginning of the year till you stay as a member. You end up actually getting all access to every single specialist you have, and it's all free of cost. So the membership fee is the only thing which you actually end up paying.
So this is physical new things you'll have to build out, right?
It's one center. It's just one center
in Hyderabad. So this is this 100 crore is for this one center. I mean.
So this, as I said, this includes the full layout of all the startup costs, the advertisement costs, all the other startup losses and everything else. But it is going to be much less. We expect that will actually be fairly profitable fairly quickly.
Sir, morning. This is Rima here. Let me talk to you about your margins. And here I'm reading out a note that we've got from Nomura, where they say your gross profit growth at 14% year on year was the slowest in the last 4 years. Gross margins are down 160 basis points year on year. And most of the decline was an account of lower contribution from the pharma private label, which recorded an only 2% year on year revenue growth. So that's the context. And we can see that in your operating margins. Operating margins at 7.1% for Q1, lower than last year's level of 8.5% and much lower than the Q4 level. What happened on the pharma private label front, and what can you guide going ahead?
So on the pharma private label, if you actually look at it, the year-on-year absolute numbers have gone up, but as a percentage, it came down slightly, and that is because we have actually pushed a little bit more on the brand side and all. We have basically taken out the emphasis purely on private label to basically saying that we're going to sell everything. So that's one. But outside of that, the war situation also caused a little bit of dip out there because supplies did not come in time. There were a lot of variation. Most of the cost of private label medicines or private label general goods is all through packaging. And since the packaging costs were going up and down, we had some supply issues on both our medicine as well as the general goods side. And a combination of, let us say, supply side thing and our own emphasis on making sure that our top line is going up, our branded sales are going up, and we're making sure that the incentives to the employees were fully aligned with the interests of the customers. We saw a slight dip, but that's a temporary thing. We expect to actually come back.
This emphasis away from your own private label, is it just a 1-2 quarter thing because there is a cost escalation on account of the Middle East tension, or is this something which is going to linger because margins on your private label would be higher? So will that have any margin implications, sir?
No. See, as long as we bring back the private label sales, I don't think there's going to be any long-term implication out there. I think this is going to be a temporary thing for us. We are, getting back the private label both in the pharma side as well as in the general goods side. I don't think that's going to be an issue.
So private label mix, just to complete the point, continues to go up by 20-30 basis points every quarter. That's what you told us last time.
Yeah. See, the early adopters all came in. Most of them bought the private label. The guys who got converted, fairly quickly. And now it's, I would say, a little bit of consolidation. We expect to actually start seeing the growth now that the supply chain is back, at least to its full efficiency. And this will basically start actually going up.
Right. Just two questions. Would you just leave us with the guidance for the? I know you don't usually put out a number, but broadly, what should we expect for 27?
as you said, I can't really give you any guidance at this point of time, but it really should not be very different. For the year, I think we'll continue to, get the number of stores up, get the margins on the private label up, get the percentage of private label up, and get the overall margins up. So a lot of the things which we have seen this quarter were a result of not just the private label thing, but also because of the slight increase in wages across Karnataka and Andhra. After the new labor code came in, the wages went up in Karnataka by nearly 50%. So we have seen a little bit of that shift there. So we have seen a little bit of taken a little bit of hit on that, but we are adjusting some of our other things to make sure that this is taken care of. One thing which we have done is readjusted the discount slightly, decreased it by 1% to a majority of the people, one of the schemes out there. So we are making corrections to make sure that this is taken care of, but I can't tell you, where exactly we'll be with, but I don't see any problem, as we go forward. We'll probably make up the numbers in the next 3 quarters.
Got that. And will you set up more, just to complete and wrap up with what I started with? Will Hyderabad be the first health center, and then you will kind of sort of, do this in other cities as well?
So this is a pilot project. As you know, we did one more pilot in the past. It worked out decently, but not to the level I wanted. Our diagnostic center, it has now become profitable, but it did not really take off in the way we expected. So we actually let it be. So we are fairly disciplined about any new kind of project which we take up. We will see purely based on the data how we should actually take it forward. I am, of course, super confident that this will do very well. But, we are guided by the board. We have some metrics which we need to hit before we take a call on whether we actually make more investments.
Got it. Thank you very much, Mr. Reddy. Appreciate you joining us and running us through the plans afoot. Some new, of course, some on the earlier path in terms of trying to improve some of the matrices across segments. As you said, private label, of course, is one of them. Well, I think we'll take a quick break. 2 managements before 9 a.m. More coming up. We're about 7 minutes away from the pre-open session. We'll connect with Devin for a fundamental stock check in terms of what he's focused on. Lots of other earnings have come through as well. Sudarshan and Mitesh on technical trading idea. Stay tuned.
Welcome back. Well, let's welcome Devin Choksi, MD of DR Choksi FinServ on the show. Hi, Devin. Good morning. Good to see you win. Devin, tell us, how do you approach these pharma stocks today? There could be a bit of a knee-jerk reaction, but people are now questioning whether or not this implementation after 2 years, is possible. And, various question marks. It's going to increase the cost of production. The timeline that's given is not viable as well. So implementation may possibly not see the light of day. In that case, how do you approach these stocks? And do you look at select winners? Probably an auto pharma that's done an inorganic growth out there. Probably a Synerest pharma as well. Could be relatively better placed. Your take.
And Nigel, good morning. Well, for us, I think nothing has changed beyond the point. Yes, I do agree that I think at one level, the cost adjustments factor will have to play its role. And maybe I think as we have seen in past, most of the companies have been successful in passing over this particular cost, I think in whichever format in which they operate. So frankly, I think we have not yet gone into that space where probably I think things are going to be completely no reversible situation. Second most important point, I think most of the Indian pharma companies, in particular the frontline pharma companies like Sun, Cipla, Dr. Reddy's, etc., they are relatively much stronger as far as I think their supply side situation is concerned to the market. And that's where probably I think we see the situation remaining relatively more stronger. Companies in API and CDMO space, I think relatively remains much more better compared to I think the other ones because they have a cost pass-through mechanism at the same time in various situations. So in my viewpoint, I would think that these things do not change beyond a point. On the contrary, if some of these companies which are already quoting at a lower valuation currently, if they start getting available in the market at further lower valuations because of the price correction or the knee-jerk correction as we want to call it as, probably I think we may get an opportunity to buy them into the portfolio.
Yeah, no, absolutely. And we'll see if you get that sort of dip opportunity as we open up this morning. Lots of opinion, of course, coming through here. What else, Devin? Lots of other numbers, right? Bandhan, any thoughts? Reported earnings and, there have been believers backing, well, maybe the story is turned and the cleanup is underway and all that has been underway. But as part of it, the ROA guidance has been brought lower by Bandhan, and many are pointing to that as a big negative this quarter. Any thoughts?
Yeah, Prashant, I feel that I think some of the larger banks would be or should be in a preference choice, I think, comparatively for two, three reasons. FCNR deposits, I think, is strengthening the books. And as we have seen in the quarterly reported numbers for some of the private sector banks, their corporate loan book has actually shown up a distinctly higher amount of growth as compared to the retail book. So I guess I think the majority of the corporate money demand is now happening, which up till now was anticipated, but now it has actually started happening. And the companies have started reporting 15 to 18% kind of a loan book growth in this kind of situation. So the larger banks remains a strong candidate as far as reporting the higher numbers are concerned in the remaining 3 quarters of this financial year. And that's where we believe that I think likes of HDFC to Axis, we will have relatively much better numbers to talk about in this financial year. And that's where our focus would stay with them. Also because of the fact that these companies are available at a valuation where the downside risk definitely is, I think, much more protected. And today in this market, if I see this situation of downside risk getting protected, it's a better opportunity to consider into the portfolio.
Two other names, right? Actually, one, TVS, 5% move yesterday. You think there'll be a follow-up? Commentary has been pretty solid on the call. Numbers were great. Bajaj also reported, and Bajaj also has actually done well. Couple of upgrades. I don't know if you have any thoughts on either of these two. And the other one from, again, financial services is M&M Finance. Reported numbers in the last hour. Stock went up sharply, 7-8% higher. Your thoughts, Devin?
Yeah, Prashant, I think both Bajaj as well as TVS, both of them have reported significantly large amount of numbers on the export side. And currency appreciation one part, but more importantly, I think higher amount of tractions which they are seeing in different other markets of the world is definitely giving them an advantage. Bajaj in particular, after having the majority stake acquired in KTM, is now fully integrated into Bajaj Auto, and the numbers are distinctly showing different picture as against, I think, only reported numbers based on the sum of the parts. But here out, actually, I think the full numbers are getting reported because it become part of the company. So to a greater extent, I think if you even minus that part, then also the new vehicle launches along with the exports, both of them are giving a significantly high age. In fact, I think 30% of the total business coming in Bajaj is coming from electric vehicles, which is profitable now, which definitely gives you a good confidence. So we feel that both Bajaj and TVS, both of them have upside to capture now from here onwards.
Deven, any view on agility? The numbers look quite good. The growth on the top line, if you look at it on a year-on-year basis, was up 28%. Margins were maintained more or less. What's your view on this name?
Not yet sure, Nigel. I think haven't been able to capture, I think, the company's numbers. I think.
All right. What about gold finances? Gold had dipped below $4,000 per ounce, and now it's popped up again. Overnight we saw a bit of a spurt on that one after the sharp correction. So any view on gold companies or the gold financiers? Would you be looking to buy these names? And also, if any view on Hindustan Zinc, the other stock that's seen a sharp correction, but silver suddenly is shining again.
Yes, so to leave aside this volatility in the bullion prices, gold and silver prices for a while, but overall, I think the gold finance companies are seeing a good amount of traction also because of the fact that the replacement of jewelry, which scheme which has started by most of the companies, this is basically giving a good amount of opportunity to some of these financing companies. The collateral part, I think, is becoming much more stronger in such situation when I think the swapping is happening from the old to new jewelries. So to a greater extent, I think this particular business is likely to continue on a growth which is also fueled by the larger amount of disposable income in hands of people. So come festive season, we should be seeing a relatively better festive season for these companies going forward.
Yeah. Yeah, I mean, I think numbers should be good this time around across the board. IT services, have to ask you a quick one. Any thoughts, Devin? Had a bit of a bounce over the last 2 weeks for IT stocks. Infi reports numbers tomorrow. Should be interesting to watch. Anything there?
Downside in the stock price, I think, is fully now captured, I believe. And I believe that in most of these companies have shown the path of having higher amount of intake in form of the order intake in form of, I think, the AI based projects, I think, which are coming in. And I think TCS kind of company has also started showing, and HCL too, I think, have started showing relatively, I think the indication has started coming about changing in the revenue model just from the time and effort basis billing system to outcome based billing system is something which we are going to be experiencing. So next 4 to 6 quarters or 8 quarters are going to be very interesting for some of these companies when they transit from one end to another end. We remain comfortable because most of these companies are today available at below the intrinsic value. And that's where probably downside risk is protected. So we remain comfortable into these companies with a target that 15 to 20% upside is distinctly possible over next 3 to 4 quarters.
Well, Devin, we'll leave it there. Thank you very much for joining us. Good speaking with you, as always. Well, just quickly...
IBM, by the way, reports numbers today. You remember the profit warning that IBM gave last week? So today the official numbers come out, and last week when IBM gave that profit warning and Arvind Krishna spoke about how enterprise tech budgets are getting crowded out and therefore the company is losing out on the mainframe, the stock had fallen more than about 25%. So the actual numbers, the conference call will be very critical.
And Google as well, right? Which is the other one, which kind of is a test for all this AI spending and whatnot. All of this, of course, also happening in the backdrop of all these Chinese models and questions once again about ROI and what will all this spending yield. Just to quickly look at Bandhan Bank in the pre-open. This is still, there's still about 3 minutes to go for the pre-open, but Bandhan, I think, is opening about, it's down 10%. 187, 188 on Bandhan. Look at TVS in the pre-open. Maybe is there a day two kind of a move coming through there? It's up about 1 1/3. Bajaj, let's just put it up. M&M Finance, take a quick look at it. Sagility, I think, is opening slightly higher. Report a decent set of numbers. M&M Finance is up 3%, another 3%, I should say. Sagility is up about 1.8% or so. Anthem Bio is another one, right, which reported numbers. And you'll hear from the management, by the way, a little later on the program. and Anthem is down 3% as well. So yeah, 771. So just a quick read through in terms of how these stocks are trading opening. Sudarshan is with us and so is Mitesh. Gentlemen, good morning. Good to have both of you here. Apologies. We had two managements to get through with their numbers, etc. But Sudarshan, how are things looking? Oil's at 92 now and it's flashing red.
Yeah, good morning. Well, things are looking better for me in Delhi. It's raining finally, so I hope the monsoon has come here. But for the markets, they are very indifferent. Now, see, this is a very choppy market. In a choppy market, the best trade is to have one single view, and you don't know if that view will work out or not. But rather than keep on switching from long to short every now and then, take a view and fix it. The choppy market will tell you whether it was right or wrong. So the view is hold on to your long position with a stop at 24,000. If that level is breached, get out and then do nothing. Till that level holds, be long.
Okay, fair enough. Mitesh, would you concur? Last week on Friday, we got a sense that perhaps markets are breaking out on the way up, but then we got wedged back into the trading range. Sudarshan says, keep the faith, stay long. What would your advice be?
Good morning. I think exactly, what has happened. Friday, I think the Bank Nifty closed above 58,450 and just above it. And then on Monday, we kind of just opened below that. And as you rightly said, the Bank Nifty came back into the range and the Nifty never actually closed above 350, 400 zones. So it's a range in that sense. And being a range typically means that the next buying area should be at the lower end of the range, which is now shifted to about 24,050 zones. So maybe in a day or two, if we get a level close to about 24,050, long positions can be explored. And again, on the upside, 24,350, 400 would be the first target.
Okay. What about stocks, Mitesh? What would you go with?
I have three buys and a sell. On the buying side is UPL with a stop at about 605, half for a target of around 640 to about 645. Buy on HAL on a mild pullback, say if you get it around 45, 60, 50 zones. Buy with a stop below 4505 or 4500. That's the support pivot and look for a target of 4680. Eicher Motors managed to get past the earlier highs, so that's a buy with a stop below 7620 for a target in vicinity of 7850. And one sell call, that's HDFC AMC. Keep a stop of about 2633 for targets of around 2480, which could be tested in the near term.
Okay, Sudarshan, what about you? Your picks?
Yes, I have CG Power. Buy CG Power with a stop under 900. REC Limited is a buy with a stop under 355. National Aluminium is now a sell with a stop above 350. And Zydus Life is a sell with a stop above 1165. So two longs, two shorts.
Okay, got that. If Bandhan Bank opens lower, Sudarshan, would there be a trade? I mean, technically, how is it looking?
Technically, it was looking as a buy on dips opportunity, but a lower circuit is not a buy on dip because you have to wait for the markets to stabilize. But at some point, not necessarily today, once there is stability, the decline ends, it's a buy.
Okay, and we'll be talking about two-wheelers, Bajaj and TVS Motors from the conference call takeaways. Mitesh, before we get to our Sudarshan for the fundamental view, any technical calls?
See, TVS yesterday was very clearly a price and volume breakout. And the stock, appears to be heading towards the earlier highs on a weekly chart, which is close to levels of 3860. But the bigger movement will happen if we start getting past those 3860, 3880 zones. I think then the stock will have the potential to head towards 4200. So quite positive over there. But of course, you will have a supply level around 3860, which has about 4 weekly highs. If you look at the chart starting from January to March to April.
Look at the reaction on MedPlus. So I read out a slew of reactions across the board. MedPlus is opening 10% lower and 9.5% down, but no volumes in the pre-open. There is the underlying base business, which has not done very well, and of course they're spending money to do something new. So perhaps all of that weighing on the stock. Dollar rupee is flattish, so not very much by way of a reaction this morning, even as oil's moved up 96.30 or so on the dollar rupee. Well, let's just revisit the two big numbers, auto numbers and the con call highlights and what stood out. Lots of chatter around this. Bajaj and TVS. Sudarshan is here with exactly that. Sudarshan, morning.
Good morning, Prashant. So two stocks having similar kind of portfolio. One is today top Nifty gainer. One is amongst top mid-cap gainers, Bajaj Auto and TVS Motor. Yesterday, after a strong set of earnings, both the companies held the analyst call and have given the guidance on both the fronts, domestic as well as international. Talking first about the international business, this time both the companies had seen a huge growth. And for Bajaj Auto, this was the first quarter where volumes on the export front have surpassed the domestic on the quarterly basis. Now, talking about the guidance, both of them believe that Q2 and FY27, the high-level growth might continue not only in the domestic but also on the export front. For Bajaj Auto, what the growth would be led by, it would be new launches. Company is saying that it's going to launch new 150cc segment, 10 facelifts in 160 to 400cc segments, new 125cc Pulsar and 2 new 125cc brands. Also, they will be increasing the capacity by 25%, especially focusing on electric vehicles, where for Bajaj Auto, Chetak's capacity will increase to 16,000 units. And now another positive for Bajaj Auto is that Chetak in this quarter has turned EBITDA positive. Talking about the TVS Motor, they believe that commodity cost pressure that they had seen in Q1, in Q2, that commodity cost pressure will come down, and approx 30% of commodity cost they had managed to pass on to customers. Now, about the guidance, they believe that Q2 potentially seeing the same or slightly better growth rates, and two-wheeler industry on the domestic front is going to maintain the double-digit growth, and it can be potentially better than Q1. Now, EV growth, they believe that again it's going to be similar to what they had seen in Q1, and even for FY27 growth is expected to be healthy, and they are also looking to increase the capacity to 8.3 million units from current capacity of 6.8 million. So after a strong set of earnings, commentary also is looking strong from both the companies, Bajaj Auto and TVS Motor.
Got it. Thanks a lot for that, Sudarshan. Well, let's hop across to Ananya. She's here to tell us about Bandhan Bank, the stock that is getting slammed in pre-open as well as, as we open up. Go ahead, Ananya.
Well, they reported a decent quarter, PAT jumping 35% year-on-year due to lower provisions. Loan growth also stayed healthy, and microfinance book saw improvement in the asset quality. But the main negative was the cut in the ROA guidance by 40 whips. So ROA will remain in the range of 1.2 to 1.4%, the management mentioned. And it is mainly because funding costs are expected to stay high and technology spending is increasing. Now here, if you look at the brokerages, they stay divided. JP Morgan and Nomura believe pressure on margins and profitability could continue, while CLSA is encouraged by the improving asset quality. And Jefferies believe FCNRB inflows could help reduce funding costs over the coming quarters. Now, if you look at the stock has already gained nearly 46% in the last 6 months. So much of the turnaround story is already reflected in the price. Now, going forward, investors will watch out for the profitability and margins.
Okay, all right. Thanks very much for that, and we'll track all these stocks as they open up. There's about 2 minutes to go for the market open to for the markets to open, and we're down about 40 points, 24,150. So just all these names, right, which we've discussed from 8 o'clock. Indian Hotels is up 0.6. JSW Infra is down about 3%. Sagility starts about 2% lower. And we've got Sun and Cipla and Dr. Reddy's on this entire generic news flow. These are small, it could be any other day. So 0.5%, 1%, 1.25% lower. Signed DLM is starting flattish. Anantraj is up about 1.8%. There is Anthem Biosciences and Bandhan Bank, which are lower. This is clearly earnings reaction flowing through. Gabriel is down 2.5%. I mean, some of these names have had such sharp run-ups, Gabriel included. Aavas Financiers is starting absolutely flat. And there is more. I think there's some news flow on Paras Defense. They signed a MOU with MP State Electronics Development Corporation. Again, one of the big winners in the small cap defense space, which has done phenomenally well. 40 points, 30 points lower on the Nifty. The first rates are through. You've got the Sensex, which is down, I think, about 100 odd points. And what else? The small cap index is down 0.15. The mid cap index is, I think, starting slightly lower as well. InterGlobe, some of the Nifty losers are there at the bottom of the screen, and the heat map should give you a quick snapshot view of how the stocks are, the 50 stocks are opening. Interesting to see HDFC Bank as well has lost 7% in the last two sessions. Indigo is sharply lower. I mean, it's lower. It's the biggest loser, and on the back of oil jumping. Sun and Cipla and Dr. Reddy's are some of the other names which are lower, but they are not down big. They're down, but not selling off hard. Bajaj is the biggest Nifty gainer. Reported during market hours, a tepid reaction yesterday, but I think post the call, markets have liked what they heard. ONGC and Hindalco and Eternal are some of the other gainers. So it's basically 48, 49 stocks which are higher, and the rest which start higher this morning. So 100 points down, 0.4%, 24,088. Rima.
Well, Bajaj Auto is now just 2% away from its 52-week high. The stock, after opening at levels of 1,630, is about 200 points away from that. Other auto stocks also seeing buying. So Eicher Motors, M&M in the green, Tata Motors passenger vehicles. ONGC has opened up strong. Eternal seeing some buying ahead of numbers. So on your watch list should be Eternal, Nestle and Dr. Reddy's ahead of numbers. InterGlobe Aviation, as Prashant pointed out, is the biggest casualty today. That's down 2.5%. And sectorally, the big slide is coming through in pharmaceutical names. So Cipla, Sun Pharma, Dr. Reddy's, and we should pull up some of the others as well, like Lupin. These are weak in trade. Private sector banks, particularly in HDFC Bank, continues to see selling. Along with that, in SBI, ICICI Bank, Axis, all down between 0.5% to 1%. And IT too is seeing some profit booking, so over 1% fall on Tech Mahindra and Infosys.
Well, that's right, Rima. A few stocks actually that are calling for attention. One is Gabriel. The problem is that they've done a related party transaction. So, in the longer term, this acquisition could actually be favorable. But in the near term, the street doesn't like it, when you do a related party transaction. And that explains why that stock is now getting clonked back, getting hammered actually down close to around 6%. The other few names that are coming up for you on screen, MTAR Tech. Yesterday, there was massive volume in the last hour of trade after going circuit to circuit lower. I think 6 lakh shares got traded in the final 60 minutes. And that as well has opened up close to around 5%. Sri Lotus Developers, that stock actually is moving on high volumes. It's up 4.5% in today's trading session. So big up move is what we're seeing out there. RR Cabel, that's the other stock that's doing pretty well in today's trading session. And E2E Networks, I think they came out with a set of numbers yesterday. Vinny had said that those numbers were very good. The street likes it. So that one as well is flying away as we speak, up close to around 5%. And BCCL, that's Bharat Coking Coal. The volume degrowth is what we already knew when they declared their operational performance. But that's what's led to, negative margins as well, though realizations moved up. So that's another stock that's lower in today's trading session. Just to highlight a few more, Candor Robeco AMC, 7.5% higher, flying away in this sort of a market. And Huhtamaki India, that as well is up close to around 8%. Wondering what's going on there. But that stock is moving up. And for the last 2 days, we've been talking about this in the FNO chat as well, that Kalyan Jewellers is a stock that suddenly there is a lot of interest at lower levels. And there's a lot of long build up on that one. So after rallying close to 40-45%, it's still seeing an up move almost at around 600 rupees today.
Oh, absolutely. Just look at this stock called MPS Limited. I think it's got a big move higher, some 10% or so on the back of it. Reported numbers. Yeah, there you go. 13% higher, and there's a big 2,424 on that. Very, very small volumes. We don't usually talk about it at all. Actually, not so small volumes. The lakh shares have traded on the NSE at this point in time. Well, the markets are down about 0.4, 0.5% or so, and that is a start. Pratik Gupta is with us, CEO and co-head at Kotak Institutional Equities. Pratik, good morning. Great to have you with us here. Thanks for joining in. What is the sell-side view on this pharma news which has come through this morning? What are you telling clients, Pratik? One view is that, well, it's negative and raises uncertainty. The other way to look at it is, well, it removes uncertainty, right? 2 years, you've got a clean run. And in 2 years, it's going to be campaign time, and President Trump will be about 5 months away from finishing his term. So will all of this really happen, right? That's the other way to look at it. So just your thoughts.
Good morning, Prashant. So I think the pharma tariffs, firstly, given that it's a 100% tariff and not a more realistic 10 or a 20% tariff, so therefore this doesn't seem like a very serious issue at this point in time. We don't think the market will take it too seriously because this is more of a posturing and pressure tactics to try and get the manufacturing operations to move to the US, which again is not an easy thing for the companies to do. They have to move the entire supply chains. Easier said than done. So this is more like a pressure tactic. So we think this will have some sentimental negative impact, but this will, as you rightly said, this will drag on for a bit. If it was a straight, 10, 15% tariff, that would have been far more realistic. So we think this will blow over after some time. There will be negotiations. This will drag on. You run into the midterm elections. And then let's see what happens. So this will probably just sort of sentimental impact for the time being. It is negative, of course, for companies, the US generic companies, which are exporting straight to the US and do not have any manufacturing presence. There are a handful which have some kind of a manufacturing presence in the US. They'll be less impacted. But by and large, we're not taking it too seriously at this point in time.
So what's the call on pharma at Kotak IE? Are you all bullish and you'll stay bullish?
Pharma selectively bullish, but more on the domestic pharma sector, and that was the case even before this tariff news overnight. We think the generic space, as it is, apart from the tariff risk, there's intense competition. Margins still haven't stabilized, and we think the outlook is much better for the domestic pharma companies. The growth runway is much longer and more sustainable. So our preference has always been for the last, say, at least a year or so, for the domestic pharma companies.
Prateek, what's the call on HDFC Bank now? The stock's been a rank underperformer, not for 1 year, close to 5 years now. And most mutual funds have held on to it as a large weight despite the underperformance. What's the call now?
So we can't make any stock-specific comments, but I'd just say in general, that's also true with some of the other private sector banks. And there have been obviously stock-specific issues in the case of HDFC Bank in terms of various. One is obviously it was a very well-owned stock by foreigners, and as foreigners were selling India, as they were rotating out of India into other markets, that was one big reason. But apart from that, I think in general, the banking sector got hit with various issues in the last few years. Foreign selling was one factor, slow growth, NIM pressure, loan growth, all of that. The economy went through a lot of shocks as such. But at these valuations, given the underperformance of most of these private banks, including the HDFC Bank, we're actually quite constructive if you have a 1 year plus time frame. There are actually, from a valuation perspective, these stocks have come down to very reasonable levels. And frankly, these are the big plays on India's economic recovery as and when, assuming this oil price issue doesn't blow up once again. So we think we're actually quite positive from here on.
Hi, Prateek. Good morning. Good to see you, Ben. If that's that one theme that you're betting on, that you believe that's probably in a structural bull trend, which one would that be and why?
So I think the themes, there are many of them, like defense, capital goods, power, T&D, etc. But the problem is valuation. So some of those themes are already extremely well discovered and the valuations are very, very high. So therefore, if you look at, as an investor, you need to also look at valuations. You can't just look at the growth prospects. You have to figure out what is already priced in. From that perspective, we like some of these themes, but they're already priced in to a very large extent. We think the upside is quite limited, at least over the next year or year and a half or so. So therefore, we are back to looking at some of the most cyclical economic recovery plays, which have been sort of underperforming and where valuations are a little bit more reasonable. So that brings us back to, say, the banks, the NBFCs, I would say some of the hotel and hospitality companies, the hospital space, the telecom sector, and so on. So it's really more valuation focused rather than where the themes might be from a growth perspective alone.
Yeah. No, absolutely. Point taken there. Lots of action. I mean, there's almost FOMO in mid and small caps. Prateek, you'd agree, right? Stocks are, I'm saying there's just FOMO. I mean, stocks are ripping 40, 50%. We were talking with a sell-side analyst, and I was asking him whether, he told us that he's working on initiating coverage. He's postponed it. He's saying that the stocks run up. So, would you agree with that characterization? Absolute FOMO.
Yeah, that tends to happen with these small caps. The liquidity is much lower, so a little bit of buying does tend to result in outsized returns in the short term, and valuations do tend to get out of hand pretty quickly, which is the case in our view right now. These small caps, obviously, the growth prospects in many of these companies are far superior compared to the average of the Nifty 50. But at the same time, I think you have to keep in mind valuations. You have to, when you're investing, you have to maintain the valuation discipline. And that's where at this point in time, I would agree with whichever small cap analyst that was, that generally speaking, a lot of these small caps are becoming expensive again. And again, you got to take a really long-term view, like 5-7 year view to sort of get in at these valuations. But otherwise, we'd prefer the large caps once again. And also given, once again, you're having the sort of geopolitical uncertainties emerging again. Oil is back to $90. The monsoon outlook obviously is a bit, uncertain. You've got the trade tariffs. Looks like this time it's pharma to begin with, but even our India-US trade deal still hasn't been filed. So a lot of uncertainties out there, and obviously not forgetting the AI risk, so on. So you've got to be a little bit careful. We don't think we're in a raging bull market as yet, and I would be a bit cautious on the small cap stocks in general.
By the way, just one question, a fundamental question, Prateek. What is the minimum market cap criteria for most institutional investors? After which they, is the minimum, and only then they start to look at companies. Is it 5,000 crores, 6,000? Has it changed?
It's actually increased over the years as the fund sizes have grown over the years. So even a small mid-cap fund for a local mutual fund, that they would probably not look at anything less than a few thousand crores to begin with. As far as the foreign institutional investors are concerned, for them, their definition of small cap is like typically $2 to $5 billion, in some cases even as much as $2 to $10 billion. So the universe is somewhat limited, but I think the other criteria is not just market cap, it's also the actual liquidity in the stock. And that means you look at the free float, you look at the average trading volume, and not just the headline trading volume, the actual delivered volume, because you tend to have a lot of intraday speculation, which is not real liquidity. So when you look at liquidity, unfortunately, a lot of these small caps, they don't make the cut. So if someone wants to buy, even a small mid-cap fund wants to buy, let's say, 50 crores, 100 crores of a position in a stock, that's not easy to do in many of these small caps without impacting the price quite significantly.
But there is liquidity in mid-caps. Prateek, are we seeing increased interest or inquiries from the foreign investors? The FPI, are sort of back in the Indian markets, at least when we track the data in early July. And in the past, whenever we spoke about foreign inflows, it was always concentrated in large caps. But now increasingly, the money that they're putting in is either in IPOs or some of these mid-caps where we are seeing earnings delivery. Does that create sort of a structural tailwind for mid-caps over large caps?
So I think you're right to some extent that we have seen foreign investors broadening their investment universe when they look at India. So for example, historically, the banks, consumers, and the IT services stocks were really the focus areas, and that too mainly the large caps. What we've seen over the last, say, about 2-3 years or so is that foreigners are sort of focusing a bit more on expanding their coverage, going beyond the let's say, the top, say, 100 odd companies. And yes, in some of the larger IPOs coming out of India, there is likely to be more foreign interest. We are seeing that happening, partly because of valuations as well, where IPOs tend to come in a little bit of a discount to the prevailing peers already listed in the market. So there is definitely some interest, but again, foreigners care about, one is valuation, especially relative to regional valuations. There, unfortunately, most Indian mid-caps don't qualify. Most of our mid-caps are quite expensive compared to the rest of the region, even though some of them may offer slightly better growth. And second is liquidity, which again matters a lot. Like I said, even for our domestic mutual funds and insurance funds, some of the mid caps, they may appear big market cap wise, but the liquidity wise, it's not easy to take a meaningful position. The same is actually true for the foreign investors as well. And in many of these IPOs, the allocations tend to be a problem, whether it's in the anchor or in the main book. The sizes are too small for them to bother with. So we don't see many of them participating, not because the market cap is not big enough. It's just the position sizes they can get is not meaningful enough for them to bother with. For them, and almost every institutional investor, you have a pretty detailed investment process. You have to write an investment thesis, get it cleared through your investment committee, and so on. So that tends to be quite painful and it requires a lot of effort. So therefore, they don't bother with companies which are beyond a certain, which are below a certain cutoff.
You briefly mentioned about IT companies. I think we were discussing this the last time as well. It appears the street is getting over pessimistic on some of those companies and select opportunities could emerge. What's your positioning right now?
So as I said the last time as well, if you take a slightly longer term view, a 3-4 year view, then I think we believe that these companies, these businesses will survive, they will adapt and they will change. But we are going through a transition which is quite painful, both from an earnings standpoint as well as from a valuation standpoint. From an earnings perspective, obviously there are some temporary headwinds, temporary tailwinds in the form of the rupee, which is out there, and some large deal wins, etc. But the fact remains that the AI theme is not over as yet. We are seeing AI adoption spread. Eventually, we believe our Indian IT companies will be required. They will be required to do especially for the enterprise level IT implementation of AI. That's where their role will come in. But retraining, reskilling, let's say, hundreds and thousands of engineers in each of these large IT companies, that will take some time. You will see customers putting pressure on margins. There's obviously a little bit of a trade-off in terms of how much you can use AI yourself as an IT services provider. There is a cost of the tokens, and you have to compare that against the human cost. So there's a little bit of a rebalancing underway right now. So we're going through a transition period. We will see likely somewhat weak earnings growth for this year and perhaps even next year as you go through the revenue deflation cycle. But eventually we'll come out of it. Having said that, in the short term, we are still cautious. We have been recommending an underweight. That stance hasn't changed. We think valuations need to come off a little bit more. We've come down a lot, but maybe especially given the uncertainty and the risks out there, we're still not turning positive as yet.
Prateek, great conversation. Thank you very much for joining in.
Thank you.
All right, let's move on and invite the management of Bajaj Auto. The company reported a strong revenue growth driven by healthy volumes. Margins have got a boost on the back of robust exports and a weaker rupee. And the electric vehicle business is now contributes nearly 30% of the domestic revenues. We have with us Rakesh Sharma, Joint Managing Director of Bajaj Auto, on the show now. Thank you very much, sir, for joining in. This is Rima here. Exports still growing strong, and you're confident of the 2.5 run rate continuing month after month going ahead. So what are we seeing in the export market, and is there a possibility that your overall volume growth for the year will be higher now? I was looking at a JM Financial note, and they're saying the company's volume growth driven by exports could be 14% this year versus their earlier guide or expectation of 11%.
Good morning, Rima. Yes, the exports came in very strongly. It was the highlight of the quarter, despite the West Asia crisis, which has an impact, a severe impact on logistics. Our exposure to West Asia is less than 3%. So not from a sales point of view, but from a point of view of servicing all the demand which we were getting. And I would say both logistics and supply chain difficulties impaired availabilities by 10 to 15%. So we were looking at, about 120,000 units more. And the forward view, and hoping that, logistics opportunities are good, we should be breaching the 250,000 mark in balance in this quarter and hopefully continuing into quarter 3.
And for the full year, do you think you can push volumes to low teens kind of, a volume growth, export and domestic combined?
Well, I must say that the segments we are participating in are looking very promising, because you've seen the exports have moved up from 200,000 to 250,000 or so. The electric segment, which both for three-wheelers and two-wheelers is a very strong segment for us. In three-wheelers, e-autos have doubled. The industry has doubled. In electric scooters, the industry is growing by 70%. The third segment, besides exports and the electric vehicles, is the sports bikes, the 150cc plus segment. If you see, the two-wheelers are growing in quarter one, the Vahan registrations grew at about 14%. But, with an industry as large and as diverse as this, a singular number hides a lot of meaningful content. Because, like I said, electric two-wheelers, which are important, 175,000, they're growing at 70%. 100cc bikes are growing at 3%. 150cc plus bikes are growing at 25%. So there is an enormous diversity which is now getting reflected. So a singular number hides, valuable interpretation. So when we sort of peel the onion, the segments which we are aggressively participating in, exports, the 150cc plus segment and electric, all looking promising. But how this will all combine and what will be the final growth number with so much of volatility, I would hazard a guess. We are taking it month by month and quarter by quarter.
Yeah, Mr. Sharma, it's been a good quarter, no doubt. And I think across areas where you're focused on is all delivered very, very nicely. Good morning. Good to see you. And that 250,000 export number, that is now sustainable, right? We will see that every month.
Well, Prashant, the forward view is suggesting that certainly we should be breaching 250,000 in the short term. And let's see how it goes from October, November, December, which is a bit of a slowdown in exports from a seasonal point of view because Christmas and all gets over. So the Latin American markets we're not shipping so much to Latin American markets in Q3. But yeah, it's looking promising. And there are a couple of reasons for that. The first one is that, despite the crisis, I must say we've all been surprised by the resilience which many, many markets have demonstrated internationally. Africa has come back, led by Nigeria. Africa is the industry is growing at almost 50%. The currencies are a little bit up and down compared to the US dollar, but nevertheless, it's growing at 50%. And we have grown our retails there by 100%, again, led by Nigeria. Latin America growths have come down, but they are still in a good growth zone, growing at 5-6%. And over there, our retails are growing at 30%. Asia is a little bit muted, largely because of the Indian subcontinent, but places like Philippines, where we have a very good footprint, they're doing well. So the underlying demand is strong, and our competitive positions, allow us to get a disproportionate share of the growth. So therefore, we are quite optimistic about exports ticking away at this level.
I just had a couple of questions, quick questions on the electric side. Chetak is also now EBITDA positive. Where is the electric segment is growing pretty fast, right? Is this ICE scooter users buying electric vehicles, or are these? Somebody was saying that even motorcycle users are now shifting to electric scooters. Which one is it? And is it both? Is it predominantly one?
Yeah, I would say it is very difficult to quantify it precisely. But on the basis of whatever research we do, and if you look at some of the reasons why this is happening, it suggests that most of the cannibalization is occurring in the ICE scooters segment. To begin with, if you see the performance delivery of electric scooters and ICE scooters is very much in the same zone, in the sense that the usage is limited. It's like an average user is riding about 30-40 kilometers. which is very, very comfortable delivery from an from a electric scooter. If you look at motorcycles, motorcycles tend to be used for much longer distances, and that is where the range anxiety sort of comes in. So it would be difficult to imagine a person who's riding long distances shifting to electric scooters. But having said that, some motorcycles are obviously used for short distances. There are the delivery people, etc. But then those fellows are riding 12 hours, and then again range anxiety sort of steps in. So I would say that 80% or so, if I were to hazard a number, I would say almost 80%, like you said, predominantly the movement is from scooters, i-scooters to electric scooters.
And there are wait periods now. So is this basically demand is a bit of an issue, right? What is the, you got more capacity coming up. Others are also adding capacity. Could you give us a sense of where we are and where we will be, say in I'm talking about Bajaj and the industry as such, in terms of just capacity?
Well, it's difficult for me to comment about what the others would do, but I will certainly say that we challenged a demand for our products, challenged capacity quite significantly in Q1. And some of it was, of course, because of the disruption which everyone faced in April, May, on account of, the LPG shortages and manpower migrations and stuff like that. But nevertheless, there are three areas where we are really getting challenged on capacity. One is the electric two-wheelers, which we just spoke about. Then there is also the high-end bikes, our 250cc plus bikes, both in KTM, Triumph, and Pulsar brand. And third is a few sub-segments in the three-wheeler business, particularly the larger format three-wheelers, where we have been doing extremely well, both in the electric and the ICE side, in India and overseas. So these are the three areas where we are undertaking an unlock of capacity. And even a slightly longer-term forward view suggests that we have to undertake a substantial increase in capacity. Our capacity is about, everything put together, about 7 million units per annum. And we think that we have to increase it by 25% and go beyond 9 million. That is the kind of demand outlook we are seeing for our kind of segments.
We're out of time. We wanted to talk about margins as well, where I think the performance has been pretty strong despite all the input price rises that we've seen. We wish you all the best of luck, Mr. Sharma. Thank you very much for joining us. So all guns firing, and it's a good show. Stocks up 3%, 3.5% this morning. 10,750. We take a break. We're back. The management of Anthem Biosciences is going to be with us on their first quarter numbers. There is a bit of a dip as far as operating results go. Stocks a little lower. And of course, we'll ask Mr. Bharadwaj about the tariff threat, 2 years out, that is, as well. Stay tuned. Coming up.
Welcome back. Markets are low, and let's focus on a couple of earnings reactions then. We've got a pharma company that's joining in to discuss their numbers, as well as the announcement of Mr. Trump this morning that generics are going to be taxed in the next, going to be under tariff in the next 2 years or so. To help us out with how did the quarter shape up as well as the industry outlook, we're joined by Mr. Ajay Bhardwaj, the MD and CEO at Anthem Biosciences. Hi, sir. Good morning. Good to see you, Ben. Well, before we get to Mr. Trump's announcement earlier this morning, let's focus on the numbers. There's a sharp degrowth if I look at it on a year-to-year basis. Margins are more or less steady at around 36%. Explain it to us. Why was there a degrowth on the top line? Was there some deferment of revenues, which in turn could mean that quarter 2 and quarter 3 will see a makeup of that deferment? Please go ahead.
Yeah, Nigel. Good morning.
Morning.
You're absolutely right. Our numbers for the quarter are lower than this similar quarter last year. But, we've been at pains to explain that the nature of our business is lumpy. Markets are, the CRDMO business is still new for the markets. We are more than confident that we will make up the numbers and will return to our normal growth in the quarters ahead. So we have no cause for concern. It's just that our customers have deferred their supplies to later quarters, and that's it's been like this year on year anyway. So there's no cause for concern at Anthem. We are very much on track to deliver the growth that we've historically delivered year on year.
All right. And if I look at it, in the last year, you did a mid-teens growth. So you think you could get back to that sort of a number? Should it be a 10 to 15% growth, or are you optimistic that could be even more? We get the point that it's lumpy in nature, so don't look at it on a quarter-to-quarter basis. But on an annual basis, should we be bracing for that mid-teens growth? And also, if you could help us out with the margin outlook. Traditionally, if I look at it, it's been between that 35, 36% to around 40%.
Yeah, I think we would do better than our mid-teens growth. There's no question about that. See, the other thing that we have is complete visibility is on our order book. So our order book is more than 60% of what we intend to deliver at the end of the year. So again, as I said, the order book is strong. It's just that the numbers will come in the subsequent quarters for this year. And again, this will, we will, and I want to just, let everybody know, we might have a bumper quarter sometime again this year, but that again doesn't mean that becomes the benchmark for the same kind of numbers quarter on quarter. It will always be lumpy. And as far as the margins are concerned, we have delivered better margins than we did in the same quarter last year, and we will continue to have strong margins. So again, there's no cause for concern. Our material margins have actually gone up. Our EBITDA has gone up, and at the same time, our PAT is also higher than all of last year's PAT. So we were 26% PAT last year, and this year we are up to 27, nearly 27% PAT. So.
Okay, all right. Tell us about how do you see the product mix as well, revenue mix evolve from here on. Specialty, I think that's a smaller part, but that's growing. Also, the CRDMO business is bulk of it. So how do you see the mix evolve in terms of revenue contribution?
Yeah, the revenue contribution, as we, right now, 70% of our revenue in the quarter has been development and manufacturing. 12% has been R&D, and the rest, about 18%, is specialty ingredients. So the mix is, what is traditionally been. The number, when we deliver a higher number at the end of the year, all these segments would have grown. The split would more or less remain unchanged.
Right. Mr. Bhardwaj, good morning, sir. Could you also give us an update on the pipeline, and specifically things in the pipeline which are at a late stage, close to commercialization?
Yeah, Prashant, we have had in the last year 4 new products which went from phase 3 into commercial. We are yet to see the numbers from those products, and most of those products, all those companies have been absorbed by big pharma. So there's always a lag from the point when the company has been acquired to the buildup of numbers. So these are 4 new products. When we IPO'd last year, and it's actually the first year to date. It's been 1 year since we've been a public company. We had 10 commercial products. Today, it's up to 14. And we have another 10 products which are in late stage. So that will form the pipeline in the future. So going forward, also, we're very optimistic And there's been a very hectic mergers and acquisition activity in the pharma market, and many of the companies we work with have recently been acquired by big pharma. So as I said, we've said earlier as well, our play in this is that the biotechs that we work with eventually get absorbed or get acquired by big pharma, and therefore a bulk of our business then goes from being R&D and development to manufacturing, and that continues to be the playbook.
Got it. So you said 4 products went from phase 3 into commercialization, right?
Right.
And you are, in terms of impact from that, that's yet to come in. I mean, those are. And when will we start to see that? What's the size of this? I mean, just we can, I think, talk in terms of TAM or opportunity here for these 4?
Yeah, these 4 molecules, the analysts say their peak sales will be in excess of $10 billion. So, and those numbers will kick in another 3 or 4 years from now, the peak sales. But we will start seeing some revenue contribution. Already we've seen, some POs which we'll execute later on in this year. But large contributions can only begin from next year or the year after that.
And you also said there are 10 more molecules which are in
late phase.
In late stage, which is phase 3.
Correct.
Okay. So and 14 which are in the commercialization stage.
Already commercialized.
14 already commercialized, which includes the 4 that you spoke about, and 10 more which are in phase 3.
Yes, correct. That's the right number.
Okay. So hi, Rima here. What is your view on Trump's latest statement on generic pharma? How does that impact your company or your order book? And have you or the CRDMO industry started thinking about setting up manufacturing plants in the US?
So Rima, morning. We are, again, our business is completely non-generic. So we are not at all affected by any tariffs on the generics side. And the companies that we work for, our large contributors to our business, are big pharma. And all the big pharma already has, the ones that matter, already have arrived at some deals with the current administration. So they have their separate deals, which allows them to be zero tariff. So even going forward, big pharma, I don't see it affecting us at all. So we continue to be very optimistic that our CRDMO business, which is non-generic, will continue to grow. And our business is completely on novels and no generics contribution.
Okay. But just hypothetically, what's the difference, the cost differential between manufacturing in India versus the US?
I mean, it's substantive. It just depends, I would, if you ask me a number, at least 5x at the very least. And depending on categories of molecules, it could be even bigger, 10x maybe.
Oh, all right. So hopefully better sense prevails. And, for the good of everyone, these tariffs don't come into play. But that discussion for another day. Before we let you go, Mr. Bharadwaj, 2 questions. One is, you're sitting on a lot of cash in your books. So how do you want to utilize it? And is there a probability that we hear Anthem doing a big inorganic acquisition or a small inorganic acquisition sometime in the next 2 quarters?
We're always looking at companies which can add, which can be businesses that can be accretive. However, we haven't found something which is, which fits in very nicely with us. So inorganic growth is always a possibility. At the same time, the cash that we have, we've said this before, and we're adding a lot. We are building Unit 4, which is adding a lot of capacity. For instance, our current capacity is 425 kiloliters. And when we complete Unit 4, which will take a couple of years, it'll be doubled to 800 kiloliters. Our fermentation capacity will go from 140 kiloliters to 300 kiloliters. So we're going to put our cash to good use. As you see, we have so many molecules which are waiting to be commercialized. So we have to be prepared with our build out and our capacities, because when the molecules go commercial, sometimes you have to ramp up manufacturing very quickly. So keeping that in mind, I think we're putting our cash to good use.
Got it. All right. But inorganic growth, you're on the lookout. You said that earlier as well. Something could be closed out, you think? Either in this calendar year, is there a possibility?
I mean, again, I'm not saying that we have anything ready that can happen now, but we're continually looking.
Got it. So we'll wait by for that announcement then, and we look forward to having you back on CNBC TV 18 to detail that inorganic growth, if at all it does take place. And all the best. This quarter seems to be a bit of a one-off, and you're confident of going back to growing ways for the remainder of this fiscal as well. Thanks a lot for joining in. Let's hop across to Sudarshan. He's here to revise the TVS Motor con call highlights. Sudarshan?
So TVS Motor has built on to the opening gains, currently up almost 4% after a healthy set of earnings, and also the commentary that company has given in the analyst call was positive. So first talking about the commodity cost, company saying that in Q1 commodity cost was around 3.5%. In Q2 it's expected to be around 0.5%. Of the total commodity cost increase, 30% has been passed on to consumers, and also because of the rupee's depreciation against US dollar, that has also helped company on the margin front. Talking about the demand on the international segment, where the export almost forms 30 to 35% to its total volumes. Now, on that front, company believes that in Q2 and in FY27, the high-level growth that it has seen in Q1 and in Q4 FY26 will continue. On the domestic front, double-digit growth is expected to continue in Q2, and even going forward in FY27, growth is expected to be very strong. Just if you compare Q2 versus Q1, Q2 growth rates are slightly going to be higher than what we have seen in Q1 levels. Now, on the EV front, the growth is expected to be the same what company has seen in Q1. On the capacity, because of the increased demand, company is looking to increase the capacity for both two-wheelers and three-wheelers. So for two-wheeler, capacity is going to be increased to 8.3 million from 6.8 million units. And for three-wheeler, capacity is going to be increased to 0.42 million units from current capacity of 0.25 million units.
All right. Thanks very much, Sud, for that. Well, there is the auto stocks which are doing very well. One more big earnings reaction, right? India Mart down 6%, 6.5%. So much. As I said, it's earnings heavy and it's going to remain that way for the next 10-15 days. Well, Nagaraj Shetty is with us with what he wanted to do as far as trades go. The markets are now firmly lower. Nagaraj, take it away. What's the advice?
Hi, good afternoon, Prashant. Yes, market is feeling pressure due to geopolitical conflict, rising depreciation of INR and rising crude oil prices being heavy on the market. Right now, market is below the support, and initially there is a probability of Nifty reaching down to 23,800, the next set of support. The immediate support is around 24,000. I don't think that this support is going to hold. So overall, market is in a slightly in the pressure, and some more weakness is likely down to the support, and where I'm expecting a slight bounce is likely to happen from the lower support.
Okay, what about stocks, Nagaraj?
I have two stocks from both buy and sell side. First is from buy side. The auto ancillary stock RACL Geartech Limited. This stock has been in a larger consolidation phase, made an attempt of breakout recently. The overall chart pattern is looking positive during this falling market. This stock stood firm, and I'm expecting a upside breakout in this kind of market at around somewhere around 1375, 1380 levels. The overall chart pattern is looking positive and can look to buy at this point of time. Currently trading around 1373. The immediate target would be around 1450. One can place a stop loss at 1335. Second one is from sell side. That is Varun Beverages Limited. VBL has been continuously falling over the last few weeks, and lower tops and bottom from the chart is indicating a more weakness in the near term. Currently trading around 456, 455, 485, 456, and immediate target would be around 430. One can place a stop loss at 470.
Okay, thank you very much for that. Sign DLM is a big mover today, 11% up on that. Very strong numbers. The company's top line growth stands at 35%. This is the highest ever revenue growth. And even the management commentary on the out margins is positive. So in Q1, margins went up 150 basis points year on year to 10.5%. But the management is talking about opening up 2 new growth lines, robotics, AI infrastructure, data centers. And from FY27 to FY29, the margin guidance shared is 11 to 13%. They closed the current quarter at 10.5%. The stock is reacting to that. Mangalam is now joining in to get us a check on the Sensex derivatives at this hour.
Well, it's a Wednesday, and that means that we're one day ahead of Sensex expiry tomorrow, and the market's actually quite weak in today's trading session so far. Not only are the macros impacting the overall tenor of the market, we have some weak earnings as well. So we have selling across the board, and then to add to all of that, the tariff-related issues with the pharmaceutical index, that's taken that index lower as well. A recovery in the chip stocks meant that the IT stocks have also fallen. So it's across the board that we're seeing selling, and as a result of which the Sensex, which is down about 0.75% right now, has actually fallen below the 20-day moving average as well. The 20-day moving average was an important support for the frontline indices, and today's decline has meant that it's fallen below that. So that's something that we will monitor. Now that it's fallen below that, maybe because of reverse polarity, this will perhaps be a resistance on the way up, and that's what call writers are betting on, because you see the maximum open interest is on the 77,000 call, a premium of almost 235 rupees, which again, if you plug the premium into the strike price, 77,235 thereabouts, is pretty much where the 20-day moving average is. So any rally towards the 20-day moving average on the Sensex is likely to be sold. However, there is support at lower levels as well. So the 76,500 put is equally active in today's trading session. We've seen premium of almost 150 rupees out there. So about 76,350 thereabouts is where we are expecting support. So a broad range that you're looking at, 76,350 at the lower level for the Sensex, and on the way up around 77,250.
Right. Mangalam, thanks very much for that. We'll take a break. Manisha, on the other side, we have commodities in focus. Stay tuned.
Welcome back. M&M Financial is moving well, 6.5% up on that. Today, HSBC has upgraded the stock to a buy, raised the target price to 410. Currently, the stock is at 372, reacting to good set of numbers and their brokerage update. But as promised, let's talk commodities. Manisha is joining in, and she's watching precious metals today.
Well, I'm looking at all kinds of metals really because we've seen stronger gains come in the overnight markets there. But I'll start with precious metal prices because we're looking at gold prices gaining 2% in the overnight markets, and with that, gold is trading at a one-week highs. It's trading above $4,100 an ounce as well. Same goes for silver, 4% of strong gains coming in for this one, and we are closer to $60 an ounce. And you also have seen stronger gains come in for platinum, palladium, 2 to 3% of gains overnight coming in for these metals as well. Well, it has to do with the Middle East uncertainties, rising oil prices, inflation concerns, fact that you could be looking at interest rate hikes going forward. And the markets are now pricing in a 55% probability of a rate hike coming in from US Fed in the month of September therein. Not just about precious metals, but the base metals have done quite too. Copper is gained up by 3% overnight. It is a 5-week high that we are trading in right now. There's a tight physical market in China. Almost $100 a ton of a premium is what China is paying to get the copper in. If you look at the LME and 3-month comparison, it's a $250 a ton there as well. So that tells you that there's an immediate physical tightness that is keeping the copper prices higher. The LME inventories are the lowest since the month of March. The Shanghai inventories are at a season low as well. The only place where you have higher inventories perhaps is the US markets, and they're not even using it right now. The markets also are looking at Grupo Mexico's second quarter net profit up by 72% as compared to last year. This is on the back of higher copper prices. And then you have guidance coming in from Rio Tinto, from BHP, Antofagasta, everybody saying that this year and the next year as well, there is a lower copper production guidance. So lower supplies, lower inventories, stronger demand and higher prices in case of copper. Nickel is also trading at a 1-month highs, and this is as Indonesia is looking to review nickel production quotas going forward for this year and the next as well. The expectation is that Indonesia could be looking at lower exports, more nickel in use within Indonesia locally as well, and that is what the street will watch out for. The Middle East tensions also seem to have raised concerns, especially when it comes to sulfur supplies, and that in turn has been supportive for metals across sector there. And finally, aluminum should come in on your screen. Remember, 9% of global aluminum comes in from Middle East, and with concerns yet again coming in there with Strait of Hormuz nearly closed, we have seen aluminum prices come back in favor as well. Here as well, there are concerns with supplies, not just because of Persian Gulf, but the LME inventories are at a 2022 lows, and the Shanghai inventories have continued to see a decline as well, down nearly 14% in matter of last couple of months itself, and that is where aluminum also is getting its support.
Thank you very much for that. We will get into a break. On the other side is our special Indonomics segment. Lata will connect with 3 eminent former bankers to decode if the huge improvement in PSU Bank financials is a structural change or merely a temporary result of a cleanup.
Welcome to a special Economics. In the past 5 years, public sector banks have gone from strength to strength, even as the large private banks have somewhat lost ground. As of FY26, the bad loans, gross NPLs of public sector banks was actually less than that of private banks as a percentage of total loans. Now, PSU banks' loan growth has also been faster than that of private banks in the last 3 years. PSU banks have recaptured lost ground. They were losing the market share for decades. Now they have regained market share. And the stock market too has rewarded public sector banks. The PSU Bank Nifty has risen by 242% in the last 5 years, while that of private banks rose by only 55%. So the questions we are asking today: does this represent a structural improvement in PSU banks, or is this just a temporary improvement because of the heavy cleanup and the recapitalization that happened from 2018 to 2020? Joining me to discuss this are former Bank of Baroda chairman and, more importantly, former Deputy Governor of Reserve Bank, Mr. S.S. Mundra, former Managing Director of Punjab National Bank, Sunil Mehta, and he was also chairman of IBA, and Mr. Harshvardhan, one of the best banking experts from Bain, and more importantly, independent member of the Karur Vaishya board. So very much an insider. Gentlemen, good morning, and thank you very much indeed for your time. Mr. Mundra, this has to begin with you, since you have been there and seen it all as regulator and banker. Like I told you, gross NPLs, which were at double digits in 2018 for public sector banks, has fallen to like 1.4, 1.5, just like private sector banks, sometimes even better. And like I told you, they are grabbing loan growth back. Does this look like a structural shift?
Thank you, Lata. And you have picked up a very interesting topic to discuss today. First, I think I fully endorse what you are telling. If you look at the figures, and particularly in last 2 years. Now, see, what is the general discourse? General discourse is normally you pick up a time frame of last 4 to 5 years and then talk about it. If you take that framework, obviously it looks like that compared to, let's say, 21 or 22, the public sector banks have lost the market share, private banks have gained the market share, the performance, profitability, operating profit, etc., all the parameters will look negative. But what is interesting is to look at the period of last 2 years. If you look at the period of last 2 years, that is the 25 and 26, which is completed now, you would realize that almost in all the parameters, I would say a couple of parameters, deposit growth in private sector bank is still better than the public sector banks. Other income, private bank have still a marginal advantage over the public sector banks. And let's say the CASA deposit, probably there is a better performance by private sector banks compared to public sector banks, and which ultimately results into the operating income. But interestingly, in last 2 years, the market share gain of private sector bank is almost muted or in decimal points, let's say 0.4 or 0.5%. And whereas advances, the public sector banks has grown better than the private sector banks in last 2 years, and also catching up on the other income, operating profit, etc., etc. So I would say now with the consistently for 8 quarters or 2 years performance cannot be brushed aside as something which has happened by accident, or it has happened accidentally. It's not so. I think it is showing a structural improvement in the performance of public sector banks. And last thing which, initially I would like to mention, see, we should remember the period before this, 21, 22, 23, 24, was marked by 2 things. Cleanup was continuing of the balance sheet, capitalization was underway, and moreover, a lot of big consolidation happened in public sector bank, which take its own time, to settle down and then move towards the growth. So I would certainly say it still is a mixed bag, but there is a structural improvement. Public sector banks are recording good performance. But there are few areas where they would need to really still focus on, so that this trend not only continues but it strengthens and they don't again slip back. Let me stop here at the moment.
Yeah, I think you very comprehensively covered the fact that they have made advances in many places, but on deposits, on CASA, the private sector banks are still showing higher, better growth. Mr. Mehta, let me focus on the structural part. There were two things that were not there in the, in the previous decade, which has come in now. One is huge digitalization in public sector banks, probably started under you in PNB. And secondly, the acrylic has come in Reserve Bank. So even if we go through a bad period, that structural improvement should prevent loan shopping, corporates kind of loan shopping between banks. So do you think, therefore, this is a permanent improvement in PSU banks?
So thank you, Lata. It's a very interesting point you have raised. Let me give you four major factors which have brought structural changes into the performance of public sector bank. One of them is implementation of public sector bank reform agenda. We commonly call it EASE. This is EASE. This was like in 2015, there was a Gyan Sangam, which was followed by a Manthan in 17. And the entire public sector bank has undertaken a reform journey so that they can stay in line or ahead of the curve in reforms. And that reform has helped in creating of the stress asset management verticals in each bank and has really brought focus back on recoveries, corporate governance, and the profitability. That has really contributed. Another important reform which the government introduced was IBC. So IBC, because the cleanup started in 2016 with asset quality review, and that impact lasted for 4 years. Like from 16 onward, the entire cleanup started, and by 2020, most of the banks have provided for their all bad loans, which were cleaned up during this process.
Got it.
So the provision of coverage ratio of most of their banks has gone as high as up to 90%, and on an average more than 75%. So that has created a gold mine for them.
Yeah. I think we will get back to you, Mr. Mehta. There's some, connection problem. Ms. Harshvardhan, now as the neutral party who has not worked in a public sector bank, do you think this is an action replay of 2004 to 2008? Mr. Mundra would remember this very well. We saw public sector banks go from strength to strength. I mean, they were shining balance sheets and P&Ls of public sector banks in 2006, 2007, 2008. But come one, excess period, and we saw them decline again. Do you think there are structural changes now that even if there is a loan boom, they will not go back to the kind of problems they saw between 2016 and 20?
So, Lata, I would be somewhat more circumspect compared to the other two panelists. And let me give you the reason. If you're right that the public sector banks have performed very well, but if you pass the performance, there are three main factors. One, you mentioned the growth has been strong, not just for the public sector bank, for the whole system.
Yes.
We're growing 16% last year. This last month, we did 18% year on year.
Yes.
And it's been driven by a lot of this growth is under guarantee of MSMEs, the MSME guarantee scheme, gold loans, and so on and so forth. But there are two other important factors you have to keep in mind. Our credit card provisioning levels are at historic low. I looked at 25-year data from 2000 to 2025. Average credit cost provisioning to assets is about 1%. We are below 50 basis points right now. In fact, public sector banks for the last 3 years have been below private bank. They're at about 30 to 40 basis.
Yes.
This is unsustainable. Structurally, we are not such a low credit cost banking system. This is going to inch up. The other important thing you must realize is the pre-provisioning operating profit has been basically stable. It has not improved. So there is no gain on margins. There is no gain on operating costs. In fact, operating costs have set. So there is no productivity gain despite consolidation. What has added is a lot of recoveries that have happened of bad written off and bad loans. This is effectively the capital government put in coming back as profit. And so two of the three factors that are driving these extraordinary performance, to my mind, are structurally not sustainable. Or at least the jury is out. We'll have to wait for another couple of years to see whether this is... because the stock of bad loans are decreasing, so recoveries are going to go up.
Mr. Harshvardhan, you're touching a very, very relevant point, because I'm not asking a philosophical question or a political science question here. There are people who have loaded up on public sector banks because of their extraordinary performance of the last 5 years. But in the last 1 year, actually PSU shares have fallen a little more than private banks, because the feeling is exactly what you said, that all the provisioning, all the credit cost lowering, everything is over now. That is what I want to ask, whether you see structural reasons for the public sector banks to continue at least the strong performance, if not stronger. Harshvardhan, very quickly, sir.
So even the loan market share gain has been marginal, and it has happened in things like mortgages, where published banks are doing all low margin kind of prime mortgage. They are going at 15%. Private banks are going at 5%. So I'm not sure about the margins or the pre-provisioning operating profit maintained at this level. And clearly, provisioning costs are going to go up. So I would want to watch for another couple of years before declaring this to be a victory and a structural shift.
Okay.
For me, a significant outperformance is because of one-off factors.
Yeah, fair enough. And I have another relevant issue for all three of you. And let me start again with Mr. Mundra. So, the recruitment issue, it is still open exams, national exams. And you may now want an AI expert or people who are immediately, you see someone and you want to recruit them. This is a freedom private sector banks have and public sector banks don't have. I know of instances, I don't want to reveal it, in banks where you bring an outsider and they are really made to feel uncomfortable by the old boys club because this lateral entry is not very welcome. So therefore, do you think this outperformance in financials is difficult for PSU banks in the age of AI?
Okay, Lata, of course, I will respond to the question which is in a particular context, but I can't really restrain myself before reacting to a couple of the things which were mentioned earlier.
Okay.
I agree with Mr. Harshvardhan on some of the things about the guarantees and the MSME and gold loans and operating costs and the provisioning level, and they are unsustainable. My only caveat is everyone is on the same bandwagon. If one is committing sins, all are committing sins.
Yeah.
So private sector banks are no different in that respect. Yes, I agree. If you look at the end of 26, the total capital and reserve, which public sector bank as a block and private sector bank as a block are having in their books, is almost equal. But this capital is supporting a different level of business. The private sector banks it means they have the cushion of capital, they have the luxury of capital, and they have a better operating income. So I don't dispute that. And you talked about 2004 to 2008. I think we all remember what happened, where the things went wrong. The head office banking was happening and the large ticket loans were done. But one thing I can tell you very convincingly, that I think the public sector banks have learned their lessons well. Balance sheets are much better diversified, and they have started looking like both. Okay. Coming to your question about the lateral recruitment and people feeling uncomfortable, yes, in the beginning it was always so. But I would tend to feel that gradually this has become an accepted factor, and the now acceptance and the freedom to work is much greater than that. When we are talking about, interestingly, if you look at PSB and if we talk about 5 years, you will observe that the market share of all public sector banks put together has fallen comparatively more than SBI. SBI has been almost able to defend its market share even throughout the last 5 years. So, and digitalization and the apps and all that, I think they have put a very brave one. I would say, I would say there are issues, but it's not that suddenly that it's a 2-year wonder and now it's going to change. I don't agree with that.
Okay, actually, Mr. Harshvardhan has a point, sir. Where the advances have grown is, it is in home loan and auto loan. A product which private banks are not touching because the margin is very low in home loan and somewhat low in auto loan. You look at you look at personal loans, you look at credit cards, their percentage is increasing. So they are in a high risk, high return.
Sorry, Lata. Don't pick up the time frame selectively. If you pick up for home loan and this thing a time frame of 1 year and for other things 5 years, then it is selective.
Fair enough.
You look at that, and you will be surprised to know that we don't know who is following whom. When the private sector banks are following PSB model or PSBs are following the private sector model. It's a very mixed bag.
I agree with you entirely. And I can tell you that you mentioned SBI by name. SBI bankers are held in very high regard in private sector banks. They know they can't match some of their skills. So, I agree with you that there are times when private banks pick up the hint from public sector banks. And I don't want to run anyone down. I'm only very happy with the PSU performance. And so are a lot of investors, like I showed you the stock price. So, Mr. Mehta, this is clearly a stock market question. Do you continue to bet on PSU banks, or have they run their course, as the stock price seems to indicate? In the last 1 year, the outperformance has ended.
Lata, there is a large gap between the market reward to the public sector bank and what is there for the private sector bank. If you take terms in terms of market dynamics, you'll observe that the multiples available to private sector bank is as high as 16 or 14 times, whereas in public sector bank it's a 1 time or 2 time. So where there the multiples are still at a lower level, there is a scope for the market to provide further appreciation, because the performance has really improved during the last 5 years because of the certain structural changes, right from fees, that is a reform agenda, to the IBC, to the consolidation, to the digitalization that is being undertaken. So all these processes are bringing a future value to the public sector bank, and I hope they will continue to perform in future.
I like that word you say, hope, sir. Unfortunately, stock market does not look at hope as a data point. You know, the more important question I want to pursue with all of you is that within private sector banks, the old private sector banks have done much better than the new private sector banks. For example, RBL, Federal and Karur Vysya. There is a Karur Vysya representative over here. That is one of the best performing stocks in the last 5 years. So that question we're going to discuss threadbare after the break, whether the order of importance now has become old private banks, PSU banks and finally new private banks. That is not an order we were prepared for at all as stock market investors. That question after the break. Bazaar viewers, you will get to hear this after market hours. We have to take a break and get into Chartbusters.
Hello and welcome. You're watching us here on Chartbusters, and it's all about the earnings. The stock of the moment right now is Indian Hotels. A good performance coming in, delivered on all counts, a beat on revenue, EBITDA as well as profits. Though, remember, the air catering business saw some softness. It's the growth businesses that stood out, 22% year-on-year growth. We do have Puneet Chatwal, who is the MD of the company, joining us now. Thanks a lot, Mr. Chatwal, for joining in. Congratulations. You had earlier said that the first quarter looks good. Well, it is slightly better than what you had guided for the full year as well. 12 to 14% revenue growth is what the range you had mentioned. Even if you discount the low base in the first quarter, this gets offset by the uncertainties of this year's first quarter. So the question is that now that the first quarter has been above 14%, can we extend that to the entire year and believe that maybe you will cross the guided band that you had given for the full year?
Angulam, correction, because you asked me on the last quarter, on the last interview that we had, do you think you could go higher than 14 and could it be 15? I said yes, it depends on the impact of the West Asia crisis. If it's over, definitely it would be 15, but with a bit of luck, it could get there. So I think definitely the first 3 weeks of July have been extraordinary. Even higher than that number that we have seen, but whether it will sustain for the next 9 weeks, that we can't say today, but the outlook remains very positive, and we definitely see 12 to 14% growth and maybe even higher.
All right, 12 to 14% and maybe even higher. What brokerages are surprised by is the RevPAR growth as well. You're guided for high single digits. Do you think there is possibility that that goes to double digits this year?
Yeah, it looks likely if the summits don't get cancelled, like we had the cancellation of the Africa summit because of Ebola. Now we have the BRICS summit coming up, some other business delegations coming up. If all keeps going the way it is, and with the expected increase in foreign tourist arrivals in the second half of this year, yes, that could go up and sustain at a higher level.
Hi, Puneet. Good to see you in. What about air catering? That was a bit of a weak spot in quarter one, but the hope is that it recovers in quarter two. Is it showing signs of that?
No, I don't think it will recover in quarter two, but eventually it will. We have always seen that whenever there is a crisis, the demand in airline catering or in hospitality within those regions goes down, like for us, for our 3 hotels in Dubai. But the moment the crisis is over, it comes back much stronger than anybody could ever imagine. And I see no difference this time that whenever the crisis is over, the demand both in airline catering as well as in hotels in Dubai or where Dubai is well connected to, like in Maldives or Sri Lanka, that these markets will bounce back very strongly.
Okay, all right. Puneet, I took a flight from Mumbai to Tokyo, and it was an Air India flight. I'm guessing that, you all would have played a part in that. Food was yum. I was pleasantly surprised. So kudos on that one. Personal experience just narrating out there. But that said, let's talk about the international business. You've gone to the head, you're foraying into Germany, South Africa as well. How large do you think this piece can become?
The majority of our business will be Indian subcontinent, at least in the next few years. But we will keep growing selectively in key international markets. Frankfurt is very interesting for the years to come because there is a Lufthansa flight to Frankfurt from every key metro from India. There is also Air India flying to Frankfurt. It's a very good day flight, actually, that you mentioned, Mumbai, Tokyo. I would say Mumbai, Frankfurt is a highlight. The other places where we would look at is obviously Singapore, Bangkok, Bali, Switzerland, etc. So definitely not in the North Americas. I mean, we have no plan to go to Canada or to extend our presence in US. But if we get another good property in UK, we would look at it, but all on a capital light model. So if we needed to spend some money like we have spent in Frankfurt on renovations or startup costs, we'll do that to get our foot inside the door, but we are not going to buy single assets. That's not a part of our strategy. Definitely not in international. All our investments will be on the domestic front.
Right. As you were talking, I thought of if there was a phrase in which one could summarize what you've done, both at Indian Hotels, in the hotel industry, as well as now with the international plan, it looks like a string of pearls theory, right? When you started out, it was just the Taj, and then you diversified. That string of pearls happened to all the other brands. Now, even with the acquisitions, those strings of pearls have come by with Bridge and all the others that you've made. And now, which you're speaking about, looking at important properties at important destinations internationally, that also falls into the string of pearls theory itself. It seems like, you're looking at assets as individual pearls doing well, and all of that then looking, good on the overall consolidated business.
Even into a necklace kind of thing, right?
Even to a necklace. And, I just wanted to understand, in this necklace, when everything is woven, do the small pearls and big pearls eventually dilute, the overall return ratios, margins? Is there a possibility? Because, when there is a big diamond and next to it is a small diamond, no one looks at as much as the small diamond.
Yeah, I think the complement, it creates a very good design. So it's a destiny or the designing your own destiny. So you need the big and the small. You can't just work with the big in life, and you can't work just with the small. So as long as the ratio is good and the businesses are complementing each other and becoming a part of the customer journey. So if a customer is going into integrated wellness, then can go to Atmantan. If they want a homestay, they can go to an Ama. If they want an affordable stay, they can go to Ginger or Tree of Life. If they want to have that once in a lifetime experience, they can go to one of our palaces. So I think we are touching all the important touch points in a customer's journey today. And that's what makes it exciting. The aspiration, obviously, is the big diamond of Lake Palace or the Rambagh Palace. And the small diamonds like the Avantika or the Bridge Rama on the Ghats of Banaras is no less in those relevant markets and in those relevant locations.
Right. For Mangalam and me, we normally look just at staycations, I think. So the Churchgate property, the Bandra property, but I believe the Vikhroli property as well is something that we should be looking at. The palaces for another day for us, I think so, at current juncture of our lives. But Puneet, tell us about margins. How's the trajectory on that one?
I have, firstly, before I come to the margin, I'll come to this good idea. We just opened a nice boutique property near your house. It's called the Bandra House on the Turner Road. So you could try a staycation there. Or
it's 27,000 rupees a night, Puneet.
It doesn't matter. We can, work for
20,000 rupees, Nigel would say, why don't you stay at his house?
No, 10,000 you come and stay. But Puneet, tell us about margins.
Margins are very strong, 31% EBITDA margin for a business which has, pressures of airline catering margins falling by 10%, which has pressures from international business. I think from that point of view, Indian Hotels, as one of the companies or the only hospitality company which is global in nature from India, is definitely posting leading margins. On standalone, it crosses 40. So in Q1, 40% plus on standalone is a very good figure in margin. And we have always guided, we'll try to maintain margins, but margins are at such a healthy level. We don't like to give guidance on that. But our growth is very important to us, especially with the new businesses. We need to scale them up and scale them up as fast as possible, because at that level, scale is very critical.
Perennial question that always exists, right? 4,400 crores of cash on your books. You're looking at asset-right models. You're looking at investing in the right properties. You're looking at management for some other properties, etc. as well. But your tenure so far has also been consolidatory in nature, where you've taken down some structures, simplified some structures. Oriental Hotels, that's the question. 68% promoter stake, 2,500 crore market cap. The stock has been a buzz because of belief that maybe at some point in time, Taj would like to take the promoter's stake. What's the update here?
I think any kind of simplification has been part of the group strategy, which trickled down to different group companies. And, what we did 50 years ago, 60 years ago was relevant at that point of time. If you see, Now, we have not entered into any such relationships, at least in my 8.5 years at Indian Hotels. Why? Because it doesn't make sense to do that today. At that point of time, it made sense for all partners to come together and build businesses that way. So whenever any opportunity comes to simplify, we will simplify. We did that with Roots Corporation. It became a wholly owned subsidiary 3-4 years ago. Last year, we simplified by getting out of the Taj GVK partnership. And if any other opportunity comes to do that with any other group company, we will definitely look at it seriously and simplify the structures so that going forward, it creates more agility for us in decision making and also in terms of driving performance. It becomes very difficult to drive performance under the same brand when it sits in a different entity which has its own governance. So I think that is the key. If I wanted to invest, let's say, Indian Hotels management feels it would be great to invest 100 crores in Fisherman's Cove, which sits in OHL. Now, we have the cash we can deploy, but we can't do it like that. It doesn't work that way. So I think if any opportunity comes, we'll seriously look at it. And we are always looking for opportunities, whether it's a single asset acquisition like we did with Atmantan last year, or Ank and Pride as a portfolio, or with Bridge, or with stake sale in GVK. I think that would be a fair comment to make, that whenever anything comes up, why not? And if it helps our partners who've been partners with us for 40, 50 years, why would we not do that? That is the spirit of the Tata Group companies.
Okay. All right, we take that point. This time around, your answers are lot more colorful that you've given to us than what you would have earlier outrightly denied, but we'll take that on board. And also, probably, Bandra House, one of these days. By Bandra House, I mean Nigel's house and not the Taj Bandra House.
The offer is open to both of you all gentlemen with food and a couple of drinks if the need arises. Thanks a lot, Puneet, for joining in and giving us all of those details.
Thank you. Always a pleasure. Thank you for having me.
Thank you. With that, we take a short break, come back. On the other side, we have the management of another company. This one is new to the bourses. We have Cube Highways. The IPO opens. It's the Highways Trust, where the IPO is open for subscription. Vinay C. Sekar, who's the leader at the company, joins us.
Welcome back. You're tuned into Chartbusters here on CNBC TV 18. Well, as promised, we've got a new management that's going to be joining the bosses. Cube Highways Trust InvIT, that opens a subscription today. It's a 5,000 crore issue entirely in OFS with the floor price set at around 151 rupees a share. We're now joined by the management, Mr. Vinay Sekar, to walk us through the details and the objectives of this issue. Hi, Vinay. Thanks a lot for joining in.
Thanks, Nigel. Thank
so
you
a couple of quick questions. Why the switch basically from private to public? How does it help the company? If you could just give us a broad detail on that. And this is a complete OFS, right?
Yes, that's
so,
right.
no money comes into the InvIT. So, will the selling shareholder look to pair stake in the future as well? If you could give us some clarity on that front. Please go ahead.
Thank you so much for this. I think just to summarize again, 5,000 crore OFS. Yeah. The floor price is 151. The cap is 152. It is 100% OFS. It's the reason for doing this is to convert from private to public, because what we've seen over the last 3 years is that domestic investors have shown a huge amount of interest in infrastructure and specifically into InvITs and REITs. There's a lot of issuances that have happened in the recent past which have been very successful. And therefore, strategically, we think converting from privately listed to a public listed format would help us tap into wider pools of capital.
Okay.
Ultimately, the role of an InvIT is to release risk capital so that that can be used to create more infrastructure. The wider the pools of capital that come and play into InvITs effectively plays that larger role. InvITs are
what
able
explains
to,
then the OFS?
OFS, yes. So OFS, of course, at this point we don't need capital, but as a strategic option, we wanted to shift from private listed to a public listed InvIT, right? Yeah. We went to all unit holders and said, if you want to participate in an OFS, we're happy to facilitate that. The sponsors have agreed to participate. But what's also important to note is that they're committing 4 more assets to the InvIT, which they are going to swap for units. So eventually, after this, we will do a preferential issue where they will actually take on more units. So they are showing their commitment to the business through taking on units. But in order to meet our strategic objectives and make a reasonable sized IPO, we had to request people to actually sell through an OFS.
And, what's your asset procurement policy out here? Do you get everything from the parent? How's the valuation decided? Sure. And what's the outlook here?
Sure. Over the last 3 years, when we did our first private listing, we were 18 assets. We've grown from 18 assets to 27 assets as we speak. I've already told you the fact that we've signed 4 more assets, right? These are from the sponsors. In the past, over the 7 assets, 7 assets came from the sponsors. 2 assets, we took it directly from the market as well. So we're pursuing both strategies. A majority of our assets comes from our sponsors because they're very good at acquiring assets and de-risking it and making sure they are actually InvIT quality assets. But of course, if we find good assets outside, we'll continue to acquire them.
So the next 4 are also from the parent itself?
The next 4 are from the parent, which they've already signed for. Beyond that, there are 3 more assets for which they have offered a right of first offer. The 4 assets are the enterprise value. It's about 7,000 crores. It'll be at a discount to the enterprise value that a third-party valuer has done. So we followed all of the processes that SEBI mandates us to follow.
Okay, all right. Yeah. Give us a few more details then. Where do you see the AUM headed? If you could help us out with some clarity on that front. And the dividend payout is something obviously people who are applying will want to know. Absolutely. So give us some clarification on that.
So after this public listing, we will be the largest publicly listed InvIT in India. But the real advantage of this size is the diversification that it offers. We have 27 operational assets at this point in time, 18 of which are toll assets, which essentially give you GDP and inflation-linked cash flows. And the remaining 9 are annuities where you don't take the traffic risk. So it's like a portfolio of assets, debt and equity mix, right? In terms of the diversification, we cover 12 states and 1 union territory. And then 70% of our revenues comes from commercial vehicles and about 30% comes from passenger vehicles. You get the stability of the commercial vehicles, you get the growth of the passenger vehicles as well. So there's a lot of diversification in this pool. So what you get is a scaled, highly diversified and stable portfolio of assets that gives you long-term visibility of cash flows, which are both GDP and inflation linked. In terms of the question on dividend
and DPO.
DPO. Yeah. So in the last 3 years, in the first year, we distributed 10.09 rupees. In the second year, that scaled up to 11. And the third year, it went up to 13.77, right? There are 2 real factors that drive distribution growth. One is the organic traffic growth. Underlying portfolio is majority toll, and that will essentially give you nominal GDP linked cash flows. The second reason is the fact that we've kept on acquiring assets. And as I said, we've already we have a good pipeline of assets, 4 assets that are committed, 3 more that we have a right of first offer on. So that gives us a view to get to 34 assets in the near term.
Right. So, in the very near future, the bid pipeline from NHA has been slightly muted.
Yeah.
Does that pose an AUM growth risk at some point? And also on the assets that you have toll collections on, what's the average age of your portfolio and what's the pending back of the envelope NPV of the tolls which are expected or the annuity which is expected?
Yeah, so I think interesting question, because yes, we have a portfolio that is very mature. On an average, we have over 9 years of operating history on our portfolio, but that doesn't mean we don't have concession life remaining. Our average concession life remaining is 18 years, which is quite long and gives you the ability to ride through cycles, right? So that's one. On the question in terms of growth, we are 27 assets right now. 31 when we close the 4 assets. We have 3 more substantial assets for which we have a right of offer. So in the near to medium term, we have 7 assets. So our pipeline is very robust. Of course, beyond that, we will keep working on developing this pipeline. We've shown that in the past as well.
All right. Yeah. Take that point. Thank you so much for joining in. Wish you good luck. And once you list, we will press you more for some more details and some more numbers as well this time around. The questions will be a lot tougher.
Of course.
That we'll take a short break, come back on the other side. We get you more on the markets and a lot of stock-specific action. Stay tuned. Well, briefly, after going below the 24,000 mark, the Nifty is recovered from the lows, still holding above the 24,000 mark, but a cut of almost 160 points. We have Bajaj Auto, which has moved to the high point of trade and seen a decent move, and Nestle ahead of numbers. That stock comes up for you, has moved to the high point of trade as well. Let's get you some ideas from profit coming in from our colleagues at Money Control Pro, and today we have Jitendra Gupta joining in with the stock.
The recent correction in Siemens Energy India presents an attractive opportunity for long-term investors. The company has emerged as India's largest pure-play energy and power technology player. We think India is entering a multi-year T&D capex cycle with close to 9 to 11 lakh crore of investments expected through 2032. The national electricity plan targets nearly 500 gigawatt of renewable capacity by 2030, driving demand for HVDC corridors, ultra-high voltage substation, and grid modernization. Additionally, growth is coming from data center, nuclear power, which is good for companies like Siemens Energy India, which is operating in the entire value chain, entire power value chain. Moreover, the order book stands at around 18,000 crore, which is 2.3 times, providing strong revenue visibility for the next few years. To support further demand, it is investing close to 2,800 crore in capacity expansion, including doubling transformer capacity, setting up a new large power transformer facility. Exports already contribute close to 30% of the revenue, and which is also gaining momentum. In terms of valuation, while the stock trades at around 45 times FY28 estimated earning, we believe the premium is justified given its unique positioning, technology leadership, and of course the long runway for the earnings growth.
Thanks a lot for that, Jitendra. Well, on that note, we'll wrap up on this edition of Chartbusters. That's it from Mangala, myself, and the entire team that put the show together. You stay with us, though. The team of Trading Hour is waiting by.
You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangala Malu. With me, Hormaz Fatakia, as well as Ritu Singh joins in as well. It's a weekday of trade, no two ways about it. The Nifty down about 161 points, buoyed lower by a lot of factors. We've had poor earnings coming in from some of the banks, some weak guidance as well. Then you had Brent, which is now moved to $92 per barrel. The rupee, which has weakened further, closer to 96.5. And we have the broader markets as well. The mid-cap index down by almost 0.7%, 2,100 stocks in the red for about 850 in the green. So by and large, it's been a weak day. We've broken below important levels as well. The 20-day moving average for the Nifty for 1. Ritu, good morning.
Good morning, Hormaz, and good morning, Manglam, to you as well. Yes, we've broken below that important, mark. But, it's right across the screen. It's the third straight day of selling that we're seeing. And like you pointed out, some of the earnings have been a bit of a disappointment. All of that is weighing on the sentiments. You have the Bank Nifty that's down almost 580 points as we speak. That's, dragging the frontline index lower, as is the IT pack. That's also trading in the red today, down about 230 points as we speak. And the broader markets don't look any different. The market breadth also shows you more than 2 stocks are declining for every 1 stock that is advancing at the moment because, the macros also don't look very good. Oil prices back to the levels that we'd seen weeks ago in June at 92. So, none of that is looking very good, for the equities right now. But as always, let's focus on individual movers and shakers and what to keep your eye out on. And Hormaz has walked over to the wall with that list.
Over the last couple of days, the Nifty the bulls were playing he loves me not with the Nifty, and the Nifty continued to grind lower, and today it is trying to give a decisive answer to the bulls by moving further down, and but the bulls are not throwing in the towel just yet. They're still trying to hold on to those levels of 24,000 as of now, still 170 points lower, yes, but it is the banks that are causing this pain as has been the case. So the Nifty Bank 2 is now down another 500 points, and now it has broken below the 57,500 mark, the lower end of the range that it found itself in for a better part of the last couple of weeks now. And so it's now 57,000 on the downside becomes the first important level to see for the Nifty Bank as well, that too at the low of the day. But the accident of the day has to be Bandhan Bank. Results were mixed, but the commentary was on the weaker side. Some downgrades have come in as well for the lender, 15% lower on the stock. The biggest single day loss, I beg your pardon, since March of 2020 for Bandhan Bank. Some of the other earnings reactions as well have not been very impressive, at least on the negative side. Gabriel is down 7%. More than the earnings, it is of course the transaction that they have gotten into. India Mart is down 5, was down 7 as well as 1 point. And Aavas Financiers too, trading with losses of around 4%. The sector in focus today has been pharma. The latest announcements made by Donald Trump on the generic pharma tariffs, and that has had an impact on the smaller pharma companies more than the larger names. Of course, the larger names are down as well, but Marksans Pharma is down 7, Solara is down 6, Granules, despite the management telling CNBC TV 18 that they are well positioned in the US, they have manufacturing there, they are looking at expanding their presence in that country, is still down 5.5%, and Aurobindo Pharma as well, trading with losses of 3.5%. Almost every stock on the Nifty Pharma Index trading with losses today, and some stocks that are extending their gains after their first quarter results. Look at M&M Financial. More upgrades have come in for the stock today. 7.5% higher on this one. And the stock was up 8% after its results yesterday. Adding to that tally, Bajaj Auto 2 among the top gainers on the Nifty today. 4% higher on the stock. And TVS Motors 2, the stock that ended 6% higher after its results yesterday, is added another 4% to its tally. Some stocks that are making headlines, of course, they too, some of them are result reactions. Cyan DLM is a positive one, 14% higher. Indigo, of course, with the rise in crude oil prices having a negative effect, 3.5% lower here. And Data Patterns, the stock was set to be winning an order yesterday. That stock was up around 6-7%, extending its gains by adding another 7% to that tally. And lastly, stocks at 52-week lows. Look at MedPlus, that's down 15% as well today. Another earnings reaction. Asian Granito and Sai Silks Kalamandir too not having a very good day at the office. Ritu.
Hormaz, thanks very much for running us through that exhaustive list. Let's bring in the first management of the day on the show. The Indian Overseas Bank management, they'll be joining us. They've delivered a high-quality April to June quarter. What aided the show in this quarter was, asset quality seeing a sharp improvement. Gross NPAs were down almost 64 basis points sequentially. The lender, in fact, has also had the strongest provision buffers it's maintained among peer PSU lenders. So, to put context into the quarter gone by and, what lays ahead, we're joined by the MD and CEO, Ajay Kumar Srivastava. Mr. Srivastava, thanks very much for your time here on CNBC TV 18. And congratulations on what's been a steady performance. But let me start with your guidance. You're talking about a credit growth guidance in the current environment at 13-14% or so. historically, the bank has delivered 20% plus in the last 3 years or so. And, even the system-wide credit growth is running at 2-year highs at 18, 19%. So, are you being conservative with the number, or, do you see perhaps fewer opportunities that some of the other banks are talking about in the market?
No, certainly it's not a question of being conservative. This 13-14% guidance which we give every year, that is the minimum which we intend to achieve. And last 3 years, the guidance has been that only 13 to 14% of growth. But in fact, actually, we have delivered the growth of 20% plus. And going forward also, that is going to be the strategy. That 13 to 14% is going to be the base. Beyond that, we are not putting any limit. If circumstances allow, conditions allow, economy supports, of course, this year again and going forward also, it can be 20% plus growth in credit.
So the strategy is to under-promise and over-deliver. But Mr. Srivastava, what about the deposit front? I read in your commentaries you're targeting about $600 to $650 million of FCNRB raised by the end of September. What will that do for your deposit number? Are you baking that into the guidance as well?
Yes, see, we are having 4 overseas centers, and we are having a customer base of NRIs to the tune of more than 4.52 lakh active NRI customers. And with the new dispensation given by RBI, we very aggressively approached our NRI customers. All 4 overseas centers have been put into action. And the combined sum of all the efforts, we have created a FCNRB monitoring cell also at central office. So the combined sum of all these efforts have resulted in mobilization of 300 million of fresh FCNRB deposit over last, I will say, 2 to 3 weeks. And we intend that by the time this dispensation comes to an end by September, we should be able to move up additional 350. So total, it will be around 600 to 650 of fresh FCNRB mobilization. That is what we intend to do. And 300 million we have already done. And its entire thing is without leverage, one-time leverage, I will say. That is akin to loan against deposit, whatever FCNRB deposits we are getting. Against that, we are giving 90-95% of the loan, and that too one time only.
All right, so that gives us some clarity on what you're thinking of from the FCNRB perspective. If you could give us some sense on the yields going forward, and given the interest rate scenario, what is the NIM profile likely to be?
If you look at last 4-5 quarters, our NIM numbers, we have been consistently able to maintain at around 3.30 to 3.40 in that range. This quarter, the domestic NIM is 3.48, quarterly improvement of around 13 bips. And global NIM is 3.37 and 12 bips improvement quarterly. And going forward also, we are pretty confident that we will be able to maintain NIM in this range around 3.30 to 3.40. That is the guidance for this year also. It may improve, but certainly it's not going to come down.
Mr. Srivastava, what about your asset quality, sir? You had mentioned that you're expecting the slippages to remain minimal. You're not seeing any alarming stress. But is there some that you are seeing, because your SMA2 book has gone up by almost 500 to 600 crore rupees sequentially, and the total SMAs were down around about 2200 crore. What is the asset quality picture looking like? Are you expecting more upgrades and recoveries this time around, this financial year?
Yes, exactly. Last 2 years, our slippage ratio has been one of the best in the system. And for this June quarter also, slippage ratio is 0.06% only. In absolute terms, it is 195 crores over a credit portfolio of above 3 lakh crore plus. And the slippage ratio has been hovering around 0.11 to 0.13 or 0.14. Of course, SMA has increased by 500 crores. That is a temporary phase, I will say. But if you compare actually out of that, how much has slipped actually to NPA, it is hardly anything. As I said, for 3 months, for a bank which is having trade portfolio of 3 lakh crore plus, the total slippage is 195 crores only. And last 4 quarters, there hasn't been any corporate slippage. So asset quality wise, we are 100% safe and secure.
Got that, Mr. Srivastava. Thank you so much. That's all the time we had, but a pleasure having you here on CNBC TV 18 and look forward to the next conversation. We'll slip into a short break on that note, but when we return, we'll get you, the stock of the day. The management of Bandhan Bank joins us to discuss their first quarter numbers, also get you some bond updates.
Welcome back. The stock of the moment is Nestle. Just look at the intraday chart. It's up 3%. The stock went into numbers at a record high, did extremely well, but continues to do well. Why is that? Because these numbers are phenomenal. There's no other way to put it. The street was expecting a 19 to 20% revenue growth. The company has gone ahead and done a 25% revenue growth. Well, the street was expecting a 25% jump on the EBITDA. The company went ahead and did a 40% jump on the EBITDA. So EBITDA is coming at around 1,538 crores. This compares with the poll of 1,375 crores. Margins at 24.1% at a multi-quarter high. And then you have a net profit growth, where the street was anyway expecting a 30% jump over same time last year. And the company's gone ahead and reported a 48% jump in the net profit as well. 975 crores versus expectations of 857 crores. The same time last year, the company did 659 crores in their profitability, which has now jumped to closer to 1,000 crores. And the domestic business has been, the strong leader out here. Exports, obviously, on a much smaller base, grew over 30%, but domestic business grew by 25%. And we've seen the management commentary as well. They've said a large part of the growth has been volume-led. And the company, the last time we spoke, hadn't taken any price hikes in the first quarter. So suffice to say, volume growth this time around could be over 20%. Has that been broad-based? Turns out yes, because if you look at the internals as well, there has been growth which has been led by the confectionery business, which is doing extremely well. Deeper penetration of Kit Kat and chocolates into beyond urban areas is growing for them. Powdered and liquid beverages doing extremely well for them as well. 20th consecutive quarter of double-digit growth. Nespresso at the premium end is doing well. And alongside that, a strong double-digit growth for prepared dishes and cooking aids as well, which obviously comprises of the Maggi portfolio. The one portfolio of the company which wasn't growing as fast in the past and as fast as all the other parts of their portfolio was milk products and nutrition. But here as well, there has been broad-based performance as per the management, built on underlying volume growth across key brands and channels. So there is strong growth from old products and new, and much stronger than what the street was anticipating. The stock not particularly cheap now after this up move, close to around 62, 63 times FY28 earnings. But if you continue to delight shareholders with this kind of outperformance, no reason for that multiple to not sustain. So that's the stock of the moment. Nestle, 25% revenue growth, 50% plus profitability growth, 40% plus EBITDA growth, a good quarter. Ritu.
Take that, Mangalam. What's really not delighting shareholders, though, on the other hand, is Bandhan Bank. That stock is down more than 15%. They've had a reasonable quarter, no doubt. But what's really worrying investors is that very sharp cut in the exit quarter ROA guidance that has come in. So let's bring in Partha Pratim Sengupta, the MD and CEO of Bandhan Bank, to discuss what's really happened there and the way forward. Mr. Sengupta, thanks very much for your time here. Let's start with that ROA guidance that has spooked the street. We'd seen lows of 0.2%, you'd recover to 1.1% or so. And when you'd come on, you'd said, the bank could go to as high as 1.8%. Why the cut now? I mean, we understand that the environment is uncertain. But the fact of the matter is that the asset quality environment overall for banks has been improving. We're starting to see growth trends in the MFI segments as well. So why now? Why have you cut this guidance?
Okay. So let me tell you that when we gave the guidance, it was just after 1 month of my joining. For sometime in December, January, we have given the guidance. And it was based on one major factor, that we will be going back to the same level of microfinance, and the contribution of microfinance in the ROA would be as robust. What we have witnessed at one point of time, you remember that the bank's ROA was 2.5, and when the microfinance share was almost 65 to 70%. Now, then we witnessed the turmoil that happened in this particular segment. Almost all the MFIs lost monies, the NPAs were higher. We were also not insulated. While we have performed much better than the industry, there was definitely an impact on our ROA. We thought that this should be overcome by December quarter end, but unfortunately, it took almost a year time. The recovery started, say, mid-November onwards for that year. By that time, our ROA has dipped to 0.2. Now, after reaching an ROA of 0.2, we again reworked, strategized, and then moved on, and we moved on only towards the north. So 0.2 to 0.4, 0.8. Then we ended up the last quarter at 1.1. And this year also, after also incurring an one-time expenditure of 61 crores on account of this New Wages Act, for that, which is a one-time expenditure, we have maintained an ROA of 1%. So we are improving. But at that time, when we have given this guidance, there were two basic things on assumptions. Definitely. Number one is that we will continue to improve our NIM, which was already at around 7.4% at one point of time. As you've seen that as we move towards the more secured books, it has moderated. We have given that indications, but we thought that the cost of funds would. So the first thing was that when the repo rate cut happened, we told the investors also and also to the market that, okay, we have to pass on the entire benefit to our borrowers, but the plus point from the benefits from the depositors, which we will get only at the time of renewals, which will happen Q4 this last year onwards, and the entire Q1 to Q4 of this financial year. But what we are actually seeing in the market is that while we got the benefit in Q4, Q1, but there is a pressure on interest rate, although the repo rate has not increased. You have seen that the GSEC has not come down. Number one, the other market interest rates are also a little bit, I would say the moderation has not happened to the extent. So definitely I can say that the cost of funds for which many banks, and especially our peer competitive banks have increased their rate of interest. And we also, being a bank for only 10 to 11 years, we also need to increase the rate of interest. So the effect of the benefit of cost of funds, what we expected that we will get for the entire quarter, has not now being looked for. That is the main thing I can say, a major factor. The second factor is, again, we thought that everything in the microfinance segment has been corrected. We have also revamped the model. The new credit underwriting system has been introduced. The SRO guidelines have been implemented. So all these factors definitely are doing all the internal corrections. We are very, very now strong in our credit quality in this segment. But the question is, if you want to give a 1.8 ROA, I need to be over in particular segment. And considering the current West Asia crisis for that year, and this segment is most vulnerable to the energy crisis, which will get the first affected for that year, this particular segment. So we need to be very cautious in our growth. So we kept a very moderated growth
very
of
briefly,
5%. Yeah.
Yeah, but we got that, Mr. Sengupta. Just very briefly, so then should we assume, given that you're seeing continued stress in the environment on account of what's happening in West Asia, is this a conservative guidance? I mean, could you go even below this cut that you've given of 1.2 to 1.4? And how long before you get back to the 1.8% originally guided range?
Let me just tell you for that year that this is definitely, we have shown that from September onwards, we are making sequential improvements, and that would continue. That is definitely, we will have to continue, and that will be done also for that. So we will probably not come down below what the guidance that we have given it. But the question is that we wanted to be very, very transparent and clear to our investors. I could have given this guidance a quarter back, or a quarter that is debatable, or a quarter forward for the day. But the question is that, you see, that if I want to maintain 1.6, 1.8, I need to be over the secured books, which is under intense competition, and because of the rising cost of funds, will never give me that ROA. It is only the unsecured books. So I need to be over aggressive. What we have seen in the past and very recent past, we don't want to repeat. So we have to be cautious and cautiously grow. Again, I'm saying that we are not stopping the growth. We will grow in this segment, but we will definitely keep a watch that uncertainties do not affect our balance sheet. And that is why we are transparent to our investors. I hope there is a knee-jerk reaction, yes, in the market, but I hope the investors would understood, and continuously they would appreciate that our continuous performance quarter after quarter. You see, already I can say that the worst period for Bandhan Bank is over. We are now only growing and improving.
Mr. Sengupta, since we've very little time left, on your margins as well, there was this expectation and you had guided that there would be an improvement. Instead, we're seeing margins at about 6.2% only. I mean, have these bottomed out? And, with the kind of tech spends you're undertaking, etc., is there room to expand from here? Very briefly.
We said that the main reason for cutting the ROA guidance is because the major factor is the NIM for that year. So we were expecting that it moderate to 6.5, but we are finding that probably it would be stable at this level. Even I can say that a little bit, and coupled with this is definitely the tech cost that has increased because of the West Asia war. You see the cost of servers, the cost of any of the infrastructure, tech infrastructure, they have suddenly got increased for that. You can find it. And we are investing huge on technology. Last 2-3 years, we invested on CBS. Now we are investing on the LOS. We have to continue our investments on the digital products that we cannot stop. So all these affected the operating cost to assets, which was we contemplated that it would be around 4.1 to 4.2%, has already reached 4.3%. So majorly this NIM and this operating costs are the major two factors where we feel, although our credit costs would improve, sequentially would improve, but we are expecting that yes, NIM will probably be stable or contained at this level only.
Okay, so it won't expand as you had previously guided. Mr. Sengupta, thank you so much for your time here. Many more questions, but we're out of time here, and hopefully have you back when you report your next quarter earnings. Take a break on that note. Back with more on the markets in just a bit.
Welcome back. Now, in some important news that could impact the Adani Group airport business and the GMR Group that operates and holds controlling stake in major airports, including Delhi and Hyderabad, a Bloomberg report suggests that the government is weighing a major policy shift that could shake up India's airline duopoly. Sources are now telling Bloomberg that the Aviation Ministry has initiated talks on a policy change that would allow airport operators to own and run airlines. Here's why this matters. Now, the current rule bars any airport operator from holding more than a 10% stake in an airline. Now, that's the wall that the government may now look to bring down. Now, any waiver, though, won't come easy and will need legal clearance, first from the Law Ministry, then from the Cabinet. So this is still early days and deliberations are still underway within the Aviation Ministry. CNBC TV 18 has reached out to the Aviation Ministry for a comment, and that response is awaited. Remember, the Adani Group is India's largest private airport operator and holds a majority stake in the Mumbai and the Navi Mumbai airports and operates 6 others. In fact, CNBC TV 18 Shireen Bhan spoke to Jeet Adani in December of last year ahead of the Navi Mumbai airport launch on the group's possible foray into the airline business. Here's what he had to say.
What part of this business are you currently not into that you want to get into? I mean, you know, the big question is a foray into airlines the next big plan on the Adani Group's calendar?
No, absolutely not. We were legally not allowed
I know,
to.
but I know you're legally at this point in time not allowed.
Yeah.
But the government's been talking about, you know, competition. The government's been talking about the need for a large airlines, especially in the light of what we've seen happen with Indigo.
Absolutely.
If tomorrow the opportunity were to arise, would you consider it?
I would say there's nothing that we won't consider. But as it stands today, structurally, the airline industry is not something that we see, fitting our sort of capital discipline. We're used to high margin businesses, investing in asset, and sweating that asset well. The airline is completely opposite in every.
So from a unit economics point of view, it doesn't make any sense for you,
for us. No.
For you at this point in time, or even in the future.
Yeah.
If the opportunity were to arise.
Yes.
So that's not something that you would consider.
Not at all.
All right, with that, we'll take a short break. Come back on the other side. George Joseph of Ask Investment Managers joins in for some market stock talk.
Welcome back. The frontline index still very much in the red. 24,040 is where the Nifty is at, and the Bank Nifty trading with cuts of almost 1% at about 57,295 as we speak. Oil prices, they're continuing to rally as well. They've hit a 2-month high on the back of worries that there could be more disruptions thanks to the escalating tensions in West Asia. Oil prices now actually are at the levels that we had last seen in June, hovering around that $92 a barrel mark for the Brent. As a result of that, the rupee is also seeing quite a bit of pressure today. We saw that relief rally in yesterday's session where it closed at 96.23 against the dollar. But since then, it has resumed its slide back, currently at about 96.46, not too far off from its record low. RBI interventions have been few, they've been sporadic. And, even with all those RBI measures to draw in dollar inflows, that seems to be working, as we've been telling you here. And it's helping confidence, but immediately it doesn't really create enough dollar supply in the spot market to offset some of that dollar demand that's coming in from importers. So oil prices continuing to pressure rupee, and the combination of that, weak rupee and the rising oil prices typically triggers the stop loss selling among traders, and that's forcing bond prices down as well. And therefore, the yields, which are inversal, are going up. So yield on India's 10-year benchmark GSEC has also come under a bit of a pressure on your screen now at about, we can see about 6.8% or so. It's been hovering around there. So that's as far as the macro setup is concerned. Manglam, over to you for our next guest.
Yep, we do have with us, a fundamental market expert joining in. We have George Joseph from Ask Equity, CEO Equity at Ask Investment Managers, who joins in to discuss the way the market's set up right now. George, we thought that maybe the worst of the war is behind us. And from a price standpoint, yes, it is. But it seems like the worst of volatility isn't behind us, the uncertainty. We're still not very sure of where this goes from here on. Oil prices from levels of $72 per barrel, as low as that, have bounced all the way up to $92 per barrel. What is the investment scenario looking like as per, what, the geopolitical scenario is? Earnings haven't particularly been bad so far, but a few of them have not actually done well either.
Yeah, absolutely right. If I look at from my fund manager career perspective, the last 25 years where I've been associated with the fund markets, I seriously think this is one of the most exciting time that every day new news flows, and especially driven by the US president's tweets and messages, markets dilly-dallying. This kind of scenario I've never come across in the past. And this is very, very unique and it's very interesting. So how this will pan out is anybody's guess. But if you look at from the fundamental perspective, India macro is fairly robust compared to 2013 levels, where the twin deficit was high, dollar was appreciating significantly, and also we had the current account deficit, and as well as the inflation on a significantly higher trajectory. So whereas today it's exactly the opposite. Inflation is benign to a certain extent. And even after 80-85% move in crude oil price last 3-4 months and then cooling off. So we have not seen that much of impact in the macro. And that is the beauty of India at this point in time compared to what it was earlier. So macro perspective, we have significantly improved compared to what was more fragile in 2011 to 13 period, where the taper tantrum and all was going on. And when you look at from the fundamental growth perspective, the capex-led growth is clearly visible. Corporate capex is growing. Listed companies of top 500 companies, the corporate capex is growing. It's roughly around 12 trillion rupees, and government capex is around 12 trillion rupees. And state government capex around 8 trillion rupees. So it is growing at a decent pace. So we are in a new cycle starting 2020. It's a capex-driven cycle in some shape or form, not like the way it was in 2006-7, where China was growing at 10% and India was growing at 9%. It is half the growth of China right now, and India growing at 6-7%. So it's a very different level of expectation we need to build, but at the same time we are in that regime of cyclical rally taking place, and that started in 2020. We are still on. Market volatility, as you rightly mentioned, it is significantly higher than what it used to be, and we have to live with this kind of situation. But looking at fundamentals, is there any spotting opportunities possible? The answer is yes. Banks and financials as a space is looking very attractive, and various other sectors like that.
George, the sector of the morning has been pharma, with the latest announcements that have come in from President Trump on the generic pharma tariffs over the 2-year timeline that he has laid out. Do you see this as on the flip side of things, do you see that the generic pharma companies now get more clarity on what they have to do over the next couple of years, and by the time the 200% tariff is supposed to take effect, President Trump's term would almost be coming to an end? So how do you view this fall that you have seen today in the pharma names? Do you view this as a buying opportunity for the longer term?
Definitely, yes. These companies have proven their mettle over the last 20, 30 years. It is not like, it's a one-day game. It has been there, proven in the global landscape, and not only in US, in Europe and other markets as well. So Indian companies are capable to handle these kind of situations. But having said that, 100%, 200% tariff, is not practically possible. Looking at the volumes that India supplies to US, the day you say that, the tariffs are going to be significantly high, many drugs will be out of the market, and which will put, US many patients under pressure, right? So if you look at the antidepressant pills, you look at the diabetic pills and, various other pills, which US consumers are having, and majority of it, the volume that India supplies is like massive. And, one of the companies in India itself supplies almost 10% of the entire volume in the US, generic volume. It's like a different scale at which India operates. So it is not easy for US also to curtail the supplies and, live with a very low cost regime. So to my mind, these are all noise. We need to look into the details and see that maybe some cost of compliance will go up, some sort of a baseline shift of manufacturing to US, maybe 10-20%, companies have to think about, so which will add to some sort of margin impact. But overall, US market is going to be very lucrative for Indian pharma companies from a long-term perspective. So still companies will deliver good growth and, margins in US, and the companies who are positioned there well in advance and have proven their mettle over a period of time will succeed. So I am very, very positive on pharma, and this looks like an opportunity. Any dip is an opportunity to buy into these things.
All right, two-word answer. What two other sectors are you, bullish on right now?
If you look at what we think is that, the cyclical sectors like banks and financials, as I mentioned, is one of the cheapest sector. IT is coming out of the lull period again. It is a global cyclical sector which is coming out of the lull period of the news on Anthropic and the AI, and so it looks like a very good services-oriented business which is available cheap, which looks like attractive to me. If you look at the capital goods and engineering, which is exposed to the data center manufacturing arena, and you look at the way even the two-wheeler exports, the numbers which is stacking up from the Indian companies, it's all looking very, very attractive. So exports as a basket, manufacturing exports or import substitution, be it in defense or other sectors, it looks like, very interesting play. So manufacturing, engineering, capital goods sectors, looks robust as well. So we are like the entire cyclical basket, to be frank.
Pleasure having you today, George. Thank you for sparing time and joining us. Looking forward to the next interaction. Let's take a short break. The management of India Mart on the other side in our Earnings Central. Stay tuned. Welcome back. Onto the management of India Mart. Then it was a muted first quarter. The key concern comes from the consecutive decline in paying subscribers. We are now being joined by the founder and CEO, Dinesh Agarwal. Dinesh, good morning. Thank you for taking out time. Yet again, similar question as always. Paying subscribers continues to remain a concern. Third straight quarterly decline. And the same again. When does this stabilize? More importantly, forget growth. When does this fall, stall, and then we talk about growth going forward?
We continue to do various initiatives on the product side, on the trust side, and on the advertising on the buyer side. It is reflecting into the better retention and monetization on the gold and platinum suppliers, but on the silver suppliers who are coming newer into the platform, we are not able to arrest the the churn, and that is why we continue to see a stagnant or declining number of subscribers. And it is also compounded that since the churn is high, we are not going very heavy on new supplier acquisition also. And we are trying to find ways and means or reasons to further improve the supplier retention, and then we can go whole hog on the supplier growth. So I can only say that we keep trying various things, and as and when things will improve, we will let you know.
You know, Mr. Agarwal, you've been saying that for nearly 2 years you've acknowledged subscriber challenges, yet net additions continue to deteriorate. I remember clearly you had said that it's a product market fit problem, and there's nothing that you can say until you see about 2,000 to 3,000 subscriber additions for a few quarters, before which you can call out a trend. I wonder what, product market fit challenges are you now solving for, largely because on the one hand, subscribers aren't coming. Then the existing ones, they're upgrading. So there is ARPU, which is there, but the feeder to the upgrade, which is the silver category, is not coming by yet, right? And then at the same time, to arrest that, you've also gotten, the supply, the other side of the market has come down. So it seems like a vicious cycle.
Yeah, I mean, these network effect businesses, when they reach a certain scale, these churn issues can become elongated, and we need to find a further product market fit which can increase the number of buyers quickly, which can help suppliers retain better. Because in terms of the number, the quality of inquiries and everything, I think we have seen significant improvement, and the suppliers are liking that. And that is reflected in the gold and platinum monetization. While the number of buyers has been stagnating, and we are trying to do the performance marketing, since we have never done the performance marketing ever since 2016. So now we have started doing performance marketing for the last 3-4 quarters, and we have been able to arrest the churn on the buyer side. So that's why I'm saying that until we find a better product market fit on this side, we will continue to fill by way of advertising, because there's multiple things that are going on in the market. There's buyers are also going from Google to AI overview to ChatGPT to so until this whole thing settles down and we find a better product market fit on that, I think we'll continue to remain in that single-digit growth trajectory.
Mr. Agarwal, let me just push you a bit on that. I mean, this average revenue per user, the growth has been slower, but marginally and steadily you've been increasing that. 64,000 to 69,000 is where you're at. Is that going to continue to do the heavy lifting while, your subscription base keeps coming down? Is that the plan? And also on margins, if your customer acquisition cost is actually coming down, what is offsetting, with your margins actually coming down, to about 35.4% from 35.8%? What's happening there despite the acquisition cost coming down? Why are margins still under pressure?
The margins are not pressure. We have always guided that we maintain margin at around 33% plus minus. These are the quarterly ups and downs because the fourth quarter is typically very heavy on the collection, and that's why the collection expenses are also heavier. And the first quarter is slightly, because the margins are coming from revenue from operation, they are not coming directly from the collections. So if you really see, the revenue from operation is an 18-month average of the collections that are coming there. On the subscriber side, as I said, we continue to work, but there is no point going very heavy on the subscriber addition until we fix the churn. And whatever 1 lakh customers that are liking our service very much, for them, we continue to improve the supplier retention and supplier upgrade by way, whatever buyer advertising that also we are doing only for the categories where we are able to monetize better. So I don't think we will be under pressure of the revenue growth. We will continue to do that 10% kind of a revenue growth. But yes, you are right. Mostly it will come from the ARPU growth. Until we fix the churn, the customer-led growth is not coming.
Just a final question before we let you go, Mr. Agarwal. The one part of your business which is doing well is Busy Infotech. You aspire to grow between 35 to 40% CAGR out here as well. What's the incremental investment that is needed out here? And secondly, what's the contribution of Busy Infotech to your overall numbers right now? And by when does it become significant? What's the 3-5 year target here?
Yeah, so this particular quarter, Busy Infotech numbers are in terms of revenue from operation, Busy was 36 crores, and in terms of collection, Busy is 59 crores. So out of the 463 crores, 59 crores collection came from Busy. And so this is now becoming almost 15% of the collection and almost 10% of the revenue. Going forward, as Busy continues to do 30% plus kind of a growth, we expect this share of the revenues to increase in the overall revenue.
Mr. Agarwal, pleasure having you today. Thank you for sparing time and joining us, and wish you good luck for the rest of the year as well. Take a short break, focus on the bond markets on the other side with Manisha Gupta.
Well, as promised, let's shift focus to the bond markets. Manisha Gupta joins in with an update from there on our bond market special.
Well, the Indian bonds have opened slightly on the lower side, and the corporate bonds actually have been trading in a very, very tight range for the last couple of days now. It is about the crude oil prices trading above $92 a barrel yet again. If you look at the prices, they are up more than 30% from its July lows, and that is where the concern comes in for a country which imports 85% of its crude requirement. The pressure on the Indian rupee has just about continued as well. There is dollar strength. There is weakness also when you look at the Indian equity markets. The regional equities have been trading on the weaker side as well. Traders are expecting, though, that the inflows from the RBI special measures would continue to support the markets herein. If you look at the overall number, it has been to the tune of $17 billion worth that we have seen come in for the FCNR deposits therein. When you look at the overall secondary market deals, well, Tuesday has been much better than what we saw on Monday at 89 billion. Yesterday, which is Tuesday, was 105 billion. So a bit of a gain up in sense of volumes therein. The issuances that are lined up yesterday were quite negligible. Only one company which came out with a private bond issuance. But today, there is 39 billion rupees which is getting bid today. Within this, you have Bajaj Finance, which is planning to raise nearly 20 billion via bonds which are maturing in June 2029. And then you have HDB Financial Services, which is also inviting bids today to raise nearly 10 billion, and they are doing it via reissuances of their July 2029 bonds therein. There are a list of other issues as well which are open into the market today via the private bond issuances window. You have Asirvad Microfinance, you have SMFG India Home Finance Company, there is Indostar Capital Finance as well, to name a few. So today the private bond issuance market does seem quite healthy therein.
Thank you, Manisha, for getting us that update. And on that note, Manglam, Hormaz and I take your leave in this edition of Trading Hour. But stay with us. All the news and updates will continue right here with Halftime Report up next.
The market is a sea of red as Trump raises the tariff threat, with generics the latest to draw his attention. No let-up in the US-Iran tensions adds to the concerns. Realty, healthcare and financials are the big drags.
Donald Trump has now put pharma generics on his Make in America list, and he's warning of 100% tariffs on imports in 2 years down the line. The levy, he says, will rise to 200% in the following year. The announcement has India Pharma in a tizzy.
Bajaj Auto and TVS Motors see strong growth in the domestic market, but more importantly, they expect exports going full throttle. Bajaj expects to ship 2.5 lakh units a month, while TVS sees a further pickup in overseas sales.
And Bandhan Bank slumps after it says return on assets will dip and its margins will remain under pressure, while MedPlus's CapEx plan seems to spook the street. On the flip side, Cyient DLM surges on beating estimates and flagging new growth verticals. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a session which is down and out for the markets, you'd have to say. So we have the Nifty, which is just about testing 24,000 as we speak. We have the mid-cap index, which is also down and out, down around 1%. Remember, it has been resilient for the broader markets this entire week, but that seems to be coming undone at this point in time. The Bank Nifty too at the low point of the day, down around 1.2%, or over 700 points gone on the Bank Nifty. We do have, besides the financials, which is weak, we have the pharma index, which is reeling under pressure in today's trading session on the back of the President Trump tweets. But separately, stocks such as Bajaj Auto are managing to hold up with a gain of around 4.6%, and Nestle doing well post numbers as well.
Hi Ekta, good afternoon. You're trying to bring some green on the screen with the auto pack, but auto is the top sectoral gainer, right? And Bajaj Auto, TVS Motors among the top gainers. FMCG, slight bit of a green there because of Nestle, UBL, Radico. All these are managing to support the FMCG pack. Apart from that, there's nothing exciting and nothing green on the screen. We have Realty, PSU banks, Pharmas, all of them trading in the red. So let's look at the broader end of the market, right? What is the mid-cap index doing as well? Mid-cap index is also down in today's trading session, along with the benchmark indices. Now, Nifty mid-cap also is trading with cuts of around 8 and 9% in the trading session as well. Similarly for the small cap index. So advance decline ratio today, obviously more in the favor of declines versus advances in today's trading session, given that both the mid and small cap are trading at the day's lowest point. You have numbers coming in at the bottom of your screens as well for SmartWorks, so keep an eye out on that. Net profit at 13 crore versus a loss last year, as well as in terms of overall the performance of the company. We've seen the stock price also spark up and jump up and trade after these numbers are just reported. So yes, that's SmartWorks numbers for you. Revenue growth of 44% as well. We'll watch out for that. But let's talk about what's on the show for you all today, right? We'll be putting the spotlight on pharma stocks, which are buzzing today's trading session and focus as Trump has presented a renewed timeline for tariffs on pharma drugs. Now, we will take this conversation forward with Darshan Jain of Indian Pharmaceutical Alliance, as well as later with Bernstein's Nandan Kulkarni, to understand the impact of Trump's tariffs and on the pharma companies and what it means for Indian pharma companies. We'll also be focusing on top buzzing stocks, Cyient, DLM, Nestle India, Bandhan Bank. All of these are seeing stark moves after the Q1 earnings, so we'll focus on that. We'll also have a commodities corner segment where Manisha will join us to take us through the key trends in the segment as well as in the cryptocurrency space as well. So that's what's lined up on the show. But first up, Ekta, let's start by talking about pharma, right? War is still going on. You have other issues that are going on, and now tariffs have come back, and now the focus is on pharma pack.
Well, yes, we all thought that pharma would, US generics or Indian generics would be unscathed because the Indian market is so cheap in terms of generic drugs and the American consumer needs that. But surprise, surprise, we have President Trump, who has tweeted something absolutely opposite. He has said that all generic drugs being bought into the US will continue having a tariff of 0% for 2 years. That's starting August 1st. Then that will be raised after 2 years to 100% for 1 year, and then 200% thereafter. The stated intent is reshore generic manufacturing back to America and a penalty for those who don't build plants in the stated timeline. Now, Indian generics, how important are they? 90% of the US market by volume is generic. India supplies 40% of generic drugs to the US. So 4 out of 10 pills in the US are basically manufactured in India. India pharma exports are valued at around $10 billion to the US. India has the largest number of US FDA plants outside of the US, which is around 650 plus. And manufacturing in India costs 30 to 50% less than the US. Labor, which is a large part of it, costs around 35 to 50% lower than the US in India. Now, Indian companies have a huge exposure to the US. So as of FY26, Lupin 42% of their sales, Aurobindo 42% of their sales from the US, Glenmark as well at around 42 odd percent, Zydus 40%, Dr. Reddy's 34%, Sun 29%, but it should reduce post the latest acquisition, and Cipla around 22%. But many of these companies, Vinny, already have a lot of capacities in the US. So say for example, Lupin announced an investment in Florida, which was around $250 million. We also have Aurobindo and Sun Pharma, which made recent acquisitions as well. So all of that should possibly work in favor of these companies. Now, moving forward, generic manufacturing in the US can be 5 to 10 times more expensive. So this is the reason why Washington should probably be more worried than Delhi at this point in time. The cost differential also depends on the molecule and the type of drug. The more complex the molecule, the more expensive it'll probably be to make it in the US as compared to India. And the cost of manufacturing could then rise by around 25 to 30% right away, and the cost of generic drugs could then rise by around 50 to 70 odd percent. So if a drug costs around $2 to say $4, that could go then to around $4 to $7 for the US consumer, and that matters to them. Now, eventually, what exactly is generic pharma going to do? What we will see is possibly use the same playbook that they used for branded pharma, which is basically a dilution possibly of the announcements by President Trump. And generic pharma is likely to make capex announcements in the next 2 years as well, that yes, we are investing a certain amount in the US to assuage the concerns. Now, it's not going to be something which is going to be huge enough. It's probably going to be a hedge according to the people that I've spoken to. But if in case this does come through, small and medium generic companies which are serving the US could see a larger impact. Also, the US elections will possibly coincide with this deadline of around 2028, 2029, and that's when things will probably become a little more complex as well. Now, industry stance at this point in time is wait and watch. There's no formal order, there's no fine print, and there is a clear sense that Indian pharma has to lobby its case before the clock runs out. So the bottom line is, yes, it's sentimentally negative at this point in time today. Economically, it's improbable possibly at this scale. And for the American consumer, this could be a tariff that ends up taxing their own medicine cabinet. So we need to wait and watch and see how exactly the developments go forward. As of now, it's definitely a sentiment negative at this point in time. But to get more perspective on this important issue, we have Sudarshan Jain of the Indian Pharmaceutical Alliance, who's joining in now with his view on it. Mr. Jain, thank you very much for taking the time out. Well, it's definitely a very uncertain day for Indian generic manufacturers. What is your reading in terms of how Indian pharma is going to respond to what President Trump has said?
Thank you very much, Ekta, and you have put the facts rightly. Before I start talking about it, you understand the sector very well. As we are all aware that India has been a trusted partner in supplying of affordable, quality assured medicine to US. In fact, India has around 41 manufacturing plants in 12 states, which is offering jobs to American citizens. We have got investment in manufacturing, research, and supply chain as far as US is concerned. We are also continuously engaged with the US government, and economic sustainability will be the critical factor to decide the manufacturing. As you already said, the companies like Lupin, Cipla, Zydus, Sun have already invested. And we are one of the highest investors among all the countries in the US in the pharma sector. In fact, if we see, we have got $20 billion investment in the US, in the manufacturing sector, and Indian companies are constantly evaluating wherever there is economic sustainability to invest in the US. The concern, as you already said, the cost of manufacturing for some of the products will be very high. It takes around 4 to 5 years to begin the manufacturing. However, wherever there is a possibility, particularly for high-value products, the companies are examining the manufacturing. The order has just come in. We are examining the implication, and we are constantly engaged with the US government representatives as far as this impact is concerned.
Mr. Jain, when you say that you're continuously engaged with the US government, what is it that Indian Pharma is proposing to them at this point?
So basically, the critical issue, we have been saying, what are the products, the list of essential products, what can be the sustainability and predictability which can be provided to the manufacturers in terms of demand estimation, continuous supply, or buying, because those factors, economic sustainability is a very, very important factor as far as the whole investment thesis is concerned. So first is, already the investment is there in the US in the manufacturing plants. Next question is from US point of view and Indian point of view, what are the product categories where it is economic advantage to manufacture in US? Can there be product categories where the technology can be used for further reducing the cost in the US? Because we have got a very strong trading relationship as far as the pharma sector is concerned. The critical factor becomes economic sustainability and what can be done in terms of giving predictability to the manufacturers that there will be a demand for those products, it is economically viable and sustainable to manufacture in the US. So that kind of discussion is taking place. There has to be a guaranteed government purchasing and demand signals. There has to be reimbursement as far as taking care of disadvantages of economy. And there has to be regulatory predictability to accelerate the manufacturing facilities in the US. So there are discussions which are going on, Ekta, and let me assure everyone here watching this channel is India and US are committed for healthcare and medicine security for both the countries. Because medicine is fundamental as far as healthcare security is concerned. Medicine is equivalent to healthcare security, and availability of medicine is fundamental. And economic sustainability is very, very important for
Absolutely, sir. Absolutely, sir. Afternoon, this is Vinny joining in the conversation as well. You know, you spoke about around 40 facilities, over 40 facilities that Indian pharma companies have as a presence in the US as well, right? So will they have a bit more of an advantage? And, you know, these tariff uncertainties have been going on for a year. So have we already started maybe increasing? What is the conversation with the pharma companies here as well that have facilities there? Have they expanded some bit of their base in the US as well furthermore?
So Vinny, all the companies will take their own economic investment call, depending upon how does it make a sense. Like just to give the example, manufacturing paracetamol and metformin, low commodity items may not be viable, whereas there are products which are delivery system-based products. There are products which are oncology products. Companies are taking the call. Lupin has taken the call to invest in Florida. Piramal have taken the call. Aurobindo is investing. And as we saw, Sun has bought Organon as far as US is concerned. So each company is taking the call, and economic justification as well as geopolitical reasons will be very, very important. At the end of the day, patient is important. Healthcare security is equivalent to medicine security. So the availability of medicine is very, very important. And India has played a very important role in taking care of healthcare costs in the US. In fact, Indian companies, generic medicine, bring the saving of more than $200 billion to the US economy. And it is very, very important from healthcare point of view. And all the companies are engaged closely with the US administration to make sure healthcare security is there, medicine security is there.
Okay, Mr. Jain, now we're going to leave it on that note. Always a pleasure listening into your views. Thanks very much for joining in and speaking with us. And I'm sure this is a conversation which we will be revisiting as the months go by and we get more clarity in terms of what President Trump wants to do when it comes to generic pharmaceuticals. Thanks very much for joining in. So that's the IPA saying that they're continuously engaged with the US government on generic pharma, and India and US are committed on healthcare security. They're currently examining the implications. We'll take a short break, but Dharmesh Shah of ICICI Securities will join in with some trading ideas. Remember, it's a down and out day for the markets. More on that once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. Markets have come back below the 24,000 mark now. 23,995. Around that mark is what the Nifty is trading at. But a whole host of stocks that are moving around in the trading session. Which are those names? What is the reason behind that? We have Vivek to take us through all of that. Vivek, over to you.
Well, thank you so much for that. A bit tough to choose from so many movers in the session today. Stock-specific action, news developments, as well as earnings reactions is something that is keeping the market quite active. But overall, advanced decline ratio in favor of the declines. In terms of individual names, well, we just saw the results of Nestle, a very strong beat as far as top line is concerned, has cooled off a little bit from the day's highest point, but still very good performance coming in from this FMCG major. Data patterns, yesterday, remember, at around 3 p.m., we had told you about the news flow where the company has likely bagged an order from HAL. Jio Financial today has gone ahead and written a note. That particular stock high by almost 10% in the session today, almost doubling of the order book. Bajaj Auto follow-on buying being very strong, almost 5% higher for Bajaj Auto after a strong set clean yesterday. M&M Financials, after a while, this particular stock has surprised positively as far as results are concerned, and AUM growth has been very strong over here and very good asset quality seen as well, over 7% higher for that. And Cyient DLM, after a while, you're seeing very strong order book accretion, so that particular stock higher by over 12% in the session as well. On the other hand, quite a few laggards. Can't look past one of the sectors that's once again been impacted by Donald Trump social post. Pharma The entire sector is down almost 1.5%, and most of the generic pharma names down anywhere between 1% to 3%. Bandhan Bank, clearly one of the weakest stocks of the session, almost 17% lower, and ROA guidance cut and NIM under pressure. Street doesn't like that at all, over 17% lower. Aavas Financiers, again, significant elevation as far as top management is concerned, and AM growth has been below what the street was anticipating. MedPlus, that particular stock stands out as well. High volumes, weak performance as far as Q1 is concerned, 14% lower there. And IndiaMart, despite strong EBITDA margins, again, subscriber growth here continues to remain quite subdued. That stock low by almost 5%. Whole host of stocks buzzing on the back of results.
Okay, Vivek, thank you so much for that. But on that note, let's also bring on board Dharmesh Shah, Assistant Vice President, ICICI Securities, joining us right now. Dharmesh, afternoon. Thank you so much, as always, for joining us on the show. Nifty obviously now moved down a bit further as well. 23,980, around that mark is what the Nifty is trading at. What are the levels that you're keeping an eye out on? Uncertainty is continuing, but what is it that one should watch out for the Nifty as well as the Nifty Bank, which is also seeing an underperformance today?
Yeah. Good afternoon. Absolutely. I think so. If you look at the Nifty, I think so. It has been trading in this range of 23,800 to 24,500 for last 2 weeks. But if you look from the medium term perspective for last 5 to 6 weeks, I think so. Market has been trading in this range of 23,000 to 24,500, something that trading range for the market. But in this process, again, I would say that the market has been respecting the 100-day exponential moving average, which is again a place at around 23,900 to 800. We believe, I think so. Going forward, 23,800 will be the very important level to watch out for, which we expect to hold in this process of current corrective phase. Absolutely, I think so. If you look at the market, the current corrective phase, maybe on the back of spike in the crude oil prices, and I think so some bit of a tariff on pharma that seems to be denting the some bit of a sentiment in the market. But what we believe, I think so market should see a strong support in this range of 23,800, 900, and eventually I think so we should be trading in this range of 23,800 to 24,500 in the days to come. So it is more of a stock specific action likely to continue. As far as Bank Nifty is concerned, yes, absolutely. Post HDFC Bank numbers, I think so. If you look at the market for most of these heavyweight constituents of the banking stocks have been into the corrective phase. So we look for the banking, I think so, more likely to see a consolidation, but 56,500 likely to be a strong support for Bank Nifty. So more of a consolidation likely to continue going forward.
Okay, all right. Stocks?
As far as stocks are concerned, again, we remain to be positive for defense space as a whole. The stock sector has been into corrective phase for a long period of time, but we believe the way the base formation happening for most of these defense stocks, defense is one sector which likely come back in action, where HL remains to be our topic. Now, HL, again, for last 6 weeks, the stock has been consolidating in this range of 4,400 to 4,500, and finally has witnessed a breakout above 4,500, currently at 4,600. We expect HL to head towards 4,850, hitting a stop loss of 4,440. So HL is one which will remain to be on the positive side. Apart from HL, MRPL is something, one of the oil and gas space which we like, where if we will post strong sets of numbers, MRPL has witnessed a breakout of a falling trend and supported by strong sets of volumes. So we believe MRPL is something one which we like, where we expect the stock to head towards 189, keeping a stop loss of 167. So HL and MRPL remains to be a top pick.
Okay, those are your top picks there. But Dharmesh, thank you so much as always for joining us on the show, talking to us about individual market levels as well as individual stock names. On that note, viewers, we're going to slip into a very short break. After the break, we'll come back and Manisha Gupta will be joining us to talk us through the key trends in the cryptocurrency space in our Crypto Corner segment. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back. Well, below 24,000 currently for the Nifty. We have the mid caps, which are under pressure as well. State Bank of India is your top loser at this point in time, down around 2.2%. But we do have Cipla, Infosys, Dr. Reddy's, Axis, all of these under pressure at this point. But let's move away from the markets for a bit. Time for our Crypto Corner segment. We have Manisha who joins in with what to watch and the key developments. Manisha.
Thank you so much for that. When you look at the prices itself, and we have seen stronger gains continuing for the month of July for most of cryptocurrencies therein. Bitcoin has surged past $66,000, and we have seen 15% of gains from the July lows coming in for Bitcoin itself. Not just that one, when you look at the last 1 month, it has been stronger set of gains. If you look at the institutional demand, that has been on the positive side. The US spot Bitcoin ETFs have logged in 6 straight days of net inflows, and that clearly is showing in prices. So while Bitcoin is up 5.5% in the past 1 month, Ether has gained 16%. You have Cardano putting in 15% of gains in the same time, XRP 2.5%, and Solana gaining 12% apiece. Well, the crypto regulations and policy is something that the markets are not very happy with right now, because the US Clarity Act has been quite delayed and continues to be in a deadlock even now. It is facing political headwinds. There's a deadlock over the unresolved ethics section, as it were, between the Senates, and that is what is leading to that delay. Apart from that, you also have news coming in from Russia, where the crypto payment has been banned. Now, Russia has passed a crypto regulation bill. It has built legal framework for cross-border trade, but it has prohibited domestic crypto payments, and it also has capped the retail investors at around $3,800 an year. In the meanwhile, not such a good news coming in from Tether merger as well, which has seen a collapse therein with the Bitcoin firms deal. Tether's three-way merger of Bitcoin firms has now officially fallen through. In the meanwhile, you also have Galaxy, which has set up $5 million of a fund, which is aiming at shielding Bitcoin network from future quantum computing threats. This is something that the markets see as a positive at this point.
Okay, Manisha, thank you so much for that. But on that note, we're going to slip into a very short break. And on the other side, we'll have a conversation on the commodities front. And Manisha will take us through a conversation with Christoph Ruel of Crystal Energy. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back, and joining us on the show now is Christoph Rual. He's Global Advisor at Crystal Energy, and he's joining us from Buchenbach, Germany. Christoph, hi, thank you so much for joining us. What is your sense when you look at the overall crude oil prices? We've gained nearly 30% from the July lows, and it's not just about the Strait of Hormuz right now because the markets are looking at more waterways under threat. What is your reading of all this?
My reading is it's a curious mixture of déjà vu. We have been there before when you see this on-off of blockades and wars and threats, and of the worry that there's a new quality in it which could happen if overland pipelines are attacked. So what we have seen in the past is disruptions of the Strait of Hormuz, and we have seen that for different reasons, both safety valves of oil markets have held up very well. The first one is prices didn't go as high as most analysts expected because there was lots of oversupply in the market before, lots of inventories, all these things we have discussed before. The second safety valve is that even if prices went up, it didn't affect the economy so much. And we can discuss later why this happened, because oil just lost some of its importance for the global economy. Its share has gone down. But now, if we think about not only the on-off in the Strait of Hormuz, but the potential of overland pipelines being destroyed, lasting danger, kinetic danger to infrastructure, then this whole conflict goes into a second round. And all the old worries about an impact on high prices and then on the economy are back.
I get your point on that, Christoph, because the first time that it happened, we had a lot of stock inventories on water. There were strategic petroleum reserves which were higher. All of that not available to the market right now. So what is your sense? What are we looking at in sense of global inventories? And are you looking at prices going higher highs? I mean, are you looking at 95 and a triple digit coming back for crude?
The oil markets have changed a great deal over the last few decades. So what we have is now the share of oil in the economy is much lower. The amount of oil you need to produce $1,000 worth of GDP has gone down from almost a barrel, that's 150 something liters in the 70s to 60 or 70 liters today. So it declined by 60%. And one of the effects is that if you have a disruption, you need higher price increases than you used to in the 70s to create the same economic damage. And that's what we have seen now, what we have been seeing now. We had not only the first safety belt, which was all these inventories you mentioned, which mitigated the disruption effect on prices. We had also the structural change in oil markets, which meant that higher prices were not creating the same economic damage as before. Or the other way around, that prices had to increase much, much higher to create the same damage as we have seen in the 70s. So we have a lot of runway. Prices need to go a lot beyond 100 or 120 even to create serious economic damage. But all of that is of no help if there are physical disruptions, if a pipeline is blown up, and all the pipelines are vulnerable to that, and real disruptions which cannot be turned on and off. So there's two risks here. One is that the lack of a threat to the economy, which we have seen out of the first round of Hormuz experience, triggers politicians to become more risk-loving and to take more risks and to continue more down this dangerous road of threatening each other, of warfare and of disruptions. And the other is that in the course of this escalation, physical damage happens, which cannot be repaired very quickly, which is not a one-off event, which then would drain the inventories, which are already diminished, but which have protected us so far.
Going forward from here, are you also anticipating the Chinese demand to come back? Because till time, that clearly has been a factor which controlled crude oil prices from going much higher. And the other point really is about the filling the SPRs yet again. The US has been talking about that. Their inventories are the lowest since 1983. Do you see that demand coming at some point in time?
Inventories will have to be replenished, but that will have to wait. The biggest uncertainty in this market is China. We have seen both an unprecedented and huge buildup of strategic petroleum reserves in China before the war started, but nobody knows exactly how much is there. And then what we have seen is a big decline in the imports in China. And if we look at the global decline in demand as a result of the Hormuz crisis, most of that was to do with China importing less. And that is probably not so much a decline in demand as a switch in China or drawing down inventories. And so, yes, they will have to be replaced at some point, but they are large enough for this to take a while, and also the Chinese have been known as a matter of policy to replenish their inventories when oil is cheap. So they will do what they did before the war and wait until oil goes to 60 or below and then replenish their inventories. In the US, the situation is a bit more critical for two reasons. Number one, it's public, so everybody can look at the numbers. There's no secret that the SPR, the Strategic Petroleum Reserve in the US, is the lowest since 20 years. So, and number two, the US is playing on the forefront of this, and again, it could mean that the oil price and the high and low oil prices start to determine politics and not the other way around. So if the oil price is low, the US administration feels emboldened to try another round of attacks or closures of the street. And if the oil price is high, they threaten away from it in the view of these low inventories and worried about the impact on the economy. So that changes causality here.
Christoph, one final question then. And as you mentioned, it's becoming about more waterways right now, even the physical pipelines therein. So with Hormuz under attack and Red Sea also seeing some uncertainty, so is the case with Bab el-Mandeb as well. How much and how higher and how long do you believe all this can go on?
I think that we are confronted with a set of politicians on both sides who will push the system to the new limits. I said earlier that modern oil markets are better integrated, better at absorbing shocks than most people expect, and the impact of oil prices on the economy are much more muted than they have been historically, and therefore there's a longer runway for prices to rise. This does not mean that we are not confronted with administrations and politicians who are willing to take that in order to double up on risk and to become more reckless and to push this flexible system to its new limits. I'm afraid that this is what we are seeing right now. And there's no obvious way out because, everybody knows the US administration has a problem which they need to resolve before the midterm elections. And they have an enemy which is strong enough to make a swift and smooth and half-hearted attempt at solving the problem invalid. And so this looks like it might escalate further.
All right. Christoph, thank you so much for joining in. So that is really the view coming in for the crude oil prices right now. We're looking at cost of production, share of oil, all of that declining. But as Christoph tells us, that the prices of crude will have to be much higher than $100 a barrel to start making a damage, especially on the economy.
Absolutely, Manisha. Important to keep an eye out on in the world of commodities. And thank you so much for taking us through that conversation as well. On that note, we're going to step into a very short break. After the break, we'll connect with Bernstein's Nandan Kulkarni to understand the impact of Trump's tariffs on Indian pharma companies. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. As of now, the Nifty has inched lower, and look at it now at the day's lowest point again, 23,970 levels. So it's trying to make that comeback, but down 0.8% in the trading session. Mid cap, small cap too have fallen further in the trading session, and specifically in the last 30-40 odd minutes. What are we seeing in terms of a fall coming in? Infosys, Tata Motors, PV, as well as Asian Paints from the Nifty side are seeing a bit more of a fall in the trading session. And broader end of the market also, we're seeing some names that are seeing a bit more of pressure. That is going to be Emphasis, Oracle and Motilal, which have seen a sharp fall, specifically in the last 40 odd minutes. So that's about the market. We're seeing it inch lower further as well. Most of these stocks again have moved to the day's lowest point. Let's keep it going and actually talk about a pharma company. A 25 to 30% increase in manufacturing cost is likely if generic drug production shifts from India to the US, and that's the word coming in from Granules India's management. And the comments come as US President Donald Trump has announced a timeline for imposing tariffs on generic pharmaceutical imports. Listen in to that conversation we had with what Granules management had to say in terms of the feasibility of the manufacturing shifting towards the US side as well.
Granules is well positioned to tech transfer a lot of products to the US as needed, if needed. And Granules from a US position is also has two facilities right now, and we're also embarking on our journey for the third facility there. But to answer your question straight up, I think it's going to be a huge task if that is actually implemented. But I see that to be a close to being impossible at this point, purely because of the cost differential. You're talking at least a 20 to 25% increase in costs, and passing that on to customers will be extremely difficult. 2 years is extremely short, especially for the kind of products that are going there. But the medium and low volume products, there's different sets of products if you talk about generic pharma, right? So the large volume products, which are extremely dependent, which the US is extremely dependent on, will take a long time. Yes, we have one manufacturing site, one packaging site, and now we're also starting our logistics division over there, our warehouse situation. And if needed, we always have the capacity and the flexibility to increase the manufacturing space in our existing facility. Well, you'll have to look at least, like you said, 50 to 70% increase in costs for the business to be sustainable.
Okay, so that's the Granules India management talking about the impact of President Trump's steps towards Indian generic pharma. And to take that conversation forward and to get a more granular view, we have Nandan Kulkarni, who's the Director, India Healthcare at Bernstein, who's joining in. Nandan, well, it's been a very, very busy morning for the entire pharma industry and analysts as well. But your report interestingly says that there is an opportunity to scale up generic production in the US relatively quickly, if in case, these steps are taken by the US government. Just take us through that.
I think there are three important points to look at when you think about this whole tariff proposal. Number one, 70 to 80% of generics in US that India supplies are broadly on solid orals, the simple tablets and capsules of the world, where number one, what will happen as the deadline starts nearing through is there will be shortages because the current economics of moving to US are unsustainable. We believe that is going to lead to a much better consolidated view of the market, which will revise the prices substantially upward. And against that backdrop, Indian biopharma will have a much lucrative position to site transfer the products in the US market. So that's number one, most crucial driver of new price equilibrium. I think second point, which many on so far have also alluded, is a 50 to 70% kind of a rise in cost and price. Indian biopharma is well positioned given its large manufacturing network in US already present. And we are talking about leading players like Sun Pharma, Zydus, Lupin that we like, who have these established networks where that site transfer is possible. And number three, US FDA has been relatively conducive by its policies and guideline framework on how quickly you can do this transfer for solid oral products and how efficiently can you do. So with all of these three levers coming together, we believe Indian biopharma has an opportunity to capture a much increased pie if the tariffs have to come through.
Okay, so you were saying this is an opportunity and Indian biopharma companies maybe could catch a larger pie. Afternoon, Nandan, but what about the pricing then as well, right? Obviously, US is much more expensive in terms of pricing and manufacturing over there as well. So obviously the prices are expected to go up. Your thoughts on how do we manage that as well? And obviously drugs becoming more expensive then, likely.
You're right. I believe at a policy level, it's going to lead two things. Number one, because of increased prices and therefore out-of-pocket cost, US FDA is going to become significantly conducive to innovation pathways like 505(b)(2)s, orphan drugs, which are more protected, more better in terms of margin structure. And again, here Indian biopharma and the names that we like Zydus, Lupin, Sun Pharma, will start benefiting from this trend. And this is a massive opportunity because 505(b)(2) orphans are a very ignored category in the past. So that way, the policy will start shifting gear to adjust towards the mix of payers and towards the mix of, the prescriptions that are coming out. That's first an important point. Second, I believe, is the rationalization of these higher prices will start happening by some form of incentives to be rolled out for manufacturing in US. Because the massive problem will continue to be the labor cost in US and the overheads on running a plant. So some form of incentive subsidy, some form of tapered view or cashbacks will start being offered to mitigate some of these rising prices. But both of these are pretty long-term in nature. I think in the short term, there will be a pass-through cost, certain pain on the pairs, and therefore some form of shortages are expected if this framework.
Okay. All right. So there could be a possibility that there could be drug shortages if in case this policy is executed as is. Nandan, just wanted to talk about specific stocks now. Which do you think the likes of Aurobindo, Sun Pharma, Cipla, all of these companies which have anywhere between 25 to even 40% exposure to the US will be impacted because of this, because they have been making these little inroads into the US, getting more aggressive in the past 1 to 2 years. Lupin announced a $250 million investment. Aurobindo acquired Lanet. We have Sun Pharma, which has acquired Organon. So they are making their presence felt in the US. Do you think they'll come out unscathed?
That's an important point to ponder about. And there are two specific things that we have to separately talk. Number one, what happens between now and 2028? Broadly, hardly anything except minor side transfers because the tariff continues to be zero in that policy framework till more certainty emerges. So I think short term, nothing immediate to be seen and felt. Second lens of that is in the medium to long term, precisely beyond the tariffs. This supply chain disruptions drove the names like Sun Pharma, Lupin to start investing increasingly in the US onshoring as a structural hedge. And I believe that's a great mode that is going to emerge in this uncertain period. Because number one, most of these investments are in complex generics. For example, the case of Lupin that you mentioned is in complex generics, respiratory. All of these are well-margined products. Number two, the acquisitions are also towards innovation basket, which means it improves margin. There is a more room for pairs to accommodate, more room for companies to absorb the cost. Both of these are going to therefore provide a significant de-risking to stocks like Sun, Loop, Zydus over the next medium to long term from any of these impending tariff. Aurobindo is going to be broadly at a neutral stance, in my belief, because it has a very large exposure to simple generics, and therefore pure onshoring is not going to be fully economical, at least in the near term. So that's how I would stack up. The one who are moving to innovation like Zydus, Lupin, Sun, benefiting the best. Somebody like Organon will be at a broad neutral, partially mitigating the impact because of Lanets and other acquisitions that they have done.
Nandan, thank you so much for joining us on the show, explaining us the impact, the opportunity that comes in for Indian biopharma companies as well. So thanks so much for that. And on that note, viewers, we are absolutely out of time. Thank you so much for tuning in. We'll come back with more in terms of stocks and market-specific action as well. Stay tuned in.
Welcome back. Well, you're still tuned into Halftime Report on CNBC TV 18. Well, it's turning out to be a down day for the markets. We have the Nifty, which is just about holding at around 24,000, and the advanced decline ratio, which could improve hopefully as the day goes on. Just about 1,400 stocks advancing to over 2,700 stocks declining at this point in time. That seems to be the key pinpoint. But on that note, we need to wrap up on Halftime Report. From the entire team, thanks for watching. Business Lunch up next.
The market is a sea of red as Trump raises the tariff threat, with generics the latest to draw his attention. No let-up in US-Iran tension adds to concerns. Realty, healthcare and financials are the big drags. Donald Trump has now put pharma generics on his Make in America list, and he's warning of 100% tariff on imports 2 years down. The levy, he says, will rise to 200% in the following year. The announcement has India Pharma in a tizzy. Bajaj Auto and TVS Motor see strong growth in the domestic market, but more importantly, they expect exports going full throttle. Bajaj expects to ship 2.5 lakh units a month, while TVS Motor sees a further pickup in overseas sales. Bandhan Bank slumps after it says return on assets will dip and its margin will remain under pressure, while MetPlus's capex plan spooks the street. On the flip side, Cyan DLM surges on beating estimates and flagging new growth verticals. Nestle India kicks off FY27 with high volume growth that sees it beat street estimates by a wide margin. Strong domestic and export sales coupled with cost savings provide a perfect mix for better profitability. Hello. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. Good afternoon, guys. Rise in geopolitical tensions, a stronger, Brent prices rising to over $90 a barrel, a weaker rupee, and a bad outlook from select banks has sent the markets in a tizzy. The Nifty and the Sensex, both of them down 0.8%. The Nifty right now below that 24,000 mark. It was holding above that level, but it has broken that crucial level, is now at 23,993. The mid-cap index, which was doing well over the last two sessions, is also falling in line with the blue chips. It's over 1% in the red. The Nifty Bank also 1.3% lower. If you take a look at the sectors, the realty index is leading the fall on the Nifty. DLF, Lodha, Godrej, all of those stocks seeing cuts of over 3% in trade. The pharma index feeling the heat after Trump's tariff threats. Lupin down nearly 4%. Aurobindo Pharma down over 3%. And Cipla now down 1.5% in trade. Private bank, that index falls 1.5%. After Bandhan Bank's outlook was weak, that stock is over 16% in the red. Other private banks also fall in tandem. RBL Bank down over 3%. And heavyweights like ICICI Bank and HDFC Bank, both of them down over 1% in trade. One of the few sectors that's bucking the trend is the auto pack. That index is about 0.5% in the green. Bajaj Auto up nearly 5%. TVS Motor up nearly 4% on very strong numbers that we saw yesterday. But our top focus, US President Donald Trump has announced a timeline for imposing tariffs on generic pharma drugs being brought into the country starting August 1st, 2026. Ekta explains what it means for the Indian pharma companies. Ekta?
Well, thanks for that. Yes, absolutely. President Trump is in fact threatening a tariff on generic drugs. The term zero tariff for 2 years from August 1st, then 100% for a year, then 200% after that. The goal, reshore generic manufacturing to America and improve national drug supply security. Now, why exactly should India care? Because India is the generic backbone of America's medicine cabinet. 90% of all US prescriptions by volume are generics, and India supplies roughly 40% of them. That's $10 billion in terms of export business. India also runs over 650 US FDA-approved plants, the most outside America itself. And the reason it works, manufacturing here costs 30 to 50% less than in the US, with labor costs a large part of the pie being 35 to 50% cheaper. So who's exposed? Several frontline names, Lupin, Aurobindo and Glenmark, each draw around 42% of their sales from the US. Zydus close behind at around 40%, Dr. Reddy's at 34%, Sun Pharma at 29%, and Cipla at around 22%. Many already have US capacity, with Aurobindo and Sun Pharma building up US presence further through recent acquisitions, and Lupin with a $250 million investment in Florida. All this could work in the company's favors. Now, here's the number that should possibly worry Washington more than Delhi. Industry voices say generic manufacturing in the US runs 5 to 10 times more expensive depending on the molecule, raising costs by 25 to 30% for US production to even be commercially viable. Prices would then need to rise 50 to 70%. Take paracetamol. A box of 100 generic tablets costs $2 to $5 in the US today versus $7 to $15 for branded versions of it. Shift generic production home and the same box could climb to $4 to $7.50 per box. And that gap only widens as the drug complexity increases. Now the impact. Industry watchers are drawing on the branded pharma playbook. Some dilution as deadlines approach. Analysts expect generics to follow a similar script. Capex announcements as a hedge, not a full manufacturing exodus. There's also political catch. Trump's term ends in Jan 2029, and this 2-year runway ends right around the 2028 US election. But there's no guarantee policy reverses if the political winds shift. And in that scenario, smaller and mid-sized generic companies serving the US could see a far bigger hit. Now, industry stance right now is wait and watch. No formal order, no fine print, and a clear sense that Indian pharma has to lobby its case before the clock runs out. Bottom line, sentimentally negative today, economically improbable at scale, and for the American consumer, this could be a tariff that ends up taxing their own medicine cabinet.
All right, Ekta, many thanks for taking us through those details. Now, the other stock on our radar is Nestle after it delivered a stellar show in the April to June quarter. The consumption major reported a massive beat on revenue, EBITDA and profit. Mangalam Malu is joining us to break it down for us. Mangalam?
Well, if Nestle's results are something to go by, the consumption recovery is definitely well and truly on. Add to that the power of a new leader and increased penetration, and you have a 25% revenue growth. Not that the street wasn't expecting that. A 19% revenue growth was what was baked into our estimates as well, but the company went ahead and beat those estimates by a wide margin. So the revenue growth came in at 25%. The EBITDA itself grew by about 40% as against street expectations of nearly 30-35%, and as a result of which Nestle's net profit grew over 48% to around 975 crores. This compares with street expectations of 857 crores and a much bigger jump if you compare it to the same quarter last year, a 659 crore jump. What has this been led by? Domestic business, which is mainstay of Nestle, has grown over 25%. And over the last few quarters, if you notice, ever since Manish Tiwari has taken over as the leader at Nestle, the growth has really picked up and it's grown faster than the industry. Exports on a much slower base have grown at around 35%, and the company's cost-cutting measures accelerated. And despite that, we saw a margin expansion because, they grew their ad spends by over 40% as well. Across the board, there was volume-led growth in 4 of their key categories, and the management remains confident as well. The only monitorable from here on is because we've put on a big base over the last few quarters in terms of growth. Growing on this base is something that the street will be eyeing, especially at a time when the stock is at a record high and trading at around 62, 63 times FY28 earnings.
Absolutely. All right, Mangalam, many thanks for those details. And Nestle now 2% higher in trade. Now, Bandhan Bank slumps over 16% post its Q1 numbers. In its post-earnings call, the management stated that it has cut its exit ROA guidance to 1.2% to 1.4% from 1.6% to 1.8% earlier. In fact, we spoke to Partha Pratim Sengupta, MD and CEO of Bandhan Bank, where he addressed the bank's guidance, the impact of wage hikes and the outlook for net interest margins. Take a look.
When we gave the guidance, it was just after 1 month of my joining. For sometime in December, January, we have given the guidance. And it was based on one major factor that we will be going back to the same level of microfinance, and the contribution of microfinance in the ROA would be as robust. What we have witnessed at one point of time, you remember that the bank's ROA was 2.5, and when the microfinance share was almost 65 to 70%. Now, then we witnessed the turmoils that happened in this particular segment. Almost all the MFIs lost monies, the NPAs were higher. We were also not insulated. While we have performed much better than the industry, there was definitely an impact on our ROA. We thought that this should be overcome by December quarter end, but unfortunately, it took almost a year time. The recovery started, say, mid-November onwards for that year. By that time, our ROA has dipped to 0.2. Now, after reaching an ROA of 0.2, we again reworked, strategized, and then moved on, and we moved on only towards the north. So 0.2 to 0.4, 0.8. Then we ended up the last quarter at 1.1. After also incurring an one-time expenditure of 61 crores on account of this New Wages Act, for that, which is the one-time expenditure, we have maintained an ROA of 1%. So we are improving. So the effect of the benefit of cost of funds, what we expected that we will get for the entire quarter, has not now been looked. That is the main thing I can say.
On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. U.S. Trade Representative Jamieson Greer has signaled new tariffs based on Section 301 investigation into forced labor. Speaking to CNBC, Greer hinted at new tariffs on at least 60 countries over forced labor practices. This comes as President Trump's 10% temporary tariff expires on the 24th of July. India is among the 60 countries facing an additional 12.5% tariff.
With forced labor, the Section 301 investigation of forced labor, again, the U.S. has laws to prohibit trading goods with forced labor. Other countries, most don't have a law. Those that do don't really enforce it. We expect to see some action soon. I can't really specify a timeline right now. I have a responsibility to brief Congress and other stakeholders before I really reveal that kind of thing. But we do expect action soon on that.
Ambassador, though, the FT reports that this would be much broader than just a small number of countries. That this would be a significant expansion. Is that not right?
Well, it covers 60 countries, 60, and about 99% of our trade. And that actually illustrates the scale of the problem we're facing. For years, again, the United States has had on the books this law where we prohibit the import of goods made in whole or in part with forced labor, and we enforce it rigorously. Other countries, most don't have it. Those that do, don't enforce it. The EU will say, we have a law on forced labor, and while that's true, it doesn't come into effect for another year and a half. So, like, by the terms of their own law, it's not in effect. It does cover 60 countries because it's such a prominent problem in the world.
Let's go across to Abhimanyu Sharma for more on this. U.S. Trade Representative has hinted at action under Section 301, and this includes India, right? Abhimanyu, tell us the likely impact on the ongoing trade deal negotiations.
Well, the ongoing trade deal negotiations are basically aiming to create a certainty in terms of the tariff architecture, in terms of the tariffs which are going to be levied on both the sides, and the kind of benefits in terms of preferential trade access which would be provided to both India as well as the United States by virtue of a trade deal. Now, the uncertainty around the total amount of tariffs, the tariff architecture continues since earlier 50% tariffs were in place from the American side on Indian goods, in which 25% reciprocal tariffs were there, and the rest 25% were tariffs for import of Russian oil. Now, when both the sides reached an agreement, when both the sides had reached some degree of an agreement in February this year, then that 25% was removed. Subsequently, the US Supreme Court on the 28th of February did away with the reciprocal tariffs, now which led to the entire change in the architecture of tariffs, which was followed by the 10% tariffs which are currently in place and are slated to expire on the 24th of July. Now, post the 24th of July, in case a trade deal is not reached by then only MFN tariffs will apply for export of Indian goods into the US market. Now, currently, the USTR is undertaking two different investigations. One is against the practice of forced labor, and the other is against the issue of excess capacity. Now, the probe, as far as forced labor is concerned, is already at an advanced stage, and rightly, what the USTR had hinted that they are considering under the probe a levy of 12.5% additional tariffs against 60 countries, which comprise of 99% of total American trade, in which India is also one of the countries. Now, India has already taken part in the consultations. Both the government and the industry have given their respective replies, and India has opposed any such levy of tariffs as far as any forced labor practice is concerned. India has also come up with a notification. The DGFT had a few days back issued a notification against the practice of forced labor to ensure that relevant practices, that relevant laws remain in place in India to buttress India's argument before the USTR. Now, it clearly remains to be seen for now how the tariff architecture is going to be shaped like in the near future, since it's just 2 days till July 24th, post which only MFN tariffs are slated to apply in case a trade deal is not reached between India and the United States by then.
All right, Abhimanyu, many thanks for those details. Now, in some important news that could impact the Adani Group's airports business and the GMR Group that operates and holds controlling stake in major airports, including Delhi and Hyderabad, a Bloomberg report suggests that the government is weighing a major policy shift that could shake up India's airline duopoly. Sources tell Bloomberg the Aviation Ministry has initiated talks on a policy change that would allow airport operators to own and run airlines. Now, here's why this matters. The current rules bar any airport operator from holding more than a 10% stake in an airline. That's the wall the government may now look to bring down. Any waiver, though, won't come easy and will need legal clearance. First from the Law Ministry and then from the Cabinet. So this is still early days, and deliberations are underway within the Aviation Ministry. CNBC TV 18 has reached out to the Aviation Ministry for comment. That response is awaited. Remember, Adani Group is India's largest private airport operator and holds majority stake in Mumbai and Navi Mumbai airports and operates 6 others. In fact, CNBC TV 18's Shireen Bhan spoke to Jeet Adani in December of last year ahead of the Navi Mumbai airport launch on the group's possible foray into the airline business. And here's what he had to tell us.
What part of this business are you currently not into that you want to get into? I mean, you know, the big question is a foray into airlines the next big plan on the Adani Group's calendar?
No, absolutely not.
No.
We were legally not allowed
I know,
to.
but I know you're legally at this point in time not allowed.
Yeah.
But the government's been talking about, you know, competition. The government's been talking about the need for a large airlines, especially in the light of what we've seen happen with Indigo.
Absolutely.
If tomorrow the opportunity were to arise, would you consider it?
I would say there's nothing that we won't consider. But as it stands today, structurally, the airline industry is not something that we see, fitting our sort of capital discipline. We're used to high margin businesses, investing in asset, and sweating that asset well. The airline is completely opposite in every.
So from a unit economics point of view, it doesn't make any sense for you,
for us. No.
For you at this point in time, or even in the future.
Yeah.
If the opportunity were to arise.
Yes.
So that's not something that you would consider.
Not at all.
Well, on that note, it is time for us to head into a short break. For news and updates on the other side, stay tuned. Welcome back. On to the latest updates on the West Asia war. The United States bombs Iran for the 11th consecutive night as Defense Secretary Pete Hegseth says the cost of the war has reached $37.5 billion. Meanwhile, U.S. President Donald Trump has threatened to attack a suspected Iranian nuclear site called Pickaxe Mountain pretty soon and very heavily. CNBC's Dan Murphy gets us the latest updates.
CENTCOM completing an 11th consecutive night of strikes on Iran overnight as we see Yemen's Houthis declaring this naval blockade on Saudi-linked ships through the Bab al-Mandab. Axios reporting this morning that President Trump is now weighing effectively two options here. That would be, number one, a new 10-day ceasefire to reopen Hormuz that's being pushed by Qatar, Egypt and Pakistan, or number two, which would be a massive joint military campaign with Israel to force Tehran to capitulate. Now, previous efforts to bomb their way to peace haven't necessarily worked, and it seems as if the Iranians are also digging in this morning. But President Trump also highlighted last night a quite new and material warning. He said the US will bomb Pickaxe Mountain. This is a deep underground site suspected of being of nuclear use by the Iranians. President Trump says they'll be hitting that area soon, and there's nothing Iran can do about it. So we're watching the escalation risk in the region. For now, it seems as if oil prices have been relatively stable, with Brent only just retesting that 90 USD handle. Meanwhile, another interesting development in the region this morning, the Wall Street Journal reporting that President Trump has formally approved a civilian nuclear agreement with Saudi Arabia. Now, according to the Journal, this is a 30-year accord worth tens of billions of dollars. It's expected to be signed as soon as today by the U.S. Energy Secretary Chris Wright and his Saudi counterpart, Minister Prince Abdulaziz bin Salman. CNBC has reached out to all parties involved seeking comment and clarification on this, but at the core of the story, the Journal says American companies would build Saudi Arabia's nuclear infrastructure under this deal, effectively shutting out rivals like Russia and China, and also potentially paving the way for US firms to build an enrichment facility under a black box arrangement that would keep sensitive technology in American hands.
So Dan, there with the latest from West Asia. But with that, it is a wrap on this edition of Business Lunch. But Midcap Radar comes up next to take all the market action forward. Stay tuned.
Good afternoon and welcome to Mid-Cap Radar, live from the CNBC TV18 Motilal Oswal studio. I am Vivek Iyer and with me is Hormaz Fatakia. Good afternoon, Hormaz. Well, a session we're actually seeing quite a bit of a downtick, especially as far as the benchmark indices are concerned, but that masks the fact that there's quite a lot of action, volume-backed activity as far as the broader end of the markets are concerned. Quite a few stocks reacting very positively to good set of numbers coming across.
Good afternoon to you as well, Vivek. You know, a lot of the earnings reactions, especially in today's session, has predominantly been on the negative side. Yes, there have been positive ones as well. The fact that earnings still, of course, there's still a lot more numbers to be reported during the course of the day, but these are the headlines that we are tracking at 1:30 this afternoon. The market continues to trade with cuts. The Nifty is now below 24,000. IT, pharma, financials drag, while FMCG and auto bucked the trend. The broader markets underperform.
Science DLM rallies over 10% on a strong Q1 performance. The company beats street estimates, flagged new growth verticals, and reports a record order book.
Aavas Financier slumps on a mixed first quarter as AUM growth misses expectations and spreads remain under pressure. M&M Financial advances though on strong business asset growth and stable asset quality and some brokerage upgrades as well.
Pharmacy retailer MedPlus shares tumble over 14% after Q1 net profit declines and margins contract. The company also announces around 155 crore rupees of fresh capex on new healthcare and food processing projects.
And shares of IndiaMart trade with cuts of over 5% as the company's paying subscribers fall for the second straight quarter. Collections also slowed. The management tells CNBC TV18 that they need to further strengthen the product market fit to drive subscriber growth.
Well, a bit of a recovery that we are seeing, especially as far as some of the mainline indices are concerned. We're looking at names like IndusInd Bank that will report its results. That particular stock has moved to the high point of the day. On the other hand, Eternal, which too will report results later today, expected to be during market hours. That particular stock has seen a downtick, has moved to almost a 1.5% cut now. But these stocks and a whole host of other names is what we have on our radar. We are standing by at the big wall with our special segment, Mid-Cap Movers.
Well, yes, a lot of stocks moving around in today's trading session. Starting off with the gainers first, we have CRISIL reacting to its Q1 earnings. But remember, in the last 1 year, the stock is down nearly 22%. Tata Teleservices is well reacting well to its Q1 earnings. But this stock also has been an underperformer, down nearly 34% in the last 1 year. Chennai Petro also gains in trade today. The stock has been continuing its run over the last 1 year, up nearly 65%. Kalyan Jewellers also seeing a big jump today. In fact, this stock has gained up to around 70% in the last 2 weeks itself, and Aegis Vopak also up nearly 85% in the last 4 months. On the flip side, looking at some of the losers in today's trading session, we have Gabriel India reacting to its Q1 earnings. Although the stock is up nearly 50% in the last 6 months. Chem India Projects also taking a hit today, but this stock has gone up by around 200% in the last 4 months. Kaplan Point also has seen a run of nearly 60% in the last 4 months, but today taking a cut. And PG Electroplast has been an underperformer over the last 1 year, down nearly 27%. Today also down nearly 6 to 7%. And Ola Electric, this stock has been an underperformer right since its listing, down nearly 60% since the time the stock listed. Also looking at the top sectoral loser today, that's the realty index, down nearly 2.5%. We have stocks like Brigade Enterprises, DLF, Godrej Properties, Prestige Estates, as well as Lodha, all on that list today.
Yeah, thank you for those updates there. The movers in the broader markets more towards the losing end than on the positive side. Numbers also flashing from Orient Electric just a couple of minutes ago. Just put up CSB Bank before we move on. That was the number that came in just a few minutes ago. Asset quality has seen some pressure. Provisioning has gone up. And the slippages have also seen a marginal increase from last year. So 5.5% lower on CSB Bank. There's some recovery from the lows, if you could call it that. But the stock now closer to its 52-week low of 317. But moving on then, MPS, which is a learning and platform solutions provider. It was a strong first quarter for them. The numbers saw revenue growth across segments. To discuss this and more, let's welcome in Rahul Arora, who's the chairman and CEO at MPS, who's joining in on the show. Rahul, good afternoon. Thank you for joining in. You have an aspirational target of 1,500 crores on the top line front for FY28. Is it a mix of organic and inorganic? And if inorganic is a part of that, is there something that is on the anvil for you in terms of inorganic growth?
Thank you so much for having us. Yes, I think the aspiration is now turning into reality. We dreamt this back in 2022, 2023. This year, of course, we are looking to closer to 1,000 crores, and then the home stretch of 500 crores next year. Yes, it's going to be a mix of both organic and inorganic, 60-40.
Well, Rahul, the street clearly likes what you've delivered as far as Q1 FY27 is concerned. It's a 20% upper circuit as far as the stock is concerned. Now, let's talk about the rest of FY27. Now, you have an EBITDA target that you've set at 300 crore rupees. Now, generally, what we've seen and what you've also said in the past is that H2 is typically stronger compared to H1. Will that trend continue in FY27? And that calls for a clear upgrade as far as the guidance is concerned. So would you go ahead and do it right now, or will you wait for some more time?
Yeah, so like you said, H2, we have some seasonality in our business. H2 ends up being stronger than H1. We expect this year to be no different. We expect that to play out. We did build our guidance bottom up. So typically, as you know, we tend to underpromise, over-deliver. So think of 300 crores as the floor, not the ceiling. It also implies a 21% 3-year CAGR on EBITDA. So feel very comfortable crossing that, that floor that we've already defined, given that H2 is going to be stronger than H1.
Rahul, what is going to be the next focus area then as you head towards your growth aspiration? You mentioned 60-40, but on the 40, is there anything that you are looking out for at the moment in terms of acquisitions? Anything that we can expect to hear from you anytime soon?
Yeah, I think so. From our perspective, every acquisition that we look at tends to be expansion of capabilities rather than chasing revenue. So that same theme will continue. Secondly, the core of MPS is science. And one of the reasons we're doing well is AI plays out really well in the field of science. So it'll probably be in the field of science, education, as well as expansion of capabilities. And yes, we will close out something this financial year.
You will close out something this financial year. How? By when do you expect that to happen? This quarter or in the second half?
We'll update you as soon as that happens.
Okay, you've given us a bit of a hint. Also tell us, you've given us what capability the company that you are looking at is in. What is the kind of target that you've set? What will be the size of this particular acquisition? Will you dip into your own reserves, or will you look at external funding to go ahead and close this acquisition? And typically, what does it add to your top line?
So we're not looking at any asset lower than $15 million in revenue anymore, simply because we realize the effort, whether it's a $5 million company or a $20 million company, is pretty much the same. So it's more efficient to go for bigger bites now. In terms of financing, our business is generating 15 to 18 crores of cash every month. We're sitting on some decent cash reserves. So between internal cash and, I feel very comfortable going up to 200 crores of debt if that's required, because that's the level of cash the company is generating from operations. So between cash accrual and that kind of debt, we will be running with the financing on the next.
And which geography is this acquisition?
So all assets that we look at tend to be outside of India. Delivery tends to be in India, but the markets tend to be outside of India.
Rahul, how has Unbound Machines turned out for you? Is the growth that you have achieved so far this time around, is it only planning to scale up further?
Yeah, Unbound has done many things for us. Of course, one of the things that it has done is improve the scale of the company. But more importantly, it's gotten us into this new world of outcomes-based revenue. So today, about 25% of our revenue is outcome-based, where we in fact pay royalties and to other partners from who we work with. So we get to actually participate in the gain share rather than just billing for our time and material. So that's been a very big change for us, actually partnering in these kind of projects. Secondly, our recurring revenue has shot up as well. So the quality of revenue has significantly improved. Today, 45% of our revenue is recurring. So it's not transactional. It's booked for the next 3 years. And that's really allowing us to invest back into the business. Most of Unbound's customer base is institutional. Our total customer count on the B2B side has gone from north of 400 to north of 850, which then allows us to now cross-sell into this customer base. And that's where the confidence around organic growth is coming from.
Okay. Rahul, you're present in 3 main segments, if you could put it as resource solutions, education, as well as corporate learning. Going forward, what is the ideal top line mix? And secondly, we want to understand whether there is any sensitivity as far as the strength of the dollar and the rupee is concerned, because significant presence you have both in US as well as UK. So any sensitivity analysis you could help us with?
Sure. So in terms of so far the it's only been beneficial to the to the bottom line. So from for typically what we see, most of our revenue is USD as you pointed out. So it's been highly margin accretive for us. In terms of the markets that we operate in, research, education, and corporate, research continues to be the highest margin business. Tends to be stable, grows at 10-12%. Education tends to be lower, slightly lower on margins, around 35-36%, but tends to grow much faster. So the last couple of years, for example, education has grown north of 20%. We expect much of that trend to continue through FY27 and onward as well. The corporate learning part of our business is actually making a very decent turnaround this year as we enter the managed services space. And now that the margin story for the corporate business has been unlocked, we're happy to see that the revenue side is also improving.
Rahul, pleasure having you today. Thank you for sparing time and joining us. Wish you good luck for the rest of the year and towards your aspirational targets as well. Take a short break. On the other side, Neeral Patel, the CMD of Atlanta Electricals, joins in to discuss the numbers and the road ahead. Stay tuned.
Welcome back to Mid-Cap Radar. Well, don't really look at the headline indices to get a sense of what exactly the market is doing, because like we just mentioned, the mid-caps are doing very well. Have a look at the company we just interviewed a while back, MPS, at the upper circuit, doing very well in the session. Well, the next management on our show is Atlanta Electricals. Remember, they too had a very strong Q1. The transformer manufacturer reported a strong Q1 with almost a 45% growth as far as top line is concerned. To discuss the performance of the FY27 outlook, let's welcome Neeral Patel, CMD of Atlanta Electricals. Good afternoon, Mr. Patel, and thank you so much for joining us. A 45% top line growth is what we've seen as far as Q1 is concerned. Do you attribute this mainly to higher capacities? And FY27, given that you started off Q1 on a strong note, give us the outlook or the guidance for top line, EBITDA, EBITDA margin, and PAT.
Gentlemen, good afternoon, Vivek. Thank you for having us here. Yes, we've started with very strong performance both in execution and order booking. We were able to maintain a steady growth in the last quarter, wherein the revenues from operations jumped by about 48%. The gross profit grew by about 55% year-on-year basis, wherein the revenue is, the order book is all-time high in this particular quarter of about 974 crores orders booked in this particular quarter. This improvement is structural and reflects improvement over operational efficiency and gradual shift towards higher kV class products, meaning 220 kV class products.
Well, and a word on the guidance?
Since we've gone public, we've been maintaining 40% CAGR guidance year-on-year basis, and that's exactly the company is striving to do, and as of today, we're able to achieve it.
You're going to stick to the 16.5%, 17.5% EBITDA margin band. Could you improve on that?
The company is in the phase of technological development, infusing newer products, higher kV class products. So with all those research and development costs, we expect the margins to be fairly stable because the higher kV class products will have incremental margins, which can be offset by R&D costs. But yes, the margins to be stable.
Neeral, a lot of your order book for this time, the 25% jump that it has seen sequentially is also because of the VPNL order that itself has contributed to close to 300 crores. Now, how healthy is the demand looking like currently? What's the kind of order inflow that you have had this time around? Or if not this time around, at least in the first first month of the second quarter, what's the demand situation looking like on ground?
The demand situation is quite exciting. There's this huge level of requirements coming in from the state transmission companies, the renewable sector, battery energy storage systems. So yes, the demand is pretty good. These are exciting times for the industry. It looks pretty robust. Like I said, 974 crores order book in one quarter is the highest that we've done in historical 2 years. So we are achieving these kind of markers, and we would ensure that these markers are the targets are almost doubling every year.
Well, Mr. Patel, I also want to understand as far as the approval that you've got from Power Grid is concerned, for setting up a new facility, what kind of capex does it entail? What does it add to your capacity? And what is the incremental capex turn or top line growth you can expect from there?
So we have already done the capex. The capex, which is Unit 4, the Vadodara facility. The capex is already finished. The plants are commissioned, and the plants have received Power Grid approval. We have also applied for the vendor development product in Power Grid, and we are hopeful to get a good turnaround to start this establishment of 400 kV class with Power Grid.
Mr. Patel, a quick word, there has been quite a lot of headlines, especially in terms of allowing Chinese players to come ahead and enter the market. 4 companies with presence as far as India are concerned are already talking about significantly ramping up capacity. What does it do to your prices? So how much of your order book is currently sold out, or what kind of bookings have you seen? And are you worried about competition?
We are not as worried about the competition when the Chinese companies are allowed. Typically, there's only one transformer manufacturer that has been allowed by the Indian government, and they are operating on Indian soil. And to our knowledge, they have already booked with a lot of orders. So we don't see much of disturbance in the market. Also, the type of requirement that is there in the industry, such capacities would not make a huge difference is what we anticipate.
Neeral, the demand from the transmission expansion or the renewable integration, the BESS, data centers, exports, all of it. Now, which of these segments is actually contributing meaningfully to your growth? Because there is a lot of chatter about all of these segments almost every other day. And what exactly do you see as a bigger opportunity for you going forward in the pipeline?
We've been witnessing a complete demand uptake in the power transformer segments in past couple of years, and that is specifically due to renewable energy expansion. The new growth drivers like battery energy storage systems, data centers, EV charging networks, which will also keep the momentum up going. Eventually, all of this is going to end up onto the transmission sector, and hence transmission sector also needs these kind of transformer products that we make. So indirectly, directly, all the sectors would be, loading getting the power from the transmission network. And that's where Atlanta has a very strong foothold in almost 19 states and 3 union territories.
Well, Mr. Patel, thank you so much for joining us. We wish you all the best for FY27. You've guided for a 40% growth across metrics with stable EBITDA margin, and we will hold you to that. Thank you once again. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Still 200 points lower on the benchmark index. Adani Power's numbers flashing at the bottom of your screens. A 34% uptick in its revenue. Of course, Vivek will get you more details as the numbers come in. Of course, the board has also approved a fundraise of up to 15,000 crore rupees through a QIP and other securities. So keep Adani Power on your radar. But what is on our mid-cap spotlight segment today? Ria is here with a stock that's on her radar. Ria.
Well, yes, data patterns has been in focus today. In fact, the stock has been gaining since the last two trading sessions, and today the stock is up nearly 12%. Yesterday, data patterns had emerged as the lowest bidder for a 1,300 crore rupee project from HAL. Now, this order pertains to electronic warfare equipment, which includes a buffer amplifier as well as a built-in test equipment module. And the government e-marketplace website had indicated that the award of contract has gone to data patterns. Now, remember, the FY26 order book for the company is nearly 926 crores, and in fact in the Q4 earnings call the company had said that they do expect to receive nearly 1,000 odd crores of orders within the next 1 to 2 months, for which the negotiations had already been completed at that point. And in fact for FY27 they are expecting an additional further order inflow of nearly 1,500 to 2,000 crores. In fact, after FY26, after the results came in, the company had also given guidance for the year ahead. They have said that they have a strong order book pipeline pegged at nearly 2,000 to to 4,000 crores over the next 24 months. Over the next 2 to 3 years, they also target to maintain a revenue growth of nearly 20 to 25%. And for FY27, the company expects to maintain their revenue growth rate of 20 to 25% and an EBITDA margin of nearly 35 to 40%. And additionally, they are also expecting to remain net debt free. Apart from this, JM Financial has also come out with a note on data patterns. They have maintained their ad rating on the stock with a target price of 4,080 rupees. They have highlighted that the order is scheduled to be executed within 180 days from the date of the award of the order, and they do view this as a potential order as highly significant for the company, because this exceeds data patterns total FY26 order inflows of nearly 1,100 crores, and it has also will then surpass the year-end order book of 926 crores. Now, currently, the stock trades at nearly 54 times the FY28 EPS, but JM Financial believes that there is potential for further earnings upgrades once the order materializes.
Well, thank you so much, Ria. Well, just to give some perspective, what Ria mentioned, a little over 900 crores is where the order book is currently. A single order will be much larger than the entire that is got, and this particular highlighting done by JM Financial in terms of the EPS upgrade appears quite significant. The stock up almost 13% in just the last 7 trading sessions. Well, a couple of stocks on your radar. Dr. Reddy, that's all set to report its number later today, along with other pharma companies now trading near the day's lowest point. Also, have a look at SRF. That particular company too will deliver its results a little later today. And Eternal is the other stock on the radar. That too is under a bit of pressure ahead of its earnings. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan, and with me as always is Vinny Motiwala. Good afternoon, Vinny. Good afternoon, guys. You know, rising geopolitical tensions, soaring oil prices, which are now at $93 a barrel, a weaker rupee, all weighing on markets today. The Nifty now below that crucial level of 24,000 as we speak. It's 210 points in the red. The mid-cap index, which was relatively doing better over the last couple of days, is now underperforming the blue chips over 1% in the red, and the banks not helping the Nifty either, 1.3% lower. If you look at the indices that are not doing well, it's realty that's leading the fall. Then we've got those private bank names that are not doing very well after Bandhan Bank's earnings came out, and the outlook was not looking good, and that stock fell over 17%. On the flip side, we've got only two sectors that are bucking the trend: FMCG after Nestle's stellar quarter, and then we've got those auto names after Bajaj Auto and TVS Motor came out with good numbers as well. So those two indices managing to stay in the red, Vinny, in the green, Vinny.
Absolutely. Only two sectors in the green today, Arundhati. But, you know, realty, like you mentioned, banks, pharma, all of them under pressure as well. And advance decline ratio obviously is a bit more in the favor of declines versus advances in the trading session, given that we're seeing that the mid and small cap is seeing a bit more of an underperformance and a bit more of a fall versus the benchmark indices. But on that note, let's get started with the show for today. This is a show where we solve all your stock-related queries. To do that, we have Asta Jain of Hem Securities, as well as Vaishali Parekh of Prabhudas Leeladhar joining us to answer all the stock-related queries. Asta, as well as Vaishali, good afternoon. Thank you so much, as always, for joining us on the show. Let's get started with the first query. This one is coming in from Johnson, who's writing to us from Hyderabad. He's holding 721 shares of Sai Silk. This is at a price of 100 rupees per share. Wants to know whether to hold or to accumulate more, given that the stock is currently trading below the price, right? It's trading at 87, so they're making a loss. Does it merit averaging? Asta, first to you. On the fundamentals, Sai Silk, how is it looking?
Hi, good afternoon to everyone out there. So talking about Sai Silk, we all know it is a South-based ethnic wear company. And what we have seen in the financial, that there was a slight decline in the revenue, and that mainly management contributed, those reasons that maybe there were the fewer wedding dates. So that has led to the smaller decline in the revenue. But what is the major focus of this company? That the number of store additions, I think that they have added it to around 66. It was around 66 stores, which have now they added to 81. So the number of stores added was good. And in fact, going ahead, we will see the management will continue to expand. So my idea here is that in the wake of, we know that this balance sheet of the company is very strong, because they are almost a debt-free balance sheet. And in the coming future, we can see some sort of increase in the revenue on the back of the strong management commentary. One can average out this counter at the current point of time. So my idea here is it is quoting somewhere at around 87. So maybe at the lower level of 80 to 75, one can average this counter and remain invested in this counter for the medium-term perspective.
So remain invested for the medium-term perspective. Vaishali, good afternoon. You know, what do you make of Sai Silks? He wants to know whether he should hold or sort of, you know, accumulate at this point. Any levels he can watch out for?
Hi, very good afternoon to all of you. So I think talking about Sai Silk, we've seen a massive correction right from 180 in the recent past to now 87 levels, which means that the stock has really been in an oversold zone, and the indicators are showing there could be an exhaustion in the selling. So I would say at these levels also, to better your price, add more at this stock, but actual confirmation and strength of the stock is seen only above 100 levels. So better to average out your price at these levels and look for higher targets.
All right. Okay. So that's your view on Sai Silks. Now, the next query is coming in from Rajan, who writes to us from Bangalore. He holds 4,000 shares of Jio Financial Services at 240 rupees, and he is making a loss. The stock is currently a little bit below that mark, 234. He wants to know what is the one-year outlook for the stock. So, Asta, let me come to you. What do you make of the stock? What's the one-year outlook? Should he stay invested?
1 year outlook is positive for Jio Financial Services, and yes, I would like to recommend hold on this counter on the wake of first of all, the kind of financial performance we have seen. I think we will see a increase in the revenue as well as bottom line going ahead also. So my idea here is, yes, Jio Financial is looking strong from the medium term perspective. And yes, one can remain invested in this counter with a price target of around 250 to 260 at the initial levels.
Okay. You know, Vaishali, what's your view coming in here? 4,000 shares of Jio Financials, 240 rupees. And in the last 1 year, when you look at it, the stock has seen a decline of 25%. Though the viewer has bought it at a higher price, what should they be doing now?
So actually, Vinny, there's nothing really happening. I mean, this was everyone's delight that yes, this could post good results. It would perform well. But so far, technically, it doesn't do. It's not showing any strength. I mean, it's a range-bound move between 230, 220 to 250. Unless and until we see a jump above 250, there could be a clarity that yes, we are heading towards 265, 280 levels. So for now, I would just say hold.
Okay, you would say hold right now. That's the word for Jio Financial Services. Let's move on to the next one. We have Rajesh, who's writing to us from Hyderabad. He wants to know whether he can buy Gland Pharma at the current price for 2 years and asking if the company's prospects related to exports, especially to EU, are they looking attractive? And obviously, today we had the Trump tariff situation which came in as well. So they want to understand, given all of this, is this a good pharma stock to invest in, or are there other names in the pharma pack? Over to you, Asta, your view. Gland Pharma, is it a good one given the current scenario?
So talking about Gland Pharma, yes, it is one of the leader in the injectable, and not only in India, it is a global leader because the parentage is China. So China, I believe that in fact with this EU trade deal also, because they have got a very strong market, export market in the Europe. So definitely it will going to help the company in posting good set of numbers, and their balance sheet is also in a very strong, momentum right now, and they have seen very strong growth as well. The only, concern about the company is first of all the regulatory risk, which we believe is there for the, all pharma companies which are operating in the sector. So yes, there are concerns, but that are mainly industry related, not company related per se. But here we can see the valuations are also at the comfortable level. So I don't think that there is any need to exit from this counter or enter into any other counter. Stay invested in the Glen Pharma is what I recommend. And whatever benefits we will see from this EU trade deal, definitely these benefit will be, company will be reaping these benefits over the period of a time. So for a medium to long term perspective, remain invested in this counter with a price target of 2,700 to 2,800.
All right, so you're saying remain invested, but Vaishali, this person wants to buy Gland Pharma. Is buying at the current price a good bet for him, considering the current scenario globally, especially with Trump's tariff threats? So what should he look at? What level should he watch out for?
So see, currently there is no damage to the trend, but considering all these news that we are witnessing right now, it can see a whipsaw maybe going towards 2,200. And I think that would be an appropriate level to get into the trade and perhaps add more. Because just as even Asta mentioned, I'm looking at the longer term data, monthly chart and all. The stock has fallen from 4,400 levels and still holding strong and on a road to recovery. So I would say yes, add more at 2,200 if given a chance and hold on for higher targets.
All right, so that's your view there on Gland Pharma. The next query is coming in from Bikash, who writes to us from Kolkata. He holds some shares of Vedanta at 360 rupees, and he wants to know what the prospect is in the near future for Vedanta. So, Asta, let me come to you for the fundamental view. He has shares at 360 rupees. Vedanta is now at 262. What's the prospect in the short to medium term?
Short to medium term prospects are strong. Why? Because what we have seen that now it has become a diversified commodity portfolio. Secondly, what we believe that due to this demerger, definitely this helped company in unlocking the value, and they've got a very strong dividend history as well. So my idea here is that, and in fact, their FY26 performance, if I'm correct with my memory, is one of the bestest performance ever. So I think on the basis of all these factors, yes, Vedanta is looking still good to us, and that is why we recommend hold on this counter with a price target of 280 to 290.
And Vaishali, on the technical front, Vedanta for you, what is the near-term prospect and near future? So short-term as well as long-term targets, if you could give for this.
Well, so first of all, as a disclaimer, we have recommended this stock just in the recent past to our clients because technically, I think it's pretty much done with its corrective move. Worst scenario, I think it can fall to 240, 245 levels. So I would say even if it dips, please do add more. And this also is an attractive level to look for. The first trading target that we would look forward to is 285. And from there on, we can see higher targets. So I guess step by step, depending on your time horizon, hold this stock.
Okay, surely that's a view coming in there for Vedanta. Let's move on to the next query for today. This is a caller query that we have coming in from Sivakumar, who's calling us from Coimbatore. He has investments in Bandhan Bank, and today that stock has seen a fall. We've seen the numbers coming in as well as the management commentary. But I will take it over to Mr. Sivakumar to actually take us through what is his query. Sir, afternoon, can you hear me?
Yeah, I'm hearing you.
Yes. Sir, what's
Hello.
your query?
Yeah, good afternoon. Hi, I'm holding 1,600 shares of Bandhan Bank at an average buy price of 178. Right now, I'm sitting with a loss of 6,000 rupees. I would like to know the recent post-earnings reaction and management guidance update. What will be the short-term target for this stock?
Okay.
Can you suggest?
Sure. Short-term target is what you're looking at. And today, we had that management commentary also. So just for your reference, they've spoken about some impact coming in on the NIMs because of the wage hike. NIMs, they said, moderated because the bank is now moving more towards the secured loan. And obviously, they said that worst is behind them and will improve from here on. Believe NIMs will remain at these levels. But, Asta, firstly, you just on the fundamentals, what's your view? Though it's a short-term target that Mr. Sivakumar is asking for, but on the fundamentals, does it merit still holding Bandhan Bank right now?
Major reason is that the reduction in the guidance by the management and especially that of ROA from 1.6 to 1.8, they have reduced it to 1.2 to 1.4%. So that was a major reduction. So now we have to see how management going forward will work on the margin, whether the margins will be stabilized or we can see increase in the margin. Along with that, asset quality needs to be watched, closely because we have to see whether they have shown some sort of an improvement in the asset quality as well. So my idea here is in the short to medium term, definitely this stock will show some more downside momentum. Be ready for that. But in the medium to long term perspective, maybe the stock can show some sort of a stability after falling from here. So right now, my target here for the Bandhan Bank is down at present. But my idea is it can fall till the level of maybe 165 to 168, but afterwards it should stabilize. So stay invested in this counter only if the perspective is medium to long term, where the medium term means at least 3 months or more than 3 months.
All right, so stay invested if you're looking at the medium to long term. Vaishali, what's the short-term target for Bandhan Bank that you have, and should the viewer be stay invested?
I would say currently it is sitting on a make or break levels. It's taking a support of a 200-day moving average. And today's low is also around 169. So if these levels break, then this could trigger a further sell. And if we see a stability at this level, then the bounce that I would look at is near-term target would be around 190 levels. And from there on, if it still moves, then maybe 210. The strength of the stock is only about 220 and sustaining above it. So watch the stock very closely. Below 168, it's a fresh sell.
All right, so watch the stock very closely is what you're saying. But on that note, we have to take a quick break, but don't go anywhere. We'll answer more stock queries on the other side. Stay tuned.
Welcome back to your stocks on cnbc TV 18. We have a whole host of numbers that are coming in, and you can see them flashing at the bottom of your screens as well. We had Adani Green previously. Now we have Mahindra Holidays that has come up with these numbers as well. Operationally, seems like a bit of a weakness that we're seeing because margins are down to 15.4% versus 17.5%. Overall, EBITDA is lower as well. So that'll be key to watch out for. And the company has reported a loss this time versus a profit last year. So more in terms of internals, where stock has seen a sharp fall coming in right now once the numbers were reported. So let's keep an eye out on that one. But let's keep it going with more of your stock-related queries that you all have sent us. And we still have our experts, Asta Jain of Hem Securities, as well as Vaishali Parekh of Prabhudas Leela, to answer all those queries. The next query for today, Raj is writing to us from Jaipur. He's holding 3,150 shares of Bajaj Housing Finance. Is at a price of 112 rupees per share. Wants to know whether to remain invested at this one or book his losses. Asta, what's your view on Bajaj Housing Finance? As a group, obviously, Bajaj is a strong group. We've spoken about this before as well. But since they're making a loss, is it better to get out of the stock and then maybe re-enter at some levels? Fundamentally, how is it looking? First up to you, Asta.
So what I believe that by their Q1 FY27 business updates, so they have shown growth in their AUM. In fact, disbursement have also shown up around growth of around 33%, while AUM has shown the growth of around 24%. So now Q1 FY27 business update seems to be on the stronger side. So I think right now we should just give the time to this counter, and hence I recommend rather than booking losses, let's wait for the more details to come in. So just hold this counter, and in fact, if results will be on the higher side, then definitely we can see this stock moving upside till the level of 90 to 95. So just hold is what I can recommend at this point of time for this counter.
So you recommend a hold at this point. Vaishali, business update was good. What should the viewer do? Should he, stay invested in the stock at the price that he bought it at, or do you think he should book his losses at this point?
I would say hold on, because nothing much has happened. It's only consolidating. But there is right now no negative trigger. But having said that, I would say 80 to 80 levels is the crucial support level. So hold with these levels. And I would say have further conviction only if the stock goes above 93, 95 levels. That would get the stock back in trend. So right now it's a hold.
Okay, it's a hold that you're saying coming in here. I just wanted to know, is average an option, Vaishali, right now?
Well, then 82 would be the level, which is again a make or break. So your risk reward ratio again becomes favorable.
All right. The next query is coming in from Praveen, who writes to us from Chennai. He wants to know whether it is the right time to accumulate Hitachi Energy India, GE Vernova and TND India, given that the power equipment stocks have corrected. And this was on the back of the news that the government had made a while back. So Astha, what do you make of these companies right now?
So yes, now the reason being, we all know that there's a massive transmission investment pipeline is there. Then the data center expansion is there. So I mean, all these and the renewable energy is also there as a story. So I mean, these factors are pointing out towards the strength in these counters. So now, if I talk about the Hitachi Energy, they are a leader in the technology, which is HVDC technology, that is high voltage technology. And my idea here is that being the leader in this technology, this counter is looking good. The valuation is on the higher side, so that can be one of the caveat in this whole positivity. But still, I believe that with their strong exposure to transmission, etc., and they are well positioned to gain this industry tailwind benefits as well. So yes, Hitachi Energy is looking good to us. Maybe buy on dip strategy can be applied to this counter. Regarding GE Vernova, it is also looking good to us because what we find attractive in this counter is their strong order book. So yes, both of these counters are looking good to us. But if I go with one, then GE Vernova is looking good to me, and Hitachi Energy is like buy on dips sort of candidate because of the premium valuation.
Okay, absolutely premium valuation for all these names, right? In the TND space, all of them are trading at those levels. The P levels are much higher, current P levels versus the 2-year historical average as well. On that note, on the technical front, Vaishali, Hitachi Energy, GE Vernova, the space surely is buzzing, but which one? And is it the right time and maybe a level that you could help the viewer with?
Definitely. So according to me, chartically, both are very similar in pattern, and both of them have a very strong uptrend. Right now, it's only in a consolidation. So if you were to talk about Hitachi, I think 30,000 level is appropriate, ideal to get into the stock, because I think all going well and the story is so intact. I think this can again go higher towards 36, 38,000 again. And likewise, even GE Vernova is also technically very well placed and currently at support level. So it can be bought or added more at these levels, keeping in mind that yes, 4,000 is the actual support, 4,200. Buy at these levels, and I think this can again go towards 5,000 and higher.
Okay, that's the last query for today coming in here. So Vaishali as well as Asta, thank you so much for joining us as always, helping our viewers get answers to all their stock-related queries. And viewers, thank you so much for sending us your queries as well. On that note, a quick check in terms for what the market is doing right now. We're seeing a bit of a few point inch up from when we started the show. We are at now 23,984, still below the 24,000 mark. 23,984 is where the Nifty is at currently. When you look at it in terms of crude, now it's gone up above the $94 per barrel mark as well. 3.45% uptick that's coming from the crude, and all those crude related stocks are seeing that impact and a bit of a pressure on that front as well. So we'll watch out for that. Broader end of the market continues to see that bit of a more of an underperformance in the trading session, and that's been the trend since the get-go. That mid and small cap has been underperforming in the trading session today. So that'll be key to watch out for. And obviously in terms of individual movers as well, in the last 30 odd minutes, specific fall that has come in for HFCL, Oracle, as well as Action Construction. Yesterday we saw an up move because of its numbers. Today a bit of a fall after its numbers as well. So let's watch out for that. From the day's highest point, all these have seen that correction coming in. But with that, we're absolutely out of time on this edition of Your Stocks. Thank you so much for tuning in. Remember, you can always email us your queries or send it to the phone number that will be at the top of your screens for you all as well. So do send us your queries. Last sort of trade is still left. And for that, you have closing bell up next.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan is up about almost 1.5% now.
There will be zero tariff for 2 years.
Saudis getting the oil from their eastern fields.
The capex actually is going to be slightly less.
40 points, 30 points lower on the Nifty.
Small caps, they don't make the cut.
We'll be going back to the same level of microfinance.
India pharma exports are valued at around $10 billion to the US.
The street will be eyeing, especially at a time when the stock is at a record high.
A lot of the earnings reactions, especially in today's session, has predominantly been on the negative side.
Okay, well, that is the day so far. You just have to see one price. That is the price of oil. And the price of oil is now 93. The last I checked, 93 plus 93 something. And you have about a 1% cut across the board. Actually, mid-cap, small caps are down more. And the Nifty is down just under 1%. This is Closing Bell. We are coming to you from the CNBC TV 18 Motilal Oswal studios. There you go. I mean, actually, he's not 93. He's 95, 94 and a half. So that's a big pop coming through. And I mean, it was there because it was almost, it was surprising that despite all of what was happening, price was at 88. And now it kind of is reflecting, all the troubles in that part of the world in a real way. So it's a big up move, even compared to where we were when we started on this morning. I'm Prashant and Nigel is with me. Nigel, hi.
Well, hi, Prashant. The individual stocks are really reacting to numbers. CSB is down. That one is clonked out. You have a couple of other big earnings reactions. Like you have a Cantra, Robeco, AMC. That stock, in fact, is flying away as we speak. So individual stocks, they're doing a thing of their own. But the headline index is getting hit because of crude oil prices. And we could have argued the last few days we have been resilient. Today, that resilience has given away because the 24,000 mark actually was holding out, which now has just got broken. And we have been trading below this mark for majority of the trading session, which is a bit of a worry.
Absolutely. And I think will we test the 23,800 mark once again, which has been tested so many times. It's been tested, but it's been broken as well. But I mean, more often than not, we've kind of reversed. The last rally on the Nifty began from around the 23,800 kind of level. So you're kind of in a way, you were in a range and you're now at the lower end of that range, so as to speak. So let me just quickly tell you what is, actually, why not tell you what's lined up on the program before anything else, right? So it's a weak session across the board. Oils are the big macro worry, macro overlay, but lots of specific earnings which are in focus. Tata Communications is there, CSB, Nigel mentioned that. There's the asset management companies, Canada Robeco, Aditya Birla and others. Will unpack all the results. And by the way, lots of big moves on the back of some of these numbers. Data patterns, of course, is the other one which is firing away even as the market is selling off. So we'll talk about why that has happened. By the way, 17% in 2 sessions, as you see. And of course, what to expect from companies, right? I mean, you'll have Dr. Reddy's, Eternal, Indusen, which will report numbers today. So it's a packed show as always. How should you position yourself and what should you do in terms of trades to take now? Mitesh is with us with the advice. Mitesh, good afternoon. Welcome back. What do you do?
Good afternoon, Prashant. We've been saying that 24,000 or thereabouts should be the support, and the market is now trading below that. Now, below 24,000 means that the index is also trading below the 10, 20, 30-day average, and that's not a very positive sign. In fact, we hope that there will be some bounce back to explore long opportunities. That's not happened, and the market still remains near the day's low. So my understanding is that if we don't recover and close about 24,000, then I think we might retest 23,800, which was the level which the index was testing in the later part of June, and then we might get a reversal. But for the timing, I think this looks like it will extend on the negative side. So I have 2 sell calls. RBL Bank is the one which is after a long time given some kind of a corrective breakdown. So after a good rally, the stock is showing signs of a pullback or a correction profit booking. So that's a sell with a stop at about 363. Look for targets of roughly around 340 there. And the second stock is Premier Energy. And, that's also a stock which after a rally is breaking that important base level, which is around the 1,020, mark. So it's trading below that. So keep a stop roughly around 1,031. Look for a target of around 970 to about 965.
Got it. All right. Thanks a lot for that, Mitesh. Well, let's address a couple of stocks that are reacting to their numbers, Tata Communications as well as CSB Bank. First, let's go across to Ananya. She's here to tell us about CSB Bank. Hi, Ananya. Good afternoon. It appears the credit cost number popped up a little bit. The NIMs did contract, and I think the cost of deposit has moved up. And that's why the stock has taken a hard knock. Tell us more.
Well, that's true. The stock is under pressure due to these reasons because of the sequential decline in these factors. YOY, the trend looks good, but if you look at the sequentially, the trend looks weaker. Let me walk you through the business numbers first. So gross advances grew 24% year on year, while deposits rose faster at 26% year on year. However, if you look at the CASA ratio, it declined to 19.41%. That will be a key monitorable. It shows that deposit growth was largely driven by costlier term deposits. Now, loan growth also remained heavily dependent on gold loans, which expanded 47% year on year and now account for 54% of the total loan book. Now, on the earnings front, the numbers look good. The YOY trends look good. PAT rose 27% year on year. NIM improved to 3.66%, making growth and margins the only key positives here. But however, the sequential performance was weaker. Fee income fell 30% quarter on quarter, which along with softer treasury income pulled operating profit down to 15% quarter on quarter. At the same time, the cost to income ratio increased to 64.55% from 61.88% quarter on quarter, indicating weaker operating efficiency here. Now, the bigger concern was on the credit side. Total provisions rose 2.1 times quarter on quarter to 49 crore, mainly because NPA provision increased nearly 4 times quarter on quarter. This was in line with the slippage ratio rising to 0.97% from 0.66% quarter on quarter, while credit costs doubled to 0.36% from 0.18% quarter on quarter basis. So lower fee income, lower asset quality, a declining slippage ratio will be the key monitorable going forward also.
Is there a call, Ananya? The investor call?
Yeah, it's later this evening.
Today? Later today?
Yeah, today.
Okay, well, I think that'll be consequential. Stocks down sharply, and I mean, if you're trading on the back of moves and calls are post market hours, it'll matter what is said on the call, and what happens on day 2 post the reactions. Today, of course, I mean, I think it's already recovering a little bit, but 6.5% lower right now. And thanks for that. Well, Tata Communications is the other one, down in trade post first quarter numbers. Let's wrap this number up. Vinny is here with all the details. Vinny.
Hi, so for Tata Communication, overall, the numbers largely in line with expectations. There was an exceptional item, and that is the impact that's coming in on the profits of the company. Now, just first up, in terms of revenues, that's seen a growth of 0.4% on a quarter-on-quarter basis, yearly 10.5% growth. So revenues came in at around 6,582 crores for the company. Apart from that, now let's move on, talk about the profits of the company. When you compare it on a quarter-on-quarter basis, the profits are down by 50%. What is the reason? There's an exceptional loss of 106 crores versus a loss last year that came in of 20 crores, the exceptional amount. So this is largely on account of 2 reasons. One, there was a fire incident at the co-located third-party data center, which was of around 30 crores. The other one was a provision of contractual obligations. Because of that, there's a 50 crore adjustment. So this is the exceptional items that are coming in for the company in its P&L account. Now, apart from that, when you talk about the margins of the company, that have also seen a dip on a quarter-on-quarter basis as well as on a year-on-year basis. Looking at the trends in terms of the EBITDA margin of the company, it came in at 18.7%, right? Now, that's the lowest level that we've seen coming in, and this was a level we saw last coming in Q4 FY25. Nonetheless, the management is saying that they are on track to deliver double-digit EBITDA growth for the full year as well. So that will be key to watch out for. But as of now, we saw some impact coming in because of those exceptional items, and that's why we saw a sharp fall coming in the stock as well, and then some bit of a recovery later on.
Got it. All right. Thanks a lot for that, Vinny. Well, let's welcome Sid Khemka, Head of Research Wealth Management at Motilal Oswal, who joins us on the show. Hi, Sid. Good to have you in. Tell us, what do you think of CSB Bank? The street for the time being is a little bit concerned with regard to the compression on the NIMs as well as the credit cost that went up. And on Tata Communications as well, there's a bit of a one-off out there, but the stock actually has recovered from the day's low. I think you'll have coverage on both these two. So what would you say?
Hi, good afternoon. So unfortunately, CSB, we don't have coverage, but if you look at broad numbers, I think on a Y&Y basis, the top headline numbers are decent. NI rose about 26%. Operating profits, that grew just 13.8%. So there is definitely some margin compression that is impacting the numbers. Provisions, that also increased sequentially to 49 crores compared to 23 crores in the previous quarter. I think you see some of these banks, especially the mid-sized banks, where the recovery was expected, given that there is a healthy system credit loan book growth, are witnessing some kind of pressure, especially on the margin front, as the competition for deposits has been pretty tight. Case in point being Bandhan Bank yesterday reported all-round good numbers, but definitely there was some issues which the management cutting their guidance of ROEs going forward, which was kind of a big negative surprise, given that they were kind of witnessing the kind of growth recovery, and with the exit ROEs all reduced sharply. I think we have
We're going to come back to you. We're going to come back to you, Sid. We're going to come back to you, get a better line on that one. But we'll go back to hear out Sid's view on those banking names. Let's keep it with earnings. So let's go across to take stock of a couple of AMCs and how they fared in the quarter gone by. What we're focusing right now on is Canara Robeco as well as ABSL AMC. Divyani is with us to run us through the fine print. Divyani?
Well, Canara Robeco AMC came out with a good set of numbers with mark-to-market gains aiding PAT growth this time around. Mutual fund quarterly average AUM was up 1%, with equity quarterly average AUM also up 1%, but market share saw slight moderation quarter-on-quarter. SIP flows did drop 5% quarter-on-quarter, but management noted early recovery signals in this particular space. Coming to the financials, revenue was up 2% quarter-on-quarter, operating profit was up 3% with slight margin expansion, and other income aided the bottom line sharply, up to 30 crores this time around against a loss of 10 crores in quarter 4. Now PAT as a result was up 83% to 76 crores. Now management has also hinted towards a good pipeline of NFOs, including SIFs that come in later. Now after a good set of numbers from Canara Robeco AMC, let's come to an operationally weak quarter, that was ABSL AMC. Mutual fund quarterly average AUM dropped 1.9%, and this is despite Nifty seeing a 6% up move in quarter 1. Market share continued moderating across both equity as well as overall, and SIP flows this time around fell 10% quarter-on-quarter. Higher employee expenses also impacted the operating profitability, but mark-to-market gains this time around have aided profit in spite of the weak performance, with other income coming in at 162 crores this time versus a loss of 33 crores in quarter 4. Now the silver lining though in this entire quarter was the explosive growth that was seen across the alternate space, with AUM growing 4 times quarter-on-quarter. But looking at all of this, the valuation gap is also something that we need to take into account. ICICI, SBI and HDFC AMC all trade between 40 and 46 times their FY26 earnings. ABSL AMC was trading at 34 times, but after the recent down move is trading at somewhere around the 29 times their its FY26 earnings. That said, Canara AMC is relatively undervalued compared to all of their peers, trading at somewhere around the 25 times their FY26 numbers, and this is the reason why there was a sharp up move that was seen in Canara and a down move that was seen in ABSL AMC after the recent results.
Pretty interesting. Thanks very much, Devyani, for that. Sid, view on the two AMCs?
Prashant, I think if you can hear me properly now. So Aditya Birla AMC, I think, reported good numbers in terms of a flattish kind of number in line with expectation, and net profit grew because of higher other income. What we see is that in terms of the fund performance, that Aditya Birla AMC is showing improvement because of the new fund management team, and that has led to a stronger distribution traction. They are now expanding into alternates, PMS, passive. Some of the products in the GIFT City has been launched. which provide meaningful long-term visibility beyond the core mutual fund business. I think Canara and Robeco also reported very strong numbers, but comparatively, I think if you look at the best stock in the space is Nippon India AMC, which continues to outperform, very strong numbers there, and valuation also higher. After the Aditya Birla now catching up, we still believe that there is room for growth in Aditya Birla AMC, where we have a buy rating and target price of 1290, almost 1300. So we still see room for 20-22% upside on Aditya Birla AMC. Canara Robeco, because of purely from a valuation, I think looks interesting in terms of numbers they have been delivering, and with the kind of growth, the valuation gap should kind of fill in. So in terms of size, they may be small, but growth and valuation-wise looks attractive.
All right, look at the bottom of your screen. You have the numbers of BPCL that are flashing for the viewers out there. There's a revenue growth out there, but there's an EBITDA loss, and the bulk of that, I think, would be because of inventory loss. So X of that, we'll have to wait by to analyze those numbers. For the time being, the stock saw a bit of a knee-jerk reaction, but I think the street is coming to terms with that. Probably there was a big inventory loss for the first quarter, and that's why we're seeing a bit of a recovery. We'll wait by for further clarity with regard to the GRMs as well as what are the volumes in the past quarter. So hold that thought for the time being on BPCL. But the stock of today as well as yesterday's data patterns, that's flying away in a couple of trading sessions. The company has emerged as the lowest bidder for the 1,300 crore project from HAL. Let's bring in Ria for a quick analysis on that one. Ria?
Well, yes, data patterns has been in focus over the last two trading sessions. It is up nearly 20%, and just today we are seeing a gain of nearly 12% on the stock. And this is because yesterday the company has emerged as the L1 bidder for a 1,300 crore rupee project from HAL. Now, this order pertains to electronic warfare equipment, which includes a buffer amplifier as well as a built-in test equipment module. Now, as per the government e-marketplace website, that has indicated that the award of contract has gone to data patterns. And remember, this is significant because the FY26 order book of the company was just about 926 crores. So this 1,300 crore order will more than double the current order book of the company. Now, in the quarter four earnings call, the company had said that they are expecting to receive nearly 1,000 odd crores of orders within the next 2 months, for which the negotiations had been completed at that time. And they are also expecting a further order inflow of nearly 1,500 to 2,000 crore rupees in FY27. In fact, after the results of FY26, the company had given their guidance for the years ahead. They had said that they have a strong order book pipeline, which is pegged at nearly 2,000 to 4,000 crores over the next 24 months. In fact, they also have a revenue growth rate target of 20 to 25% over the next 2 to 3 years. And for FY27, they are targeting to maintain their EBITDA margins at nearly 35 to 40% and also maintain their net debt-free status. And apart from this, JM Financial has also come out with a note on data patterns. They've maintained the ad rating with a target price of 4,080 rupees. And they have highlighted that this particular order is scheduled to be executed within the next 180 days from the date of the award of the order. And they have said that they view this potential order as highly significant for the company because, as I mentioned before, this exceeds data patterns total FY26 order inflows of nearly 1,100 crores and also surpasses its current order book of nearly 926 crores. Now, in terms of the valuations, currently the stock trades at nearly 54 times its FY28 EPS, and the brokerage has said that they do see potential for further earnings upgrades once this order is awarded.
Okay, thanks for that, Ria. Big move is what we are seeing. Sid, any view on this one? Data patterns popping up in trade?
Nigel, I think pretty strong numbers there in terms of order win. Now, effectively, the order book has now rocketed to 3,300 crores. So, if you look at the new project, electronic warfare, of about 1,300 crores from HAL, that is pretty strong. And they have been getting new orders, for example, radar supply contracts, about 300 crores. FY26, they saw a strong order inflow record, new orders of about 1,120 crores. So company effectively is doing pretty strong. The challenge that we see is in terms of valuation. So our estimate suggests about 30% kind of a profit CAGR over the next 2 years, but stock trading at about 50-55 times, that leaves little room for upside. Nonetheless, I think the entire defense value chain, that looks very attractive. Purely, I would say, in terms of valuation, better to enter in any correction or a risk reward which is favorable, then jumping in at current levels. So I would wait for some better entry opportunity. Otherwise, I think the company is in a very sweet spot, getting consistently large orders, and the strong order book gives enough growth visibility for the next 2 years.
Got it. Okay, all right. Thanks, Sid, for joining in and giving us that view on all of those stocks. Wishing you a good remainder of the day, and we'll see you soon on the show. By the way, from the broader markets, a few stocks actually that are calling for attention as we speak. Pull up Wakefit Innovations. I think that one is up more than 10% now. Massive move is what we're seeing out there. Mahindra & Mahindra Financial Services, that's a stock in 2 sessions that's gained more than 15%. So big move is what we're seeing. The numbers were out yesterday and that one has popped up. Lotus is another stock. Lotus Developers, I think the IPO came at around 150 bucks, listed at 200, 220 rupees. From there, the stock actually halved. And in the last few trading sessions, that as well is coming into its own. For today's trading session, it's up close to on 10%. So big move is what we're seeing on that one. It's holding with those gains as well. So keep an eye out on that stock. On the flip side, Himadri Chemicals, a stock that saw a big run in the last few days. Profit taking has crept in. So Gravity catching up actually with that one currently at the low point of the day. Slip into a short break. On the other side, Jigar Mistry of Point Capital is waiting for us. Stay tuned.
Okay, welcome back. We've got SRF numbers coming through at the bottom of the screen. So it's a busy time with earnings flowing in, 49% growth in EBITDA, 76% growth in net profits. These look like pretty solid numbers if this is all operational. 24.5%, 24.6% margins compared to 22% margin on a same period last year basis. So superb numbers. The EBITDA number, I mean, even if the net profit is inflated, I think the EBITDA growth is quite commendable, which is 49% higher, 1,237 odd crores. Let's see if the stock reacts, but 2879 is where we are at.
Across segments, actually, there's a good amount of growth. So technical textiles business out there, that's, coming at around 600 crores. That compares with roughly around 467 crores. So good growth on a year-on-year basis. The chemicals business, which is bulk of the business, out there you have a 2,245 crore. That's a little bit lower on a sequential basis, but it's much higher on a year-on-year basis. So that's why, in fact, that number, the growth as well, the largest proportion of their business has done well. But just on the margin parameter, on a sequential basis, the chemicals business, which is the largest proportion of their business, there is a bit of a degrowth. On the absolute EBIT number, as well as on the margin front. There is some compression. Though on a year-on-year basis, there will be an expansion in absolute number. But I think that's something that the street will look at because that's the largest part of their business. So we'll try to revisit the numbers. But chemicals business, in fact, the growth is good. But I think profitability on a sequential basis has taken a bit of a hit. And I think that's why the stock has come off a little bit from the top.
Absolutely. 3% down. There's some recovery, but down about 3% or so. Jigar Mistry is with us, co-founder at Buoyant Capital. Jigar, great to have you with us here. Thanks for joining us. Buoyant's, of course, done phenomenally well in terms of the performance has been great, and of course, consequently, AUM growth has been pretty great as well. So just we're chatting after a while, Jigar. What's the size of the fund now at Buoyant?
Hi, Prashant. Thank you as always for inviting us. All included, we are a little over $2 billion now.
Wow, that is, it's been an amazing, I think Buoyant can be the poster child for the growth of, the fund industry, the non-mutual fund industry, really. Done you and you, of course, your team has run remarkably well. So how are you? What's the view now? And just give us a sense of, where you're invested, fully invested, how much large caps, how much broader, mid caps, small caps. Just give us that sense.
Right, Prashant. So I think, we operate this philosophy where we turn aggressive or defensive basis the way in which we think the stocks are positioned. So we changed our stance to aggressive for the fourth time as we completed our 10 years of existence at the end of March 2026. So when the conflict was still ongoing. The way in which we approached this essentially was that, if you looked at from a 52-week high, the micro caps on average had fallen about 41% median average, and large caps were down about 17%. But, the small caps on a 5 or a 10-year CAGR and large caps on a 10-year CAGR looked fairly priced. Right? So the earnings growth was broadly in sync with what the stocks were returning. Post that, essentially, what we thought was that, there will be a slow recovery as the conflict situation subsides. You would see some amount of, recovery in the Indian markets. But what happened in April, frankly, was way beyond a relief rally. And when you look at the, details of that, you find that much of it had to do with the color of the money coming in. Right? So a lot more domestic money came in, mutual fund SIPs continue, even though, the other inflow can be a bit lumpy. But the stocks that did the best were the ones where retail holding was the highest and the institutional holding was the lowest. Obviously, the small cap exposure that we had essentially also did well, and we took some money off the table there. So as we speak, we should be about 60 to 63% on large caps and the balance on small and mid caps.
All right. Hi, Jigar. Congratulations, as Prashant said. What a way you all have scaled up business. Investors happy, you all are happy. I recall that day when, you were moving on from the sell side and you said you're going to be starting your own. We had a coffee that day. And wow, strength to strength, brother. Well done. Let's talk about some of the recent investments then, that you all have made. Smart meters, that seems to be a place that you like. Tell us a little bit more about that. The street has been a little bit cautious because order inflows have slowed down, but that's not happened for a while. So we could be bracing for orders to open up yet again in the smart meter space. And also that working capital cycle has been elevated, cash conversion has been elevated, which managements have indicated they're gradually working on that and things should improve. So tell us about this theme.
Right, Nigel. So, see, obviously, the electrification theme, people play it through different ways. The allocation that we had just got, which got announced, was a reasonably small allocation. So, from that standpoint, it's not a large one. What we are building in essentially is that when you value businesses like this, the O&M part of the business is something that you don't really get to see. Right. And the margins in the O&M business, when that starts becoming a larger part of the product, or the larger part of the revenue mix, leads to improvement in margins. And the recovery that was pending, at least the way we see this in the working capital cycle, broadly appears like it will play out. So, but as I said, see, this is a very small part of what we have been allocating at. The larger chunk, to answer your broader question, is that for the first time in a decade, we are allocating very heavily to consumption. Right. And very briefly, see, between 15 and 20, you saw consumption do very well. People, went to an extreme to suggest that, their buys even at 150 and 200p. But the economic impulse of the RBI, of the government, was to spend on consumption. Post-COVID, however, if you take the state, center, and PSU capex, that number together has been growing between 25 and 13%, 30% between 2020 and 2024. And that completely changed the volume dynamics of consumption, and the valuations also normalized. So for a majority of the past 6 or 7 years, these stocks have not done great, and the valuations have come back to what we think is normalized. From 2024, initially it started with the state budgets and now the central budgets as well. The money is moving in the hands of people. By our calculation, something like 6 lakh crores have moved in. That's about 1.7% of GDP. Anything above 1% in absence of a crisis period is considered massive. We are tracking on where that plays out through consumption. But now I think what happened with the 15 to 20 cycle is something that we are expecting in consumption to play out again. And that is where the last 12 months has seen the largest amount of additions. We have added something like 8% of our portfolio into the consumption theme. In addition, lending institutions and healthcare are, if you add these three, they make something like 50% of our portfolio allocation.
Okay. All right. Got that, Jigar. Thanks a lot for joining in and giving us your view on a couple of themes that you like as well. Appreciate you joining in. Thanks a lot.
Thank you.
Well, I think SRF is a stock in focus yet again, because the absolute number is a big beat. I'm just looking at a couple of estimates that I've got. And in fact, that 1,240 crores, it was a number that no one actually was estimating. The estimate, I think, was less than 1,000 crores. A couple of sales notes have come in. And the beat really has been led by a smaller part of their business, which is the packaging films EBIT. That's coming at around 350 crores. I'll tell you what, on a year-on-year basis, that's up 150%. Smaller part of the business, but big beat out there. On a sequential basis, that EBIT number, which has come at 350 crores, it's more than doubled. So, 150 crores odd has become 350 crores. So that's where, nearly around 200 crores, Philip, is what has come in. And the chemicals EBIT, the margins that I was talking about, that's at around 27.6%. So on a sequential basis, actually down 4.4%, 440 basis points. Though on a year-on-year basis, those margins have been maintained. So the largest part of the business has grown well. The margins have been maintained year-on-year. Though on a sequential basis, there is a pullback of close to around 400 basis points. Street, for the time being, is bidding up that stock. It's been strong over the last few days as well. But let's shift focus to India's aviation space. That's in the spotlight on the back of a Bloomberg report suggesting that the government may be looking at a policy shift for the sector. Private airport operations could soon own and operate airlines. No one better than Madhya to join us to tell us all of that. Madhya.
Well, the Bloomberg report is saying that the government is considering a major policy shift that could allow private airport operators to own and operate scheduled airlines. The proposal is currently being discussed within the Civil Aviation Ministry and will require the Law Ministry's approval. But if approved, it could pave the way for airport operators like Adani Group and GMR Airports to launch their own airlines. Now, if the rules do change, Adani would have already have a presence across almost the entire entire aviation value chain. Besides operating airports, the group has presence in aircraft maintenance, ground handling, flight training, airport retail, airport lounges, and even aircraft assembly through its partnership with Brazilian aircraft manufacturer Embraer. An airline is the only missing piece here for Adani Group. The Adani Group won the rights to operate 6 airports in 2019, including Ahmedabad, Lucknow, Jaipur, Guwahati, Mangaluru and Thiruvananthapuram. That became possible after the government in 2018 removed the requirement for bidders to have prior airport management experience, opening airport privatization to new infrastructure players. The group's biggest expansion came in 2021 when it took control of the Mumbai International Airport from the GVK Group and got Navi Mumbai Airport too as part of the deal. Since then, the group has expanded well beyond the 8 airports. It recently inaugurated a commercial terminal at Mundra Airport, which used to be its private airstrip. So if the government does allow airport operators to own airlines, and should the Adani Group look at the opportunity, it could potentially have a presence across almost every segment of the aviation value chain, from airports and airline operations to maintenance, ground handling, flight training, retail, and even aircraft assembly. And it's not just Adani. The other private operator, the GMR Group, which operates Delhi, Hyderabad, Goa, and Nagpur, has also expanded beyond airport operations. The group has built businesses in aircraft maintenance, cargo handling, duty-free retail, aviation training and airport parking. So if ownership norms are eventually relaxed, both of India's largest private operators already have significant aviation ecosystems in place. India does have a shortage of airlines, with Indigo controlling 66% market share and Air India at 24%, Akasa at 6% and SpiceJet just at 2%. So while such a policy change would bring competition in the aviation sector, there are also concerns of airport operators possibly allocating prime slots to their own carriers. Nevertheless, if the proposal eventually becomes a policy, it could fundamentally reshape India's aviation landscape. CNBC TV18 has reached out to the Aviation Ministry and is awaiting a response.
Well, it's a pretty interesting story, Madhya, and thank you for that. So will we see newer players getting in? Is an open question at this point in time. Take a quick commercial break here. We'll come back with some short-term trading ideas with our technical expert on the other side. Coming back.
Welcome back. Keep your eye out on the bottom of your screen. You have Eternal's numbers that are flashing for you, and prima facie, it's at least missed what Mangalam's poll threw up. So we'll have to wait by for further clarification whether or not there is any kind of one-off in those numbers, because for the time being, the net profit number is a big mess. So probably there is a couple of one-offs out there. But the operating profit, actually, the EBITDA number that's been flashed, is a miss in comparison to Mangalam's poll as well. So some kind of clarity on that front. And Mangalam, I'll tell you what, he's going to be punching in the numbers. He'll be with us, I think, in the next 120 seconds to dissect those numbers for us. For the time being, the stock has gone south and it's currently at the low point of the day. Sharp drop, Prashant, as we speak.
Oh, absolutely. And that's and you know, when Eternal reports numbers, especially, and you know, it's a number one player across both categories, quick commerce and food delivery. There's a bit of a effect on other companies as well. We'll stick with, of course, right now looking at the Eternal numbers in some detail, but you know, they're by far the leader the faster growing segment is quick commerce, where I think you know, Blinkit makes money. The other, you look at the other 5-6 odd players, I don't think combined make money at this point in time. So clear leader, but there's a bit of a disappointment coming through. I think we got the EBITDA number, which is now flashing as well. Mangalam is here, so I think we can go across to him. Mangalam, take it away.
Well, for Eternal this time around, the EBITDA slightly below street expectations. So if you look at you know, the reported numbers, the revenue growth of 17% at around 20,211 crores is slightly above street expectations of 19,850 crores. The EBITDA here, the street was working with a number of 670 crores, but the company's gone ahead and reported 594 crores, and that's where a 3.5% margin expectation has turned into 2.9%. Sequentially, there hasn't been a big jump, and that's something that the street perhaps may not like. And the reason why that has happened is more to do with the food business than it is to do with the quick commerce business. So if you look at the food business, year on year, the revenue growth has been fairly strong, 37%. And out here, the EBITDA growth, however, has been just 34%, which means the margins have come off by about 60 basis points. Food business was supposed to be margin accretive. My sense is year on year, because of higher fuel prices and increased costs, the margins may have come off. No real problems for the you know, Blinkit business or the e-commerce business. In fact, quarter on quarter, the e-commerce business has done a lot better, and that is something that the street may like and which may stem the decline that we're seeing in the stock price right now. Quarter on quarter, e-commerce revenues have grown by about 18.5%, and the EBITDA out here has jumped by 38%, which tells you the benefit of operating leverage is kicking in well and truly on. 265 crores has turned into 365 crores. Now, the reason we're looking at Blinkit quarter on quarter is because year on year, remember, the inventory recognition model of the company changed, so these numbers aren't comparable. For every other number, you're looking at it year on year, which can be comparable, but barring Blinkit, which quarter on quarter makes more sense because of the change in inventory model, and out here 18.5% revenue growth is what the street likes. The other business, which may have been a bit of a drag on the EBITDA, is the going out business, which is District, where the company has said that they will continue to make investments. So out here, revenue growth year on year has been 15%, but the EBITDA loss has increased from 48 crores to about 61 crores. So growth out there will be extremely crucial. But all said and done, while the stock has recovered a tad from the lows because Blinkit's internals are strong, we're still awaiting the shareholders' letter, which will have a detailed analysis of what went by this quarter. But for now, it looks like there has been a miss in the food business, but Blinkit has actually gotten stronger.
All right, Mangalam, you know, as you speak, you said it, the stock has seen a good recovery from the low point of the day. In fact, the adjusted margins in the food delivery business, the management is saying that they're approaching the upper end of the guidance of around 5 to around 6% of NOV. So that explains why the stock actually from the lows, I think it went down to around 276. That's seen a good bounce, you know, from the lows. But further clarification is awaited. I think, you know, Sudarshan as well is sending us the NOV growth is on expected line. So a little bit of a miss, but the street is looking at the internals a little bit more closely. And that's why seeing a wee bit of recovery from the lows. Mangalam may rejoin us to give us some more analysis in just a bit. Let's tell you what's going on in the F&O space. Though it appears we're moving towards the lower end of the band. The problem is crude oil prices. You know, just a couple of sessions ago, it was behaving quite well, $86, $87 per barrel, after going down to $75 per barrel mark. Now, the problem is it's holding very, very close to a $95 per barrel mark, which is an issue. You know, that's what's going to be weighing on sentiment. Also, if you look at the advanced decline ratio, last few trading sessions, your portfolio will feel good, right? Because you had more number of stocks advancing than declining, irrespective of what's going on in the globe. That's turned around today. So that's the problem point. Looking at the options data, 24,000 call. The premium has come down by nearly around half. So 270 rupees has become around 140 rupees, telling you there is aggressive writing being seen at that level. Not just that, even the 24,100 call, the premium has halved out there. So aggressive writing is what we are seeing on both those two strikes, which explains why the bears now are feeling on top, because the call writers are back in play. And the 24,300 mark as it is has been a bit of a upper level. And once we visit that mark, we're normally getting rejected. Now moving to the lower level though, the 24,000 put, the premium has come down. Has gone up actually from around 88 bucks to around 163 rupees or thereabouts. So there is actually writing being seen at that particular level because the bulls still believe that lower end of the band, which is 23,800, can get defended. So that's the important mark you need to look at on the downside. Individual stocks, Polycab is a stock that corrected, I think, close to 7 to 8%. There's a fear that there could be some supply that's coming in. That's coming for a bit of a short squeeze today. So those shorts are covering out their positions gradually. And that's why that stock has moved up. We'll have to see sustenance of this move because that overhang still continues to persist. The other one is Kalyan Jewellers. You know what a stock that's been? It's turned into a bit of a buy on dips. And that's why on a day-to-day basis, we have been just talking about the stock. On the charts, the stock has seen a 40% rally. And after that, it's continuing to see a buy on dips. On Monday itself, it went down, I think, to around 565. And from there, it's closer to around 600 rupees. So there is a bit of a short covering bounce. And Nestle has come back on the buying list. One of the pleasant result surprises with solid volume growth out there and good numbers. So that's why, in fact, that stock is seeing fresh buying. But as I promised, Mangalam doesn't want to let go of the action. He's joining in. He spotted something more in Eternal. Mangalam.
Well, these numbers actually internally look fairly strong, and that may cause a recovery in the stock price. And why do I say that? Because a couple of things that really stand out. Quick commerce, quarter on quarter, the business has grown by 18.5% on an NOV basis. The street was working with a number between 18 to 20%. Food delivery, it's grown at around 13% quarter on quarter. Yes, earlier it has grown fairly, stronger, but this time around, it could also be on account of lower items which were given by restaurants in their menu, and which is why the growth has not been 16 to 18%, but 13%. The important part here is that the management's commentary as far as competition is concerned is fairly good, where they're saying that while there has been no change in the way competition has come by, there is actually at the same time predictability in the competitive activities which are taking place. They say that Blinkit has actually seen a fair number of retained customers, and that's reflecting well in their EBITDA margins in Blinkit, which have come to the higher end of their 5 to 6% band. So from here on, the margin expansion play for Blinkit doesn't happen, but the fact that they are retaining customers and continuously expanding their dark stores tells you that the move is fairly positive and they are fairly on track despite the competitive intensity being on track, and the company says that they are anticipating that, and it's become fairly predictive. The important part, again, from Eternal's district business growth perspective, they maintained their growth targets. In fact, they said that the 60% year-on-year jump that they've seen in districts business is not seasonality, and there are no one-offs out here. This is structural, so their expansion plans out there are working as well. So all these factors point towards a better looking outlook coming in from the industry leader out here, and the stock, which had corrected a fair bit from the top, also has seen recovery, and as a result of which now moved into the green.
Mangalam, stocks up 2%. I think it was almost up 2%. So it's a fast-changing screen out there. But the most significant thing out of the numbers so far, what you've seen, and the presentation is very detailed and very, very granular. But so far, one thing that really stands out to you.
The one thing that always stands out to me for Eternal, and this is, right from the last 5 or 6 quarters, the number that I look at most closely is the cash balance at the end of the quarter. Irrespective of all the burn that they're doing, irrespective of the growth that the company is reporting and all of that and stuff, the one thing I personally track is from last quarter to this quarter, has the cash of the company increased? And that has predictably happened over the last few quarters as well. So remember, the stock had seen a bit of a correction from the top sometime around the second quarter last financial year, when the cash had fallen from 18,314 crores to about 17,820 crores. From there, we've seen a recovery from the lows, largely because every subsequent quarter, the cash of the company has increased. This time around as well, it's at 18,288 crores. This compares with 17,972 crores. So amidst all the growth investment and dark store expansion that they're doing, the burn rates, you can speak about contribution margins, EBITDA margins, adjusted margins and all of that and stuff. The one thing that stands out is that quarter on quarter, for the last 3 quarters, the cash has constantly increased, and that's a positive.
Okay, well, Mangalam, thanks very much for that. Interesting, and the stock always sees like a two-part reaction, immediate reaction after the numbers, and it's happened so many times, I think, in the last many quarters, and then more details, commentary, etc. starts to come in. We see the second phase, and that's essentially what has happened here. We have Mitesh now joining in with some trading ideas as well. Mitesh, what do you have?
I think given the fact that the market is just closing around 24,000, it's kind of a tricky situation. So I take a VBL Varun Beverages as a STBT. That's one on the negative side. Keep a stop at 461. Look for a target of around 450 kind of level for tomorrow. And the Adani Group stocks, I think Adani Ports has come down to its 34-day exponential average. So we'll take a BTS with a stop below 1808 for targets of 1835.
Yeah. Got that. Mitesh, thanks very much for that. We've got about 13 minutes to go for the market close. Numbers today from Dr. Reddy's. Let's get a quick preview going. Ekta has got that. Ekta, take it away.
Thanks for that. Well, for Dr. Reddy's this quarter, it is expected to be a subdued quarter. So the street is anticipating around a revenue growth of around 3% this time. Margins should come in lower this time at around 16% and a profit which would decline this time. Now, the key culprit would be the US business because of Revlimid generic, remember the cancer drug, which a lot of the companies benefited from. And that high base will then impact their US business. Not to mention, there will be price erosion expected in the base business of the US for Dr. Reddy's as well. Now, separately, as the US estimates then stand anywhere between $290 to $295 billion. India is expected to be resilient, so that's expected to grow around 12 to 13%. Emerging markets and the European markets also should perform well, along with the NRT acquisition, which is basically the anti-nicotine business that they had acquired, and that would be integrated in more markets. EBITDA margin range is anywhere between 14 to 21%, but the consensus is going with around 16%. Now, commentary with regards to semaglutide, the Trump tariffs, as well as the 7 observations to the Bachapalli facility will be top of mind for Dr. Reddy's.
Got that. Well, so numbers later, as Ekta points out. I think Mayuresh Joshi is with us with his thoughts on what markets are doing. So many reactions which are fast-paced, but I think let's just get a quick view, Mayuresh, good afternoon, on Eternal. I don't know if you heard Mangalam explain the numbers, but any thoughts?
Afternoon, Prashant. No, I did hear Mangalam explain the numbers. But again, I think as a space, our own sense is that these companies are loaded with cash as we speak. They have gone on an accelerated mode as far as dark store operations are concerned. And therefore, both from a head start perspective over the last few years, along with the expansionary mode that they've probably gotten into, I think even if competition probably comes through from the likes of an Amazon or a Reliance, for competition to build up that kind of a backend is obviously going to take time. And therefore, both resource, time and cost management will take its toll in terms of how competition intensity probably plays out. And therefore, I think the management commentary that a large part of competition is now getting gestated into is a point well taken. However, I think our concerns lie on 2 fronts. One, in terms of how will the margins expand? If margins are going to remain steady state or around the same levels as we speak, for obvious reasons, I think the expectation in terms of significant amount of revenue growth and NOV growth across their business segments is something that one should ideally look at. And secondly, because I think it's a business where margins are thinly traded, I think the ROEs of these businesses are extremely low. So I think we like to chase businesses where there is far more consistency in terms of reported cash flows, and those cash flows actually translating into better ROEs for the business as a whole. So yeah, I think for the business as a whole, I think structurally, I think a large part of the competition intensity pressures would largely be in the price. But I think because return ratios remain extremely poor, and there is still a little bit of an uncertainty across business models as they evolve. Our own sense is that there are better off plays in the market as we speak. So I think we remain absolutely neutral on this.
Got it. All right. Stay with us, Mayuresh. For the time being, we'll take a short break, come back. We'll continue our chat with Mayuresh. We'll also wind down the markets. Stay tuned. Welcome back. Well, if you look at the result reaction we got at the start of the show, that is SRF, and the stock actually has given up most of the gains that we saw. It saw a bit of an intraday pullback. The absolute EBITDA number was a big beat, but actually the stock has come in for some profit taking. Remember in the run up to these numbers, it had already seen a bit of an uptake, and now it's coming for profit taking because maybe the chemical segment, which is the largest part of the business, the margin contraction is something that's weighing on the stock, and that's exactly what I pointed out when these numbers came out. But the smaller part of their business, which is the packaging materials business, that has done very, very well. And that seems to be a bit of a rub-off on a couple of names that have packaging. Cosmo Films has moved to the high point of the day. Polyplex as well has moved to the high point of the day because this is a smaller part of SRF's numbers. But both these two companies, they're basically into packaging. So after those numbers came out, you saw that both these two stocks have put on some more weight. Both of them currently at the high point of the day. Seems like the street is reading through that these numbers were good for this particular segment, and that's why both these two could do well. Mayuresh, wanted your view. I think you track these companies, SRF's numbers on the whole look good, but the smaller part of the business actually seems to be where the beat came about, the packaging material segment. And that's why you have Cosmo as well as Polyplex that are up. You track either of these names?
Yes, I do, Nigel. Afternoon to you as well. And therefore, I think the expectation largely is that since the packaging part of the business has done well, I think they had an alternate press release that they're also expanding their business. So I think they're putting in a 25,000 MTPA BOPET plant or a 250 crore capex. And therefore, I think one really needs to understand management commentary once they go on a con call on how do they see the dynamics of this business going forward. You're already seeing that there is significant amount of capacity additions that are probably happening across the globe. When it comes to both parts, the BOPP part as well as the BOPET part, that probably happens. And therefore, the trends in terms of demand-supply dynamics, pricing, input costs obviously depend a lot in terms of crude derivatives as well. And therefore, how does that play a portion in terms of the management thought process in terms of putting in that capex for expansion of the capacities will obviously give us the flavor in terms of how Cosmo or to a certain extent the other packaging films are probably placed. But yes, I think the smaller part of the business for SRF, including technical textiles, has probably done.
InterGlobe will report. We'll have the number, expectations come up on your screen. Any thoughts on this one? It's come off the lows, Mayuresh. A bit of a turnaround story here. I mean, if you want to believe it, but 1% higher.
I think the street probably believes, Prashant, that the worst is probably over and they're starting probably with a clean slate with the kind of provisioning that they've probably recorded on the balance sheet. And therefore, whatever they do henceforth will obviously reflect positively in terms of the management strategy and vision going forward. So the expectation largely is that, at least on a quarter-on-quarter basis, I think there should be reasonable amount of advances growth like we've seen for the BFSI space in general. But generally, I think in terms of management of their balance sheet, how do they manage the liability side well over the next few quarters, the NIM guidance that they probably give out and the asset quality. I think there is expectations of runaway growth for InterGlobe Bank. Unfortunately, we don't own InterGlobe Bank as we speak. I think we like the smaller private sector banks, Prashant, to be honest, a little bit more compared to the larger private banks.
Crude and all, right? You've spoken about in the past. Crude Vaisya, yeah. Okay, I think we're just a minute away from market closing. Mayuresh, stay with us. We'll come back to you on markets forward in a bit. But I mean, just to wrap up things, right? It's down to 24,000, just under 24,000 on the Nifty. The Nifty Bank taking a hit by about 700 points, 1.25%. Mid and small caps down more, about 1.3, 1.1, 1.3% kind of losses coming in there. Real estate has had a run up. It pulled back. PSUs had a run up, pulling back today. IT. Run up last week, but it's been pulling back this week, and Infosys will report tomorrow. I think the only sector which was up was FMCG, large sector, which was up 0.5% or so. Indigo, top Nifty loser. The top Nifty gainer is Bajaj Auto, 6% reacting to numbers. By the way, numbers came yesterday, but the commentary, I think, mattered. One of the top losers, of course, is Bandhan Bank, ends 15-16% lower. SBI Funds is basically at issue price, 10 rupees away from issue price, down on large volumes, by the way. Lodha DLF, I mentioned the index, but Lodha DLF constituents which were down sharply. MedPlus, we had the management early on before markets open, another 10% cut today. Lupin, Aurobindo on the pharma side, or the tariff threat from President Trump lower. Data patterns and Bluestone perhaps stand out as two big winners. And for Bluestone, I mean, I think it's been a pretty spectacular week as weeks go. So let me just look at what it's done. This is day 3 this week, and it's up 30% for the week so far. So 777 from 600 last week. I think we're going to wrap up on this edition of Closing Bell. Markets forward. We'll pick up on the action in just a bit. Stay tuned.
Markets end in the red but recover sharply from the day's low, with the Nifty managing to hold the 24,000 mark. Heavyweights remain under pressure as IT stocks and Reliance Industries along with HDFC Bank continue to weigh on the benchmarks.
US President Trump threatens to impose 100% tariff on generic pharmaceutical drugs from August 2028, provides a 2-year window for companies to move manufacturing to the US. Shares of Indian companies decline as they supply nearly half of the generic drugs dispensed in the US.
Shares of Bandhan Bank plunged nearly 17% after the management cut its FY27 ROA guidance. Motilal Oswal's rating downgrade also weighs on the stock.
Eternal's Q1 numbers point to healthy operating momentum. Food delivery growth came in line with expectations, while quick commerce growth outpaced estimates. Expectations losses at District also narrowed sequentially, signaling improving execution across its key businesses.
You're with us here on Markets Forward, your go-to show where we aim to get you all the data points to gear up for the next trading day. I'm Hormuz Fatakia. With me is Ekta Batra. Ekta, good afternoon. Well, another day, a disappointing day for the markets this time around. Well, for the last couple of days, we went nowhere, but today was a decisively down day.
Hi, Hormuz. Yes, absolutely. You know, we had the Nifty, which was down close to around 200 odd points. We had the mid caps, which didn't manage to hold up either. So it was down around 1% and there was no sort of respite in terms of the advanced decline ratio. We also had the Bank Nifty, which lost around 700 odd points. So a lot of stocks in focus in today's trading session. So we'll discuss all that and more, and obviously key sectors such as the pharmaceutical space. Let's tell you what we have in store for you today. We'll start with the top movers and shakers of the day with Vivek Iyer. We'll get you the details of Trump's latest tariff threats against generics along with all of the key earnings. Last but not least, we'll delve into the key market events to watch out for in tomorrow's trading session. But on to our first segment of the day. Vivek joins in now from the wall with all of the top movers and shakers of the day. Vivek, over to you.
Well, thank you so much for that. You know, what a volatile trading session we saw, especially volatility increased in the second half of the trading session. But earnings is what kept the market very excited, and stocks reacted quite wildly to some of the results that did come in. First on the list, of course, is Nestle. Very good set of numbers. Strong beat across what the street was anticipating in terms of the top line, higher by over 3.5% today. Data patterns, that particular stock stood out from the broader end of the markets. A large order coming from HAL, which goes ahead and actually doubles the order book that the company has. Stock higher by over 12%, following a 6% up move yesterday. Bajaj Auto, strong commentary coming from the management. Earnings beat as well. Stock higher by almost 6%. M&M Financial, after a while, this particular stock positively, or the company positively surprised as far as asset quality trends were concerned. Street like that particular stock did very well as well. M&M Financial Services and MPS Limited, you know, that particular management spoke to us, you know, at around 130, 145. A very strong commentary coming in. Stock ended the session at the upper circuit. On the other hand, quite a few laggards as well. Can't look beyond the pharma pack. The post coming in from Donald Trump on Truth Social is something that spooked the entire street. Most of the stocks ended lower in the session. Bandhan Bank, a cut as far as the ROA guidance as well as NIM is something that the street didn't like. So Bandhan Bank too, one of the top brags today. In fact, you could call it the accident of the session. Bandhan Bank is the one that we're talking about. Aavas Financials is the other name on the radar. AUM growth was well below what the street was anticipating. MedPlus2 saw significant selling pressure, and India Mart subscribers churn there continues to remain quite elevated. And again, the silver pack of the company is not doing very well. The street didn't like that, down over 5%.
Vivek, thank you for that update. Of course, the sector, the big talking point all through the day was pharma, and that is after US President Donald Trump's latest salvo on generic drug imports, and that ensured that Ekta had a very, very busy day.
Well, yes, absolutely. President Trump is threatening a tariff on generic drugs. The terms are zero tariff for 2 years from August 1st, then 100% for a year, then 200% after that. The goal is reshore generic manufacturing to America and improve national drug supply security. So why should India care? Because India is the generic backbone of America's medicine cabinet. 90% of all US prescriptions by volume are generics, and India supplies roughly 40% of them. That's $10 billion in terms of export business. India also runs over 650 US FDA-approved of plants, the most outside America itself. And the reason it works because manufacturing here costs 30 to 50% less than in the US, with labor costs a large part of the pie being 35 to 50% cheaper. So who's exposed? Several frontline names: Lupin, Aurobindo, Glenmark, each draw around 42% of sales from the US. Zyd is close behind at 40%, Dr. Reddy's 34%, Sun Pharma 29%, Cipla 22%. Many already have capacity in the US, such as Aurobindo and Sun Pharma, which are building up their US presence further through recent acquisitions. Lupin's also invested $250 million in Florida. All this could work in these companies' favor. Now, here's the number that you should possibly, or Washington should probably worry about more than Delhi. Industry voices say generic manufacturing in the US runs 5 to 10 times more expensive, depending on the molecule, raising costs by 25 to 30% for US production to even be commercially viable. Prices would then need to rise 50 to 70%. Take, for example, paracetamol. A box of 100 generic tablets costs $2 to $5 in the US today versus $7 to $15 for branded versions. Shift generic production home, and that same box could then climb to $4 to $7.50. Now, the gap will only widen as the drug complexity increases. What's the impact? Industry watchers are drawing on the branded pharma playbook. Some dilution as deadlines approach. Analysts expect generics to follow a similar script. CapEx announcements as a hedge, not a full manufacturing exodus. There's also a political catch. Trump's term ends and the 2-year runway ends around the US elections. But there's no guarantee that policy reverses if in case the political winds do shift. And in that scenario, smaller and mid-sized companies serving the US could see a far bigger hit. Industry stands right now, wait and watch. No formal order, no fine print, and a clear sense that Indian pharma has to lobby its case before the clock runs out. Bottom line, sentiment negative today, economically possibly improbable at scale, and for the American consumer, this could be a tariff that ends up taxing their own medicine cabinet.
Indeed, and that is something that was not very well received by the street. It'll be interesting to see how a lot of the pharma players in the US react to later in the day. Earlier, we did speak to a lot of managements as well during the course of the day. Granules and Anthem Biosciences, both of them shared their views on these announcements.
Granules is well positioned to tech transfer a lot of products to the US as needed, if needed. And Granules from a US position is also has two facilities right now, and we're also embarking on our journey for the third facility there. But to answer your question straight up, I think it's going to be a huge task if that is actually implemented. But I see that to be a close to being impossible at this point purely because of the cost differential. You're talking at least a 20 to 25% increase in costs, and passing that on to customers will be extremely difficult. 2 years is extremely short, especially for the kind of products that are going there. But the medium and low volume products, there's different sets of products if you talk about generic pharma, right? So the large volume products, which are extremely dependent, which the US is extremely dependent on, will take a long time.
Pharma, the sector of the day. To take the conversation forward, we are now being joined by Mayuresh Joshi from MarketSmith India and Jay Thakkar from ICICI Securities. Gentlemen, good afternoon. Thank you for joining in. Jay, now that we are back at 24,000, how important is 23,800 now on the downside? And if that breaks, what are the levels that you're watching out on the index henceforth?
Hi, very good afternoon to you, Harmaz. And I think, overall, Nifty has been trading within this broader range of 23,800, as you rightly said, that, below 24,000 level, that's the level to watch out for. And I think that that is what Nifty, in fact, respected. The last time it had actually fallen when, this kind of, geopolitical tension initially, again, started post signing the MOU. And but then, markets recovered and it consolidated for, almost 7 to 10 trading sessions approximately, Hamas, within this range of, say, 23,800 to 24,300 on the upside. And that is 4 to 500 points range within which it consolidated. No major breakout, despite that recovery, despite, significant short covering, which we had seen by the FIs in the index futures, right from 2.68 lakh contracts to almost it had fallen to 2.15 lakh contracts approximately. Almost 50,000 contracts got got covered, we saw stock-specific momentum as well building up. Most of the sectors have seen a good amount of short covering, apart from Nifty Metal, because metal stocks haven't bounced back that much. Otherwise, most of the sectors did bounce. But then, despite that, Nifty couldn't take off those 24,600 levels. And Bank Nifty as well, consolidating and reversed and closed below 58,000 post, the heavy Saturday wherein we had most of the banks coming out with their results. So I think that markets are still within that range only. As I would say that it's not 23, if not 23,800, if that gets broken, I think next support is quite nearby post that is at 23,650. That is the gap area. So for me, I think market is within this 1,000 points range now. It's a broader range, big range. I think unless you don't see a breakout from this range, it might just even more consolidate within this range. The VIX has started to bounce back from quite an oversold territory of say 11.5, 12. So it might inch to 14, 14.5. So market may spend some more time, almost at least the July series within this range is what I believe. If at all, it has to break out, probably it might break out from the August series.
Okay, all right. Well, we do have Eternal's Q1 numbers, which point to healthy operating momentum. Food delivery growth came in line with expectations, while quick commerce growth outpaced estimates. Expectations, losses at District also narrowed sequentially, signaling improved execution across its key businesses. Manglam joins in with more.
Well, beyond the headline numbers, good internals is what I would say for Eternal this time around. Let's look at the headline numbers. The revenues, a little over 20,000 crores versus street expectations of a little under 20,000 crores. The EBITDA came in at a little under 600 crores. The street was working with a number of 670 crores. And that's where the mild miss was. And that was a reporting miss. The net profit as a result of which coming in at 92 crores. And the poll was about 335 crores. But here's where the numbers really stand out. And that explains why the stock recovered from the lows as well. The key internals, which are then notified in the company's shareholders letter, food delivery NOV or net order value grew at 20% versus expected 18 to 20% growth. So that's the higher end of the expected range. Quick commerce grew upwards of 86%. The street was expecting a range of 80 to 85%. District, the going out business, saw a growth of 60% year on year, and the company says this is structural and not necessarily seasonal. And out here as well, losses narrowed from 81 crores to 65 crores quarter on quarter. They added 200 Blinkit dark stores as well. Management commentary also fairly robust. They expect the NOV and quick commerce business, which derives most of its value on Zomato, has, they expect that to be robust. They're not seeing any visible impact of high input costs or high fuel prices on demand yet. They expect competitive intensity to remain high, but that's become predictable. So the company's modeled that. And the fourth quarter average retention across all their cohorts has been almost half for Blinkit, which signifies their competitive strength in a highly competitive environment. The two things which are most important for me is the quick commerce operating leverage beginning to show. Yes, the Blinkit EBITDA has increased quarter on quarter, and now the pace of increase is also growing fast. So that's a positive. And secondly, for the last 3 quarters, despite all the investments that they are making and despite all the noise around competition and slowdown, etc., the cash balance, which is the most important thing of the company, has been increasing. So these 3 factors led to the stock recover from the lows today. Good internals, good EBITDA coming in from Blinkit, good commentary, and finally increasing cash.
Indeed, a lot of standouts there in Eternal's results. But since we are on the subject of standouts, the first one that started off the earnings for the day was Nestle. Mangalam, tell us more on that.
Well, it's a stellar set that came in from Nestle. The street was already anticipating a good performance coming in because of the new leader, the underlying, consumption recovery that everyone's been speaking about. And at the same time, they had the favorable base as well. So the street was baking in a 19% revenue growth. Guess what? The company went ahead and reported a 25% revenue growth. Add to that, it's percolated all the way down to the bottom line. The EBITDA of the company grew by 40% and the net profit grew by 48%, much ahead of street expectations. And now we have, the company's commentary as well, where they said that the strong quarter was led by volume growth. So estimates are it was around 20 to 21%, which is industry leading by far. And there has been growth across all their key product groups, and the cost savings programs that the company accelerated, took their margins to 24%, which is higher than the same time last year by about 350 basis points, despite them having increased their ad spends by about 40%. So all these factors led the stock higher. However, the stock was slightly contained at highs, largely because, one, it was at a record high, and going forward, growing on this increased base will become a little difficult, and the valuation headroom is limited as well, as Nestle trades at over 60 times FY28 earnings.
Okay, fair enough. Thanks very much for that, Mangalam. Well, Mayuresh, what are your thoughts in terms of Nestle and what it reported this time?
Afternoon, Ekta. Afternoon, Norma. Afternoon, Jai. So I think very strong set of numbers. And as Mangalam pointed out, I think the only two worry factors, if I have to say worry factors, will be valuations and the base at which this company will report forward numbers. However, I think all the four business segments, whether it's prepared dishes, the confectionery part of the business, the liquid beverages business, has reported strong double-digit volume growth. And therefore, that's reflecting very, very positively in terms of the revenue growth that has come through. EBITDA margins surprisingly have held up above the 24% watermark that we consistently speak about. And the outlook that the management has probably given in that press release in terms of expectations of how commodity prices are expected to move. They are probably expecting some element of stability happening, whether it's cocoa prices, sugar prices a little bit under the pump as we speak. Edible oil prices remain relatively stable, and coffee probably remains well supplied. Obviously, they have an element of pass-through as well. So strong set of numbers. As a disclaimer, we continue holding the stock in our global portfolios.
Indeed, Nestle, they're almost 3% higher in today's session. But the accident or the casualty of the day could be very easily be Bandhan Bank, and that is after its results. The ROA guidance was lowered, the stock ending 17% lower in today's trading session. Speaking to CNBC TV 18, the management also said that the expected benefits from the lower funding costs did not materialize during the quarter, while the wage hike also weighed on its results. The bank also added that the net interest margins are expected to moderate as the loan book shifts towards a more secure mix. Jay, how damaged does the chart now look for Bandhan Bank back below that 200 level? The stock had run up significantly before today's fall. It was up 45% this year. What are the levels you're watching out on the downside? And then we get to Mayuresh on the results as well.
Well, see, you are right, Hurmaz. I would say that bank had rather, I would say, from the recent lows of 145, had seen some long build-up as well. But then, Hurmaz, in the past few days, few trading sessions, since, the stock was consolidating within this range of, say, 215 to 200, we had seen, the stock, in fact, had shown the fall in the open interest, which clearly indicated some profit booking that was happening. And now with the break of 200, I mean, the overall trend definitely has shifted from up to down with almost 16% downside and with a clear gap down now. So this gap area of 200 is likely to act as a very clear resistance, I think, going forward. And, more importantly, was what I would like to point out is that it had actually a very critical support around 185 levels. In fact, it has not only broken down from 200, but it has broken down below the levels of 185 as well. So there are multiple hurdles now for this stock. First is at 185, then after 200. So it will take a lot of time for this stock to revive and then, move higher. Until that doesn't happen, I think any bounce towards these levels, will act as a clear supply going forward.
Mayuresh, very quickly, Bandhan Bank, stay away from a name like this considering the uncertainty?
Oh, absolutely. And therefore, I think we prefer the smaller private sector banks who have reported far better set of numbers.
All right, Mayuresh, Jay, thank you for sparing time and joining us on the show today. Short but interesting conversations. Take a short break. All the top corporate voices on the other side and some key events to watch as well.
Welcome back. Well, some corporate voices of the day. The management of Bajaj Auto told CNBC TV 18 that the company is seeing strong momentum in exports despite ongoing geopolitical tensions in West Asia. Monthly exports run rate is expected to remain above 2.5 lakh units. The electric scooter and sports bike segment are witnessing particularly strong growth.
The MD and CEO of Indian Overseas Bank said that the bank has delivered over 20% credit growth in recent years, even as it guides for a more sustainable 13 to 14% growth going forward. He said that the NIMs have remained stable at around 3.3 to 3.4% over the last few quarters, and the bank expects to maintain that range going into FY27.
And MedPlus Health is expanding beyond its core pharmacy business. Speaking to CNBC TV 18, the management said it plans to add around 800 stores in FY27 and invest 100 crores to set up a health center in Hyderabad. The company also expects its concierge medicine business to turn profitable soon, although it is currently being run as a pilot project.
And before we wrap, we bring you some key market events to watch out for going into tomorrow's trading session. Devyani is standing by with all of that. Devyani.
Let me start with the results first. Infosys, Mphasis, Cyient, Cipla, Coromandel International, Indigo, IEX, Meesho and Motilal Oswal Financial Services, all of them come out with their results tomorrow. Now the Parliament monsoon session day 4 also is set to happen tomorrow. Now on the IPO front, Indo MIM's 3,800 crore IPO opens tomorrow with the price band set at 461 rupees till 485 rupees per share. Lohia Corp's 1102 crore share IPO also opens tomorrow with a price band set at 404 rupees to 425 rupees per share. Extranet Technologies IPO also opens for subscription tomorrow. The 167 crore public issue will be open for bidding till July 27th. Now coming to the global cues, the European Union ECB interest rate decision followed by the President Christine Lagarde's press conference is set to happen tomorrow, and the US initial jobless claims data is also set to come out tomorrow. So these will all be the events that we'll be watching out for tomorrow.
Okay, thanks Devyani for that. With that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. Crude oil prices hit the $95 mark as the US and Iran continue to trade strikes. Trump threatens to target a suspected Iranian nuclear site soon. Tehran says that would amount to an expansion of the war. US Secretary of State Marco Rubio says Iran is not serious about peace talks, even as mediators meet in Islamabad in search of a breakthrough. Sharp cuts on Dalal Street. The Sensex down over 700 points. The Nifty drops below 24,000. The rupee weakens against the dollar and moves closer to the 97 mark. President Trump threatens to impose a 100% tariff on generic pharmaceutical drugs from August of 2028. Provides a 2-year window for companies to move manufacturing to the U.S. Shares of Indian companies decline as they supply nearly half of the generic drugs dispensed in the U.S. Zomato's parent Eternal misses estimates in the first quarter. Profits nearly halved sequentially, but operational performance remains strong, with food deliveries growing at 20% and quick commerce orders surging 86%. Bloomberg reports the government has initiated talks to drop a clause that may clear the runway for airport operators like Adani Group and GMR to own and run airlines. The current rules bar Delhi and Mumbai airport operators from owning more than 10% in an airline. The Aviation Ministry is yet to comment on the Bloomberg report. The student protest continues at Jantar Mantar. 16 Delhi metro stations closed for security reasons. The Supreme Court refuses to hear a petition on the protest and the police crackdown. Chief Justice Surya Kant tells a lawyer, don't waste our time and yours. Parliament adjourned for the third day without any business. The Union Minister Riju says the government is ready to debate the NEET paper leak in the House next week. Opposition leaders protest wearing black shirts, demand a statement from the Prime Minister. The death toll from the Sikkim tunnel blast rises to 20. At least 5 people trapped for the last 48 hours. Preliminary reports suspect a burst of methane trapped within the rocks caused the explosion at the under-construction tunnel. Ukrainian President Zelensky resorts to damage control, replaces the country's army chief after the removal of the defense minister, which led to protests on the streets. The 35-year-old Fedorov had been widely praised for his attempts to modernize the army, which had led to a wedge with the now former army chief, seen by many as a Soviet school commander reluctant to implement radical changes. OpenAI reveals 2 of its AI models went rogue during a cybersecurity test. They hacked into a rival company called Hugging Face, which provides open source AI tools. The incident highlights growing concerns about AI systems causing cyber attacks. By the top story this evening, the US and Iran exchanged fire for the 11th day as tensions refuse to die down. Here are the latest developments. The US military claims to have carried out strikes on Iran's military operations centers and maritime capabilities. US forces also claim that Iran has hit over 30 commercial vessels transiting the Strait of Hormuz. President Trump has also warned of attacks on Iran's underground nuclear facility site at Pickaxe Mountain. In retaliation, Iran launched missiles and drones at U.S. bases in Jordan, Bahrain and Kuwait. According to Jordan's military, 4 Iranian missiles have been intercepted, while 2 other missiles fell in remote areas. Kuwait's army said it continues to confront missile and drone attacks through its air defense systems. In the oil market, Brent crude prices surging, now over $95 a barrel, with ships transiting through the Strait of Hormuz being subdued. According to marine traffic, 45 vessels have passed the waterway in the last 24 hours. Separately, 2 India-bound tankers in the Red Sea also made a U-turn following a warning from Yemeni militant group the Houthis, who have announced a naval blockade of Saudi Arabia. Top U.S. diplomat Marco Rubio is in the Philippines for the ASEAN summit. The U.S. Secretary of State met with his counterparts from the Quad alliance, including India's External Affairs Minister S. Jaishankar. Rubio said Iran does not appear serious about negotiations and reiterated that no country can claim control over any international waterway.
Unfortunately, so far, even though we have reached agreements, they have not kept their commitments. And as the President stated earlier today, I guess, today Washington time, yesterday our time here now, the problem we're having right now is that they're not serious about talks. If they're serious, we're serious. If they're not, then we will do what is necessary to protect our interest and also the interest of our allies.
The U.S. Secretary of State Marco Rubio. The U.S. casualties in the conflict have been steadily rising. Nearly 500 U.S. troops have been injured in the Gulf, according to a report by the Associated Press, citing sources. The Pentagon has announced nearly 100 casualties, including the deaths of at least 18 military personnel. Meanwhile, in what comes as a big boost for Saudi Arabia, President Trump has approved a landmark nuclear agreement. Wall Street Journal reports the deal will provide Saudis with a civil nuclear program and potentially open the door to enrich uranium within Saudi territory. Another key development comes from the UK, where the new Prime Minister, Andy Burnham, has allowed the US to use British military bases to carry some strikes on Iran. This is largely a continuation of the policy adopted under former Prime Minister Keir Starmer. And back in the US, the Secretary of War, Pete Hegseth, was grilled by lawmakers during a testy Senate hearing. Hegseth revealed that the war with Iran has cost more than $37 billion. He argued that the Pentagon is running low on cash and sought $88 billion in supplementary funding, calling it urgent and necessary.
Last week, President Trump said the U.S. would charge a 20% toll to each ship to pass through the state. So based on your opposition to tolls, did you talk to the president out of that idea, or did someone else?
Iran's not charging tolls, and they're shooting at ships right now.
But Trump said that he wanted to charge a 20% toll.
We have a blockade right now of all Iranian ships in Iranian ports, and it's effective.
Do you have a new estimate about what the war has cost us so far in this, the 5th month of the first year of this war in Iran?
Senator, the estimate we have as of today is $37.5 billion.
$37.5 billion spent on the war in Iran so far by the U.S. That is the U.S. Secretary of War, Pete Hegseth. Now, the last street ending the day lower as escalating geopolitical tensions, a surge in crude oil prices and a weaker rupee weighed on sentiment. The Nifty slipped below the 24,000 mark, closing almost 200 points lower, 680 points lower on the Nifty mid-cap. The HDFC Bank stock down by about 1%. Nifty Auto was the only one that closed in positive territory on the back of very strong numbers that came in from companies like Bajaj Auto and TVS. Those stocks were up and about in trade today, even as the markets were lower. Well, FMCG also bucking the trend today. But from equities to the currency market, where the rupee weakened by more than 30 paise against the dollar as rising crude oil prices dented sentiment, the rupee is now moving closer to the 97 mark against the greenback. 96.56 is where the rupee closed for the day. The big story coming in from President Trump. He's threatened to impose 100% tariffs on generic pharmaceutical drugs, but from August of 2028. Now, he's provided a 2-year window for companies to move manufacturing to the U.S. Shares of Indian companies declined as they supply nearly half of the generic drugs that are dispensed in the U.S. Ekta is here with more on Trump's threat and the implications for Indian pharma. Ekta, to be clear, this is a proposal still. It has not been notified. It has not come into effect. We don't have the fine print or the details. But if this were to go through, what will the impact be and how is industry reacting to this threat?
India is the generic backbone of America's medicine cabinet. 90% of all US prescriptions by volume are generics, and India supplies roughly 40% of them. That's a $10 billion export business. India also runs over 650 US FDA-approved plants, the most outside America itself. And the reason it works? Manufacturing here costs 30 to 50% less than in the US, with labor costs a large part of the pie being 35 to 50% cheaper. So who's exposed? Several frontline names, Lupin, Aurobindo and Glenmark, each draw around 42% of their sales from the US. Zydus close behind at around 40%. Dr. Reddy's at around 34%. Sun Pharma at around 29% and Cipla at around 22%. Many already have US capacity, with Aurobindo and Sun Pharma building up US presence further through recent acquisitions, and Lupin with a $250 million Florida investment. All this could work in these companies' favor. Now here's the number that should worry Washington more than Delhi. Industry voices say generic manufacturing in the US runs 5 to 10 times more expensive depending on the molecule, raising costs by 25 to 30%. For US production to even be commercially viable, prices would possibly need to rise 50 to 70%. Take paracetamol. A box of 100 generic tablets costs around $2 to $5 in the US today versus $7 to $15 for the branded version of it. Shift generic production home and that same box could climb to around $4 to $7.50. And that gap only widens as the drug complexity increases. Now the impact. Industry watchers are drawing on the branded pharma playbook. Some dilution as deadlines approached. Analysts expect generics to follow a similar script. CapEx announcements as a hedge, but not a full manufacturing exodus. There's also a political catch. Trump's term ends in Jan 2029, and this two-year runway ends right around the 2028 US election. But there's no guarantee policy reverses if the political winds shift. And in that scenario, smaller and mid-sized generic companies serving the US could see a far bigger hit. Industry stance right now: wait and watch. No formal order, no fine print, and a clear sense that Indian pharma has to lobby its case before the clock runs out.
Well, yes, wait and watch indeed. Ekta, many thanks for joining us. Let's talk about earnings now. And let's start with Nestle reporting strong numbers in the first quarter, ahead of street estimates on all fronts. Net profit up 45%, revenue up more than 25% on an annual basis. All four product groups have recorded strong double-digit growth as well. So strong quarter there coming in for Nestle. Zomato's parent company, that's Eternal, has missed estimates in the first quarter. Profits have nearly halved sequentially. However, operational performance has remained strong, with food delivery growing at 20% and quick commerce orders surging 86%. Manglam joins us now with more. Manglam, why has Eternal seen such a hit on its profitability?
Well, beyond the headline numbers, good internals is what I would say for Eternal this time around. Let's look at the headline numbers. The revenues, a little over 20,000 crores versus street expectations of a little under 20,000 crores. The EBITDA came in a little under 600 crores. The street was working with a number of 670 crores, and that's where the mild miss was, and that was a reporting miss. The net profit as a result of which coming in at 92 crores, and the poll was about 335 crores. But here's where the numbers really stand out, and that explains why the stock recovered from the lows as well. The key internals, which are then notified in the company's shareholders letter, food delivery NOV or net order value grew at 20% versus expected 18 to 20% growth. So that's the higher end of the expected range. Quick commerce grew upwards of 86%. The street was expecting a range of 80 to 85%. District, the going out business, saw a growth of 60% year on year, and the company says this is structural and not necessarily seasonal. And out here as well, losses narrowed from 81 crores to 65 crores quarter on quarter. They added 200 Blinkit dark stores as well. The management commentary also fairly robust. They expect the NOV and quick commerce business, which derives most of its value on Zomato, they expect that to be robust. They're not seeing any visible impact of high input costs or high fuel prices on demand yet. They expect competitive intensity to remain high, but that's become predictable. So the company's modeled that. And the fourth quarter average retention across all their cohorts has been almost half for Blinkit, which signifies their competitive strength in a highly competitive environment. The two things which are most important for me is the quick commerce operating leverage beginning to show. Yes, the Blinkit EBITDA has increased quarter on quarter, and now the pace of increase is also growing fast. So that's a positive. And secondly, for the last 3 quarters, despite all the investments that they are making and despite all the noise around competition and slowdown, etc., the cash balance, which is the most important thing of the company, has been increasing. So these 3 factors led to the stock recover from the lows today. Good internals, good EBITDA coming in from Blinkit, good commentary, and finally increasing cash.
All right, Manglam, many thanks for joining us. Recovering from its intraday low after its numbers. After months of legal and boardroom disputes, Bira 91 founder Ankur Jain has stepped down from the company's board and his executive role as part of a settlement with lenders and investors. The agreement paves the way for the company's restructuring and a fresh capital raise. As part of the settlement, all litigation will be withdrawn, personal guarantees extended by the founder will be released, and the promoter family will exit the board and all executive positions. Both sides have also agreed to withdraw all claims and legal proceedings, bringing the dispute to a close. So, for possibly a fresh start there for Bira 91. We will head to a break, but up next, OpenAI reveals 2 of its AI models went rogue during a cybersecurity test. That and more when we get back. According to a Bloomberg report, the government has begun discussions on scrapping a rule that could pave the way for airport operators such as the Adani Group and GMR to own and operate airlines. Under the current policy, operators of the Delhi and Mumbai airports cannot hold more than a 10% stake in an airline. Madiha joins us now with more. Madiha, let's turn the spotlight on the Adani Group and GMR. Both groups already have presence in the aviation value chain. Now, if the government were to tweak the policy, make this change and allow airport operators to own and operate airlines, how will they stand to benefit?
Absolutely. Both will stand to benefit because they have a significant presence across the aviation value chain. So Bloomberg is reporting that the government is considering a major policy shift that could allow private airport operators to own and operate scheduled airlines. The proposal is currently being discussed within the Civil Aviation Ministry and will require the Law Ministry's approval as well. But if approved, it could pave the way for airport operators like the Adani Group and the GMR Airport Group to launch their own airlines. Now, if the rules do change, Adani would have already had a presence across almost the entire aviation value chain. Besides operating airports, the group has presence in aircraft maintenance, ground handling, flight training, airport retail, airport lounges, and even aircraft assembly through its partnership with Brazilian aircraft manufacturer Embraer. An airline is the only missing piece here. So if the Adani won the rights to operate Adani Group won the rights to operate 6 airports in 2019, including Ahmedabad, Lucknow, Jaipur, Guwahati, Mangaluru and Thiruvananthapuram. That became possible after the government in 2018 removed the requirement for bidders to have prior airport management experience, opening airport privatization to new infrastructure players. The group's biggest expansion came in 2021 when it took control of the Mumbai International Airport from the GVK Group and got Navi Mumbai Airport too as part of that deal. Since then, the group has expanded well beyond the 8 airports. It recently inaugurated a commercial terminal at Mundra Airport, which used to be its private airstrip. So if the government does allow airport operators to own airlines, and should the Adani Group look at the opportunity, it could potentially have a presence across almost every segment of the aviation value chain, from airports and airline operations to maintenance, ground handling, flight training, and even aircraft assembly. And it's not just the Adani Group, but the other private operator, GMR, which operates Delhi, Hyderabad, Goa, and Nagpur, has also expanded beyond airport operations. The group has built businesses in aircraft maintenance, cargo handling, duty-free, retail aviation, training academy, and airport parking. So if the aviation norms are eventually relaxed, both of India's largest private operators are already have a significant aviation ecosystem in place. Now, we should also note that India does have a shortage of airlines, with Indigo controlling 66% market share and the Air India Group at 24%, Akasa Air at 6% and SpiceJet just at 2%. So while it would bring competition in the aviation sector, there are also concerns of airport operators possibly allocating prime slots to their own carriers. Nevertheless, if the proposal eventually becomes a policy, it could fundamentally reshape India's aviation landscape. cnbc TV 18 has reached out to the Aviation Ministry and is awaiting a response from the government.
Well, yes, it is a Bloomberg report where we are awaiting a comment from the government. Madiha, many thanks for joining us. In fact, I spoke with Jeet Adani in December last year ahead of the Navi Mumbai airport launch on the possibility of the group foraying into the airline business if the government were to change the policy. Here's what he had to say.
What part of this business are you currently not into that you want to get into? I mean, you know, the big question is a foray into airlines the next big plan on the Adani Group's calendar?
No, absolutely not.
No?
We were legally not allowed
I know,
to.
but I know you're legally at this point in time not allowed.
Yeah.
But the government's been talking about, you know, competition. The government's been talking about the need for a large airlines, especially in the light of what we've seen happen with Indigo.
Absolutely.
If tomorrow the opportunity were to arise, would you consider it?
I would say there's nothing that we won't consider. But as it stands today, structurally, the airline industry is not something that we see, fitting our sort of capital discipline. We're used to high margin businesses, investing in asset, and sweating that asset well. The airline is completely opposite in every.
So from a unit economics point of view, it doesn't make any sense for you.
For us, no.
For you at this point in time, or even in the future.
Yeah.
if the opportunity were to arise.
Absolutely, yes. Yes.
So that's not something that you would
No,
consider.
not at all.
Well, not looking at it at this point in time. That was Jeet Adani. To me, of course, the big question is whether the government will tweak that policy or not. Thousands of students continue to protest at Jantar Mantar in New Delhi, demanding education reforms and the resignation of the Education Minister Dharmendra Pradhan over the NEET paper leak. Now, 16 metro stations in the national capital have been closed until further orders, citing security reasons. This as per the Delhi Metro Rail Corporation. Interchange facilities continue to remain available at Rajiv Chowk, Mandi House and Central Secretariat. Meanwhile, the Supreme Court has refused to hear a petition on the protests and the police crackdown. Chief Justice Suryakant told a lawyer who had moved that plea, and he said, I quote, "Don't waste our time and your time. We don't want to watch any videos." This was because the lawyer had said that there was evidence on video of police brutality. Now, the Supreme Court Bar Association has condemned the police action on protesting students. The association expressed solidarity with the injured students and sought an impartial inquiry into what it described as excessive use of force. The issue also rocked Parliament for the third day in a row. Opposition MPs came dressed in black, staging a protest outside the House, calling for Minister Pradhan and Home Minister Amit Shah's resignations over the police action. Union Ministers Kiran Rijiju and JP Nadda said the government is ready for a debate in Parliament on the NEET paper leak next week. However, the Rajya Sabha leader of the opposition, Mallikarjun Kharge, insisted that Pradhan must resign first. He demanded a discussion under Rule 267, which allows the House to suspend its scheduled business. Both houses were later adjourned without any business for the third day. Education Minister Dharmendra Pradhan said the government remains 100% committed to addressing every genuine concern of the country's youth. This was his first public response on the issue since protesters marched to Parliament on Monday, and they were met by that police crackdown.
चर्चा का ड्यूरेशन कितना लंबा चर्चा होना है और किस नियम के तहत होना है, माननीय स्पीकर महोदय, सारे पार्टी के फ्लोर लीडर से बातचीत करके इसका निर्णय किया जाए। सरकार पूरी तरह से नीट पेपर लीक पे चर्चा करने के तैयार है और इस देश के युवाओं को भविष्य के लिए हम सब मिलकर के एक सार्थक चर्चा हो, ये सरकार चाहती है।
आप लंबे समय के लिए ठीक ढंग से जर्मन मोशन पे ये इशू भी डिस्कस कर सकते हैं। गवर्नमेंट हमेशा खेल खेलती है, राजनीतिक खेल खेलती है।
Well, action in Parliament. Now, ChatGPT maker OpenAI has revealed an autonomous AI agent powered by its technology hacked prominent startups. The company's called the incident unprecedented. Rachna joins us now with more. Rachna, OpenAI saying that its AI model went rogue. Now, what exactly transpired here?
That's right. OpenAI has confirmed that its own models caused last week's Hugging Face security breach, calling it an unprecedented cyber incident. Now, the company says the breach happened during an internal evaluation designed to measure advanced cyber capabilities with models including GPT 5.6 Soul and a more capable pre-release model running with reduced cyber refusals for testing purposes. Now, as per OpenAI's preliminary findings, the models exploited a zero-day flaw in a package registry proxy to escape their isolated sandbox, then worked through privilege escalation and lateral movement until they reached a node with internet access. From there, the models used stolen credentials and additional 0 days to break into Hugging Face's production service, hunting for test solutions to cheat the cyber benchmark they were being evaluated on. What makes this different from a conventional breach is that no human attacker directed it or was involved in it. The models were chasing a narrow testing goal and built the attack path themselves without access to the source code of the systems they broke into. OpenAI says this confirms in the real world what UK AI Security Institute evaluations had shown in theory, that frontier models can now sustain complex multi-step cyber operations over long time horizons. The safeguards that would normally block this were switched off by design because this was the test built to measure maximum capability. That is the uncomfortable part for the entire industry because it means the ceiling is higher than what users see in production, and containment now has to keep pace with capability. Hugging Face's security team detected and contained the activity, and OpenAI flagged the anomaly internally. The 0 day has been responsibly disclosed by both the companies, and now both the companies are jointly investigating, and Hugging Face has been brought into OpenAI's trusted access program
for cyber defense. Hugging Face CEO Clem Delling called it possibly the first incident of its kind, saying AI safety will be solved in the open and not by any single company working in secret. It lands the same day Google restricted its new cyber model to governments and trusted partners, the same gatekeeping that Anthropic used for Mythos. So clearly very interesting time when it comes to cybersecurity and frontier models. We'll have to see where it goes.
Absolutely an important issue. Rachna, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news continues right here on CNBC TV 18. Stay tuned. We're back in a moment.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now it's the end of July and you know what that means. Yes, I'm very sure many of you are thinking taxes. It is that time of the year when we have to file our income tax returns with the tax authorities. So just a couple of days to go. And for a lot of people, usually this is something that we push towards the, just towards the end of that deadline. So we are here this week with a very quick step-by-step guide to ensure that you are checking all the boxes, making sure that nothing gets omitted, all the disclosures are in place, and most importantly, that you're picking the right forms and doing everything that you need to do to ensure that that tax return is filed carefully, correctly, so that you have peace of mind. And helping us do all of this is Mr. Suresh Surana, who's the founder of RSM India. Dr. Surana, thank you very much for joining us. It's a pleasure to have you back on Let's Talk Money.
Yeah, it's a pleasure as well for me.
So, so much has changed. So I want to start by making things very, very simple, because we've also seen a brand new, Income Tax Act of 2025 get introduced, which is effective this year. But first, let's just go over and, clarify that we are talking about filing tax returns for FY26. So which act, first of all, is governing our taxes?
No, I think it's a very valid question, and there's a lot of confusion because a new act has come into play. But for the financial year ending 31st March 2026, the returns have to be filed under the old Income Tax Act of 1961. So all the provisions, sections, everything is applicable as per the previous act. This will be the last return under the old act, which served us for almost 60 plus years.
Yeah, I know. So it's going to be like a fading away, and then next year onwards, it's going to be only about the income tax of 2025.
Yes.
But before we get started and talk about the nuts and bolts of it, there have been a fair amount of income tax changes as well over the last two budgets. The move towards the new tax regime, which is now the default tax regime, changing the tax slabs, changing the rebate structure. So, some opening thoughts and observations maybe.
So I think first of all, the number of tax filers has increased dramatically in the last 10 years. So last year, for example, financial year 24-25, 9.19 crore tax returns were filed, which is the highest ever in India's history of tax compliance. However, for financial year 26, the number might drop a bit. And you may be surprised. Why is that? I think there are two main reasons. One is that the basic exemption limit under the new tax regime has been increased from rupees 3 lakhs to 4 lakhs. And secondly, the standard deduction under the new tax regime has been increased from 50,000 to 75,000. And there are a very large number of tax filers who are in that category, although the tax collection may not be significant. So therefore, due to that, this year we might see a same number or maybe a marginal dip even in the number of filers. The second point, as you very rightly said, that the new regime has not only become the default regime, like last year, for example, 88% of the people opted for the new tax regime. I will not be surprised if the number grows even much beyond that, maybe 95, 97%. Because really speaking, if you look at now the liberalized slabs, which you up to rupees 24 lakhs, and the tax rebate, which is now 60,000 rupees, which means up to 12 lakh rupees of taxable income, you don't have to pay any tax. And if you add standard deduction to that, up to 12.75 lakhs rupees for salaried people,
there's no tax.
There is no tax. But while there is no tax, they still need to file the return.
Yeah.
So many people think that no tax liability, so no return. But that is not the case. You need to file the return. Secondly, for people up to 24 lakhs rupees of income also, the slabs now are much more liberal under the new regime. And finally, at the top end also, people who are more than, who are having income of more than 2 crores. Now the tax rate is 39%, which are earlier in the old tax regime, still it is 42.74%.
That's because the surcharge rates in the new regime are a lot more favorable than the old regime.
Yeah, right? So the last slab of surcharge, which is 25% as against 37%.
Yeah.
So really you have taken the bottom given benefit much more under the new regime. And similarly, you have at the top end also people benefited. So there might be few, very, very few cases which might be, still eligible.
I'm one of them. And I need to still file my tax returns. I'm going to pay a lot of attention to everything that you're going to say. But, before we, go on, I want to place on record here the point that you just made, that even if you don't have a tax liability because of the exemptions and the thresholds, you still have to pay, you have to still file your ITR.
Absolutely.
So just tell us, the rule around this, who all has to file ITR and who all are the people who can be exempt from filing a tax return, if at all?
So if your income, which is like if you are under the new regime, and if you are having taxable income before Chapter 6A deductions. So there are deductions under Chapter 6A like which might be still eligible.
So that's the old regime.
Yeah, so generally most of them are not eligible, but if in case something is eligible, then you if you are up to 4 lakh rupees and basic exemption limit, then you don't need to file the return. Unless you are covered by, there are some other categories also that even though, for example, you don't have income which is taxable. For example, if you are a director of a company or if you have shareholding in an unlisted company, whether you have any income or no income also, you still need to file the return.
File tax return.
So that is a separate category. But other than that, If you are above the basic exemption limit, then only you need to file the return.
Sure. Okay. So make sure you go ahead and check this with your CA.
Yeah. And I think the most important category is the people who are eligible for rebate.
Yeah.
Because when you talk of 4 lakhs to 12 lakh rupees or 12.75 in case of salaried employees, that's a very vast number of people.
Correct.
They all need to file the return.
So up to 4 lakh, you don't need to file.
Yeah.
But if you are enjoying the benefit of zero tax because of the rebate, you still need to file. So that's a thumb rule. Make sure you check this with your CA in the next couple of days for sure if you haven't filed your ITR. Okay, now let's talk about what's new this year.
Yeah.
If there's anything new, because in between there was a lot of talk about additional disclosures, more granular declaration of your trades, you know, what you're doing in the market, your investments. So fill us in.
So one, of course, major change which is there is about the particularly which is in terms of trading on the, in terms of F&O. So F&O you need to report now separately. What is your F&O trading volume as well as the income or loss on that.
Is that above a certain threshold?
No.
I mean, if I'm a small trader, I do a few trades in a month here and there. Even then, I have to report?
Even then. So there is no threshold there. Similarly, if you are doing intraday trading, there is a separate disclosure on that.
Okay.
Yeah, because these are all subject to tax under as a business income, and therefore you might get more tax because then the due date of filing the return also may be later.
Okay.
So instead of 31st July, it could be 31st August.
If you are
have business income.
If you're doing intraday trading or if you're an F&O trader, that income could be business income.
Could be business income, in which case the filing date may not be 31st July, maybe 31st August if you are not subject to audit. And if you are subject to audit, it may be 31st October as well.
Okay, okay.
So that
so that's very, very important, extremely important. If you could tell us a little more about these disclosures, what kind of trades have to be disclosed, and is it very complex now with this new compliance?
No, it's not complex because it will all be reflected. If you go to your stockbroker, it will be all reflected in your account. But you need to report that. So that is one important point. The second thing is ITR 1, which was earlier only applicable if you had one house property. But if you had two house properties, ITR 1 was not eligible. Now, even if you have two house properties, which in any case, as you know also, that for two house properties, self-occupied property, there is no notional income, it is exempt.
Yeah.
So you can still file form ITR, even if you have two house properties now, which was still last year was only one house property.
Right.
The other thing which is there
whether or not they are let out, deemed to be let out, whether you're actually generating income from that house property or not, you can still go ahead and use ITR.
So up to two house properties, if they are not let out, now there is no deemed income.
Okay.
Which earlier, so that is one obviously thing is that, and many people have houses maybe at their native place and one maybe in Mumbai or New Delhi, wherever they are living. So two houses, no notional taxation is there.
Okay.
And then in case you have let out, still up to two house properties, you can file the form.
So you can use the simplified forms. If you're under 50 lakhs of total taxable income, you can still opt for either ITR 1, which is Saral, or I think ITR 4, which is
So ITR 1 is Sahaj. Sahaj is,
yeah.
So Sahaj means simple.
Yeah.
But actually the criteria for filing are not that Sahaj, I would say. Because there are number of qualifications. For example...
So okay, wait. So let's go step by step. We'll come to the forms in a second. But right now we're still talking anything that's new with respect to this tax filing season. So one is the F&O,
then you have intraday trading, then you have two house properties, you can still file form.
Anything else?
You have ATG donation if you are making. You have to give the transaction reference number and the bank IFSC code. Because a lot of abuse was there, so they want to track that if you have given the donation to charity, it has gone properly and that charity is identifiable. So that is another change which has come. You have to also give now secondary address as a mandatory requirement. Although you can fill the same as the primary address, but you have to fill up that.
What does this mean? You have to give a secondary address.
Secondary address in case you want to make sure that any communication or anything else is at least the department has a second address as well for communication.
If you don't have a secondary address, then
you can still fill up the primary address as well. So, but it is a mandatory field. You cannot skip it.
Okay. All right.
So if you just have one address in secondary, you can fill up again the primary address.
Okay. You know, one more thing I remember a couple of months back when the forms came out, and over the last few months, we've had a lot of talk around how the whole filing process will be more simple. Forms will be pre-populated.
Yeah.
Is that happening?
That is happening. So, and I think also because a lot of information is already there, even for your, like in case of financial year 25-26, you can revalidate a lot of things which we can talk a little later. For example, your tax credits, your income, what is appearing on the tax portal and in terms of auto population, so that you avoid the possibility of you getting picked up for scrutiny Because
Okay.
if there is a mismatch, then which we can also
We'll
discuss.
talk about. Okay. So now we've understood, broadly what's new in this tax filing season. Let's come to the forms. Forms remain more or less the same?
More or less the same, except for this additional disclosure, what we talked about. So there are primarily, if you are not in business income, there are 4 forms applicable, ITR 1, 2, 3 and 4.
Okay.
ITR 1 and 2 is for those people who are not having business income. And 3 and 4 is for those who are having business or professional income. So that is the first part. Then now, if you are not having any business income, and in ITR 1, if you are able to fulfill all the conditions, like what you described about that having taxable income, which is below rupees 50 lakhs. Also, it is only applicable to residents. Non-resident, resident but not ordinary resident, as well as HUFs are not eligible to file Form ITR 1.
Okay. Okay.
So that is an important
only
point.
resident, largely salaried people with a taxable income of less than 50 lakh rupees.
Not necessarily salaried people. You can have other income as well.
Okay, but not business income.
But not business income.
Yeah.
So you and even capital gains up to 1,25,000 rupees, you can still file. But if it is more than that, you will not be eligible for ITR 1.
Okay.
Similarly, if you have any in case of, if you are having a sale of house property and you are reinvesting, it may be exempt. But then still you may not be eligible for ITR 1 because capital gains, except for that 1,25,000 rupees,
right,
you are not eligible for ITR 1.
Then you have to look at a different
And
form.
then we also earlier spoke about, if you are having shareholding in unlisted company, if you are a director, if you are having foreign assets, foreign bank account, foreign securities like ESOP. Many, for example, employees get ESOP of their multinational parent company. So that is a foreign asset.
Okay. So your income might be lower than 50 lakhs, but if you have ESOPs from your company and your company is a foreign national, not ITR 1, you have to fill one of the more complex.
So there are a
forms.
lot of such, conditions which we cannot go through.
I know, but it's good to know broadly.
So please check, make sure that you are eligible for all the conditions for filing ITR 1.
Correct.
And there is a long list there.
Like you said, it's called Sahaj, but maybe not so Sahaj. Make sure you check the fine print.
At least the eligibility is not very simple.
Got that. Okay, so that's ITR 1. Now, let's move to ITR 2.
So ITR 2 is for all those people who are not having business income and who are not eligible for ITR 1.
Okay.
Very simple.
Okay.
So it's like the second part.
The second category.
If
you can't fulfill any of these conditions, you have some, foreign equity ownership or your income
bank
is above
account outside.
Bank account outside.
So
income is above 50 lakh rupees.
Income is above 50 lakhs.
So you move to ITR.
Or if you are HUF, you are a non-resident, all those things. There are a number of things.
Correct.
And you don't have business income, then you fill up for ITR 2.
ITR 3, I remember, that's a very comprehensive, very complex form for those who have business income, right?
Yeah.
And ITR 4.
So just like
people who have
ITR 1,
business income.
exactly. So just like ITR 1, ITR 4 is supposed to be, which is called ITR Sugam. For those people who are having business income, but smaller businesses, which are taxed on presumptive basis.
Right.
So for example, up to 2 crores of income, you have an 8% presumptive, income.
Right.
So those cases, similarly in professional cases also up to certain level, 50% is deemed to be income.
Okay.
So those cases, as long as again their taxable income is below rupees 50 lakhs, and similar to ITR 1, they are not covered by any of those restrictions.
Right.
Then they can fill up ITR 4.
Right. Rather than going for the more complex.
So there
ITR
one
thing.
change which has come. We must talk about that. That if you are having more than, if you are having assets of more than 1 crore, which earlier used to be 50 lakhs.
Okay.
Then you need to disclose all your assets and liabilities.
In ITR 4?
ITR 3 and 4.
3 and 4, okay.
Yeah.
So if you have business income, and earlier the threshold was you have to disclose everything above 50 lakhs, but now that threshold is 1 crore, where you have to disclose all assets.
All your assets and liabilities.
And all liabilities. In this, it's called Schedule AL.
Yeah.
Okay.
Yeah. Asset and liability. So AL.
Okay.
Yeah, Schedule AL.
So that's where the disclosures have to be made.
So therefore, even if, for example, you have jewelry,
yeah,
which may not earn any income, but you have to disclose there.
Sure.
Any shares which may not have dividend income also you need to disclose. If you are having taxable income of more than 1 crore rupees.
But the threshold this time, earlier above 50 lakhs, everything had to be disclosed.
Yeah.
This year, up to a 1 crore limit, you don't have to worry about missing any disclosure. So that's to some extent that's a relief.
Yes, that's correct.
Okay, we'll take a quick break. We've just gotten started because when we come back, we will simplify all of this down into a quick checklist. The mistakes to avoid and the things to keep in mind when you're filing your income tax return. Back in a moment.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week it's all about making sure that you file your income tax return on time and, of course, accurately, so that we can have a peaceful sleep for the rest of the year. We're in conversation with Mr. Surana. Now, speaking of the deadlines, the deadline for at least the salaried class, it remains 31st July, right?
Yeah, 31st July, unless, as we talked about, you have, underrated business income because of your share trading or because of, then you may have 31st August. Otherwise, yes, it is 31st July, which is for a very vast number of taxpayers. When we talked about 9 crore plus taxpayers, almost, I would say, 85 to 90% of them would be covered by this deadline. So it is having a very vast application for people.
Sure. So, Dr. Surana, tell us about some of the very basic mistakes that people end up making, omission or just forgetting. What are those mistakes that we need to watch out for?
Absolutely. I think the first one, as we already discussed, was that to select the correct ITR form. And there are a lot of conditions for having ITR 1 and ITR 4. So make sure that you don't file the wrong form. Otherwise, it is treated as a defective return or as an invalid return, which can have its own implications. The second is that make sure that your information, what you are submitting, your return is consistent with what is already there with the department and what is, like for example, Form 16, which you get from employer. Will have details of all your salary income, exempt allowances, your whatever tax deductions and tax paid by the employer. It must reconcile. Similarly, there is a Form 26AS, which will reflect all the tax credit which you are eligible for. So including TDS, tax collection at source, advance tax, self-assessment tax, refunds, and any tax demands. Then you will have AIS.
The annual
information statement. Which will, so suppose you have done any property transaction, you have done any high value share transaction, you have all your debit card, credit card payments, so those things.
And all of this information is automatically captured,
it is available.
Because it's all
of course, you have to log in. When you go to the e-filing and then you go to the tax returns and then there is a view AIS or view 26AS. You go there, you can see it. And if you, for example, in AIS, if you do not agree with something, for example, somebody has given your PAN number and that transaction is appearing in your name, then you will get a notice from department that you have not reported this. So you have an option, there are drop-down boxes. You can ask them to correct it, that this is not my PAN or this is an exempt income or this is basically already offered for tax in earlier year or will be taxable next year because I have received advance. So you can please make sure that you get it as close to what your return filing. So you will avoid any notice and demand. Otherwise.
So that's a very important point. If I notice some discrepancy in Form 26AS or this annual AIS, the annual information statement, and I don't agree with it,
you have option there itself available of drop-down boxes and you can give your response there, ask them to correct it.
No, correction is one thing, but because of these discrepancies, if let's say my tax liability for the year appears to be higher, that there's any unpaid tax, do I have to pay it?
No, you can still file as per what you think is the correct working. But then there is a very high probability that you will get a notice from department. Then you will have to explain at that point in time. But why to go through that? If you can correct it right now, please do that.
All right. So
that is the second part. The third important part is that many times people don't report exempt income. So for example, if you are having agricultural income, if you are having any gift from relatives, and many times people in modern context misunderstand relative to be if you are having a spousal equivalent or you are having a live-in relationship. In India, still tax laws do not recognize such a relationship. So if you receive such a a kind of gift, it is taxable in your hands.
And is there a threshold that defines?
So there is a threshold of 50,000 rupees. If it is beyond that, which I think most of the spousal equivalent will not accept a gift below 50,000 rupees. So most cases it may become taxable.
So this is controversial for other reasons beyond tax, what you're saying. Gifts, Okay, basically to simplify this, if you've received an iPhone as a gift from your live-in partner, it needs to be disclosed in your income tax return,
and not only disclosed, it will be taxable also.
It will be taxable also.
So any shares, securities, anything, any property, anything else. Then the other point which is there is that there are sometimes non-monetary transactions which are neither there in the bank statement, like for example redevelopment of property, or there is an inheritance, or there is a gift received, so it is not appearing anywhere in your bank statement, and not appearing on Form 26AS also because they don't have information on that. You still need to make sure you report all that. Because like redevelopment, there is a deemed taxability because you are giving up one house, getting another in exchange. So it is not like it is exempt altogether.
So if your house is going in for redevelopment, please report. I'm just trying to recap everything that we might miss reporting, and that leads to complications later.
And then tax demands and all those things.
So let's recap that, what we may end up not reporting, and it could cause trouble.
So like in case of non-monetary transaction, like for example, redevelopment of property, any gift which is received from either relative which may be exempt, but you need to disclose, or gift which is from non-relative above threshold, it will be taxable.
Correct.
So those things you need to consider. And then similarly, you might have in any case of inheritance, somebody, might have, whether it's shares or property or something else, you need to report that.
Even though it's not taxable, but you still need to report it.
Yeah. Okay. So you need to report, and that may not appear in your bank statement, may not appear on tax portal, but you still need to report that. Then similarly, foreign income, foreign asset, because the consequences are very severe, because under Black Money Act it gets impacted.
Right.
And then the last point, which is also very important, is to make sure that you give your correct bank account number, which is valid, so refund comes to the correct account.
Sure.
And also you do the e-verification. Within 30 days, you need to do e-verification, either using your digital signature or using OTP with Aadhaar card. So there are 3 or 4 methods by which you can do it. Please make sure it is properly verified.
Only then will it be as a valid
return.
return.
It as a valid return. Yeah.
Okay, lots to think through and lots to keep in mind, but this was very, very helpful, Dr. Surana. I think it gives us a good framework and a way to think about it. Make sure you sit down and have this discussion with your CA. Make sure all those boxes have been checked.
Yes,
as they
absolutely.
say, dot the I's and cross the T's.
And I think it's much easier to avoid than getting a tax notice or getting a tax demand, because then you will be probably spending a lot more time trying to resolve it.
Okay. All right. This was, exhaustive, and very helpful checklist. So thank you. For joining us. I think I should run now and have a conversation with my CA. With that, it's a wrap on this week's edition of Let's Talk Money. Hope you found this conversation useful. Keep sending us your feedback. Tell us what you think. Follow us on social media. And of course, we'll see you next week with another theme that impacts your money.
Let's Talk Money.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The big stories that we're tracking for you this evening. Crude oil prices hit the $95 mark as the US and Iran continue to trade strikes. Trump threatens to target a suspected Iranian nuclear site soon. Tehran says that would amount to an expansion of the war. US Secretary of State Marco Rubio says Iran is not serious about peace talks, even as mediators meet in Islamabad in search of a breakthrough. Sharp cuts on Dalal Street. The Sensex down over 700 points. Nifty drops below 24,000. The rupee weakens against the dollar and moves closer to the 97 mark. President Trump threatens to impose a 100% tariff on generic pharmaceutical drugs from August of 2028. Provides a 2-year window for companies to move manufacturing to the U.S. Shares of Indian companies decline as they supply nearly half of the generic drugs dispensed in the U.S. Zomato's parent Eternal misses estimates in the first quarter. Profits nearly halved sequentially, but operational performance remains strong, with food deliveries growing at 20% and quick commerce orders surging 86%. Bloomberg reports the government has initiated talks to drop a clause that may clear the runway for airport operators like Adani Group and GMR to own and run airlines. The current rules bar Delhi and Mumbai airport operators from owning more than 10% in an airline. The Aviation Ministry is yet to comment on the Bloomberg report. The student protest continues at Jantar Mantar. 16 Delhi metro stations closed for security reasons. The Supreme Court refuses to hear a petition on the protest and the police crackdown. Chief Justice Surya Kant tells a lawyer, "Don't waste our time and yours." Parliament adjourned for the third day without any business. The Union Minister Riju says the government is ready to debate the NEET paper leak in the House next week. Opposition leaders protest wearing black shirts, demand a statement from the Prime Minister. The death toll from the Sikkim tunnel blast rises to 20. At least 5 people trapped for the last 48 hours. Preliminary reports suspect a burst of methane trapped within the rocks caused the explosion at the under-construction tunnel. Ukrainian President Zelensky resorts to damage control, replaces the country's army chief after the removal of the defense minister, which led to protests on the streets. The 35-year-old Fedorov had been widely praised for his attempts to modernize the army, which had led to a wedge with the now former army chief, seen by many as a Soviet school commander reluctant to implement radical changes. OpenAI reveals 2 of its AI models went rogue during a cybersecurity test. They hacked into a rival company called Hugging Face, which provides open-source AI tools. The incident highlights growing concerns about AI systems causing cyber attacks. Well, the top story this evening, the US and Iran exchanged fire for the 11th day as tensions refuse to die down. Here are the latest developments. The US military claims to have carried out strikes on Iran's military operations centers and maritime capabilities. US forces also claim that Iran has hit over 30 commercial vessels transiting the Strait of Hormuz. President Trump has also warned of attacks on Iran's underground nuclear facility site at Pickaxe Mountain. In retaliation, Iran launched missiles and drones at US bases in Jordan, Bahrain and Kuwait. According to Jordan's military, 4 Iranian missiles have been intercepted while 2 other missiles fell in remote areas. Kuwait's army said it continues to confront missile and drone attacks through its air defense systems. In the oil market, Brent crude prices surging, now over $95 a barrel, with ships transiting through the Strait of Hormuz being subdued. According to marine traffic, 45 vessels have passed the waterway in the last 24 hours. Separately, 2 India-bound tankers in the Red Sea also made a U-turn following a warning from Yemeni militant group the Houthis, who have announced a naval blockade of Saudi Arabia. Top U.S. diplomat Marco Rubio is in the Philippines for the ASEAN summit. The U.S. Secretary of State met with his counterparts from the Quad alliance, including India's External Affairs Minister S. Jaishankar. Rubio said Iran does not appear serious about negotiations and reiterated that no country can claim control over any international waterway.
Unfortunately, so far, even though we have reached agreements, they have not kept their commitments. And as the President stated earlier today, I guess, today Washington time, yesterday our time here now, the problem we're having right now is that they're not serious about talks. If they're serious, we're serious. If they're not, then we will do what is necessary to protect that, our interest and also the interest of our allies.
The U.S. Secretary of State Marco Rubio, the U.S. casualties in the conflict have been steadily rising. Nearly 500 U.S. troops have been injured in the Gulf, according to a report by the Associated Press, citing sources. The Pentagon has announced nearly 100 casualties, including the deaths of at least 18 military personnel. Meanwhile, in what comes as a big boost for Saudi Arabia, President Trump has approved a landmark nuclear agreement. Wall Street Journal reports the deal will provide Saudis with a civil nuclear program and potentially open the door to enrich uranium within Saudi territory. Another key development comes from the UK, where the new Prime Minister, Andy Burnham, has allowed the US to use British military bases to carry some strikes on Iran. This is largely a continuation of the policy adopted under former Prime Minister Keir Starmer. And back in the US, the Secretary of War, Pete Hegseth, was grilled by lawmakers during a testy Senate hearing. Hegseth revealed that the war with Iran has cost more than $37 billion. He argued that the Pentagon is running low on cash and sought $88 billion in supplementary funding, calling it urgent and necessary.
Last week, President Trump said the U.S. would charge a 20% toll to each ship to pass through the state. So based on your opposition to tolls, did you talk to the president out of that idea, or did someone else?
Iran's not charging tolls, and they're shooting at ships right now.
But Trump said that he wanted to charge a 20% toll.
We have a blockade right now of all Iranian ships and Iranian ports, and it's effective.
Do you have a new estimate about what the war has cost us so far in this, the 5th month of the first year of this war in Iran?
Senator, the estimate we have as of today is $37.5 billion.
$37.5 billion spent on the war in Iran so far by the U.S. That is the U.S. Secretary of War, Pete Hegseth. Now, the Dallas Street ending the day lower as escalating geopolitical tensions, a surge in crude oil prices and a weaker rupee weighed on sentiment. The Nifty slipped below the 24,000 mark, closing almost 200 points lower, 680 points lower on the Nifty mid-cap. The HDFC Bank stock down by about 1%. Nifty Auto was the only one that closed in positive territory on the back of very strong numbers that came in from companies like Bajaj Auto and TVS. Those stocks were up and about in trade today, even as the markets were lower. Well, FMCG also bucking the trend today. But from equities to the currency market, where the rupee weakened by more than 30 paise against the dollar as rising crude oil prices dented sentiment, the rupee is now moving closer to the 97 mark against the greenback. 96.56 is where the rupee closed for the day. The big story coming in from President Trump. He's threatened to impose 100% tariffs on generic pharmaceutical drugs, but from August of 2028. Now, he's provided a 2-year window for companies to move manufacturing to the U.S. Shares of Indian companies declined as they supply nearly half of the generic drugs that are dispensed in the U.S. Ekta is here with more on Trump's threat and the implications for Indian pharma. Ekta, to be clear, this is a proposal still. It has not been notified. It has not come into effect. We don't have the fine print or the details. But if this were to go through, what will the impact be and how is industry reacting to this threat?
India is the generic backbone of America's medicine cabinet. 90% of all US prescriptions by volume are generics, and India supplies roughly 40% of them. That's a $10 billion export business. India also runs over 650 US FDA-approved plants, the most outside America itself. And the reason it works? Manufacturing here costs 30 to 50% less than in the US, with labor costs a large part of the pie being 35 to 50% cheaper. So who's exposed? Several frontline names. Lupin, Aurobindo and Glenmark each draw around 42% of their sales from the US. Zydus close behind at around 40%. Dr. Reddy's at around 34%. Sun Pharma at around 29% and Cipla at around 22%. Many already have US capacity, with Aurobindo and Sun Pharma building up US presence further through recent acquisitions, and Lupin with a $250 million Florida investment. All this could work in these companies' favor. Now here's the number that should worry Washington more than Delhi. Industry voices say generic manufacturing in the US runs 5 to 10 times more expensive depending on the molecule, raising costs by 25 to 30%. For US production to even be commercially viable, prices would possibly need to rise 50 to 70%. Take paracetamol. A box of 100 generic tablets costs around $2 to $5 in the US today versus $7 to $15 for the branded version of it. Shift generic production home and that same box could climb to around $4 to $7.50. And that gap only widens as the drug complexity increases. Now the impact. Industry watchers are drawing on the branded pharma playbook. Some dilution as deadlines approached. Analysts expect generics to follow a similar script. CapEx announcements as a hedge, but not a full manufacturing exodus. There's also a political catch. Trump's term ends in Jan 2029, and this 2-year runway ends right around the 2028 US election. But there's no guarantee policy reverses if the political winds shift. And in that scenario, smaller and mid-sized generic companies serving the US could see a far bigger hit. Industry stance right now: wait and watch. No formal order, no fine print, and a clear sense that Indian pharma has to lobby its case before the clock runs out.
Well, yes, wait and watch indeed. Ekta, many thanks for joining us. Let's talk about earnings now, and let's start with Nestle reporting strong numbers in the first quarter, ahead of street estimates on all fronts. Net profit up 45%, revenue up more than 25% on an annual basis. All 4 product groups have recorded strong double-digit growth as well, so strong quarter there coming in for Nestle. Zomato's parent company, that's Eternal, has missed estimates in the first quarter. Profits have nearly halved sequentially. However, operational performance has remained strong, with food delivery growing at 20% and quick commerce orders surging 86%. Manglam joins us now with more. Manglam, why has Eternal seen such a hit on its profitability?
Well, beyond the headline numbers, good internals is what I would say for Eternal this time around. Let's look at the headline numbers. The revenues a little over 20,000 crores versus street expectations of a little under 20,000 crores. The EBITDA came in at a little under 600 crores. The street was working with a number of 670 crores, and that's where the mild miss was, and that was a reporting miss. The net profit as a result of which coming in at 92 crores, and the poll was about 335 crores. But here's where the numbers really stand out, and that explains why the stock recovered from the lows as well. The key internals, which are then notified in the company's shareholders letter, food delivery NOV or net order value grew at 20% versus expected 18 to 20% growth. So that's the higher end of the expected range. Quick commerce grew upwards of 86%. The street was expecting a range of 80 to 85%. District, the going out business, saw a growth of 60% year on year, and the company says this is structural and not necessarily seasonal. And out here as well, losses narrowed from 81 crores to 65 crores quarter on quarter. They added 200 Blinkit dark stores as well. Management commentary also fairly robust. They expect the NOV and quick commerce business, which derives most of its value on Zomato, they expect that to be robust. They're not seeing any visible impact of high input costs or high fuel prices on demand yet. They expect competitive intensity to remain high, but that's become predictable. So the company's modeled that. And the fourth quarter average retention across all their cohorts has been almost half for Blinkit, which signifies their competitive strength in a highly competitive environment. The two things which are most important for me is the quick commerce operating leverage beginning to show. Yes, the Blinkit EBITDA has increased quarter on quarter, and now the pace of increase is also growing fast, so that's a positive. And secondly, for the last 3 quarters, despite all the investments that they are making and despite all the noise around competition and slowdown, etc., the cash balance, which is the most important thing of the company, has been increasing. So these 3 factors led to the stock recover from the lows today. Good internals, good EBITDA coming in from Blinkit, good commentary, and finally increasing cash.
All right, Manglam, many thanks for joining us. Recovering from its intraday low after its numbers. After months of legal and boardroom disputes, Bira 91 founder Ankur Jain has stepped down from the company's board and his executive role as part of a settlement with lenders and investors. The agreement paves the way for the company's restructuring and a fresh capital raise. As part of the settlement, all litigation will be withdrawn. Personal guarantees extended by the founder will be released, and the promoter family will exit the board and all executive positions. Both sides have also agreed to withdraw all claims and legal proceedings, bringing the dispute to a close. So, for possibly a fresh start there for Bira 91. We will head to a break, but up next, OpenAI reveals 2 of its AI models went rogue during a cybersecurity test. That and more when we get back. According to a Bloomberg report, the government has begun discussions on scrapping a rule that could pave the way for airport operators such as the Adani Group and GMR to own and operate airlines. Under the current policy, operators at the Delhi and Mumbai airports cannot hold more than a 10% stake in an airline. Madiha joins us now with more. Madiha, let's turn the spotlight on the Adani Group and GMR. Both groups already have presence in the aviation value chain. Now, if the government were to tweak the policy, make this change and allow airport operators to own and operate airlines, how will they stand to benefit?
Absolutely. Both will stand to benefit because they have a significant presence across the aviation value chain. So Bloomberg is reporting that the government is considering a major policy shift that could allow private airport operators to own and operate scheduled airlines. The proposal is currently being discussed within the Civil Aviation Ministry and will require the Law Ministry's approval as well. But if approved, it could pave the way for airport operators like the Adani Group and the GMR Airport Group to launch their own airlines. Now, if the rules do change, Adani would have already had a presence across almost the entire aviation value chain. Besides operating airports, the group has presence in aircraft maintenance, ground handling, flight training, airport retail, airport lounges, and even aircraft assembly through its partnership with Brazilian aircraft manufacturer Embraer. An airline is the only missing piece here. So if the Adani won the rights to operate Adani Group won the rights to operate 6 airports in 2019, including Ahmedabad, Lucknow, Jaipur, Guwahati, Mangaluru and Thiruvananthapuram. That became possible after the government in 2018 removed the requirement for bidders to have prior airport management experience, opening airport privatization to new infrastructure players. The group's biggest expansion came in 2021 when it took control of the Mumbai International Airport from the GVK Group and got Navi Mumbai Airport too as part of that deal. Since then, the group has expanded well beyond the 8 airports. It recently inaugurated a commercial terminal at Mundra Airport, which used to be its private airstrip. So if the government does allow airport operators to own airlines, and should the Adani Group look at the opportunity, it could potentially have a presence across almost every segment of the aviation value chain. From airports and airline operations to maintenance, ground handling, flight training, and even aircraft assembly. And it's not just the Adani Group, but the other private operator, GMR, which operates Delhi, Hyderabad, Goa, and Nagpur, has also expanded beyond airport operations. The group has built businesses in aircraft maintenance, cargo handling, duty-free, retail aviation, training academy, and airport parking. So if the aviation norms are eventually relaxed, both of India's largest private operators already have a significant aviation ecosystem in place. Now, we should also note that India does have a shortage of airlines, with Indigo controlling 66% market share and the Air India Group at 24%, Akasa Air at 6% and SpiceJet just at 2%. So while it would bring competition in the aviation sector, there are also concerns of airport operators possibly allocating prime slots to their own carriers. Nevertheless, if the proposal eventually becomes a policy, it could fundamentally reshape India's aviation landscape. CNBC TV18 has reached out to the Aviation Ministry and is awaiting a response from the government.
Well, yes, it is a Bloomberg report where we are awaiting a comment from the government. Madiha, many thanks for joining us. In fact, I spoke with Jeet Adani in December last year ahead of the Navi Mumbai airport launch on the possibility of the group foraying into the airline business if the government were to change the policy. Here's what he had to say.
What part of this business are you currently not into that you want to get into? I mean, you know, the big question is a foray into airlines the next big plan on the Adani Group's calendar?
No, absolutely not.
No?
We were legally not allowed
I know,
to.
but I know you're legally at this point in time not allowed.
Yeah.
But the government's been talking about, you know, competition. The government's been talking about the need for a large airlines, especially in the light of what we've seen happen with Indigo.
Absolutely.
If tomorrow the opportunity were to arise, would you consider it?
I would say there's nothing that we won't consider. But as it stands today, structurally, the airline industry is not something that we see, fitting our sort of capital discipline. We're used to high margin businesses, investing in asset, and sweating that asset well. The airline is completely opposite in every.
So from a unit economics point of view, it doesn't make any sense for you.
For us, no.
For you at this point in time, or even in the future.
Yeah.
if the opportunity were to arise?
Absolutely, yes. Yes.
So that's not something that you would consider?
Not at all.
Well, not looking at it at this point in time. That was Jeet Adani. To me, of course, the big question is whether the government will tweak that policy or not. Thousands of students continue to protest at Jantar Mantar in New Delhi, demanding education reforms and the resignation of the Education Minister Dharmendra Pradhan over the NEET paper leak. Now, 16 metro stations in the national capital have been closed until further orders, citing security reasons. This as per the Delhi Metro Rail Corporation. Interchange facilities continue to remain available at Rajiv Chowk, Mandi House and Central Secretariat. Meanwhile, the Supreme Court has refused to hear a petition on the protests and the police crackdown. Chief Justice Suryakant told a lawyer who had moved that plea, and he said, I quote, "Don't waste our time and your time. We don't want to watch any videos." This was because the lawyer had said that there was evidence on video of police brutality. Now, the Supreme Court Bar Association has condemned the police action on protesting students. The association expressed solidarity with the injured students and sought an impartial inquiry into what it described as excessive use of force. The issue also rocked Parliament for the third day in a row. Opposition MPs came dressed in black, staging a protest outside the House, calling for Minister Pradhan and Home Minister Amit Shah's resignations over the police action. Union Ministers Kiran Rijiju and JP Nadda said the government is ready for a debate in Parliament on the NEET paper leak next week. However, the Rajya Sabha leader of the opposition, Mallikarjun Kharge, insisted that Pradhan must resign first. He demanded a discussion under Rule 267, which allows the House to suspend its scheduled business. Both houses were later adjourned without any business for the third day. Education Minister Dharmendra Pradhan said the government remains 100% committed to addressing every genuine concern of the country's youth. This was his first public response on the issue since protesters marched to Parliament on Monday, and they were met by that police crackdown.
चर्चा का ड्यूरेशन कितना लंबा चर्चा होना है और किस नियम के तहत होना है, माननीय स्पीकर महोदय सारे पार्टी के फ्लोर लीडर से बातचीत करके इसका निर्णय किया जाए। सरकार पूरी तरह से नीट पेपर लीक पे चर्चा करने के तैयार है और इस देश के युवाओं को भविष्य के लिए हम सब मिलकर के एक सार्थक चर्चा हो, ये सरकार चाहती है।
आप लंबे समय के लिए ठीक ढंग से जर्मन मोशन पे ये इशू भी डिस्कस कर सकते हैं। गवर्नमेंट हमेशा खेल खेलती है, राजनीतिक खेल खेलती है।
Well, action in Parliament. Now, ChatGPT maker OpenAI has revealed an autonomous AI agent powered by its technology hacked prominent startups. The company's called the incident unprecedented. Rachna joins us now with more. Rachna, OpenAI saying that its AI model went rogue. Now, what exactly transpired here?
That's right. OpenAI has confirmed that its own models caused last week's Hugging Face security breach, calling it an unprecedented cyber incident. Now, the company says the breach happened during an internal evaluation designed to measure advanced cyber capabilities with models including GPT 5.6 Soul and a more capable pre-release model running with reduced cyber refusals for testing purposes. Now, as per OpenAI's preliminary findings, the models exploited a zero-day flaw in a package registry proxy to escape their isolated sandbox, then worked through privilege escalation and lateral movement until they reached a node with internet access. From there, the models used stolen credentials and additional 0 days to break into Hugging Face's production service, hunting for test solutions to cheat the cyber benchmark they were being evaluated on. What makes this different from a conventional breach is that no human attacker directed it or was involved in it. The models were chasing a narrow testing goal and built the attack path themselves without access to the source code of the systems they broke into. OpenAI says this confirms in the real world what UK AI Security Institute evaluations had shown in theory, that frontier models can now sustain complex multi-step cyber operations over long time horizons. The safeguards that would normally block this were switched off by design because this was the test built to measure maximum capability. That is the uncomfortable part for the entire industry because it means the ceiling is higher than what users see in production, and containment now has to keep pace with capability. Hugging Face's security team detected and contained the activity, and OpenAI flagged the anomaly internally. The 0 day has been responsibly disclosed by both the companies, and now both the companies are jointly investigating, and Hugging Face has been brought into OpenAI's trusted access program for cyber defense. Hugging Face CEO Clem Delang called it possibly the first incident of its kind, saying AI safety will be solved in the open and not by any single company working in secret. It lands the same day Google restricted its new cyber model to governments and trusted partners, the same gatekeeping that Anthropic used for Mythos. So clearly very interesting time when it comes to cybersecurity and frontier models. We'll have to see where it goes.
Absolutely an important issue. Rachna, many thanks for joining us. With that, it is time for us to wrap up this edition of Business 360. The news continues right here on CNBC TV 18. Stay tuned. We're back in a moment.
Welcome to a special Economics. In the past 5 years, public sector banks have gone from strength to strength, even as the large private banks have somewhat lost ground. As of FY26, the bad loans, gross NPLs of public sector banks was actually less than that of private banks as a percentage of total loans. Now, PSU banks' loan growth has also been faster than that of private banks in the last 3 years. PSU banks have recaptured lost ground. They were losing the market share for decades. Now they have regained market share. And the stock market too has rewarded public sector banks. The PSU Bank Nifty has risen by 242% in the last 5 years, while that of private banks rose by only 55%. So the questions we are asking today, does this represent a structural improvement in PSU banks? Or is this just a temporary improvement because of the heavy cleanup and the recapitalization that happened from 2018 to 2020? Joining me to discuss this are former Bank of Baroda chairman and, more importantly, former Deputy Governor of Reserve Bank, Mr. S.S. Mundra, former Managing Director of Punjab National Bank, Sunil Mehta, and he was also chairman of IBA, and Mr. Harsh Vardhan, one of the best banking experts from Bain, and more importantly, independent member of the Karur Vaishya board. So very much an insider. Gentlemen, good morning, and thank you very much indeed for your time. Mr. Mundra, this has to begin with you, since you have been there and seen it all as regulator and banker. Like I told you, gross NPLs, which were at double digits in 2018 for public sector banks, has fallen to like 1.4, 1.5, just like private sector banks, sometimes even better. And like I told you, they are grabbing loan growth back. Does this look like a structural shift?
Thank you, Lata. And you have picked up a very interesting topic to discuss today. First, I think I fully endorse what you are telling. If you look at the figures, and particularly in last 2 years. Now, see, what is the general discourse? General discourse is normally you pick up a time frame of last 4 to 5 years and then talk about it. If you take that framework, obviously it looks like that compared to, let's say, 21 or 22, the public sector banks have lost the market share, private banks have gained the market share, the performance, profitability, operating profit, etc., all the parameters will look negative. But what is interesting is to look at the period of last 2 years. If you look at the period of last 2 years, that is the 25 and 26, which is completed now, you would realize that almost in all the parameters, I would say couple of parameters, deposit growth in private sector bank is still better than the public sector banks. Other income, private bank have still a marginal advantage over the public sector banks. And let's say the CASA deposit, probably there is a better performance by private sector banks compared to public sector banks, and which ultimately results into the operating income. But interestingly, in last 2 years, the market share gain of private sector bank is almost muted or in decimal points, let's say 0.4 or 0.5%. And whereas advances, the public sector banks has grown better than the private sector banks in last 2 years, and also catching up on the other income, operating profit, etc., etc. So I would say, now with the consistently for 8 quarters or 2 years performance cannot be brushed aside as something which has happened by accident, or it has happened accidentally. It's not so. I think it is showing a structural improvement in the performance of public sector banks. And last thing which initially I would like to mention, see, we should remember the period before this, 21, 22, 23, 24 was marked by 2 things. Cleanup was continuing of the balance sheet, capitalization was underway, and moreover, a lot of big consolidation happened in public sector bank, which take its own time, to settle down and then move towards the growth. So I would certainly say it still is a mixed bag, but there is a structural improvement. Public sector banks are recording good performance, but there are few areas where they would need to really still focus on, so that this trend not only continues but it strengthens and they don't again slip back. Let me stop here.
I think you very comprehensively covered the fact that they have made advances in many places, but on deposits, on CASA, the private sector banks are still showing higher, better growth. Mr. Mehta, let me focus on the structural part. There were 2 things that were not there in the, in the previous decade, which has come in now. One is huge digitalization in public sector banks, probably started under you in PNB. And secondly, the acrylic has come in Reserve Bank. So even if we go through a bad period, that structural improvement should prevent loan shopping, corporates kind of loan shopping between banks. So do you think, therefore, this is a permanent improvement in PSU banks?
So thank you, Lata. It's a very interesting point you have raised. Let me give you 4 major factors which have brought structural changes into the performance of public sector bank. One of them is implementation of public sector bank reform agenda. We commonly call it EASE. This is EASE. This was like in 2015, there was a Gyan Sangam, which was followed by a Manthan in 17. And the entire public sector bank has undertaken a reform journey so that they can stay in line or ahead of the curve in reforms. And that reform has helped in creating of the stress asset management verticals in each bank and has really brought focus back on recoveries, corporate governance, and the profitability. That has really contributed. Another important reform which the government introduced was IBC. So IBC, because the cleanup started in 2016 with asset quality review, and that impact lasted for 4 years. Like from 16 onward, the entire cleanup started, and by 2020, most of the banks have provided for their all bad loans, which were cleaned up during this process.
Got it.
So the provision of coverage ratio of most of their banks has gone as high as up to 90%, and on an average more than 75%. So that has created a gold mine for them.
Yeah. I think we will get back to you, Mr. Mehta. There's some connection problem. Ms. Harshvardhan, now as the neutral party who has not worked in a public sector bank, do you think this is an action replay of 2004 to 2008? Mr. Mundra would remember this very well. We saw public sector banks go from strength to strength. I mean, they were shining balance sheets and P&Ls of public sector banks in 2006, 2007, 2008. But come one, excess period, and we saw them decline again. Do you think there are structural changes now that even if there is a loan boom, they will not go back to the kind of problems they saw between 2016 and 20?
So, Lata, I would be somewhat more circumspect compared to the other two panelists. And let me give you the reason. If you're right that the public sector banks have performed very well, but if you pass the performance, there are three main factors. One, you mentioned the growth has been strong, not just for the public sector bank, for the whole system.
Yes.
We are growing 16% last year. This last month, we did 18% year on year.
Yes.
And it's been driven by a lot of this growth is under guarantee of MSMEs, the MSME guarantee scheme, gold loans, and so on and so forth. But there are two other important factors you have to keep in mind. Our credit card provisioning levels are at historic low. I looked at 25-year data from 2000 to 2025. Average credit cost provisioning to assets is about 1%. We are below 50 basis points right now. In fact, public sector banks for the last 3 years have been below private banks. They are at about 30 to 40 basis.
Yes.
This is unsustainable. Structurally, we are not such a low credit cost banking system. This is going to inch up. The other important thing you must realize is the pre-provisioning operating profit has been basically stable. It has not improved. So there is no gain on margins. There is no gain on operating costs. In fact, operating costs have set. So there is no productivity gain despite consolidation. What has added is a lot of recoveries that have happened of written off and bad loans. This is effectively the capital government put in coming back as profit. And so two of the three factors that are driving these extraordinary performance, to my mind, are structurally not sustainable. Or at least the jury is out. We'll have to wait for another couple of years to see whether this is... because the stock of bad loans are decreasing, so recoveries are going to go up.
Mr. Harshvardhan, you're touching a very, very relevant point, because I'm not asking a philosophical question or a political science question here. There are people who have loaded up on public sector banks because of their extraordinary performance of the last 5 years. But in the last 1 year, actually PSU shares have fallen a little more than private banks, because the feeling is exactly what you said, that all the provisioning, all the credit cost lowering, everything is over now. That is what I want to ask, whether you see structural reasons for the private public sector banks to continue at least the strong performance, if not stronger. Harshvardhan, very quickly, sir.
So even the loan market share gain has been marginal. And it has happened in things like mortgages, where public sector banks are doing all no margin kind of prime mortgage. They are going at 15%, private banks are going at 5%. So I'm not sure about the margins or the pre-provisioning operating profit maintained at this level. And clearly provisioning costs are going to go up. So I would want to watch for another couple of years before declaring this to be a victory and a structural shift. For me, a significant outperformance is because of one-off factors.
Yeah, fair enough. And I have another relevant issue for all three of you. And let me start again with Mr. Mundra. So, the recruitment issue, it is still open exams, national exams. And you may now want an AI expert or people who are immediately, you see someone and you want to recruit them. This is a freedom private sector banks have and public sector banks don't have. I know of instances, I don't want to reveal it, in banks where you bring an outsider and they are really made to feel uncomfortable by the old boys club because this lateral entry is not very welcome. So therefore, do you think this outperformance in financials is difficult for PSU banks in the age of AI?
Okay, Lata, of course, I will respond to the question which is in a particular context, but I can't really restrain myself before reacting to a couple of the things which were mentioned earlier.
Okay.
I agree with Mr. Harshvardhan on some of the things about the guarantees and the MSME and gold loans and operating costs and the provisioning level, and they are unsustainable. My only caveat is everyone is on the same bandwagon. If one is committing sins, all are committing sins. So private sector banks are no different in that respect. Yes, I agree. If you look at the end of 26, the total capital and reserve, which public sector bank as a block and private sector bank as a block are having in their books is almost equal. But this capital is supporting a different level of business. The private sector banks it means they have the cushion of capital, they have the luxury of capital, and they have a better operating income. So I don't dispute that. And you talked about 2004 to 2008. I think we all remember what happened, where the things went wrong. The head office banking was happening and the large ticket loans were done. But one thing I can tell you very convincingly that I think the public sector banks have learned their lessons well. Balance sheets are much better diversified, and they have started looking like both. Okay. Coming to your question about the lateral recruitment and people feeling uncomfortable, yes, in the beginning it was always so. But I would tend to feel that gradually this has become an accepted factor, and the now acceptance and the freedom to work is much greater than that. When we are talking about, interestingly, if you look at PSB and if we talk about 5 years, you will observe that the market share of all public sector banks put together has fallen comparatively more than SBI. SBI has been almost able to defend its market share even throughout the last 5 years. So, and digitalization and the apps and all that, I think they have put a very brave one. So I would say, I would say there are issues, but it's not that suddenly that it's a 2-year wonder and now it's going to change. I don't agree with that.
Okay, actually, Mr. Harshvardhan has a point, sir. Where the advances have grown it is in home loan and auto loan. A product which private banks are not touching because the margin is very low in home loan and somewhat low in auto loan. You look at you look at personal loans, you look at credit cards, their percentage is increasing. So they are in a high risk, high return,
Sorry, Lata. Don't pick up the time frame selectively. If you pick up for home loan and this thing a time frame of 1 year and for the other things 5 years, then it is selective.
Fair enough.
You look at that, and you will be surprised to know that we don't know who is following whom. Whether private sector banks are following PSB model or PSBs are following the private sector model. It's a very mixed bag.
I agree with you entirely, and I can tell you that you mentioned SBI by name. SBI bankers are held in very high regard in private sector banks. They know they can't match some of their skills. So, I agree with you that there are times when private banks pick up the hint from public sector banks, and I don't want to run anyone down. I'm only very happy with the PSU performance, and so are a lot of investors, like I showed you the stock price. So, Mr. Mehta, this is clearly a stock market question. Do you continue to bet on PSU banks, or have they run their course, as the stock price seems to indicate? In the last 1 year, the outperformance has ended.
Lata, there is a large gap between the market reward to the public sector bank and what is there for the private sector bank. If you take terms in terms of market dynamics, you'll observe that the multiples available to private sector bank is as high as 16 or 14 times, whereas in public sector bank it's 1 time or 2 times. So where the multiples are still at a lower level, there is a scope for the market to provide further appreciation because the performance has really improved during the last 5 years because of the certain structural changes, right from fees, that is a reform agenda, to the IBC, to the consolidation, to the digitalization that is being undertaken. So all these processes are bringing a future value to the public sector bank, and I hope they will continue to perform in future. they'll continue to perform.
I like that word you say, hope, sir. Unfortunately, stock market does not look at hope as a data point. You know, the more important question I want to pursue with all of you is that within private sector banks, the old private sector banks have done much better than the new private sector banks. For example, RBL, Federal and Karur Vaishya. There is a Karur Vaishya representative over here. That is one of the best performing stocks in the last 5 years. So that question we're going to discuss threadbare after the break. Welcome back to a special Indonomics where we first discussed whether PSU banks have stolen a march over private banks and that advantage is here to stay. Now we are saying that old private sector banks have stolen a march over the new private sector banks, and will that continue? I have been speaking with former RBI DG, Mr. S.S. Mundra, also former BOB chairman, Mr. Sunil Mehta, former chief executive of IBA and managing director of PNB a few years ago, and Mr. Harshvardhan, member of independent board member of Karur Vaishya and the banking expert from Bain. Well, since we're talking about old private sector banks and Karur Vaishya is there, Mr. Harshvardhan, that question is really to you. RBL, I mean, it was Ratnakar Bank and completely not in the map of anyone. And it has given a huge return in the last 1 year. It has become a foreign bank. Federal, you ask any of the young banking analysts, they will actually count Federal as a new private sector bank. They will forget that it was once an old private sector bank. And Karur Vaishya likewise has given the best returns in the last 5 years. So do you think that's where the gains are going to come? People who are young in spirit and flexing their muscles.
Yeah, so I'll put a slightly different spin on this, Lata. It is not old versus new, it is small versus large bank. Okay. See, once you become a very large bank, you are strategically homogenized. All large 4-bank, 5-bank look alike. If you're a mid-sized and small-sized bank, you have strategic choices, which, for example, at KVB, we have exercised, we have focused on some business. When you're a large bank, you can't do that. You look at the business mix of all the top 5 large banks, State Bank and the 4 private, basically marginally different from each other. So their only difference that they can bring about in performance out of execution. Whereas a small and mid-sized bank banks tend to have strategic choices, which, for example, in KVB, were very thoughtfully exercised and executed well. So even within public sector, you would see smaller public sector banks have done better. in terms of their stock performance. So I think overall, to your earlier question, what you see is a convergence of performance and valuations of public and private sector. Now, whether we are at the end of that convergence or not is, I think, still an open question. I'm not willing to say that ultimately they'll all be true. There are still some very serious issues with public sector banks. But their valuations have moved from below 1 time book to 1 to 1.5, and private sector banks have come from about 2 to 1.5 to 2.
Yes.
So there's been a conversion of that sort. But I think the large versus small banks also is an important distinction you have to keep in mind.
Fair point, sir. They're more nimble. But but when AI comes in full force, it's already there, and we hear from the large private banks. My colleague Ritu Singh even gave the numbers. They have stopped recruitment and actually reduced their workforce in the last few months. Mr. Mundra, as we tackle this new force of AI, and another new force, that deposit cost is going to be very high. As you mingle with these new forces, who do you think is best placed?
Okay. Yeah. So Lata, but just to, again, I think if you look at old private banks as a block, needle has hardly moved. Their market share, what it was 5 or 6 years back, remains the same today.
Fair point.
There are exceptions which you mentioned, but even within that exception, RBL Bank is no more can be called as an old private sector bank, as we all agree. So I think the larger issue is that in all the three so-called blocks, whether it is PSB or private sector banks or old private sector banks, time has come when you have to look not as a block or as a sector, but as the individual players. I think something which Mr. Harshvardhan was also mentioning.
Yeah.
And so within the blocks, there would be winners, there would be stagnant, there would be losers.
Yep.
So I think market would have to look at it a different thing. Coming to your specific question, see, AI, of course, for every kind of industry, it is something which one has to critically look into. I only look from one viewpoint. If you, what you talked about before we went for break about the, head count and all that. See, private sector banks have increased their headcount very significantly in last 2-3 years.
Yes, sir.
In fact, the headcount in private sector banks put together is now more than public sector banks. And it was looking like that public sector banks are losing this race. Now, the point is with AI, if you are bringing AI and if you are able to, use it efficiently in back-up operations, whether this kind of headcount which have been accumulated can really be redeployed meaningfully, or it would become a burden. I think it would be something interesting to watch for as we move ahead in less 6 months or 1 year.
Okay, that's great. Out of time, Mr. Mehta, what are your thoughts as a public sector banker? Do you think this HR issue and the fact that, again, the CVC and CAG, those issues remain, structurally you are more constrained than the private sector banks. Will that burden come back to visit you, or do you think public sector banks are structurally better off?
So two things, Lata. First thing, all the three major banks which you have said about the old generation private sector bank, they are led by leaders from the public sector bank.
Exactly.
That is so it means public sector bank has got the bandwidth to tackle these issues. Another issue I would like to flag is regarding manpower. The consolidation has offered a very great opportunity to the public sector bank to merge the existing branches, because the multiple banks were having branches at the same place and three banks have merged, so they have branches. So they can close some of those branches and redeploy that manpower for opening of the new branches. So without increasing headcount, they can increase the number of branches and they take the advantage of economies of scale, which they are taking for deployment of the AI and the technology.
Okay. No, that is there, and I think that period is over, the consolidation and the reorganization of branches. But I would think that in an era when we are going to have unknown and very difficult challenges from technology, I'm a little worried that the legal structure of the PSU banks and the constraints we put on the CEO and the HR may perhaps make them slightly more constrained to meet the challenges. But that perhaps discussion has to be done in a more detailed fashion. Thank you very much, out of time, on what I think was a very, very useful discussion. Thank you, Mr. Mundra, Mr. Mehta, and Mr.
Thank you, Lata. Thank you very much.
Artificial intelligence is rapidly becoming the defining investment theme for global capital, and Temasek is among the investors that's putting the biggest numbers behind that conviction. The Singapore investment giant now wants to more than double its AI exposure to as much as 15% of its portfolio in the next 5 years, betting across the entire AI value chain. But what does that mean for India? Where does Temasek see the next opportunities here? And how importantly is it navigating an increasingly uncertain global environment? To answer all of that and more, joining us now is Ravi Lamba, the head of strategic initiatives and the head of India at Temasek. Ravi, thank you so much for taking the time out to join us here. And let's start with that AI theme, because clearly that's become your biggest strategic bet. You want to double your investments there in the next 5 years. Where do you see the biggest opportunities today? And, are we still in the early innings of this AI investment cycle? And where in this entire picture does India fit?
Yeah, thank you, Ritu, for having me. It's an important thematic right now. I mean, AI is clearly not just the flavor of the day, but it's the future in terms of how enterprises and people will interact with artificial intelligence. And I think what we're doing is currently, as you said before, we are looking to double our portfolio globally, but more importantly, it's just the beginning. So as I recall back in the late 90s when, software was emerging, everyone was trying to figure out how to adopt software, and then, fast forward 10, 15 years later, every company became a software company, and all of us use software without even realizing it's software. So we see AI as that is simply that in the next many years to follow, and maybe adoption will be much quicker, AI will become the next sort of infrastructure. It'll be the next infrastructure utility for across enterprises. So I think as you think about that as a thematic, and as we invest in that thematic, I think from an India perspective, we see the opportunity in India around the application layer, because adoption is needed. Adoption takes time, and adoption needs certain skills, and we think India will play well when it comes to the application layer for AI.
Okay, I'll get back to India in just a bit, but one of the interesting things about Temasek's AI strategy is you're invested in both of these big AI giants, OpenAI, Anthropic globally. I mean, does that reflect the view that it's too early to pick a winner, or are they fundamentally solving different problems and serving different markets? What's the strategy there?
I think the strategy simply is to invest behind AI companies that are at the forefront of what's happening today. And a portfolio is best served, just given the fact that the journey just started. And there'll be many winners. And therefore, if you can get a chance to invest behind people who are doing cutting-edge AI work, it's a great place to be from an investment perspective.
Well, your review also talks about this turning point for the global order. There's tariffs, there's protectionism, there's geopolitical fragmentation. All of that is reshaping capital flows. Again, today you had, comments from Donald Trump on pharma and whatnot. How is that changing the way you think about investing today versus what you'd, do in terms of allocating capital 2 years ago? How are you ring-fencing your portfolio?
So as an investment house, we do not allocate by sector or geography. We are agnostic. We are very bottom-up driven for opportunities. And frankly, all these factors that you say, we will factor that into our investment underwriting thesis. So a tariff, for example, is another cost element that we will add, just like we'll add other costs. It could be raw material, it could be anything. So we're not, and we look at these as inputs to our investment process. We are very long-term in our investment orientation. And we look at it over the long term. And frankly, if you get the cost structure right, whatever it contains, you underwrite the value accordingly. And that's how we look at it, Ritu. There's nothing specific that we draw from the current thing. We simply make sure that we are able to the best of our ability, to capture what it takes to understand the value of a company before we invest. And we're driven by intrinsic value when we think about investing and exiting. So that's the test that drives us.
Well, I was just zooming into India then, because India has been one of your strongest performing markets in the last decade, but still its share has eased a bit from 8% to 7% now. Is that simply because of what's happening on the currency front, or are valuations here making it harder for you to find attractive opportunities?
Sure. Let me give you some perspective on that. I think firstly, we had said a few years ago that we would try to deploy between $9 to $10 billion in India over the next 3 years. And we're on track. I'm happy to report that, in the last 3 years, we've deployed close to $9 billion. And it's not like we're slowing down. We are happy to keep looking for opportunities and deploy more capital. What happened last year was actually quite specific We were approximately 50 billion US in exposure to India in 2024-25. In 25-26, we had two events. One was the exit of our investment in Schneider, India, which was north of $6 billion, and then there was, of course, some sell down by Singapore Telecom of their stake in Airtel. I think they sold close to 2.7 billion, of which we account for about 50%. So if you add those two up, there was those are the two main reasons why the sort of close to 50 billion has come down to about 42, and the 7% is simply just an outcome. We don't manage the portfolio by country or by country or sector. We're driven bottom up, and that just so happens to be the percentage. From our perspective, we keep looking forward to deploy, what we said we would, and if opportunity presents itself, we can even deploy more than what we said in India because we like the thematic. India has been a great performing market for us despite, all the headwinds we've seen on the currency, and we're very happy with our portfolio performance in India.
So if you were to, Ravi, then deploy your next $1 billion in India today, what are the top 3 or 5 thematic or, sectoral themes where you'd put your money? Perhaps a theme that's still underappreciated by the market you'd like to call out?
I mean, given what we own today, we would like to double down on what we own firstly. So, we own stakes in financial services, in healthcare, in consumer, in industrial. So I think those are all great sectors, and we will keep finding more investments in that. And we'll keep finding, and we'll keep peeling the onion. So what I mean by that is, we first started investing in banks and financial services. Then we moved that to investing in insurance, and then we moved into asset management. We did some fintech. So in that sort of journey, we will keep putting more capital in these sectors that we understand well and we believe play very well to India's thematic and India's growth. Healthcare services is something we like a lot. We have several investments in India. We have investments in Manipal, in Medanta, in Dr. Agarwal's, in Cloud9, for example. We have investments in some pharma businesses. We have investments in some consumer businesses. We took a stake in Haldiram because last year because we see a significant growth in that sector, and we'll find more opportunities in that sector as well because we think investing behind great brands that can serve a 430 million and growing middle class, where where the ability to spend is increasing, is a very good place for us to be. It plays very well to our thematic.
Since you're talking about peeling this onion, going deeper, and let's look at your financial portfolio. That is one of your largest. If your playbook is pretty much on the entire financialization story. I mean, there's banks, there's insurance, there's exchanges, there's asset managers, even fintechs. But if you had to pick the next decade's biggest value pool beyond banks, where will it come from?
If you think about where India is still early in this journey when it comes to financial services, one, of course, is insurance. The other one's asset management. And we find both these thematically very attractive. Obviously, you have to choose well and you have to manage the balance sheet well. But the demand is there. It's growing. Wealth management, for example, is a space where we will see a tremendous amount of opportunity. And it comes down to how you pivot your business, use AI, use data to try and grow and grow what I would call a scale business. And when we find management that can play to that thematic, we will invest behind them.
But on banking itself, you built a pretty significant exposure, especially to private banks. Just looking at their recent performance, underperforming the PSU peers, even NBFC, and if you look at the latest numbers, it's been pretty underwhelming. What's the biggest risk, you'd say, to your long-term thesis on the banking sector?
Yeah, I think it's a good question. Look, I think we're not, again, I would say that we're not faced by, 1 or 2 years of volatility. We've been investing in the banks for more than 20 years. And we see banks as a great proxy to economic growth. We see banks can have the ability over the long term to compound equity value north of, 15%, just given the way they're structured. Asset quality is very good. Capital adequacy ratio is strong. Yes, there is some near-term volatility, which we're happy to ride through. And as we think about our intrinsic value test, and we feel that the long term is still positive, we will put more capital in this space because we do fundamentally believe that banks play a very important role in the growth of India. The Indian GDP economy is growing amongst the fastest globally, amongst the larger economies, and credit growth will be a big part of that growth. And therefore, investing behind that, that theme is an important aspect for our investing thesis in India.
Well, let's talk about the big one that's upcoming. You've been a long-term shareholder in NSE, and the exchange appears closer to a listing than it has been in years. Is it an exit opportunity for you, or do you still see value creation ahead? Because India's markets are continuing to deepen, more and more new investors are coming in.
I mean, it would be unfair for me to comment on any particular company that, any of in our portfolios in that specific way. But what I would say is the following, which I think will answer your question, that we see the IPO of a company as one more element of its life cycle. We don't look at the IPO as an exit opportunity. An IPO is an opportunity for unlocking value of a private business. And an IPO happens when conditions are right, market, companies, Reddy, et cetera, et cetera. So as far as we're concerned, we have had many companies in our portfolio that have gone public because we are agnostic to private and public. So when we've invested in private businesses, we can continue to hold them. An example is Eternal. We came into Zomato back in, it was called Zomato then, in 2015, and we still have most of our shares in Zomato. We haven't sold on much. Similarly with Policy Bazaar, and there are many such examples, companies like Lenskart and Dr. Agarwal, etc., and Medanta that went public. We continue to hold most of our stakes that we had, and to the extent we need to exit, it'll come down to what I described before was our intrinsic value test. If it says these companies, it's a good time to take some money off, having a listed asset obviously is great because you can be agile with your investment holding. But again, that's a decision that we would take at that time, but it's nothing to do with the IPO of a company. IPO is just one more event in the company's life cycle.
Take a break on that note. Don't go anywhere. We'll be right back and continue this conversation. in conversation with Ravi Lamba from Temasek. You spoke earlier about healthcare, and that's become one of your biggest India bets from Manipal, Medanta, Dr. Agarwal's that you were just telling us about. Would you say that is now India's next structural compounding story? And as assets like Manipal, they prepare to go public, how are you going to balance on one hand, monetizing what's been a successful investment or, staying invested for the next phase of growth in the long term?
Yeah, I think healthcare services we see fundamentally very attractive as a sector, and I'll tell you why. Because there's the population in India grows. You need good quality healthcare. You need medical excellence, and you need scale. So if we can be invested in a platform in healthcare services which caters to all of these demand requirements, then it's a no-brainer. The question is, can you scale? Can you scale profitably? At the same time, can you provide the best possible medical care? And what inputs do you need to provide that? And that's where we are very focused right now. In everything we own, we want to try and see how we can use the data that we have, improve the quality of healthcare, improve the output of healthcare services so users will benefit, use AI so we can improve the interaction and the way healthcare is provided. And we see that as another big driver of growth. So it's a great sector to be in. We have doubled down often in the companies that we own, and we'll continue to do that as we see the opportunity expand. And the opportunity is coming from both ends. It's coming from organic expansion and inorganic expansion. So when opportunity presents itself, we will be happy to back our portfolio companies to do M&A as well.
All right. So more M&As perhaps in the healthcare space. We'll watch out for that one. But let's talk about your consumption bet as well. I mean, you've invested close to $1 billion in Haldiram. You have Lenskart, Healthcart, Rebel Foods, CureFit, Licious. I can go on. But if you look at the data, consumption has been a bit patchy. Yet several of these businesses I just named, they're IPO candidates as well. So, is the consumer story strong enough today to justify both the private valuations they're commanding and this next wave, another wave of tech listings as well?
Yeah, I think, Ritu, what I would say is, if I look back 10 years, and 10 years is a reasonably good time frame for us as we consider our own portfolio performance, India has been the best performing market for us globally. This is despite the fact that the currency has depreciated 30% to the Sing dollar in the last 10 years. And why has that happened? That's happened because obviously we were fortunate to have picked great investments, companies to invest in and great management teams and partner with good families. But more importantly, the underlying growth has been pretty solid. India is amongst the fastest growing economies globally. You've seen, if you look at the per capita spend on a real basis, it's actually grown almost, I think, 12.5%, 13% in the last 2 years. So yes, consumption has been weak in certain sectors. It's been strong in certain. It is our job to pick the best investments possible and then continue to stay invested in them as they grow. We don't see that slowing down. Yes, there will be cycles. There will be, as you mentioned, there are a few years where it's been slow, but we will invest through the life cycle. We're not a fund. We don't have any fund life issues. We can stay invested through cycles. And more importantly, when we see weakness, because we believe in the long term, we will double down on our investments as we have before too. So this short-term volatility does not faze us. What we are focused on is the long term. We want to increase our stake, our investment exposure in India, and we're looking for those opportunities.
Well, Ravi, to me, it sounds you're not taking any money off the table. You want to double down and stay invested for the long term in pretty much every company and sector that you're currently in. But let me then get to quick commerce. I mean, you're an eternal shareholder. You brought up how, you've stayed invested in Zomato. But you're seeing quick commerce evolve from that cash burn story now. Thankfully, a bit more of a profitability debate coming up as well. But, at the same time, competition is getting quite tough. You have Amazon, Flipkart, Zepto, all of them scaling pretty aggressively here. Does it become a winner-takes-all market, or do you think these multiple players can, generate attractive returns? And any of these companies that I listed, for instance, Zepto, that's coming to the market, are you looking to make additional investments, look at any other companies in this space?
Yeah, it would be unfair for me to comment on any of our particular portfolio companies in that manner. But what I would say to you is that we believe in the underlying growth in quick commerce as an example. It has only just started as a few-year-old phenomenon. There's a lot of value to be created. Of course, you have to execute well. You have to use the right cost structure, and you have to plan the technology in such a way that it can help you scale profitably. And as we see that happening, we will stay invested in this space because it's the beginning. It's just the tip of the iceberg. And we think the sector's got a long runway. E-commerce had a long runway 10 years ago. Quick commerce is part of e-commerce. We've invested in e-commerce, not just in India, in China, in the US, in Europe, in Asia. So this is a space that we understand very well.
Okay, the other space is mobility that I wanted to talk about. I mean, you're present all the way, through the spectrum from Maruti to Ola Electric, O2 Power. Ola Electric, for instance, still loss-making, well below its listing price, losing market share. Why not back someone like Ather? I mean, is that something you'd looked at? Any regrets at all? You think Ola Electric could still come out on top? I mean, what's the thesis there?
Yeah, I will not comment on any particular company, but I think the trend, we like the trend a lot. I think the transition to clean energy is important. Our investment in Mahindra, for example, in the EV space is part of that. We came into Mahindra a few years ago, and we're seeing some great outcomes there. And look, it's a matter of investing behind a trend that's here to stay. As we find success, we will double down, and we have to be watchful where things don't go according to plan. We have to work with management and see how we can pivot the business to try and move it to the right direction. And as shareholders, where we want to sit at the table and add value with our partners, that is what we will seek to do.
Okay, let me end by asking you about your exits as well. I mean, you spoke about Schneider Electric at the start. That was one of your best exits here, so far. India's IPO pipeline, of course, is as strong as it's been in years. Are you more likely to start monetizing some of your mature bets here? Or are you still, like you've been repeatedly telling me here, primarily a long-term owner? I mean, how's the year shaping up in terms of exits for you?
I think exits is an important point. Maybe I'll rephrase it in a way that puts better picture on this, on how we think about exits. Firstly, we're driven by intrinsic value. That's one. I will not go more into that, but that's what drives us to determine whether we should hold or sell a particular investment. The Schneider situation was excellent. We invested it at a time during COVID, when things were a little uncertain. We came in, we partnered with Schneider, and there were two options. We could have stayed invested, and that company could have gone public, but Schneider decided that they wanted to consolidate the holding, and we got a great exit. So it was a win-win for both sides. Now, did we exit because our intrinsic value test had played out? No, it was a factor of working with a partner and trying to get the right outcome, which could be a win-win for both sides. And that's exactly what happened there. When it comes to other investments where we're invested, again, we will look at the same lens. If it makes sense to exit, we will. But if it makes sense to hold, and we are compounding equity in a market that's delivered so well for us, with management that we know really well, we will stay invested, and that's ideally what we will do.
Okay, finally then, the outlook for the year 2026, going into 2027, what are you most excited about for the India market today? What do you see shaping up as the biggest opportunities and also some of the biggest risks, regulatory or otherwise?
Yeah, I think the risks are important. Look, there is clearly a global impact of what's happening in the war in Iran and what's happening with oil prices. And that's driving volatility in the currency as well. I mean, there are risks here that we have to be cautious. And when there's risks, you just have to be cautious, which is what we're doing. We're being cautious. We are being selective. As we look forward, we are looking forward to continue to find opportunity in the sectors that we know well. And it'll be the same ones I highlighted earlier. I hope we can do more in financial services, in different parts of financial services when it comes to, the onion peeling that we were talking about. I think healthcare continues to be a place where we will deploy capital if we can find the opportunity to do, more acquisitions if they present themselves. And we will also grow our portfolio in the whole area of green energy and transition, where, we had a great investment in O2 Power that we exited along with EQT. I think going forward, if we find more to do there, we would like to grow that portfolio in line with our sustainability objectives. So there's a lot to do. Pipeline is strong. We are being cautious only because the environment from a global impact of the environment is affecting certain things, and we just want to be cautious about it. But we see this being a strong investment year if we can find the right opportunities. We are very keenly looking at it.
All right, a strong investment here for Temasek here in India. Thanks very much, Ravi, for taking the time out to speak with us. Always a pleasure having you here.
Thank you. Thanks, Ritu. Good talking to you.
Okay, on that note, we'll wrap up this special conversation. Thanks very much for tuning in, but stay with us. More news and updates will continue right here on CNBC TV 18.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always are Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. Zomato's parent Eternal misses estimates in the first quarter. Profits nearly half sequentially, but operational performance remains strong, with food deliveries growing at 20% and quick commerce orders surging 86%.
India's startup funding market is becoming more concentrated. Funding rose 12% to $7.2 billion in the first half of 2026, even as deal count dropped 43%, with investors backing fewer companies. Only 340 new tech startups were founded in the first half, while operator-led ventures attracted 11% of total funding.
MedTech startup BioScan Research has raised $1 million in a seed funding round led by Unicorn India Ventures. The company will use the capital to expand its market presence, secure regulatory approvals, and enhance its AI-powered brain injury diagnostic device, Cerebral.
SoftBank-backed AdMobi tech firm InMobi has appointed JP Morgan, Jefferies, Kotak Mahindra Capital and Axis Capital to manage its nearly $1 billion IPO, Bloomberg reported. The company is targeting a valuation of $5 to $6 billion and is currently domiciling from Singapore to India ahead of its planned listing.
A lawsuit filed by 26 Meta employees is raising fresh questions about AI's role in workplace decisions. The employees allege Meta used AI-powered tools to help select workers for layoffs, but legal experts say proving AI was responsible could be difficult due to limited access to internal systems and private arbitration. Meta denies the claims. Those were the headlines that we're tracking for you this evening. But on what's brewing today, after months of legal and boardroom disputes, Bira 91 founder Ankur Jain has stepped down from the company's board and his executive role as part of a settlement with lenders and investors. Rachna Dhanrajani is here with what's happened and the road ahead for the company. Rachna?
Ankur Jain is stepping away from Bira 91, the beer company he founded and ran for more than a decade. In a letter to stakeholders, Jain said he and his family are exiting the board and all executive positions with immediate effect as part of a settlement reached with the company's lenders. The family's roughly 17.8% stake in parent B9 Beverages goes as well, a full surrender of both ownership and control. Now, under the settlement, both the sides will withdraw all claims and litigation against each other, and the personal guarantees Jain had extended against corporate borrowings stand released. He calls it a clean and full close, one that required aligning close to 30 stakeholders with competing interests. The backdrop is a crisis that has been building for over 2 years now. Debt at B9 Beverages had swelled to around 1,000 crore rupees, and production had come to a grinding halt. More than 250 employees petitioned the board last October seeking Jain's removal, citing salaries unpaid for over 6 months and provident fund deductions that were never deposited. The workforce shrank from roughly 700 to 260. A glass supplier even sent a legal notice over unpaid dues last month. Investors, including Kirin, Peak 15 and Sofina, had been pressing for a leadership change as a condition for fresh capital. That capital now has a path. Lenders and investors are expected to recapitalize the company and restart operations over the next 3 to 6 months. That's all we've picked up from Bira's founder. He himself came out in a LinkedIn post and said all of this, and so we got the letter to the stakeholders.
Well, thank you, Rachna, for those details. Appreciate you joining us. On what's brewing today, planning an international holiday often means juggling multiple websites, comparing prices, chasing travel agents, and hoping everything goes as planned. But what if AI could become your personal travel planner from discovery to booking and even while you're on the trip? Betting on that opportunity is 30 Sundays, an AI-native travel platform that has just raised 61 crore rupees in a Series A round led by Bessemer Venture Partners. Joining me now is Kshitij Chaudhary, the co-founder and CEO of 30 Sundays. Kshitij, welcome to Startup Street. The online travel market is already crowded with players like MakeMyTrip, Booking.com, Agoda, and even AI assistants that are helping travelers plan trips. So how is your business model different? And I understand you call yourself an AI native travel platform rather than an online travel agency. But tell me, what's your tech edge? And if you could also take me through the fund deployment plans.
Sure, Shruti. First of all, thanks a lot for having me here today. So when we talk about the travel market, it consists of two kinds of customers. One is the do it for me traveler, and the other is the do it yourself, do it myself or you do it yourself kind of traveler. So the overcrowding is more for the do it yourself segment where most of the OTAs are playing. This segment is okay booking their hotels from different platforms, their flights on different platforms, and that is where MMT, Agoda, and a lot of these players are playing. We serve the do it for me traveler. This customer still goes to the travel agent. He wants everything in one place. He wants, the planning, the bookings, and the customer support at one place. For him, no one has really built a great product. So we do that, where he can plan his itinerary at one place, have all the bookings at one place, and get the customer support also at one place.
All right.
Yeah.
Your
And in
fund
terms of
deployment plans, yes.
Absolutely. So largely we are going to deploy funds in three areas. One is, building a better brand and on the marketing side. The second is just expansion. So right now we cater to couples. So we want to expand to more segments and more geographies. And finally, we're also investing in our product and tech teams to build even better technology for our customers.
Okay. Picking up from what you just said, Kshitij, one interesting strategy is your focus on couples before expanding to families. Why start with such a narrow customer segment, and does building a vertical AI product for a specific traveler profile improve customer acquisition economics?
Absolutely. So this actually came through a very interesting insight. We saw that, younger couples are very active on Instagram. They see these newer experiences, unique experiences in hotels out there, and then they want to go there. But the traditional travel agents still provide the fixed tours and activities that they have been, providing for years and are not able to cater to this segment. So we decided to just, take one segment. It's, what Amazon did with books and build really good, product for this segment and very good experience. So, we now contract a lot of romantic hotels experiences for this segment. And the acquisition economics are definitely better because literally there is no competition in this segment now. We've built the best, experience for this segment.
All right. And, Kshitij, in just 2 years, you've reached an annualized gross booking value run rate of around 200 crore rupees while operating profitably and focusing on just 4 destinations. What has driven that growth? And can you share current revenue, repeat customer and profitability metrics?
Sure. So let me disclose the numbers I can disclose today. So we're doing about 200 CR kind of GBV. We have a 10% kind of take rate. So this takes our annualized revenue to close to 20 CR. Today, around 30% of our customers come from our organic efforts and 15% through repeat and referrals. We are CM, in terms of economics, we are CM3 positive, which means that, our take rate, that 10% take rate is able to cover our marketing, sales, and, any operations customer support costs. So at an operational level, we are profitable.
Okay.
In terms of, what has driven this growth, I think, the strategy to focus on one segment has really helped us. It has helped us, build a very good offering and product for this segment. And, then we have been able to penetrate this segment really fast.
Okay. All right. Travel is one category where trust matters enormously. Kshitij, customers are spending lakhs on international holidays and often prefer speaking to a human. So how do you strike the right balance between AI automation and human intervention? And what will truly differentiate winners in travel? Will it be access to inventory, better AI, stronger brands, or simply superior customer experience?
So you've asked 2 questions there, but the answer to both of them is superior customer experience.
Okay.
At 30 Sundays, when we look, when we think about where should we use, humans, where should we use AI automation, we largely, decide basis what will lead to a superior experience.
Okay.
So, for example, if the customer is anxious about making a payment or, he's confused between 2 choices, that is the right time to, make him speak with an expert.
Okay.
However, if the customer, wants to finalize an itinerary which has, which has to be sort of selected from hundreds of hotels and experiences and match his preferences, AI does a much better job because it is able to sift through a lot of hotels experiences faster and, then recommend the best itinerary.
Okay.
That's how we decide. And in terms of, what will really differentiate, again, it is, the companies which build the best experience, will really themselves.
All right.
Yeah.
Sure,
So
that's what you're planning to do. So, India's outbound leisure travel market, Kshitij, is estimated at around $25 billion and continues to grow rapidly. Beyond destinations like Bali, Vietnam, Maldives, and Thailand, you've already launched New Zealand and Mauritius with more markets on the roadmap. So, how quickly do you plan to expand, and what's your long-term ambition?
So in June we did about 17 CR kind of monthly business, which is a GBV. We plan to double that by March. In terms of destinations, so we would take that to about 35. In terms of destinations, you would see that mostly we have winter destinations.
Sure.
So we would add a few summer destinations to the mix by December and launch them early next year. So we would have about 10 destinations by March next year.
All right, before I let you go, I have to ask, why 30 Sundays? How does it reflect your philosophy of travel?
Sure. So we are a couples focused company and we advise couples to do 30 days of vacation in a year so that, they can tolerate each other. And every day on a vacation feels like a Sunday. That's why 30 Sundays.
All right, on that note, it's time for me to wrap up our conversation. Many thanks, Kshitij, for joining us on Startup Street, and wish you the very best for your growth plans.
Thank you. Thanks a lot for having me.
And moving on, the global fashion industry is under pressure to deliver faster, cut costs, and build more resilient supply chains. But much of the apparel manufacturing ecosystem still runs on fragmented manual processes. One Indian startup believes artificial intelligence can change that. Groyo has raised 90 crore rupees in a Series B funding round to expand its AI-driven platform that connects global brands with manufacturers while helping digitize the entire design-to-delivery process. Joining us now are the co-founder of Groyo, Subin Mitra, and Vatsal Bhavishi, partner at Cornerstone Ventures. Gentlemen, thank you so much for taking time out and being here with us on Startup Street. Subin, let me start with you, right? You've raised this 90 crore rupees in the first close of your 200 crore rupee Series B round. What sort of convinced investors like Cornerstone to sort of back Groyo at this stage? And where will this capital sort of create the biggest impact over the next 12 to 18 months? Take us through how you plan to spend these funds.
First of all, thank you for having us, Arundhati, and I'm sure Vatsal can add a bit to that. But I think largely in 2-3 areas, right? I think over the last couple of years, the team has worked very hard to have a lot of the largest brands in the ecosystem as partners to us, especially across the UK, the European Union, and the US, right? In a nutshell, fast fashion is getting faster. And what that means is the supply chain needs to be even more tech-enabled, even more agile, and a lot more competitive, right? So that is going to be the first and foremost mandate for us, that how can we support our existing customers better? How can we go deeper with them? And how can we enable more and more of the SMEs we work with in India to take their business global, right? An aspect of that is also going to be on the tech stack, right? So technology has started playing an even more important role for the fashion industry. We have built 2 tools, one on the factory side, which we use to digitize supply operations, and second, where we leverage AI to curate designs for brands in real time. So going deeper in that and making those tools more robust so that we can make this otherwise opaque supply chain a little faster. These will be the 2 large focus areas.
Absolutely. And you've guided for a revenue run rate of 500 crore rupees in FY26, and you're targeting over 3,000 crore rupees within the next 3 years, right? What gives you that confidence to sort of scale 6-fold, and what are the biggest execution risks that you face?
So FY26 is an actual now. I think what gives us that comfort is, adding to my point, that a lot of these customers are already procuring north of 1,000 crores from India, right? They are actively looking for a solution which is not only fast, nimble, and agile, but also brings in an element of tech. We've gone after the more tail end of supply, which is difficult to work with, which is difficult to control. And we've built that supply chain capability. And having that supply chain with this cohort of customers gives us the confidence that we can get to that kind of a projection in the next 2-3 years.
Absolutely. Vatsal, let me bring you into the conversation. You've led Groyo Series B at a time when venture funding remains pretty selective, right? What sort of gave you the conviction to back the company, and what differentiated it from other B2B commerce and manufacturing tech startups?
No, thanks. Thanks for having me, first of all. This was a classic recipe in terms of investable business, that it has a massive scale opportunity. There is a significant fragmentation in the supply side of this value chain. And it's a business that can really be streamlined using technology and a tech-enabled platform. And we see Pratik and Subin and the team really having that execution prowess to be able to scale a business like this. So that gave us the confidence that yes, there is a massive opportunity that can really be solved using technology, and the team that brings the right kind of execution capability to bring all of this together. And that's how we ended up investing in Groyo. The key differentiator we see in this company vis-a-vis a lot of other competitors is the way they have executed on the entire plan. Going after the right kind of customers, not compromising on margins at any point in time, trying to solve a problem with technology first and then kind of putting more people behind it, and at any point in time, keeping their business first. So those are things that really have helped them scale to this level in a very short span of time. And we've
Absolutely.
seen them, even with scale, they haven't really, lost sight of the business.
Sure. Absolutely. And Subin, you now work with over 470 manufacturers across 10 countries and 45 global brands, right? As you sort of scale further to achieve all your targets, how do you sort of ensure quality compliance and on-time delivery across such a large supplier network?
All three of these are critical factors in our business. Which is why I think for all three of these, we have had to go in-house and build in-house capabilities, right? Capabilities both from a team point of view. So all of these are in-house teams for us, processes, and even internal tech tools which help us monitor quality, monitor on-time shipment rates in real time, and give that visibility to our customers as well, because we understand this is sacrosanct. When a very large global customer is trusting us, it is critical, not just for us, but also Indian manufacturing as a whole, that we don't falter. And that's an area we have spent a lot of bandwidth on over the last 5 years.
Absolutely. And, Vatsal, Groyo is positioning itself as an AI-powered operating system for fashion manufacturing rather than just a sourcing marketplace, right? How important was that technology moat in your investment decision? And where do you sort of see AI creating the biggest value in industrial supply chains?
So we don't see AI as a full moat as such, but we more look at it more as an enabler in this business, and someone who can really leverage AI to improve efficiency, to bring in more designs, trends, tie all of that in together. There is a bit of AI that we are also using at the factories to streamline their operations, to bring in more visibility, quality control, etc. So tying all of this together to create a seamless workflow is something that actually brings in moat, not a single pinpoint solution. And that is where Groyo has really been able to build this kind of technology. It needed a lot of data to be also to be able to bring AI up to a level where it can meaningfully add value. So we've seen some of these things working. There's a lot of things that are still work in progress, but there is a plan. We have confidence that this is something that the team will definitely execute on. And this is really what will enable unlocking a lot of inefficiencies in the entire value chain and create value for all the stakeholders in the ecosystem.
Absolutely. And Subin, if you could quickly tell us in 30 seconds, like fashion supply chains are notoriously fragmented, right? Beyond being a sourcing marketplace, what is Groyo's moat? Why would a global brand or manufacturer find it difficult to sort of switch away from your platform?
So for a global manufacturer today, the mandate is not just to procure in 30 days or to procure 500 pieces in SKU. The mandate is to also ensure that that supply chain is sustainable, that they have visibility on that supply chain, and it is as foolproof as possible, right? For the brand, we become not just an AI first tech solution, but a multi-country, multi-category one-stop shop where we manage everything from design to delivery. And they just tell us that we need this product, we need it at this price, we need it delivered in London at this date, right? And the entire backend is managed by Groyo, and they get 100% visibility on that supply chain. That experience is very difficult to replicate for any customer, whether if they work with any other offline player. And that, I think, is what really makes them stick with us and grow their business with us.
Absolutely. All right, Vatsal and Subin, thank you so much for taking time out and being here with us on Startup Street today.
Thank you so much, Anu.
Thank you.
Well, with that, it's time for us to head into a short break. But coming up, Temasek is on track to meet India deployment target of $10 billion, says Ravi Lamba, the company's India head. A special conversation on the other side. Stay tuned.
Artificial intelligence is rapidly becoming the defining investment theme for global capital, and Temasek is among the investors that's putting the biggest numbers behind that conviction. The Singapore investment giant now wants to more than double its AI exposure to as much as 15% of its portfolio in the next 5 years, betting across the entire AI value chain. But what does that mean for India? Where does Temasek see the next opportunities here? And how importantly is it navigating an increasingly uncertain global environment? To answer all of that and more, joining us now is Ravi Lamba, the head of strategic initiatives and the head of India at Temasek. Well, your review also talks about this turning point for the global order. There's tariffs, there's protectionism, there's geopolitical fragmentation. All of that is reshaping capital flows. Again, today you had, comments from Donald Trump on pharma and whatnot. How is that changing the way you think about investing today versus what you do in terms of allocating capital 2 years ago? How are you ring-fencing your portfolio?
So as an investment house, we do not allocate by sector or geography. We are agnostic. We are very bottom-up driven for opportunities. And frankly, all these factors that you say, we will factor that into our investment underwriting thesis. So a tariff, for example, is another cost element that we will add, just like we'll add other costs. It could be raw material, it could be anything. So we look at these as inputs to our investment process. We are very long-term in our investment orientation, and we look at it over the long term. And frankly, if you get the cost structure right, whatever it contains, you underwrite the value accordingly. And that's how we look at it, Ritu. There's nothing specific that we draw from the current thing. We simply make sure that we are able to the best of our ability, to capture what it takes to understand the value of a company before we invest. And we're driven by intrinsic value when we think about investing and exiting. So that's the test that drives us.
All right. So essentially no change in strategy on account of this uncertainty we're seeing globally. So let's get to India then. I mean, India has been one of your strongest performing markets in the last decade. And still the share of your global portfolio, here has eased from 7% to 8%. Simply currency and portfolio mathematics, or valuations here are making it harder for you to find attractive opportunities? What's happening here?
Sure. Let me give you some perspective on that. I think firstly, we had said a few years ago that we would try to deploy between $9 to $10 billion in India over the next 3 years, and we're on track. I'm happy to report that in the last 3 years we've deployed close to $9 billion, and it's not like we're slowing down. We are happy to keep looking for opportunities and deploy more capital. What happened last year was actually quite specific. We were approximately $50 billion US in exposure to India in 2024-25. In 25-26, we had two events. One was the exit of our investment in Schneider, India, which was north of $6 billion, and then there was of course some sell down by Singapore Telecom of their stake in Airtel. I think they sold close to 2.7 billion, of which we account for about 50%. So if you add those two up, there was those are the two main reasons why the sort of close to 50 billion has come down to about 42, and the 7% is simply just an outcome. We don't manage the portfolio by country or sector. We're driven bottom up, and that just so happens to be the percentage. From our perspective, we keep looking forward to deploy what we said we would, and if opportunity presents itself, we can even deploy more than what we said in India, because we like the thematic. India has been a great performing market for us despite all the headwinds we've seen on the currency, and we're very happy with our portfolio performance in India.
Well, I was just zooming into India then, because India has been one of your strongest performing markets in the last decade, but still its share has eased a bit from 8% to 7% now. Is that simply because of what's happening on the currency front, or are valuations here making it harder for you to find attractive opportunities?
I mean, given what we own today, we would like to double down on what we own firstly. So, we own stakes in financial services, in healthcare, in consumer, in industrial. So I think those are all great sectors, and we will keep finding more investments in that. And we'll keep finding, and we'll keep peeling the onion. So what I mean by that is, we first started investing in banks and financial services. Then we moved that to investing in insurance, and then we moved into asset management. We did some fintech. So in that sort of journey, we will keep putting more capital in these sectors that we understand well and we believe play very well to India's thematic and India's growth. Healthcare services is something we like a lot. We have several investments in India. We have investments in Manipal, in Medanta, in Dr. Agarwal's, in Cloud9, as for example. We have investments in some pharma businesses. We have investments in some consumer businesses. We took a stake in Haldiram because last year because we see a significant growth in that sector, and we'll find more opportunities in that sector as well, because we think investing behind great brands that can serve a 430 million and growing middle class, where where the ability to spend is increasing, is a very good place for us to be. It plays very well to our thematic.
Thanks very much, Ravi, for taking the time out to speak with us. Always a pleasure having you here.
Thank you. Thanks, Ritu. Good talking to you.
Welcome back, everybody. Berkshire Hathaway now holds a more than $31 billion stake in Alphabet. That's a position that the conglomerate started to build in the third quarter of 2025, but it really ramped up this year after Greg Abel took over as CEO of Berkshire. In fact, just last month, it added $10 billion as part of a private stock purchase of those Alphabet shares. Now, there's been a lot of speculation as to who decided to purchase those shares, with many pointing to the stake as a sign of how Greg Abel will be putting his mark on the Berkshire portfolio. I asked Buffett whose idea it was to buy the tech giant.
I initiated it. I mean, I normally wouldn't give you an answer on something like that, but I will, because I am not doing anything that he doesn't approve of. He's not doing anything I don't approve of. We talk all the time. He's well, every day. I mean, but he is the decider. And getting back to Alphabet or Google, it's probably number 5 or 6.
Well, I thought it was number 3 if you consider the $10 billion private placement that would go along with that, because that would put it north of $31 billion.
Yeah, but we've got the Burlington Northern Railroad, which is certainly worth far more money than that.
So you're counting fully
Absolutely,
owned companies as well.
You know, I mean, we are always making the choice between whether we'll buy marketable securities or the company. We look at them the same way. There are some minor exceptions to that. We can't set dividend policy, for example, if we don't own it. But the chances of those being material, the important thing is to buy a good business and to buy it on the right terms, and they get a right person to run it.
Okay, let me ask you though. Forever, people have thought of you as somebody who doesn't invest in technology. And by the way, you've described yourself as somebody who doesn't invest in technology. Obviously, the biggest position in the Berkshire portfolio is Apple, a position that you put on, but at the time you called that a consumer company. Google, you just called an AI company. So what happened?
Google, the real question with Google and all of its competitors now, because they're all laying out hundreds of billions. I mean,
they're big capex spenders.
So,
the biggest.
yeah, and that's real money. I mean, if our railroad were to lay out 300 million or billion or 200 billion, you know, that kind of money wasn't even put in the railroad business, you know, in terms of developing it. So, and that's the game they're playing now. They weren't playing that game with computer software.
No, so when they were asset light, you didn't like them, and the markets loved them. Now that they are
I made a mistake.
Spending heavily on capex, a lot of shareholders don't like them as much because they don't.
I think they're more likely to be a winner based on the record than probably 90% or 95% of what gets merchandised through Wall Street, because Wall Street is interested in whether they can sell something. And I can't recall a report on Wall Street that really gets into the internal rates of return that a business is actually earning. What's more important than what a business is earning? But they ask all these questions about what will happen next quarter, or you know, it's just, it's ridiculous. But you know, investing is coming up with, well, probably there's close to the most successful long-term investor was Rockefeller, but look at what oil and gas has done over 150 or a couple of hundred years. So he kept compounding at a very good rate, not as good a rate as Geico would have achieved in his early years, because it's easier to do when you're small. Getting to do it when you're large is, you got the whole world looking at you, trying to figure out, you know, how come those guys are doing it, we're not doing it.
Why do you like Alphabet above all others, and what made you initiate this position? What was the eureka moment?
I would say that I don't like it as well as at least 4 or 5 other businesses that we own.
They say you can't teach an old dog new tricks, but that Google acquisition is proof that at age 95, Buffett is still evolving and changing his thoughts on businesses. We also talked about Berkshire's largest portfolio holding, Apple, and what he thinks of the company now that Tim Cook is leaving and John Ternus is taking over as CEO.
There's no move they could make that would replace Tim that I would have liked. Net. I mean, if you got somebody, Stradivarius playing the violin for you, yeah. I mean, don't spend the next 300 years looking for another one. I mean, you've got one already, and of course, Wall Street thrives on the idea that convincing you that if you just listen to them, they've got something that nobody else has. Well, which can't be true. I mean, it's ridiculous. But it works because, well, in general it works because America has been a wonderful place to invest money. And the Dow Industrials, when I bought my first stock, had just crossed 100, and now it's 52,000 or something, and you've got dividends in between and all kinds. Well, I mean, the village idiot could have made it from that point forward. And so I've been in the right game. If I'd been in wheat speculation, I mean, wheat's gone from, you know, I don't know whether it's gone from $3 to $5 or something over 200 years. And it's a very simple business, as long as you keep remembering that it's simple and that making it complicated can well, it's just crazy. At that point, you're gambling.
But do you still like Apple?
People's enthusiasm for gambling is enormous.
You've talked about that over the last many years, probably since COVID. But you still like Apple. Back to the point.
Yeah. And I know more about Apple than I knew many years ago. But on the other hand, if you're Apple, you've got very, very smart people all over the world shooting and trying to figure out how to make sure that Apple's future, the future, is as bright as it is in the past. And look at the car companies. I mean, Henry Ford owned the car business for 20 or 25 years, and he brutally integrated like you cannot believe it. He drove costs down. He got the cost of Model T down, I think, to $285, and he always was decreasing prices while increasing wages.
Right.
So but he also was a little nuts in some ways, and that did him in. Finally, when he converted over to the Model A, and General Motors just came racing by, and my friend Charlie Munger thought that General Motors was going to be the dominant company. Who could imagine attacking their dealer fleet and everything they had going for them? And you know, you've always got somebody shooting at you.
To that point, Apple brought a lawsuit against OpenAI just last week, and basically accused OpenAI of trying to steal trade secrets.
I would say most companies would love to try to steal trade secrets. They wouldn't love getting caught. But if you really could dig deep into the hearts of managers, they'd like to steal secrets. Wouldn't you? I mean, if you had a business and you were struggling along, and the guy next door was making money, I had a half interest in a Sinclair filling station at 30th and Reddy in Omaha when I was in my early 20s, and I'd been to business school and knew all these things. And the guy next door had the Phillips station, and he was pumping 30,000 gallons a month, and we were pumping 15,000 gallons a month. So I said, we're going to wipe this guy off the face of the earth. And you know, a couple of years later, we were selling 15,000, and he was selling 30,000, and we gave up, and we closed up, and I think he's still operating.
As you know, Warren Buffett has made a practice of not making calls on where he thinks the market is heading, but he does have a pretty unique view into consumer and enterprise behavior, and I asked him if the markets right now make sense to him.
I think there are times when opportunities are just thrown at you so fast you can't, you know, it's unbelievable. And then there's other times when you're very, very lucky if you find one thing in a couple of years. And it should always be that the latter is what prevails. But since humans love to gamble so much, there's more money in actually cultivating gamblers than there are cultivating investors. If somebody bought Berkshire 40 years, 50 years ago, a guy would have made one commission. and he should spend the rest of his time telling the client, don't do anything with it. And that's just not the way. We can't expect that of humans. But every now and then you do find people that I mean, you find people who behave far better than other people.
Fair to say, though, it's tougher to find values or find
It's
cheap
tough to find
opportunities?
values when everybody is preferring gambling.
Yeah.
And from the standpoint of the state, we may have discussed this, but from the standpoint of the state, it's sort of disgusting because the state needs money for all kinds of things, roads, schools, you name it. And they have found that they can clip people who are buying nothing but hope, selling them a payout, something with a payout ratio of 60% or something like that. And if they weren't doing that, they'd have to have the income tax higher.
Right.
It's a cynical sort of activity, and I think the less you get cynicism between the governing body and the people of government, you don't want people to be cynical about their system. But there's times when the system says, just be as cynical as you want because this is what I'm going to do, baby.
Federal Reserve Chairman Kevin Warsh will head to the Hill once again today, testifying this time before the Senate Banking Committee. With so many questions as to how the Fed changes under his leadership and where interest rates will go, I asked Warren Buffett about his thoughts on the new Fed chair.
I don't know what he'll do, but I would say that that job is so complicated. I think the other day he was quoted as saying, that they have 950 economists when they could use about 10. I admire him for taking on the job. I think he will do the best he can at achieving the job he was assigned to do, which is, 2% inflation and while maintaining maximum employment. And my guess is that just like some of the others that have preceded him, not all of them, but he would read that every morning.
The dual mandate of the Fed.
The dual mandate. Yeah. And he doesn't, he knows he can't be perfect at it. And just like I know I couldn't be perfect at taking people's money and earning super returns on it. Mm-hmm. But my guess is that people were right in realizing that I cared about what happened to their money. Mm-hmm. And I would say that Warsh he cares about the country. Okay. And I think that's been true of a good many. It doesn't mean their decisions are always great, but because sometimes the decisions are so tough. I mean, imagine Paul Volcker getting, death threats all the time, and others just think they know more than they do.
But you think Kevin knows a lot and is a...
I think he's a very, I think he was a good choice.
Okay.
Which probably means the president will be mad. Future presidents will be mad at him because future presidents are looking at the next election, and he's not supposed to be looking at the next election.
Gentlemen, we brought you the news here yesterday that Warren Buffett has made his annual donations, and this year, for the first time in 21 years, that list does not include the Gates Foundation. I sat down with Buffett to discuss his current relationship with Bill Gates, how he came to the decision to cut the foundation from his giving plan this year, and whether that is a permanent decision, meaning that the Gates Foundation will no longer ever get any more money from Warren Buffett.
That's correct. But in interpreting that, I would point out that I've read a great deal since January 1st in terms of what happened with Bill and Epstein. And I've read his remarks to Congress given under oath. And I read cross-examination. And while it's distasteful, and while he made mistakes, I made mistakes in hiring all kinds of people or choosing friends and then finding out later that one way or another they weren't what I thought they were. And so I found nothing in there that was beyond what I could see, I could picture myself doing, and he ended it, and I've had situations where I made mistakes about people, or people felt I made mistakes about me, but life goes on, and no one bats 1,000 in the business of choosing people.
You're talking about hiring decisions, maybe who you're associating yourself with, and there were certainly some questionable decisions on that came up in the release of these files. But there was also other, personal information.
Yeah, which he admitted to.
Yeah.
Yeah. No, and there again, I would say that, I've known some pretty wonderful people, and I still know some wonderful people. I don't think they've made every decision correctly.
So why, if that's your opinion on it, why are you no longer giving money to the Gates Foundation?
I reevaluated my whole situation. It's just like I've been doing since I was in my 20s, and we'd gotten married, Susie and I, and we didn't really have any money, but we did know that we intended to live fine, and we intended to have a family, and but we did not have aspirations of, having 6 houses or a 500-foot yacht or anything of the sort. So even then, we talked about what we would do philanthropically. But my idea and conviction was that I would compound money at a better rate than society generally, and that Susie would give it away better than 99.9% of the people that were giving it away, and she would get involved personally with the gifts, whereas I like to do things wholesale, and she liked to do things retail. So we had a plan, but we didn't have any money.
Why did you change your plans?
Well, we changed plans because of what I've said out here. The money began to pile up.
No, but you changed your plan now. In 2024, you said it was a lifetime pledge to the Gates Foundation. Now in 2026, you were saying that's not the case. What happened?
Yeah. Well, what happened was that I gave the Gates Foundation a great deal of money.
Maybe $47 billion in total.
And I had no, and I thought that was a good decision. I think it was a decent decision. But I did not think my kids were in any way ready to give away vast sums of money. We'd started, Susie and I started with them. I think we may have given them $100,000 each.
This goes back 30 years at this point, or longer?
That's about right, yeah. But they were growing children. I mean, they had children of their own by that time. But still, I don't think they were ready for it.
So then is it fair to say 20 years ago in 2006, when you made this decision, you trusted the Gates Foundation more than your children, and now you trust your children more than the Gates Foundation?
No, because the amounts were different. It isn't to say that I trusted them differently, but I felt they were capable of handling it. I was certainly not going to turn something over to my kids and then pull it back from them. I mean, and the Gates Foundation has turned out to earn far more money than they expected to do. They spend more money than anybody in the world that I can think of.
Yeah, they have an endowment of north of $90 billion, I think, at this point.
It's around that figure, and Bill has very substantial resources outside, which he intends to give, and I believe 100%. I believe that they will go there, and I've really done the same thing as Bill in a certain sense. Except when I put it in, I tell the 3 children that it is theirs and it's their responsibility to get it done well. And you may find this hard to believe, but it's true. I've never looked at their Form 990s, which they file. I'm not judging each action as it takes place, because you take actions where you think there's only a 10% or 20% probability of success. It's not like investments.
He is donating $6 billion this year to 4 of his family's foundations. In the announcement, he also said that he is expediting the rate at which he plans to disperse his fortune, shifting the timeline from 10 years after his death to a little over 8 years from right now, by the end of 2034. I asked him what changed his mind and what those implications of his decision mean.
Well, it certainly means that I had 2 purposes in all the philanthropy, and particularly with essentially 100% of my money in Berkshire. that's my painting, and I like the painting. I like the people associated with it, and it's been refined over time. I've added an apple over here or something, and I don't know of 10 people in the United States that I would trust to hand it over to.
Your company. You're talking your company.
The company.
Right.
I don't know of 5 people, and I know a lot of people. and now I have a very high standard in terms of what I'm looking for in that person. And clearly we've found him with Greg Abel. So, and that becomes more evident by the day. Even this year, there's been added things that.
So you don't think you need to hold on to the shares or have your family have voting power over those shares for as long because you think Greg Abel is...
He is the choice. The only question is he's not immortal either. Right. You always have this mortality question, and nobody gets away from it. People can be in marvelous health or seem like it, and, who died the other day? Lindsey Graham, 71 or something. So there's an enormous variety and variation from being lucky to not being lucky, and that's the bet I make with Greg. I do not have a list of 10. I don't have 10 kids either, but even I don't have a list of 3.
In terms of who you would trust the company to at this point.
Yeah.
Right.
Now I've got directors that I trust to be imbued with they like the concept of Berkshire Hathaway, and they would like to keep it going. So I've got the right group that's the intermediary in making that choice.
Well, this is Sri Harikota, India's physical gateway to our space ambitions. So we are coming to you, and behind me, as you can see, is Vikram 1, which is the rocket which is ready to go up into space. The reason it is special is because it is the first orbital rocket which has been developed by a private company. The company, of course, which is doing this is Crude Aerospace. It's, by the way, also a unicorn. The private space industry is really taken off over the last couple of years or so. Remember, Skyroot has sent a rocket up before late 2022. Vikram S was the name of that rocket, but that was a suborbital rocket which was sent up. It went into space and, of course, then came back. This will put a satellite into orbit. The mission name is interesting. It's called Mission Agman. Essentially, it means arrival, and I think what it suggests is the arrival of the private sector as far as the Indian space industry is concerned, which, of course, so far has been nurtured meticulously over the last over 40 years by the agency ISRO. That's a government agency. This is a special moment. We've done deep dives before as far as the private sector efforts in the space industry is concerned. We've had companies from the sector on the program on CNBC TV 18 before as well. But I think this is really putting, testing whether, and I think the mission name is pretty apt. This is the success of this particular rocket will really truly, mark the arrival of the private sector in what is, the frontier of technology, which is, of course, space in that sense. The industry, of course, so far is small. There are a few companies, as I said, but of course, it's fast expanding. Private capital no longer a problem. And I think Skyroot, of course, has shown that and has been in the frontier, as I said, a unicorn, the first private unicorn. All of this, of course, in the backdrop of the giant SpaceX IPO, which has recently happened, putting it right up there as one of the most valuable companies in the world, and making Elon Musk, of course, he's been the space poster boy, but I think it really put the spotlight on what is possible right at the edge and the frontier of technology, the last frontier, some would call it, which is, of course, space. So, lots to report from here, but those visuals are important, and I think they're historic as well. From Sri Harikota here, from the launch pad of Vikram 1, this is Prashant Nair for CNBC TV 18. welcome to this special program. We are here at Sriharikota, which is basically India's physical gateway to all space ambitions out of this country. ISRO, of course, has led it, has nurtured the space program in India over the last 40 plus years, and it's entering an exciting new phase. So far, it's all been government-led, but the private sector is coming in thick and fast. And one of the companies right at the forefront of all of this is Crude. By the way, Crude, for those of you who don't know, is already a billion-dollar company. It's a unicorn in the space. I mean, if I can use that phraseology. And it's an exciting time because they're also launching their first, and actually it is not just Crude's first sort of rocket, which will put a satellite into orbit, but it is the first private rocket capable of putting a satellite into orbit. And with me today to talk about this exciting new phase is Pawan Kumar Chanda. He's the co-founder at Crude Aerospace. Pawan, great to have you with us here. Thank you very much.
Wonderful to have you.
Exciting time?
Exciting time.
How exciting? Nervous, exciting, exciting.
So every rocket launch is very unpredictable. So it's definitely nervous, exciting. But I think it's been years of effort, all coming together in culmination in a launch, right? So I'm personally very, very excited for this launch.
I'm just curious to understand what are you thinking? I mean, are you thinking about the minutiae, about wo sahi kiya kya, ye sahi kiya kya, that kind of stuff, or is it the bigger stuff?
No, definitely. This is the smallest things which go wrong in a rocket launch.
Right.
So I always say like zillion things which can go wrong, and typically mostly the smallest minute things are the ones which go wrong. Always in the mind it goes on like what could potentially go wrong. What can we do better? Even in the last minute, even if few hours to launch, still what best we can do, what better we can do, what else we can take care of, right? So this is all in the mind in the last few days, and it's very exciting. And also like you need to be at the best of the, have a sharp mind, focused mind in the last few days.
Yeah, I mean anything which is top of mind. I mean, you must have studied global sort of experience, and you've got ISRO in that sense backing you, and we're here at this Sriharikota facility of ISRO.
Yeah.
So you got that sort of backing, support, whatever, right?
Yeah.
Mentorship, guidance, anything top of mind in that sense?
Yeah, I think, so definitely I think we did our best of whatever we could do for building a rocket, getting onto the launch pad itself is a phenomenal milestone. No private company in India has ever designed, developed a rocket which can put a satellite into orbit and took it to the launch pad ready for a launch. Right? So this itself is of a very large international milestone in itself. And first time in the country.
How tough is it going from suborbital to orbital?
Oh, it's probably like, order of magnitude more difficult.
Okay.
Because the rocket is far bigger.
Okay.
It has multiple stages. Okay. The suborbital was a single stage.
Okay.
And there's so many things which need to come right. The energy is, the rocket is more. So, and the size is big, and it's probably, very few companies in the world actually launched an orbital rocket.
And this is all made in India, made by Crude. Of course, I mean, vendors and the supply chain, but all here.
Yeah, everything. This is like 100% designed in India, 100% manufactured in India, and more than 90% sourced within India. So it's a purely indigenous
But 90% value-wise, or
by value?
By value.
Yes. Yeah.
Okay. I mean, things like propulsion systems, etc.
Everything in the house. Everything built.
Because
in
you
India.
read about it, and you kind of what you learn is it's mostly done by US and European companies, etc. But I mean, so that's a big deal.
That's right. Yeah. So see, any advanced technology, many advanced technologies in India, so we believe that they come from abroad, right? So, but I think space is something which ISRO has proven. They've built a lot of indigenous tech already.
Yeah.
And I think we have built everything from scratch.
Yeah.
And we built indigenous technology from in fact completely built in India. A rocket is going to launch soon. So it's very rare that a very deep tech product or service from India, is fully indigenously built. And Vikram 1 rocket.
So when you think of AI, for the last couple of years, 2 or 3 years, we instantly think of a ChatGPT, Gemini, and Claude. And we wonder which is the better model, which is the more efficient model, now perhaps the more cost-efficient one. But AI is so much more than that. The next chapter of AI perhaps is not about the smarter model, but the infrastructure that builds it. We're talking about GPUs, data center, edge inference. And I think the country that builds this physical foundation will have that competitive edge. So I think our job for the next 30 minutes is, can India really become an AI infrastructure powerhouse? What does it take? What are our competitive strengths? Where are we missing? So Sunil, let me begin with you. We're calling this an AI infrastructure supercycle. Is it really just a catchy phrase? Or are we at the cusp of something very revolutionary? Say what the software industry did to India in the 1990s. It catapulted India, middle-class jobs were created. Or is it something similar to the internet revolution? Why are we calling this?
I think the software revolution came just 3 decades back, and internet revolution also came almost at the same time. But before that, we had electricity revolution, we had an industrial revolution, and we had got agricultural revolution before that. This is a new industrial revolution. You can call it 4.0, 5.0, whatever. But this possibly is the biggest revolution mankind has seen for over multiple decades. And if AI is percolating our personal lives and professional lives across industries, the fundamental infrastructure to build that, to host that, to train those AI models, to use those AI models for various use cases in our lives becomes fundamentally important. More than that, I would say that given the nature of the technology, given the implications of the technology where your own data is being used to train the model, it's like your raw material is being used to create an IP, and that IP in turn will be monetized to again give value to you. So it's very, very important considering the geopolitical situations where it is not just enough for India to again become a consumer of technology, but to become a builder of technology. Besides that, we need to build infrastructure. It's important we build this infrastructure of AI in India so that we use our own data in our own cultural context. We train our own sovereign models. We train our own agents and our own use cases, which are specifically for the needs of our own citizens. So the IP of our data should be built by us in India, and underlying that, the infrastructure for that, the GPUs, the data centers, have to be built here in India. It is not a fad. It is real. It is being built as we speak now.
But Sharad, why now? Data centers have been around for decades. Yota's been in the business for the last 3 decades, SIFI for 25 years. Why are we having the conversation right now?
It's mainly because to support the kind of a scale and the kind of transformation Sunil talked about. We are really in the phase where, just to take it from the sovereignty angle, where the data is being used to train and give us the intelligence, we are in the phase where we need to be talking about the intellectual sovereignty. And for that intellectual sovereignty, the infrastructure should be prepared for that. And it's scaling in a big, big, big manner. In last 30 years, the way I have seen the way the things transformed, in 2000, we were preparing the data center infrastructure to scale internet, to scale the enterprise network, to connect the enterprises and deliver to them the virtual private network. In 2005, we were enabling enterprises to implement their ERP solutions. We were helping them automate their systems. Around 2010, we were helping with the big analytics, data analytics, and the digital transformation. In 2015, we were trying to do the cloud implementation and cloud transformation, public cloud implementation that is now hyperscale. It has kept growing and scaling, and now it has reached to a level where the time to scale has consistently, time to double has consistently changed. And now, because it's changing so fast, it's doubling so fast, it is important that it is now the time.
Now is the time for India. So, gentlemen, if India has to truly become an AI infrastructure powerhouse in the next 5 years, what is the bottleneck? If I could get one answer from each of you. Ankush?
I think it's just the courage of doing whatever we believe in doing. And we have the infrastructure, we have the technology. And it's enough of technology to really change the word, to say so, or to really solve the problems of humanity and the businesses. It's just, I think we all have to come forward and do it.
Courage.
Yeah.
Okay. Sharad?
I would say the infrastructure.
In terms of?
Ability to execute and build the infrastructure fastest possible manner. So I would say speed.
The biggest bottleneck, the constraint?
Let me give a little detailed answer of this, and let me decipher this whole AI infrastructure and the AI stack for everybody. If you have heard Jensen Huang of NVIDIA speaking about it, he keeps on talking about the whole AI cake. And that cake consists of multiple layers. At the bottom layer is essentially data center. And data center is nothing but a physical building with lots of power, lots of cooling. That is where the IT equipment is hosted. Earlier, we were hosting CPU-based servers for regular applications. Now we are hosting GPU-based servers, which consume obviously too much of power and obviously require too much of cooling. So that is the physical infrastructure which you require to train AI models, and obviously after that do the inferencing on the model. That is the infrastructure piece. And of course, energy piece comes by default as a part of that because you require megawatts and megawatts of power to support that infrastructure. On the top of that is what you are creating is models. You use raw data, like assume you have taken the whole data of the internet, scrapped the whole internet, and then put into machines, and the machine use some algorithms to train itself to become intelligent. It's like a small child. When it's born, you actually keep on giving some data to the child all the time. This is A, this is B, this is C, this is 1, 2, 3. And after some time, it gets trained and then start giving his own answers, his or her own answers. That is how essentially it's happening. So that is the second layer. That is, you are using raw data, putting in the machine, and then machine become intelligent. It creates models. That's what we call as like ChatGPT or a Gemini or Claude or whatever, right? On the top of that, you create an application layer. It can be just a browser layer, like the way you use ChatGPT. You put your prompt and it starts giving you answer. You can just have a browser layer, or you can actually use the APIs of those models and plug them into your enterprise application, like you plug that into your SAP or Oracle or your email or your, let's say, MS Office. That's how the Copilot of Microsoft has come in, right? And obviously, on the top of that, you as a user are sitting, who are benefiting from that. Now, if I put that in the context of your question, I think in India, top layer is never a problem. Building use cases have been a forte of India for the last 3 decades. That is the thing which our software companies, IT companies are doing for decades, and they will again become relevant in that. It's just that they need to redefine themselves. Instead of just doing coding, which they have been doing for ages, they will have to now repivot themselves to start building AI use cases, right? That is India's forte. Just below that, people like Ankush and people like many others, fantastic people, they know what it means to make a model, how to train a model, how to use data, how to create industry use cases. Again, India has got no dearth of great talent to do that. Below that is the infrastructure part. Just for everybody's information, India was just about 200 megawatt of data center capacity, just about 7-8 years back. Today, the industry is 1.6 gigawatts. We are 8 times more than what we were 7-8 years back, right? And if we just go by the projections of the various people who are building this infrastructure and also the demand signals, you must be keeping on hearing about Google doing something in Vizag, Reliance doing something. Obviously, all of us are building that infrastructure. You will see this infrastructure going from 1.6 gigawatt to around 8 gigawatt in the next 5-6 years. If we are scaling at such a speed, you can fairly assume, despite all the cribbings we keep on doing, government ne ye nahi kiya, wo approval nahi mila, wo approval nahi mila, we still are finding our way and expanding our infrastructure so crazily, which means India is still a great place to build data center, and we have the capability to do that. My answer now, the finally coming to my answer is, I think from my point of view, I'm only looking for as much capital as I can get. The opportunity in front of us is just tremendous. First time I am seeing that sitting in India, I'm not able to give my compute, GPU compute to Indian use cases only. I'm right now exporting. US and Europe customers are coming and consuming my compute, which is hosted in India. This is the first time which is happening, that we were just consumers of technology. Today we are in a position that our compute is used by other countries. So that opportunity is big. If I can have tons and tons of capital, I have already invested 4 billion. I'm putting another 4 billion within this financial year. If I can get 10 times more than that, that's the only limitation.
So capital is constrained,
yes,
you would say?
Yes, because I can go to detailed answer, I'll not do that, but fundamentally, because the new technology, it demands too much of money. people are also working cautiously. Banks are touching it very cautiously because banks by nature are supposed to be conservative. So it requires risk money, it requires private equity, which is exposed to these technologies. It's happening very frequently in a very large scale in US. That effect is gradually going to come up in India. It is coming up. We are in touch with such people, but I think that effect has to come very, very early in India.
Sharad, I'm surprised no one has said power. Like, if you read all media articles, New York State, for instance, now they have frozen permits for data centers in their city. And everyone's concerned about the environmental effect, the consumption of water, power. Is that not a bottleneck?
Surprisingly, it's not. In India, we have surplus power. Our generation capacity is more than 550 gigawatts. In month of May, when India hits the peak, this year we hit the peak of around 270 gigawatts. Obviously, 550 gigawatt is not around the clock, and it doesn't translate. It's not an apple-to-apple comparison between 550 and 270, but we have enough generation.
And even as we get to 8 gigawatts, even then you're saying
it's still less than 3%. Even if we get to 8 gigawatt, it's still 3% of
data centers in 2030, when we get to 8 gigawatts, will consume only 3% of India's
Just to intervene, when industry become 8 gigawatt, India's installed capacity also will become around 800 gigawatt if we just go by Ministry of Power statistics.
Just remain 1 or 2%. And then the second aspect is that India consistently is investing in the renewable energy. All our additional power generation capacity is coming from solar, wind, and then now with the government's initiative towards the nuclear also. So over the period of time, we will not just have enough power, but also coming from the renewable sources. Therefore, the sustainability angle is also taken care of. Other aspect is, India data center industry, very beginning, recognized the fact that we cannot use potable water for the cooling purposes. And therefore, we deployed closed loop water chiller systems that typically uses a lot less water than what is actually be required to be used or is used in the Western world where they use evaporative cooling. So these two factors put together, yes, power is not a problem in India, water is not a problem in India.
So water is not a problem because we are using closed loop system rather than evaporator, which requires how much less water, and what percentage of the installed capacity today is using this?
Across the world, approximately 70% of the data center capacity is using evaporative cooling. But when you come to India, it's almost 100% using closed-loop water chiller systems. India has not been using the evaporative cooling at all. For the comparison sake, for the data-wise, it requires 3 million gallons of water per megawatt every year if you are using evaporative cooling. But when we are doing it using the closed-loop water chiller system, it is less than 1,000 liters per megawatt per annum. And that's the comparison of the water consumption that we have.
Thank you very much, Ankush, Sharad, and Sunil for joining in. Thank you once again.
Mr. Kant, thank you so much for joining us here this afternoon. As you look at the global world order, Mr. Kant, what worries you the most today?
This is a period of conflict. Second is that the growth and prosperity post-World War II was driven by global supply chains, global value chains. You could export, you could import, you could do just-in-time manufacturing. All that is broken down. These supply chains are all disrupted, and you have muscular industrial policies. You have protectionism, you have tariffs, and therefore we are living in a very different world, very distinct from the hyper-globalization that had taken place. But in the midst of all this disruption, there's one force which is going to drive major productivity, major rise in growth, and that is the rise of artificial intelligence, which will impact every single sector of manufacturing and every single sector, including energy, in a very big way to make it far more efficient. And therefore, we are very fortunate to be in this room at this point of time and living in this era which will witness the greatest rise of productivity ever.
Given the reorientation of the global order, what do you believe are the imperatives that Indian companies must focus on to make good of the manufacturing opportunity that everyone seems to talk about? What should the roadmap now, give me specifics of the next 3 or 5 things that between the private sector and the government we must do to truly ensure that we leverage on the manufacturing opportunity?
So, Shireen, we grew at 7.7% last year. To my mind, we should be growing at 9%. If you want to be a developed economy by 2047, you should grow at 9%, nothing less than 9%. So 9% growth over a 3-decade period is critical for India to become a developed economy. Without that, it's not possible. Now, 9%, look backwards, you require, your investment rate right now is about 29-30%. You need to accelerate the pace of investment to about 40%. From 30 to 40% means that you don't have adequate savings in Indian economy. China had major savings which it put into investments. India doesn't have that kind of domestic savings.
But it also has a massive debt problem.
Yeah. So I'm coming to that. So India needs to actually either export or either get foreign direct investment. Now, one of the good things that's happened in India is that India has actually structured FTAs with a lot of countries, and hopefully it should be able to structure a FTA with USA in due course. So you will have major UK, Europe, America, you'll have FTA, and Indian manufacturing will have to compete. So if you don't become globally competitive, if you do not have size and scale of manufacturing for Indian companies, the European companies will come and dump goods here. The UK companies will come and compete you out here. So it's a challenge. The FTA is a wake-up call for Indian industries to actually become globally competitive and get the size and scale right. It's the biggest thing that's happened, but the Indian industry, I don't think, has woken up to this call yet, that it must be able to penetrate Europe, must get the size and scale, must do R&D, must innovate, must be world-class. That's important in the world of FTA. The second critical thing is our ability to get a lot of more foreign direct investment. Now, foreign direct investment requires policy predictability and stability. I mean, you can't have advanced ruling coming after 2 years and say that we have 40% vacancies in our customs department. So you need to fill that up and give arbitration. You need to give advanced ruling within 60 days. You need imports for exports, and therefore imports should come. You can't have a situation where Volvo gets its imports right at 15% and VinFast doesn't get it and somebody rejects it. You can't have contrary rulings. All this is critical for the country. I'm making these points because predictability, you can't have cases like Tiger Global on, so you can't, because Tiger Global was a major investor in the country. So you need predictability, consistency on our tax policies over a long period of time to bring confidence in foreign investors to be able to invest here. You need loads and loads of FDI coming in. You need over 180 to 200 billion FDI, dollars worth of FDI coming into this country annual basis to drive the investment rate to 40%. And that, to my mind, is critical. The third point I want to make is about Indian private sector. And Indian private sector, the country gave away 140,000 to this private sector by reducing the corporate tax 3 years away. Instead of putting that resources into R&D and innovation, they are busy giving dividends. So Indian private sector is also lazy, and it must do more innovation, more R&D, and put more resources into cutting-edge technology and make it globally competitive. Otherwise, they'll be wiped out by the European and American companies as the FTAs come in. It's a wake-up call for Indian private sector.
The notion that the PLI would be used to create national champions would also be able to create global champions. Have we truly achieved that?
Well, some sectors have done incredibly well. I mean, look at mobile manufacturing. I mean, the value addition has also gone up. We've managed to create a lot of jobs, particularly 70% of the jobs for women. I think in the years to come, we'll become a major manufacturing nation for mobiles. There's no doubt. And
it's our number one export today.
Yeah. And major exporter of mobiles. That is because the scheme was very well structured. It was very well structured. It was very tightly done. And it was the right kind of incentive for the right kind of increased production. It has worked in some other sectors like air conditioners, a few other sectors. But, you have all kind of civil servants, you have all kind of bureaucrats. So you have, in many other sectors, it's failed because the bureaucrats just didn't structure it properly.
So it's a bureaucratic problem.
No, it's a problem of bureaucrats not interacting with the private sector adequately enough to structure it in a manner where you can create the right incentive. For instance, the battery manufacturing. Battery manufacturing should have been done much better. I mean, we should have by now, I've had about 50 gigawatt of battery storage here in this country. So I think my view is it's not just the production-linked incentive, but to create the whole ecosystem so that you get into component manufacturing, you get into machinery manufacturing next, and that ecosystem for manufacturing needs to be created, which is happening in the case of electronics and mobiles, it's happening in the case of air conditioners, but should have happened in many more cases.
Should have happened in many more cases. I also want to talk to you about what everybody is focused on, semiconductors. And we've just given the cabinet approval to the Semiconductor Mission 2.0 with a higher outlay as far as semiconductors are concerned. But again, to your point about building the ecosystem, how confident do you feel about that in light of the experience that we've had with Semicon 1?
So I feel very proud of one thing, Shireen, that the country opened up several sectors. It opened up the space sector. You've seen Skyroot with Vikram 1, what it has done. Path breaking. We opened up the drone sector, and you've seen a number of Indian companies doing drone manufacturing. We've opened up the geospatial sector. A lot of great innovative work is happening in the We've opened up the defense sector, and look at what the path breaking work that has been going on in defense, and many Indian companies are actually exporting defense equipments abroad. So the more you open up to the private sector, the greater will be the case of India becoming a manufacturing nation. These are sectors which are controlled and cabined by the government. You need to open them up. The public sector will not be able to do innovation. Public sector will not be able to do disruption. Young startups need to do that, and that is what is happening. In the semiconductor sector, the government took a major risk and actually provided a huge amount of outlays as production-linked subsidies. So 12 major manufacturers have come in. And, we were a champion of design, but design is not ultimate. Ultimately, you have to manufacture. And so you have 12 manufacturers, but in the next phase of Semiconductor 2, you'll have much more components, you'll have design, many other things. So I think this is a step in the right way. You need to create the entire, after all, mobile manufacturing is not adequate. You need chips. To be an AI champion, you can't be a manufacturer. You can't be dependent on the rest of the world. What is happening in the AI world? We must understand this. AI world, the computing power is being controlled by NVIDIA, which is a US company. The chips are being controlled by TSMC of Taiwan and Samsung and SK Hynix of of Korea. So the chips are being controlled there. But for making the chips, you need lithography machines, which are being controlled by ASML of Netherlands. And for that, you need glasses, which is being controlled by ZS of Germany. And helium gas is coming in from Qatar. But to drive all this AI, you need data. And 25% of the data resides in India. So if India can't, there's no such thing as sovereign AI, but India must be clear that we are going to control certain nodes of AI. So with your data, because the world is going to run out of all the data that is on the internet by 2030, they will have to fall back on data in emerging markets, particularly Indian data. So if you control data, and if you read the Stanford AI Index, the talent is all Indian. In fact, global talent is coming back to India. So if you have data, if you have talent, and you have progressive policies like we have right now on data and all this, there's a huge possibility that in the coming days, India will hold several nodes and will be a major player. The fourth key thing on AI will be that India does about 286 gigawatt of renewable. It should accelerate the pace of renewable. So I've been saying that if you want to do $200 billion worth of data centers which have been announced, you need to accelerate your renewables. You take them up from, your target should not be 500 gigawatt, your target should be 1500 gigawatt for security and for data centers. And 1500 gigawatt is doable in India because you have climatic conditions. And secondly, you have very good private entrepreneurship in this sector, and they've been able to attract private equity and venture fund into India. The policies are right, private sector is there, private equity comes in, climatic conditions are good. So India should raise its ambition in renewable to be a champion of data centers.
Ladies and gentlemen, a big round of applause for Mr. Kant. Thank you so much for joining us here this afternoon and being a part of Make 2026.
Good evening. Thanks very much for joining us on India Business Hour. I'm Shireen Bhan. The top stories that we're tracking for you this evening. Crude oil prices hit the $95 mark as the US and Iran continue to trade strikes. Trump threatens to destroy a bridge or a power plant for every commercial vessel targeted by Iran. US Secretary of State Marco Rubio says Iran is not serious about peace talks, even as mediators meet in Islamabad in search of a breakthrough. 2 oil tankers headed towards India take a U-turn at the Red Sea, this after a warning by Yemen's Houthi militant group who have announced a naval blockade on Saudi Arabia. President Trump approves a landmark nuclear deal with Saudi Arabia which could potentially allow uranium enrichment. Sharp cuts on the Raj Street. The Sensex down over 700 points. The Nifty drops below 24,000. The rupee weakens against the dollar, moves closer to the 97 mark. President Trump threatens to impose 100% tariffs on generic pharmaceutical drugs from August 2028, provides a 2-year window for companies to move manufacturing to the U.S. Shares of Indian companies decline as they supply nearly half of generic drugs dispensed in the U.S. It is not practical to move manufacturing to the U.S. as the CEO of Dr. Reddy's. The company misses estimates in Q1, with revenue declining 6%, profit hit by a 240 crore rupee provision for active pharma ingredients to manufacture semaglutide. Zomato's parent Eternal misses estimates in the first quarter. Profits nearly halved sequentially, but operational performance remains strong, with food deliveries growing at 20% and quick commerce orders surging 86%. The student protest continues at Jantar Mantar. 16 Delhi metro stations closed for security reasons. The Supreme Court refuses to hear a petition on the protests and the police crackdown. Chief Justice Surya Kant tells the petitioning lawyer, "Don't waste our time and yours." Parliament adjourned for the third day without any business. Union Minister Kiran Rijiju says the government is ready to debate the NEET paper leak in the House next week. Opposition leaders protest wearing black and demand a statement from the Prime Minister. Bloomberg reports the government has initiated talks to drop a clause that make clear the runway for airport operators like Adani Group and GMR to own and run airlines. Current rules bar the Delhi and Mumbai airport operators from owning more than 10% in an airline. The Aviation Ministry is yet to comment on the Bloomberg report. Temasek remains bullish on India and is not slowing down, says the India head Ravi Lamba. Healthcare remains one of its highest conviction sectors, also plans to double its global AI portfolio share to 15% in the next 5 months. That's an exclusive. OpenAI reveals 2 of its AI models went rogue during a cybersecurity test. They hacked into a rival company called Hugging Face, which provides open source AI tools. The incident highlights growing concerns about AI systems causing cyber attacks. Samsung launches new range of foldable devices at its annual flagship event in London. Also launches its thinnest and lightest flip phone yet, which weighs just 180 grams. Well, let's bring you the top story this evening. The US and Iran have exchanged fire for the 11th straight day as tensions refuse to die down. Here are the latest developments in the story. Now, the US military claims to have carried out strikes on Iran's military operations centers and maritime capabilities. US forces also claim that Iran has hit over 30 commercial vessels transiting the Strait of Hormuz. US President Donald Trump has also warned of attacks on Iran's underground nuclear facility site at Pickaxe Mountain. In a social media post, Trump has also threatened to strike civilian infrastructure once again, including bridges and power plants, if Iran attacks commercial vessels in the Strait of Hormuz. This is Trump's latest on Truth Social. He warns that 1 bridge or power plant will be destroyed for every vessel that comes under Iranian attack. That is President Trump on Truth Social. In retaliation, Iran launched missiles and drones at US bases in Jordan, Bahrain and Kuwait. According to Jordan's military, 4 Iranian missiles have been intercepted, while 2 other missiles fell in remote areas. Kuwait's army also said that it continues to confront missile and drone attacks through its air defense systems. Now, what does all of this mean as far as the oil market is concerned? Brent crude prices shot up today, hitting $95 per barrel, and then saw a marginal retreat. Now, shipping traffic at the Strait of Hormuz remains subdued. According to marine traffic, 42 vessels have passed the waterway in the last 24 hours. Separately, 2 India-bound tankers in the Red Sea also made a U-turn following a warning from Yemen's militant group, the Houthis, who've now announced a naval blockade of Saudi Arabia. Top U.S. diplomat Marco Rubio is in the Philippines for the ASEAN summit. The U.S. Secretary of State met with his counterparts from the Quad alliance, including India's Foreign Minister S. Jaishankar. The U.S. Ambassador to India, Sergio Gore, has also confirmed that Rubio, who just visited India, will visit India again later in the year. No date has been confirmed. Now, at the ASEAN summit, Rubio said Iran does not appear to be serious about negotiations and reiterated that no country can claim control over any international waterway. Take a look.
Unfortunately, so far, even though we have reached agreements, they have not kept their commitments. And as the President stated earlier today, I guess, today Washington time, yesterday our time here now, the problem we're having right now is that they're not serious about talks. If they're serious, we're serious. If they're not, then we will do what is necessary to protect that, our interest and also the interest of our allies.
Iran not serious about negotiations, but mediation efforts continue. Now, the U.S. casualties in the conflict have been steadily rising. Nearly 500 U.S. troops have been injured in the Gulf, and this is according to a report by the Associated Press citing sources in Iran. So far, the Pentagon has announced nearly 100 casualties, including the deaths of at least 18 military personnel. Meanwhile, in what comes as a big boost for Saudi Arabia, President Trump has approved a landmark nuclear agreement. Wall Street Journal reports that the deal will provide the Saudis with a civilian nuclear program and potentially open the door to enrich uranium within Saudi territory. Another key development comes from the UK, where new Prime Minister Andy Burnham has now allowed the US to use British military bases to carry some strikes on Iran. This is largely a continuation of the policy adopted under former Prime Minister Keir Starmer. And back in the US, the Secretary of War, Pete Hegseth, who was grilled by lawmakers during a testy Senate hearing, has revealed that the war with Iran has cost more than $37 billion so far. Hegseth argued that the Pentagon is running low on cash. He sought another $88 billion in supplementary funding, calling it urgent and necessary.
Last week, President Trump said the U.S. would charge a 20% toll to each ship to pass through the state. So based on your opposition to tolls, did you talk to the president out of that idea, or did someone else?
Iran's not charging tolls, and they're shooting at ships right now.
But Trump said that he wanted to charge a 20% toll.
We have a blockade right now of all Iranian ships and Iranian ports, and it's effective.
Do you have a new estimate about what the war has cost us so far in this, the 5th month of the first year of this war in Iran?
Senator, the estimate we have as of today is $37.5 billion.
$37.5 billion spent so far on the Iran war, seeking an additional $88 billion. That is the U.S. War Secretary Pete Hegseth. Now, External Affairs Minister S. Jaishankar met his Chinese counterpart Wang Yi on the sidelines of the ASEAN summit, which is currently underway in Manila. In a social media post, Jaishankar said relations between both countries have been gradually normalizing. Both ministers also reviewed bilateral ties, exchanged views on key regional and global developments.
Since the meeting of our leaders in Qatar in October 20, relations between India and China have been gradually normalized. This direction was further affirmed when they met in Tianjin last August. We believe that a stable, cooperative relationship can best be developed on the basis of mutual respect, mutual interest, and mutual sensitivity. Such a relationship can make a valuable contribution to multipolar Asia and multipolar.
Well, that's the External Affairs Minister S. Jaishankar at the ASEAN summit. Let's bring you up to speed on the market action. The Dow trending lower today as escalating geopolitical tensions, a surge in crude oil prices and a weaker rupee weighed on sentiment. So the Nifty slipping below 24,000. The Nifty mid-cap index down by almost 700 points. HDFC Bank down about 1%. Nifty Auto on the back of strong earnings from companies like Bajaj Auto and TVS closing in positive territory today. So that was the market performance for this Wednesday afternoon. But from equities to the currency market, where the rupee weakened by more than 30 paise against the dollar as rising crude oil prices have dented sentiment. The rupee is moving now closer to the 97 mark. 96.56 is where it closed for the day. The tariff threats are back. President Trump has threatened to impose 100% tariff on generic pharmaceutical drugs, but from August of 2028. Now, he's provided that 2-year window for companies to move manufacturing to the U.S. Shares of Indian companies declined as they supply nearly half of the generic drugs dispensed in the U.S. Ekta joins us now with more on Trump's threat and the implications for Indian pharma. It's not the first time that Trump has talked about tariffs on generics, Ekta, but this time there is a timeline. We are still, of course, awaiting fine print and details. What are you picking up on the impact, and what is India Inc. saying at this point in time?
India is the generic backbone of America's medicine cabinet. 90% of all US prescriptions by volume are generics, and India supplies roughly 40% of them. That's a $10 billion export business. India also runs over 650 US FDA-approved plants, the most outside America itself.